its national interest and economic security. Well, CNBC-TV18 Newsbreak confirmed as the Reserve Bank of India approves the appointment of Rajiv Anand as MD and CEO of IndusInd Bank for 3 years. His appointment is approved with effect from August 25th, 2025, subject to shareholders' nod. And in key earnings, watch out for numbers from Bharti Airtel. The company is expected to report 2.2% rise in revenue on a sequential basis, aided by an increase in India's mobile business. Also watch out for numbers from Lupin and Britannia. Good morning in the Mumbai News Centre. I am Vamakshi Dhoria. You're watching Power Breakfast. It's the second day of this week. The first day was quite good for markets globally. The handover that came in from the US markets was quite positive. And here in India as well, the markets did quite well. But today, let's see how the session holds out, because we do have the threats coming in from US President Donald Trump on raising tariffs on India further as compared to what we have right now. So of course, that is something that we'll keep an eye out for. But first up, before we head into all the stocks as well as the FNOQs, let's take a look at what the Asian markets are doing. Well, it's largely a green-looking screen. The KOSPI is the index that is gaining the most in today's trading session. So far, it's up almost 1.5%. Taiwan is the other big mover today, up almost 0.9%, and Hang Seng as well, as you can see on your screen, is up almost 0.2%. The Nikkei 2 saw very good gains in yesterday's trading session. Was in fact the top index that was trading higher in yesterday's trading session, and today we do have it trading higher with almost around 0.5%. So the Asia picture for now is it's a sea of green as far as Asia is concerned. But let's take a look at how our own Indian markets are expected to open. The GIFT Nifty will come up for you on the screen. For now, it's a 40-point downtick, but let's see where we go from here. But moving on then, we now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, Vivek is joining us to get us all the market cues we need to watch out for in today's trading session. Good morning, Vivek. What does today's session hold out?
Well, good morning. While we started off the week on a strong note, all eyes today will be on the kind of impact that Trump's latest tweet on, exactly what will the kind of tariffs that India is going to see. He's talking about higher tariffs, also penalties, something that is looming as far as Indians are concerned. On the back of that, a lot of uncertainty prevails. Now, talking about US markets, similar to Indian markets, US markets also rebounded after a 4-day losing streak. All of the US markets ended strongly higher in the session today. In fact, even the Indian markets yesterday rebounded quite significantly after a 4-week downtick, and yesterday the Nifty managed to end above the 24,700 mark. Now, the other good news was that the oil prices yesterday extended their cut. So Brent yesterday ended lower by over 1.3%. Close near the $68.7 a barrel marker. In terms of what is it that we'll be watching out for today, well, number one, Trump's tariff threat is something that we need to watch out for. So watch out for all of the OMCs in trade, watch out for the textile pack, and also watch out for the auto ancillary space. Along with that, some key result reactions today, the results that came in post-market hours yesterday, Aurobindo Pharma, Bosch, DLF, Sona, all of these key names will react to the results. And Paytm, remember, large block is expected, and Fin will be exiting their stake completely. On the other hand, some key results to watch out for today. Remember, Adani Ports, Airtel, Britannia, Lupin, some of the stocks that will come out, or some of the companies that will report their Q1 results today. Asian markets, like I mentioned, in the green. GIFT Nifty, however, indicating a gap down start for our markets today.
Well, absolutely, Vivek. Thank you so much for that update. Now, let's move on to Ria, who will now list out all the stocks we need to watch out for in today's trading session. Good morning, Ria.
Good morning, Vamakshi. Let's take a look at the stocks to be in focus today. First up, starting off with IndusInd Bank. RBI has approved the appointment of Rajiv Anand as the MD and CEO of the company for a period of 3 years. So keep your eye out on that stock on the back of that. Next up, moving on to Paytm. Sources say that Anfin is likely to sell a 5.84% equity of the company via block deals. And remember, this is expected to be a clean-out trade. Moving on to the earnings, Siemens Energy has reported its Q3 numbers. The net profit has gone up by over 80% on a year-on-year basis. Even the revenue has seen an increase of over 20%. For DLF for Q1, the sales booking has gone up by over 44% on a year-on-year basis, coming in at rupees 23,223 crores. The collections have also seen an increase of around 36% compared to the same quarter in the last year. For Kansai and Derolac, the revenue has seen an increase of just about 1.4%. and the margins have come in at 14% versus 15.5% in Q1 of last year. For Inox India, revenue has seen an increase of around 14.5% compared on a year-on-year basis. Margins have been slightly subdued, coming in at 22.5% versus 23.6% in Q1 of last year. For Delta Corp, revenue and net profit have seen increases of around 3.8% and 36% respectively on a year-on-year basis. For Aurobindo Pharma, the net profit has come in at about 824 crores compared to our estimates of 920 odd crores. Revenue has also been below estimates at 7,868 crores.
Well, thank you so much for those updates, Ria. Lots of earnings in focus today. But finally, we now have Sudarshan joining in with cues from the F&O space. Sudarshan, good morning.
Good morning, Vamakshi. So yesterday we saw a broad-based gains led by especially mid-cap index, and mid-cap index was up more than 1%. Even Nifty was higher and managed to hold on to levels above 24,700. While support came from IT, metal and autos, one sector that was under pressure and kept gains in the check was financial, especially Nifty Bank, because heavyweights like ICICI Bank and HDFC Bank have closed with cuts. Now, overnight cues are largely positive, but Trump's comment about a tariff on India might weigh on market, and that's the reason you are seeing that GIFT Nifty is indicating a start with minor cuts. As far as flows are concerned, FIs continue to sell. Yesterday also we saw in the cash market, FIs have sold more than rupees 2,500 crore and DIs have bought more than rupees 4,300 crore. In the index futures, it was just a minor buy figure of rupees 204 crore by FIs, and also they have added long position on just more than 800 contracts and have reduced short positions of around 425 contracts. Now again, FIs long exposure remains around 9%. On the option front, 24,800 call keep seeing the maximum additions. Here we saw addition of more than 14 lakh shares. Again, 24,700 call option was healthy as well. We saw addition here also almost 14 lakh shares. On the put side, 24,600 and 24,700 put have seen maximum additions. Support for Nifty remains around 24,550 and resistance is at 24,900. Stocks, one stock in the band, that is PNB Housing Finance. One stock that I'll keep a track on is IndusInd Bank, because board and RBI have approved appointment of Rajiv Anand as MD and CEO for 3 years.
Well, absolutely, Sud. Thank you so much for those details. But like you just said, it's a CNBC-TV18 News break confirmed. IndusInd Bank has appointed Axis Bank's Rajiv Anand as the MD and CEO for 3 years. The stock will definitely be in focus today. And Ritu is joining in with more details. Ritu, congratulations on your news break.
Thank you very much. Yes, the uncertainty is finally behind, and this is positive news for IndusInd Bank. The street had been factoring in Rajiv Anand's name, and this should be taken positively, with RBI now approving his appointment as the MD and CEO for a 3-year period. It takes into, it comes into effect from the 25th of August this year and will be valid for 3 years, is the appointment. But of course, that will have to be ratified by shareholders as well. In terms of, the legacy issues, the bank in its earnings call has said that those are behind, and they started Q1 on a clean slate after they swung back to profit, after that historic loss of more than 2,000 crores in the fourth quarter. And they've outlined already 5 key areas of focus. One is profitability, second is cost management, third is focus on recoveries, building the franchise, and, some effective engagement with stakeholders to restore trust. So, Rajiv Anand, before him, there's lots to take on, as, whether that is integrating the leadership also, because we've seen a whole lot of senior level exits at IndusInd Bank. He must do that. The capital raising will have to be in process. The board has approved a 30,000 crore fundraise already. And of course, strengthening internal controls, restoring governance, and the reputation of the bank will be some of the key challenges ahead.
Well, thank you so much for that, Ritu. Indeed, a positive news flow for IndusInd Bank for now, but let's slip into a very short break. Up next, we get you updates from the US President Donald Trump's tariff threat to India. Stay tuned for more. Welcome back. You're watching Power Breakfast on CNBC-TV18. Well, US President Donald Trump took to Truth Social last evening and said that he will substantially raise tariffs on India over its purchases of Russian oil. He wrote, and I quote, "India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchased, selling it on the open market for big profits. They don't care how many people in Ukraine are being killed by the Russian war machine. Because of this, I will be substantially raising tariff paid by India to the USA," end of quote. However, he did not elaborate on what the tariff would be. Remember, last week, Trump had said that he would impose a 25% tariff on goods imported from India and added that India would also face an unspecified penalty but gave no details. Now, following the US president's tariff threat, India has issued a very strong response. Parikshit is joining in with more on this. Parikshit?
Well, the Indian government has said that targeting of India is unjustified and unreasonable. They've also said that India will take all necessary measures to safeguard its national interests and economic security. And India has been maintaining that we have been buying energy from global markets based on pricing and the geopolitical situation. Also, the Ministry of External Affairs went on to say that it was the United States which had initially, during the Biden administration, immediately after the war began, encouraged India to buy more Russian oil. This is to strengthen global energy markets stability. Remember, the US and Joe Biden had never really checked India for purchasing Russian oil because we were purchasing it as per the price cap that had been set. In fact, the government has gone on to say that Indian imports are a necessity compared by global market situations. India has also hit back, saying that it's very revealing that very nations who are criticizing India today are themselves indulging in trade with Russia. For example, EU today is importing LNG, which has reached a record 16.5 million tons in 2024. US on its part is also trading with Russia. They continue to import uranium, hexafluoride, palladium, fertilizers, and chemicals from Russia. So a strongly worded statement coming out from the government, but behind the scenes, we're told that there will be efforts from both sides to manage the situation. There is a team of negotiators coming from the United States to find a breakthrough. So let's hope for the best over the next few weeks.
Well, thanks for all of those details, Parikshit. An absolutely stern statement coming in from the Ministry of External Affairs. But Parikshit, do stay on with us because you also spoke to the president of the US-India Strategic Partnership Forum, Mukesh Aghi, on how India should respond amid the tariff threats. Let's listen in.
I think once you get into a contest in media with Trump, he will go all the way to basically put you down. And I think it is not in the interest of India or the United States to get into this kind of a contest. India has quietly basically started buying more and more U.S. energy, both LNG and other aspects of the LNG coming from the U.S. I think that's where the focus should be. And I think we should just basically get away from getting into public media challenging Trump, because the moment you get into a contest, it's, he basically goes all the way down to ensure that he comes out as a winner. So my recommendation is don't react and stay focused on what's good for the country and move on.
Moving on, let's also recap what happened in the US markets then. Wall Street ended higher in Monday's trading session. The Dow climbed 585 points, S&P 500 rose 92 points, and the tech-heavy Nasdaq was up almost 400 points. CNBC's Bertha Coombs gets us a wrap of all the action on Wall Street.
U.S. markets up across the major indexes in Monday trading as Wall Street clawed back losses from Friday's sell-off. The Dow climbing 585 points. The S&P 500 was up 92, while the tech-heavy Nasdaq surged 403 points. The European Union announced Monday that in order to allow for trade talks to continue, it would delay by 6 months its planned tariff countermeasures against the U.S., which were set to take effect this week. It comes the same day as President Trump vowed to substantially raise tariffs on India over its purchase of Russian oil, saying the country is profiteering off of the Russian war machine. Meantime, Tesla announcing Monday that its board has approved an interim pay package for CEO Elon Musk, awarding him 100 million shares. In a regulatory filing, Tesla said the award, valued at about $29 billion, will slowly increase Elon Musk's voting power, which it says will incentivize him to stay focused on its business. It comes as Musk fights a court ruling that voided his $50 billion compensation package from 2018 because it was unfair to shareholders, according to the ruling. That's what's happening here in the U.S. Back over to you in Mumbai.
Well, Bertha, thank you so much for that comprehensive update. But let's move on to what the White House National Economic Council Director Kevin Hassett and Allianz Chief Economic Advisor Mohammad El-Edian had to say about the firing of the Bureau of Labor Statistics chief and their views on Powell's resignation.
Unreliable. As you know, I've been on this show on Squawk Box before I was here at the White House pretty much every jobs day for the last 20, 25 years, right? We would come up to New York and I'd be on set and we'd talk about the jobs numbers. And when I looked at the revisions that came out last week, I thought they had to be a typo or something. You probably thought so too. And, you know, it's something that has been a work in progress for us at OMB and CEA here at the White House to try to understand why the data have become so unreliable. You know, there's some part of the story about response rates and so on, but I think it's really important now that we got a fresh set of eyes over there to try to modernize the labor data, because it has to be transparent, it has to be reliable, it has to be something the market can make big bets on. And right now it's not. When the revisions are bigger than the number itself, then you know you got troubles.
This shouldn't be a political move. This is an apolitical institution. It is true that it's had persistent problem on data collection. The response rate has come down. There hasn't been much incorporation of the higher frequency data that was so valuable to everybody during the pandemic. And then clearly there's a problem of methodology. The estimation, until you get more data, seems to be off. So there are problems on the data collection and the data estimation, but you should not undermine the institutional integrity of the BLS. It's not just the president. You have the Johnson in Congress. You have Secretary Bessent. The attacks on the Fed are expanding and deepening. And I really worry about the financial integrity of the Fed, much more than the financial integrity of the BLS.
Well, on that note, let's slip into a very short break. Up next, we get you cues from the commodities market, so stay tuned. Thanks for staying tuned into Power Breakfast on CNBC-TV18. Now, as promised, we now have Manisha Gupta joining us with all the updates from the world of commodities. Good morning, Manisha. What are you watching out for?
Morning, Mama. Thank you for that. I'm looking at the crude oil prices, which are declining for a fourth straight day today, while OPEC will increase production until the month of September, and completely phase reversal of voluntary cuts that they made in 2023 is one reason that you're looking at pressure in crude oil prices. And then it is also about possible U.S. action against Russia oil flows, U.S. also threatening secondary sanctions on countries buying Russian crude, specifically targeting India is something that the markets also are seeing as a developing one. On the other side, you have the copper prices in US, which also have continued to decline, so much so that we fell 30% from record highs, and we are now trading at an April low into the markets. But the decline is only seen in case of copper, because when you look at the other metals, there is some support continuing here. Steel, for one, gained by a percentage point. Iron ore futures gained by 1.5%. Prices have seen a recovery from the biggest weekly decline since the month of April. Markets are looking at the US dollar index continuing to decline. It did touch 100 last week. It's trading at 98.5 right now. The markets also do believe on a September Fed rate cut, and that seems to be supporting a lot of metals, including gold and silver in Asia right now.
Well, thank you for that comprehensive update, Manisha. But moving on then, the Enforcement Directorate has summoned Anil Ambani for questioning as part of its ongoing probe into an alleged 17,000 crore loan fraud case. He has been directed to appear at the ED headquarters in Delhi today. Those are the visuals of Ambani leaving his residence for Delhi. Well, it was a dramatic finale to the Anderson Tendulkar Test series in England as India came from behind to pull off a 6-run win in the last match to tie the series. It was Mia Magic on the field as Mohammad Siraj took 5 wickets to give India its narrowest ever victory in any Test match. He has also become the joint highest wicket taker for India in a Test series in England. Captain Shubman Gill, along with England's Harry Brook, was named man of the series after scoring the most number of runs over the 5 Test matches. Well, that's all we have on this edition of Power Breakfast. Don't go anywhere. Pasar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello, and welcome to Bazaar Morning Call. Start of a fresh new trading session. It's Tuesday. We have tariff headlines to go over. We have a very strong statement from India to the US President and the US administration's commentary. And of course, we have more earnings. And we also have Rima with us in the house today. Guys, morning.
Hi, good morning. It's going to be an action-packed Tuesday. But at least the start of the week was good, right? So after 5 weeks of losses yesterday, the bulls completely took charge. The question is, will this, India, US, and the talk, the rhetoric, is that going to hurt sentiment? Because Asia is also holding up okay. Is that going to hurt, or can we continue to march on?
Well, ladies, the one message that we got at the start of Monday is don't bet against India.
I knew he'd
no dead economy. Just take a look at what happened with regard to the bounce back that we saw yesterday, and just take a look at that. Our boys on the screen,
Believe.
I mean, people were talking about them knocking off the runs. They were cruising away with only 3 wickets down. And India, the way we bounced back, the bowlers bending their backs in there. We had a couple of big injuries, but yet the boys came out trumps. And that's telling you, don't bet against my India, because we'll fight back. And how?
Beautifully put, Nigel, and that's indeed the cue with which we are starting.
Goosebumps.
Absolutely, absolutely. Whether it's on the field, whether it's on the border, don't bet against India. And that is what we really start off with as we look at the cues this morning as well. It's images of that beautiful win, in England yesterday. And congratulations to, of course, Team India. But talking about the parallel here when it comes to geopolitics, we've got such a befitting or strong, response coming in from the Indian side, something that we haven't really heard so far. And what I'm talking about is India's response to what Mr. Trump's latest tweet said. He kind of ratcheted up, further rhetoric yesterday. And let's just put this up, this latest threat of increasing tariffs. He went on to his social media platform and he said, India is not only buying massive amounts of Russian oil, they are then, for much of that oil purchase, selling it in the open market for big profits. They don't care how many people in Ukraine are being killed by the Russian war machine. Because of this, I will be substantially raising the tariff paid by India to the USA. So, big statement, and it got an even bigger response from the Indian side. And this is the first time India has given a very targeted point-by-point response to a lot of the commentary that's coming in. Remember, we did not respond even when this 25% tariff was levied on India, the declaration that happened around the 31st of July and 1st of August. What has the MEA said? The MEA in its response, first of all, calls the US action unjustified and unreasonable. And it then calls out the West specifically for the deals and the business that they are doing with the Russians. Look at what the MEA is saying. MEA is saying the very nations criticizing India are themselves indulging in trade with Russia. Then they talk about EU, bilateral trade of 65.5 billion just in goods. Services trade is another 17 billion. And they also point out that the EU continues to buy record amounts of LNG from Russia. And then the Ministry of External Affairs goes on to say that US itself is importing uranium hexafluoride for its nuclear industry, palladium for the EV industry, fertilizers as well as chemicals, and then ends with a flourish saying that India, of course, will protect its own national interests. So very strong response coming in, which is why you don't even have a reaction in the oil markets, because technically, India is buying almost a third of its oil requirement from Russia. And ING in that note said that, 1.7 million barrels per day of oil could be at risk if India suddenly stops buying from Russia. But none of this is showing up in the oil markets. The oil market was very, very steady yesterday, very range-bound, just around 69 on Brent. That's the picture even right now on the screen. The oil market is still dealing with the increase in output from OPEC+. India is not a risk factor at all because of the response and the stance that India has been taking. So that's on India, US. Very quickly coming back to now Wall Street. Wall Street had a great start to the week as well. It completely clawed back all the losses from Friday, and the market is squarely focused on now one thing, that is a Fed rate cut, the probability of which for the month of September is well above 80%. Now that played out in the equity market. You can see 1% to about 2% higher on US equities. That played out in the bond market. The US 10-year yield continued to fall. It fell below 4.2% in the action yesterday. Today morning, it's just at that handle. The dollar has been very, very range bound.
after its 3.5% rise in July. So not too many moves on the dollar as well. For us, of course, we managed to bounce back from oversold levels yesterday. But can the bulls keep clawing their way back? Let's see. Some of the earnings commentary, now that the season is about to wrap up, is not that bad. Q1 perhaps not as bad as what one was initially fearing when you look at the final numbers. And today, of course, banks are going to be in focus. The RBI comes out with its announcement tomorrow. We have a new man taking charge at indices, and Rima is going to talk about that. But banks will hold the key because yesterday they did not participate. So let's see what the Bank Nifty does today. Rima.
Aye, so let's just quickly take stock of the Asian markets this morning. So broadly started off stronger. Taiwan is up close to about 0.7%. The Korean markets have gained over 1%. Shanghai is also trading with gains of close to about 0.5%. Hang Seng's the only one which is flat, but broadly Asia is higher, tracking Wall Street's overnight rally, where S&P 500 posted its biggest gain since May. But the question is, will the geopolitics that Surbhi was talking about cast a shadow? Will Donald Trump's escalating threat to penalize India rattle sentiment? Because that continues to remain a key overhang for investors. Back home, just to recap yesterday's trading action, it was a strong start to the week. The Nifty closed above 24,700. There was no sign of weakness through the session. Prices showed resilience, and we finally pretty much closed at the day's high. The mid-cap, small-cap momentum remained strong. Banks were the only place where, there was a bit of a disappointment. They stayed range-bound ahead of the RBI policy decision. Key levels to watch on the way down. The recent swing low stands at 24,535. That was the swing low on the 1st of August. On the way up, around 24,900, which is the 50 DEMA for the Nifty. In terms of flows, the DII's net bought 4,400 crore. The FI's net sold 2,500 crore. In terms of stock watch then, big earnings day. Once again, you've got Adani Ports, Bharti Airtel, Britannia, so many others like Exide, Lupin, Prestige Estate. Lots of earnings reaction. So DLF looked good, Siemens looked good, but Aurobindo Pharma was a bit subdued. And then, of course, the big leadership change at Indian Bank, where Rajiv Anand has been appointed as the managing director and CEO. More with Ritu, who was on top of the story and the first to highlight it. We'll get to her. But for now, Nigel, what are you looking at?
Well, when you have a party, everyone enjoys it, right? But the night is really special when you have a better after party. So even though, yesterday's trading session was very, very good, but you like to see some follow through. So after the kind of bounce that we saw yesterday, the follow-through is going to be most crucial. And yesterday, yes, the Nifty ended higher. The problem is that, in fact, the Nifty Bank didn't participate. But we had made this point yesterday that the Nifty IT valuations in comparison to the NASDAQ, well, it's at a sharp discount. It's at around 20% odd. And in the premium in comparison to the Nifty, valuations are at around 15%. That as well at the lower end of the band. And in yesterday's trade, the IT index was the big outperformer, up close to around 1.5%. Now, yesterday, yes, we saw a bounce, and that's good news. But the bounce came on very, very low volumes. In fact, the volumes were the lowest that we have seen all the way since the 7th of July. So you just take a look at, at the averages that we saw. In yesterday's trading session, that's the number that we're looking at. That's the volume number, much lower than the averages that we have seen in the past. So the bounce came on low volumes. There was a bit of a short covering bounce as well that played out on the Nifty. We did see the Nifty that, in fact, there were some shorts that covered. So for the markets on the whole, there was a bit of a short covering bounce that did play out. Moving to the options data then, in yesterday's trade, you had the call writers that were having a gala time. They got stumped on the wrong side. So 24,700, 24,800 call. Both of them, big unwinding is what we saw there. The call writers got stuck on the wrong side, where you're seeing a mix of activity at around this 24,600 odd mark, which brings us to the levels. The recent low, that's going to be important. So that's the mark that you're looking at. You have resistance that comes in this vicinity of around 24,850 to around 25,000 odd. Yesterday was an inside day, because the high was lower than the previous trading session and the low was higher than the previous trading session as well. So, we were in a bit of a band out there. Yesterday's high was a little lower than the previous sessions, while the low, you did have a little bit of a high. So yesterday was a bit of an inside day. Moving to the Nifty Bank, it didn't perform yesterday, continues to face resistance at around the 20 as well as the 50 DMA. So that's going to be an important mark. And everyone's been talking about, right, the Indian markets have been underperforming, and valuation-wise, we're still very expensive. So you look at the last 1 year or so, the Indian markets actually have underperformed while the emerging markets have done well. And post this underperformance, actually valuations have become a little bit more palatable, because normally the Indian markets trade at a premium in comparison to emerging markets. That's come down to around 66%. Normally it's much higher. So valuations a little bit more palatable in comparison to the emerging markets. And finally, since we have underperformed in the recent past, well, the weightage on in terms of market capitalization on the global front as well has come down a little bit. The short point is, yesterday we saw a good bounce. You like to see some follow through. 24,850, that's a crucial mark. The bulls will want to get past that mark.
Okay, absolutely. Nigel, take that point. And Rima, on what you were saying on whether it'll cast a shadow, I mean, if you look at just the square numbers, and the numbers are not too big.
Not too big.
Impact on GDP, all our US exports, is just about 2.1%. On sentiment and the second order impact, right? That's what we were discussing with a couple of the companies as well, whether there will be a second order implication on this. Maybe yes.
You're seeing it in the rupee, right? From the start of the year, the rupee has depreciated by, I think, about 1.5%, while most of the other emerging market Asian currencies have actually appreciated. So there is a little bit of a sentiment. It's an overhang. Let's
but from a market perspective, unless something really happens on pharma next, from a market capitalization perspective, sectors like textiles, gems and jewelry, not very big constituents of the market. So let's see if we get some more good news on earnings and maybe some of the flows improve. Things could get better from here on. Let's then move on and bring you the equity call of the morning. Surendra Goyal of Citi says, headline trends in the first quarter are modestly ahead of expectations. Exactly the point that I was saying. Commentary on earnings seems to be improving. Now, he says EBITDA is up 7% YOY. However, adds that Citi's forward estimates have seen continued downgrades, with FY26 EPS down 1% since the start of the quarter. He says while absolute valuations remain high in historical context, relative valuations are reasonable. He says improvement in earnings outlook on the back of cumulative policy actions, low inflation, and stable macro fundamentals is key. Surendra adds that their June 2026 Nifty target is at 26,700. So just like Motilal Oswal, we heard them lower their EPS estimates by only 1%, ditto for Citi, at the end of Q1.
Even the S&P 500 has been smashing earnings expectations. There was a Bloomberg analysis. 82% of the companies have reported earnings above estimates so far, representing the best beat rate since 2021. So that's...
but how we are poised very interestingly, because going forward, a lot of people are expecting weakness in the second half in the US in terms of economy and strength in India in the second half as the monetary policy, rate cuts, etc., they kick in. So let's see. I mean, very interesting, pivot perhaps that these markets are at. Let's discuss this and more with our first guest on the show. Stephen Englander, Managing Editor, Global Head of G10 FX Research is with us. Stephen, thank you very much for joining in. You've been, of course, watching global markets very, very carefully. And we want to start right there. The point that I was just discussing with my colleague, that as you look forward the second half of the calendar year, or the second half of the fiscal year, expectations are that data in the US may not be as strong as it has been. But it's the polar opposite for us here in India, where everyone's expecting a pickup in earnings and growth in consumption in the second half. How do you look at the US picture to begin with?
Well, it's clear that the recent labor data suggests that the economy is slowing. I don't think it's falling off a cliff. It's been slowing for a while. It'll continue to slow. It looks as if productivity growth is probably high because we're seeing not too many jobs getting created, but we are seeing profits being pretty strong. So that's a good long-term sign. But I would say, setting India aside and its growth prospects for most of the world, we think 2025 growth was actually front-loaded because everybody was exporting to the US to get in under the tariff wall. And now that the tariffs are raised to the levels that have been proposed, we expect that the trade will slow and the exports will slow. So it's not super bearish. We just don't have a H2 view that's very dynamic for the world right now.
Stephen, I know it's tough to predict the second half of the year. You called it dynamic, but which way would you swing? Do you think as these tariffs take effect, and they're going to settle significantly higher than what they were ever before, 6-7 times higher, even if you assume a 15-20 times as an average, is that going to end the bull run in the US market? Or do you think, there is enough firepower in the US economy to weather it? I mean, which way would you swing on the US markets and in the economy?
Well, on the economy, we think it is slowing, but we're going to have a pretty good productivity number for Q2 that's coming out tomorrow or the day after. Earnings so far look very good. In the past, what you found is that when earnings are good, and productivity is strong, it pulls up everything. So, it's not going to be a 3% economy, but we do think that we're going, we don't think we're going to go into recession or anything. And then we'll have some fiscal stimulus, so it might add a little bit in the near term.
Hi, Stephen. Good morning. Good to see you. When we had some weak data coming out of the United States, and sometimes equity market participants, they like that because it gives you some reason to hope that the Fed now will have to go ahead and step on the pedal. Do you think that's likely to be the case? 2 more rate cuts coming in for the Fed in this year, or do you think we should be satisfied with maybe 1 or maybe not?
Well, I mean, we have 1, but we're open to the possibility of 2. I mean, and we've been discussing the possibility of doing 50 in September even. Look, I think the Fed is very pragmatic. I mean, despite the issues with Trump, if the data are clearly suggesting the thing, we've been expecting them to cut in September. We always thought that the market was a little bit pessimistic on the short term. Where we do worry is, we don't see continuous cuts as is priced into the Fed funds future curve or the SOFR curve. We think that they'll do, 1 or 2 and then stop, which would mean, I think, that we could go back, at least for a while, to dollar strengthening. For now, we see dollar weakness, but once these cuts are passed, we think that the dollar could rebound.
Okay, so let's see when the cuts start coming in and how the market then reacts to it. Stephen, on this India-US, I don't know if you heard a little bit of our earlier conversation. Do you think foreign investors who are looking at the Indian market will take note of what's happening in terms of geopolitics, just politics, purely politics, with respect to trade, our equation with Russia? Will it have any bearing, is what I'm asking, when people are looking at allocations to India?
I would guess not in the long term. You look at all the issues that have come up. I mean, the U.S. has had a terrible week with Brazil last week, but now Brazil is rallying. There seems to be an intention to get a deal and to pressure other countries to come up with a deal. It's a process. It seems most of the time that you end up with a deal and markets rally. That was the story. The story of April was everybody was afraid that there would be no deal. At May, June, we began to think that there would be a deal. Markets rallied. And I think that that's going to continue to be the case. There's no upside to the U.S. for not getting deals.
So, Stephen, which would be your top bets in equity markets?
Ooh, I mean, we're not a big equity house, but for now, I can talk about the currencies. We don't think the dollar is going to bounce back, until the Fed is done with its rate cuts. But we do have we do think that there will be dollar strength. I mean, towards the end of the year, I think that the weakness we're seeing now is temporary.
So what are the levels you're working with then in terms of the dollar index? Because from an emerging market standpoint, that's one of the key monitorables for us. And, when President Trump took over, it went dancing away to around 111. And from there, it's lost its way. So if you're seeing some strength, next 6 months or towards the end of this calendar year, where should the dollar index hover around?
Well, I think you should think about a move of maybe 4 or 5%, not more. I don't think that. I mean, there are forces in both directions for the dollar, and I think that that's going to prevent it from making a really big move. I think then, once you get it into the middle of 2026, we could see another episode of dollar weakness. But I think that for say we're talking about the end of this year and into next year, I think it's going to be a strong dollar period, but not super strong.
Okay, all right. We will keep that in mind. Stephen, thanks very much. Good conversation. Appreciate you joining us. You have a good rest of the day. Well, that's a view coming in from Stancy. Let's quickly tell you what else we've lined up for you on the show today. Coming up at 8:35, we'll have the management of Sarda Energy and Minerals joining in to talk about the company's Q1 performance and the outlook ahead. At 9 a.m., Abhizar Divanji of Neostrat Advisors joins in. He talks about the big change at IndusInd Bank. Former Axis Bank, Honcho, Rajiv Anand moves to IndusInd Bank. So what are the takeaways and what ahead now for IndusInd Bank? We'll discuss that. At 9:20, Sameer Arora joins in. He's our market master of the day. At around 9:30 a.m., we get chatting with the management of Shree Cements. They'll talk about their first quarter performance, that volume miss, and the outlook for the rest of the year. After that, we will have Abhijit Das of the International Trade Expert, who will be chatting with us at 9:45 a.m., talking about the latest threats that we're getting in from the US president with respect to purchase of Russian oil. And towards the end of the show, in our special segment, It's the Economy, Lata today discusses the economy, the prospects, the RBI outlook with Goldman Sachs economist Santanu Sengupta and B. Prasanna of ICICI Bank. Okay, quick break on that note. We'll come back with a list of top 10 stocks to watch in just a bit.
Welcome back. It's a Tuesday morning. Let's drill it down then to the top stocks that you need to have on your radar this morning. Our research team is standing by with CNBC-TV18's list of top stocks for the day. And first up is going to be IndusInd Bank. Gaurav.
Well, yes, CNBC-TV18 News Break has been confirmed because now RBI has approved appointment of Mr. Rajiv Anand as MD and CEO for IndusInd Bank. Now, this is a big move. Let's not forget that this all started on 29th of April when Mr. Katpalia resigned from the position of MD and CEO of IndusInd Bank. When we look at this appointment, they have appointed him for the next 3 years and he will be taking over from 25th of August. Remember, we were the first one to indicate that he is one of the front-running candidates for IndusInd Bank's MD and CEO position on June 27th. When we look at his portfolio and his performance, it has been very strong. He has over 35 years of experience. He was one of the founding MD and CEO of Axis Asset Management, and he was also appointed as Deputy Managing Director at Axis Bank in December 2021, where he headed wholesale banking and he was also responsible for driving digital agenda for the bank. When we look at the strong track record, it actually keeps him as one of the very key candidates for IndusInd Bank, and this can actually move the stock up because this is sentimentally positive. Although when we look at the performance and the way going ahead, it will be really interesting to see how the path towards 1% ROE will be achieved by the bank. But as of now, sentimentally positive news, and for that, I'm keeping IndusInd Bank in green today.
Okay, all right. Thanks a lot for that, Gaurav. Well, let's hop across to Ekta. She's here to talk about Auto Pharma.
Well, yes, for Oro Pharma, in fact, it was a little bit of a disappointing quarter. It missed estimates. The revenue was up around 4% this quarter. The margins came in at around 20.4% versus estimates of around 21.1%, and the profit was below estimates as well. The US revenue was the key culprit, so it came in at around $408 million versus $470 million Q on Q. And Europe, however, did well. It was up 18%. Growth markets were okay, so they were up around 8.8%, and the ARV business, which is the antiretroviral business, was up around 55% year on year. But the key reason for the sluggishness was lower Revlimid sales, and that reflected in the US business, and that's the reason why the entire set of numbers were lower than estimates. The call is at 8:30 a.m. this morning, so more details then.
Okay, all right. We'll keep that in mind. Ekta, thanks very much. Let's go to Sudarshan. He's watching out for a couple of auto component names. Yesterday, Sud spoke to us about Hero Moto. Hero Moto became the stock of the day. What about Sona and Bosch this morning? Sud?
So I'm going with green. For Sona BLW, it's mild green. And as far as Bosch is concerned, there I'm going with green. For Sona BLW, earnings have slipped year on year, but those numbers are largely in line if you compare against muted expectations. Revenue was down 4%, EBITDA too has slipped 17%, and margin has fallen to 24% from the level of 28%. So why there was a fall of almost 17%, almost 4% in the revenue? So company is saying that revenue deferral has been seen from an European EV customer. Also, a key global EV customer saw weaker sales due to demand softness. Also, because of rare earth supply disruption, revenue was impacted even due to US tariff uncertainty. But outlook is positive. Company is saying that BEV revenues are set to improve going ahead. Also, there is a strong launch pipeline over FY26-28, and share of Asia to total revenue is expected to improve to 50% from 45%. Now, Bosch earnings are slightly better than estimates. Revenue was up 11%, EBITDA has increased by 22%, and margin too has come in higher, about 13% against 12.1%. And the biggest segment, that is the mobility business, revenue was higher 14% year on year.
Got it. All right, sir. Thanks a lot for that. Let's hop across to Vama. She's here to tell us about Siemens Energy. Morning, Vama.
Well, good morning, Nigel. You know, this is the company that was demerged from Siemens and now houses the energy business. A good set of numbers coming in from the company. Revenue saw an uptick of almost 20% on a year-on-year basis. Apart from that, when you look at the operational performance, that was also very strong. You know, EBITDA margin has expanded by around 470 basis points to 19.1%. The net profit is also up almost 80% on a year-on-year basis. Now, let's look at how the different segments perform. They have two segments, power transmission as well as power generation. The power transmission segment is the segment that is leading the growth this time around. It's up almost 35% on a year-on-year basis. Even when you look at the margins, it is the power transmission business that is driving the margins higher. This particular segment saw an improvement of almost 850 basis points on a year-on-year basis. The ordering activity was extremely robust. The new orders that came in stood at 3,290 crores. This is an uptick of almost 94% on a year-on-year basis, and this uptick was largely driven by large orders received. Apart from that, the company has also announced a capex plan. They're looking to invest around 280 crores in a phased manner in manufacturing capacity expansion of high voltage switchgear products at their Aurangabad facility. So therefore, a good set of numbers. Capex plans coming in for Siemens Energy, going with the green for this counter.
Thank you very much for that. The stock had made its debut in the middle of June at a price of about 2,800, 2,850. It had listed on NSE and BSE, and since then it's had a pretty good run. Manglam is now joining in to tell us about the numbers from Kansai and Godfrey Phillips.
Well, if you look at Kansai and Interact numbers, they're soft, but the street was expecting, soft numbers given the current conditions. And now everyone believes that maybe the sector is looking up from here on itself. So the revenue is up 1.4%, no great shakes out there. The EBITDA down 8%, and the net profit saw a decline of almost 4%. So it's coming at around 215 crores versus 225 crores. The company saw mid-single digit growth in project business, which means that retail sales are still muted. And the new product contribution is the one that did well for them, over 10% of their sales. Sluggish demand environment for auto paints as well, which is a large part of their overall revenue. Stock ended lower. The market is weak. So as a result of which, we expected to see mild red. But going forward, maybe there could be some recovery, given the street believes the worst is behind. No problems for Godfrey Phillips. Smoking hot numbers coming in, especially on the revenue front. 38% growth in the company's revenue, 1,486 crores versus 1,079 crores. Yes, the EBITDA did not grow as fast as the revenue, but that's something that we saw in ITC as well. Leaf tobacco inflation has caused the margins to compress by about 230 basis points. But a strong revenue growth has ensured that the net profit grows at around 25%, even if there is a margin compression. So see some green on Godfrey Phillips. Additionally, the company has announced a 2:1 bonus, so shareholders would be happy.
Yeah, the cigarette makers have been doing well this quarter, ITC included. Take that point, Manglam. Thanks very much for that. Let's quickly move on. We have Sonal joining in on DLF. How are the numbers, Sonal?
Well, good set of numbers this time around. In fact, bookings, they were up 78% on a YOY basis to come in at 11,425 crore rupees, which was led by their new launch, which is Privana, which itself took around 11,000 crore rupees this quarter, of around 4.7 million square feet in terms of volumes being sold. Company has already achieved more than 50% of its full year guidance of 22,000 crore rupees in quarter 1 itself. So clearly it looks like they could beat it in the coming quarters. Customer collections, however, were down 6% on a YOY basis. Even in their leasing business, their EBITDA was up 14% to come in at 1,356 crore rupees, going with green on DLF today.
Okay, all right. Thanks for that. But there's going to be a large trade that we're looking forward to. Vivek joins us to tell us about Paytm. Vivek?
Well, that's right. So Paytm will be in focus. Expect a large block deal over here. Remember, Antfin, that held close to 27% stake at the time of the IPO, has consistently been pairing stake, the recent being May 2025. Today, we are expecting Antfin, that is the entity under which this particular stake is held, to exit close to 5.84% stake in the company. The floor price for this particular block deal is at a discount at 1,020 rupees a share. The total size of the block will be close to 3,800 crore rupees, and it is a clean out trade as far as Antfin is concerned. So it will be interesting to see whether the stock recovers after this particular block deal, given the fact that the overhang of any stake sale from Antfin now goes away after this particular block takes place.
Thank you very much for that. So this will be the clean out trade. And as Vivek said, will there be some sort of an overhang lifted? Manglam is back with us. United Spirits came out with their pre-quarter sales numbers.
Yeah, it's interesting, towards the end of the quarter, they're coming out with their pre-quarter update. The timing is odd, but the numbers not. In fact, if you look at the overall sales, they've grown at around 9.4% for the company, a little over 3,020 crores. It's been led by Prestige and Above, which is up around 9% in terms of sales. But Popular also has grown about 13.6%. Remember, this comes on a high base. Same time last year, the company had increased their supply in anticipation of the general elections. But at the same time, this time there are the tailwinds coming in from favorable policies in Telangana and Andhra as well. The company says that the demand environment remains muted, but they've sustained growth momentum. So see some green on United Spirits.
Okay, all right. So some green perhaps on United Spirits. Got that. Cigarette makers doing well, spirits makers doing well, Manglam sectors. Okay. We'll quickly recap our list of top stocks to watch this morning. The ones that have positive news flow around them would be, of course, IndusInd Bank, Sona BLW, Bosch, United Spirits, Siemens Energy, and DLF. Stocks with negative news flow around them would be Aurobindo Pharma, Kansai Nerolac, Godfrey Phillips because of the margin issue, and Paytm. All right, that's our stock list for the morning. Let's figure out what's happening in the world of commodities. We have Manisha joining in with the latest. Manisha, lots of big diplomatic and political headlines, India, US and oil. But it's not at least moving the oil market, so that's the good news.
Well, yes, but it could, depending on what really transpires or conspires going forward in the next week or 10 days there. As of now, the crude oil prices have seen a constant decline for a fourth straight day today. Well, OPEC Plus looking to raise output to complete the phased reversal of voluntary cuts that they made back in 2023 really seems to be weighing onto the markets because OPEC is looking to increase production by more than 500,000 barrels per day until the month of September. So that's a lot of crude coming into the markets, and OPEC does want to get its market share back in case there is a sanction on Russia. But if that happens, then you're looking at the crude oil prices really surging. Most of the banks and brokerages tell us that in an event of very strong sanctions, if India and China are not allowed to buy crude, then you could be looking at crude prices really going very volatile. At this point in time, though, with everything going fine, markets do believe that by the fourth quarter, the Brent could be averaging at 60 or sub-60 as well because of the kind of increase in supplies that we are looking at. But much would really depend on how the geopolitical goes and whether or not we do see those secondary sanctions on countries buying Russian crude. In the other metals, we've seen copper prices see some more profit taking, but other metals like ferrous have continued to gain for a second straight day. You saw steel prices gain up by 1%. Iron ore is up 1.5%, back above that $100 a ton. The weakness in US dollar index, expectation of a rate cut in the month of September, and slightly better data coming in from China are some of the supportive factors for metals.
Okay, all right. Thanks a lot, Manisha, for joining and giving us that update. For the time being, we'll slip into a short break. On the other side, Mayuresh Joshi is waiting for us. He'll give us some fundamental stock talk. We'll also be joined by the management of Sarda Energy and Minerals. They reported their Q1 numbers. The street loved it. The stock was up 20%. We'll find out more from Mr. PK Jain. Welcome back to Bazaar Morning Call. As promised, let's focus on Sarda Energy and Minerals. It's the first corporate on our radar. The company reported a stellar first quarter. Profits, EBITDA jumped up. They had, the new acquisition that came into their fold as well. And the street liked it very, very much. Well, to help us out with the past quarter's numbers and the way ahead, we're joined by Mr. PK Jain, the Director and Group CFO at Sarda Energy. Hi, Mr. Jain. Good morning. Congratulations. You have delivered numbers.
Yeah, very good.
The street loved it.
Thank you, Nigel.
All right. Good to see you, and sir. Now tell us, give us a few pointers. You have done more than 600 crores of an EBITDA because SKS has come into your fold now. And you're more a power company than a metal and mining company. And the street believes that seasonality has got taken care of a little bit because now close to 70% of your EBITDA is coming in from the power division. That said, since you have done 600 crores in the first quarter, on an annualized basis, should you be working with an EBITDA number of ballpark close to around 2,000 crores?
Should be somewhere around that.
So you can maintain...
Definitely.
Yeah. Go ahead, sir. So it can be in the vicinity of 2,000 crores. Can it be even higher?
No, it should be in the vicinity of 2,000 plus minus depending upon the market scenario.
Okay, got it. So 2,000 crores, that's going to be a big improvement from around the 1,250 crores that you delivered in the last year. That's point number one. The other positive is you have generated a lot of, of cash in the past quarter as well. And you've gone ahead and reduced the debt in your books, which is also encouraging. I look at your consolidated net debt. The consol number has come down from ballpark around 1,500 crores, closer to around 1,000 crores. So give us two numbers. What is the capex plan you have lined up for this year? And what happens to the net debt? Further reduction by the end of this fiscal?
Yeah, we have capex plan of about 750 crores to 1,000 crores during the current year, depending upon how do we get the approvals and how fast we move on the approval side, because most of our capexes are on the mining side.
And
So
what
it
happens
will
to your
be-
net debt?
Net debt should come down drastically. I think if everything goes in line what we have planned, it should be below 500 crores.
Okay, so around 750 crores of capex, and your net debt halves even from these levels. That's pretty good.
Yes.
Now, before we get to the company-specific details, are you seeing some softness on ground in terms of demand? Obviously, there's been a seasonality factor that is playing out, but is it softer than normal monsoons, or is it par for the course?
Generally, in the monsoon season, the demand for steel remains a little soft, but it does not materially affect to the secondary sector suppliers. If you consider overall demand, the secondary steel suppliers percentage is very low, so we don't face any problem on the demand side. Yes, prices remain under pressure during the monsoon season.
Got it. Let's talk about pricing then. For pellets as well as, if I look at your ferroalloys, there was some kind of stability, some improvement in quarter one. For quarter two in comparison to quarter one, how are prices shaped up? Tell us particularly about pellets, ferroalloys as well.
Yeah, pellet prices have moved up recently. All the steel products prices, including sponge iron, pellet, everything has moved up by 1,000 rupees to 2,000 rupees, depending upon the product to product. Pellet has moved up to 10,000 rupees now, from our average realization of 9,600 in the quarter one.
Okay, all right. Now on SKS Power, you have said that the asset is good and the infrastructure that you have can potentially help you all in doubling your capacity. When do you take a call on this front? Currently, it is, I think, around 600 megawatt. You have 2 units. So when do you take the call on the next 600 megawatt? And what's the ballpark number we should work with? I recall when Mr. Kamal Sardar joined in on the show, he was saying roughly, I think, in the vicinity of close to around 4,000 crores, if I remember correctly. Should that be a rough number we work with? And by when do you all take a call? Sometime in this year?
Our present capacity is 600 megawatt. What you stated is correct. And we had given figures of 4,000 crores for 600 megawatt.
Yes.
Now we are evaluating whether to go for 600 megawatt or a little higher capacity, maybe 800 megawatt or so.
Oh.
So capex will slightly change accordingly, and we are evaluating both the options, what capacity we should put up. All the basic infrastructure, land and basic infrastructure are already available, as already stated. And we are going ahead with the necessary approvals, because we have to get all the environmental approvals and all other approvals. So it will take some time to go ahead with the project. Before that, we have to get the approvals.
So ballpark around, I think, 6.5 crores per megawatt. That should be the rough capex, right?
Yeah.
All right. So that will be approximately. So we should look at a capex, then if you're looking at 800 megawatt, closer to around 5,000 crores.
Yeah, 5,000 crore plus. Because with the time changes, the cost may also escalate, as it will take another at least 1.5 to 2 years to get all the necessary approval.
Okay. So this is a story then that will get announced. The capex announcement itself could be sometime in FY27, and then from there it will take another 2 years to to come into play. Is that correct?
Yeah, capex announcement will also take time, because before that we have to have all the approvals in place.
All right. So this 800 megawatt, once you take the take the call on whether or not to go ahead with the capex, then it should by FY29 it should be up and running. Will that be a fair estimate?
I think it should take around 2.5 to 3 years to complete the project.
All right. So it will take a little longer, and
because
post
presently there are timelines for delivery are little longer. By that time, if there are changes in the delivery schedule, that may be a different thing.
So you did
we are
around
yet to finalize the capacity. We are yet to finalize the capacity, whether to go for 600 megawatt or 800 megawatt. That is being evaluated.
So directionally, last year you did around 1,250 crores of EBITDA. This year you're saying you'll do around 2,000 crores. With the capex that you all are planning, I think a smaller capex will be on the metal and mining side and a bigger capex on the power side. By FY30, you should be at an EBITDA of around 4,000 crores?
It will be far-fetched to speak on any figures for 2030. But yes, as we are continuously investing, that is a fact. We are investing about 750 crores, 2,000 crores every year based on the present capex plans. And in addition to that, we have larger plan for the thermal power project of IPP. So continuously we are investing and it should move up definitely.
All right. Final question before we let you go. The big question is funding. Having a plan is great. 5,000 crores. You're going to be throwing up a lot of cash. So what will the funding mix look like? Will it be debt and internal accruals? Or since the equity markets are really appreciating the numbers that you've given, will you look at raising some equity?
As of now, we don't foresee any requirement for raising equity, at least for the plant projects. Yes, in addition to that, if we get any other opportunity, that is a different aspect. But for what we have planned, I don't foresee any requirement for raising equity.
Got it. Appreciate you joining in, Mr. Jain. The street clearly liked the numbers and you've given us some impressive guidance for this year itself. So 2,000 crores of EBITDA. Net debt comes down from around 1,000 to around 500 crores. And the big call is on SKS Power that currently has 600 megawatt of capacity. You could potentially be adding 600 to around 800 megawatt. Congratulations on the past quarter's numbers, Mr. Jain. And we look forward to having a chat with you as the year progresses. Okay, let's get in Mayuresh Joshi, then Director Research at MarketSmith India, who joins in. Hi, Mayuresh. Good morning. Good to see you in early morning. Tell us, Sarda Energy, any view on this name? 20% yesterday, locked in upper circuit.
Morning, Nigel. No, I think great set of numbers. And if you probably look at the management commentary and construct, they're probably assuming that energy will become their core vertical as we head into the next few quarters. Obviously, I think the thermal assets that they've got, roughly 760 odd megawatt, the renewable assets that they've got, primarily out of the hydel assets that they're building in, including the Sikkim hydel power plant. I think that has significant amount of EBITDA margins, and even the tariff realizations for hydro projects have got significantly higher, backed with sufficient amount of PPAs. So our own sense is that with the kind of cash flows that they are generating, the value additions that is happening outside pellets. So obviously the management just mentioned that pellet prices are moving northwards. But if you look at sponge iron realizations, if you look at the billet realizations, you look at ferromanganese, silicomanganese realizations as well. Steady state, the ferromanganese around 70,300 odd, silicomanganese around 72,000 odd. So I think if these realizations remain steady state, along with the integrated operation that Sarda probably has, both in terms of its coal mines, and again, I think the SKS Power acquisition, which is also backed with coal mines at Gare Palma 17, I think that clearly adds in terms of superior market performance getting reflected on their energy vertical. So as for the management say, I think if they're able to probably replicate this performance and energy taking center stage as we head into the next few quarters, numbers will still show significant improvement. Obviously, I think the only risk factor remains how pellet prices move, how demand probably comes through. But because of their captive consumptions and integrated operations, I think a large part of this is well shielded. So a great set of numbers. I think on our ratings and rankings at Markets with India, I think it looks positively for us. So we remain optimistic.
Well, I remember, in 2024, when they actually backed this asset, Mr. Kamal Sarda, who's the promoter, he made a very, very rare appearance here on CNBC-TV18, one of the only appearances in the last 15 years or so. And he said, this is going to be a game changer. And it appears now those benefits are flowing through. And that's why the street, they're positively surprised by those numbers that did come out. Because SKS Power has transformed the company from just being a metal company to a more, a non-steel, non-metal kind of company. So more structured and cash flows as well can be predicted. So street likes it.
Mayuresh, as a house, are you recommending buying IndusInd Bank? That's the big stock in focus, big change. Rajiv Anand in the helm. He's a seasoned banker. He'll instill confidence. And at the end of the day, IndusInd Bank is still about 45% away from its 52-week high. So, what's the house call in IndusInd Bank at these levels?
I think that's an announcement that the street will probably write, Reena. Good morning to you as well. But what really transpires is what is the change in numbers that one really expects? Now, one really assumes and presumes that the worst in terms of reporting, because of all the issues that they were facing, is largely behind them. And it's always going to be a task in terms of reconstruct of the balance sheet. Now, the hope here is that there will be improvement in every passing quarter as we come through with a clean slate that the new management will now begin with. But I think how these numbers will stack up is going to be important. The second aspect, obviously, from a valuation perspective, absolutely attractive as we speak. But again, I think there has to be some element of confidence that the street will probably need in terms of reported numbers going forward and the base building quarters that probably happen over the next few quarters. So at this point of time, I think you're probably neutral onto the stock. We still continue to prefer a stock like an ICICI Bank among the large names.
Okay, ICICI Bank, he is the man in charge, man and at the helm. And of course, you heard it right here on CNBC-TV18. Ritu Singh breaking that story several days ago. Mayurish, hi, good morning. So, in a nutshell, I think the sense that one's getting, and I've been looking at notes from this morning, Citi had a call yesterday, Motilal, and there was also Goldman Sachs, we spoke to them as well. Consensus seems to be that, yes, Q1 is muted, but it's not a total washout. We spoke of Sarda just now. Anything else, that meets your buying criteria or has moved up into your buying category looking at the Q1 performance?
Morning, Sulbi. So, again, I think there were a whole host of numbers that were relatively good as we speak, as far as Q1 is concerned, whether it's large caps or mid caps. So selectively across sectors, I think within the auto names, as I mentioned earlier as well, I think Hyundai is something that we continue preferring. Our own sense is that numbers were decent. The kind of market share gains that Hyundai has probably done because of all the product mix and the launches that they've probably done, whether it's Creta, whether it's Exter, when you're talking about the EV platform, the export mix that they've probably got, even in the current context, the capacity expansion that they're probably doing from 8,24,000, they're expected to go up to 10,74,000 units. The margin performance, which has been relatively decent. And yet, amidst competition, our own sense is that the kind of market share gains and stability that the stock is probably exhibiting makes it a very strong case. So this is one stock from the auto space that we continue backing. Obviously, I think agrochemicals as a space is something that we've continued liking at Markets for India for a long, long time. And our sense is that with better monsoons, farm gate prices, which are relatively decent, benign input costs, the expectations of strong volume growth led with better pricing and relatively benign input costs, the operating leverage should play out very effectively. And therefore, stocks like a Coromandel, stocks like a Deepak is something that we continue backing at Markets with India. Obviously mentioned ICICI Bank within the large cap names, which continues to remain in focus. Obviously, I think the NIM compression has been there for the industry as a whole. But I think with a lag effect, I think as lending rates also start coming back in tandem, I think somewhere the NIMs probably should start becoming far more stable and relatively better growth expected in the next few quarters. Hospitals as a space within healthcare is something that we continue preferring. And largely, I think within the consumption basket, I think selective FMCG names, Marico is something that we continue liking. We're obviously looking at how Britannia will post its numbers. But I think consumption as a story, which includes FMCG, apparel makers, I think those can make a very strong comeback in the second.
What about Godfrey Phillips? Not good for health, but those numbers look quite good. And the commentary that came in from Philip Morris as well was fairly impressive, with regard to India business. So they gave a bit of a hint. And now, as Mangalam told us, the numbers are quite good. And it appears they are gaining market share over the last few quarters. Your take?
No two ways about it. And obviously, I think the inelasticity in terms of demand, as far as the core cigarette business is concerned, obviously continues, Nigel. So to that extent, I think the numbers, whether it's Godfrey Phillips or whether it's the core cigarette business for ITC, I think those are going to be cash cows for both these companies. However, our own sense is that it's a tad bit too much, specifically in the case of Godfrey Phillips. And therefore, I think we still continue preferring the other basket of stocks, as I mentioned, within the FMCG names, or something even within the alcohol beverages space. Radico has posted a brilliant set of numbers, in my opinion. Even this space selectively should continue to.
Okay. All right, Mayuresh, we'll leave it on that note for today. Thank you very much for joining in. We look forward to a conversation again soon. Do have to take a break, but we'll come back on the other side. We'll have, of course, almost 9 o'clock, so we'll have the pre-open rates coming in. Our technical experts also joining in, Mitesh Thakkar and Sudarshan Sukhani, with today's trading setup. Welcome back. Just about 5 minutes and we'll get our pre-open rates. Let's get the implied open up. So 57 points lower. That's what the indication is. Let's get to our trading experts. Sudarshan and Mitesh are with us. Gentlemen, good morning. Bulls got a breather yesterday. Now the question is whether you should take any index trades, thinking that this will continue, that pullback that we had yesterday, or whether you should be shorting bounces. Let's ask both of them. Mitesh, morning. What's your call?
Good morning, Surabhi. I was talking about the fact that index could be broadly in a bigger range of 24,550 to about 25,250. We kind of bounced back from the lower end of the range. On Friday, we got a low of 24,535, and yesterday started some kind of a bounce back. While the gift Nifty is slightly negative, I still believe that it could be a situation where in the market after opening slightly lower could still edge higher. The first midpoint pivot is around 24,950. So the initial range for me right now is about 400 points, 24,550 to about 24,950. If we start getting past that, then I'll look at even a test of 25,250, but that should be it. We on the weekly and the medium-term indicators, volatility, and the volatility indicators are very flat, which means that a directional movement may not happen, but it could be a broad consolidation.
Okay, all right. Good morning, gentlemen. Sudarshan, coming across to you. What's your call?
Yeah, good morning. See, the Nifty made some kind of a low on Friday, but that doesn't mean that the rally has started. Yesterday could be a relief rally. My view is that it is best to leave the Nifty alone. And the best scenario would be that the Nifty chops around 100 to 100 points up, 100 to 100 points down till it builds a base. Because 24,500 has some kind of stability. Now, once that happens, there is a buying opportunity that may emerge, but that's a lot of ifs. For today, the Nifty is an avoid, focus on stocks.
Let's get to the stocks then. What do you have on your radar, Sudarshan? Give us some stock trades.
Well, that's an all-buy list, mainly because, stocks keep on rotating and keep on doing good things. Bajaj Finance is a buy with a stop on as 868. I'm probably getting that number wrong. Bajaj Finance is a buy. We'll just keep it there. DLF is a buy with a stop under 780. CG Power, which was on news yesterday, is a buying opportunity with a stop under 650. And Tube Investments, TI India, is a buy with a stop under 2840. It's an all buy list for mid caps.
All right, all buy list coming in there from Sudarshan. Mitesh, what do you have on your radar?
I have more of buy calls as well. Very clearly, this market is, while it's consolidating, stocks are giving a good trading opportunity. So 3 buys to a sell. On the buying side is Grasim with a stop at 2750 for targets for around 2860. Buy on Eicher Motors had a good pricing volume breakout yesterday. So buy here with a stop at about 5580 for a target of 5700. Conditional buy on JSW Energy. If it crosses 540, buy with a stop at 529 for targets of 565. And one sell, Apollo Hospitals, that's a sell with a stop at 7380 for targets of around 7150.
Okay, all right, gentlemen, got that. Thank you very much for joining in. We'll come back to you a little closer to market opening. Right now, I have to take a quick break. Come back on the other side with the pre-opening rates. And then we get chatting with Abizar Divanji, someone who's a veteran who's watched the banking landscape of the country for so many decades. What does the arrival of Mr. Rajiv Anand mean for IndusInd Bank? Welcome back. We are getting the first pre-open rates now. Nifty is down 180 points, but it'll settle. It looks a lot more than what the Sensex is doing at this point. Let's pull up the first rate on IndusInd Bank. 10%. Now, I don't know if it'll be a 10% circuit up or not, but the first rate is showing the kind of optimism, enthusiasm, belief, and maybe even relief that the market is sensing, given that such a big veteran from the banking sector is coming over to take charge. Speaking of that, let's straight away get to that story. First, over to Gaurav. We're missing Ritu in action. She's in transit and she'll come back and tell us more about her big news break. But in the meantime, Gaurav, you tell us, I mean, he's taking over, taking charge at a time when I think the numbers that we just saw, IndusInd's numbers, 1 quarter back, I mean, year on year, obviously, it's still a tall order, right? But there's hope that at least the book will be recovered. But you tell us more as Mr. Rajiv Anand takes charge.
Well, yes, as you rightly said, there is a cloud of uncertainty definitely on IndusInd Bank, but this is definitely a positive move for the bank because now Rajiv Anand will be taking over as MD and CEO. This will be from 25th of August, and with this, we also confirm our news break. We exclusively told that he will be one of the front runners in the IndusInd Bank MD and CEO. When we look at his portfolio and his performance, he has been in the industry for the last over 35 years and he has a very strong track record. He was a founding MD and CEO of Axis Asset Management. He was also appointed as Deputy Managing Director of Axis Bank in December 2021, where he handled wholesale banking business and also was responsible for driving the digital agenda for the bank. When we look at the performance and his track record, it also makes him as one of the very preferred candidates for IndusInd Bank, and that is what something the market is also penciling in and taking it in a positive way. When we look at the other headwinds, it still remains in terms of the operational updates because the ROA is still at around 0.5%. So there will be it will be interesting to see how it will move towards that 1% mark and how he will lead that towards 1% mark. In fact, brokerages are also being a little positive now because with Jefferies, they are saying that recognition of this reorganization of the top management is actually a key initial step. They will be watching out on other joiners from other banks, and at the same time Citi also mentioned that the key monitorables include strategic roadmap, execution capabilities and also turnaround in terms of core profitability. So definitely positive sentimental move from brokerages as well, and on that we will be watching out on IndusInd Bank today.
Oh, absolutely. And you know what, the stock is still up 10% in the pre-open. The Nifty is settled now. The cut is only 65 points, but that stock, IndusInd Bank, is still mirroring. So, yeah, Nifty had opened big gap down, but now it's settled to a more modest 57-point cut. But this seems to be the expectation. Yeah, 7% now on IndusInd Bank. That's what we are getting. Let's see. Abhizir Divanji, founder of NeoStrat Advisors, is with us to give us a sense of what this means. Is this a turnaround moment for the bank or not? Perhaps too early to call. But Abhizir, great to have you on. Thanks for taking this quick call in the morning. I mean, would you say that he was perhaps among the best candidates? And it's a tall task ahead, right? There's a Ministry of Corporate Affairs probe that just opened. There's the SEBI investigation in terms of not front running, in terms of insider trading. And then the ongoing, investigations from the RBI on the derivative accounting, microfinance issues, etc. Your thoughts?
Yeah, no, first of all, yes, he's a very good candidate. And as has been said, his track record is great. But we've seen this copybook play out, right? We've seen it in Yes Bank, we saw it in RBL, we're now seeing it in IndusInd. I think the biggest challenge he would have is clearly balancing growth and credibility, creating the trust organization. And it's a pity that even today, it's a key man which kind of drives sentiment. The key man should not drive the sentiment. The trust organization should drive the sentiment. And I think that's what he would strive to achieve over his time. Also, there are probes. You talked about some ROA issues. ROA issues in IndusInd actually seem to be one-time adjustments. This is not a systemic lower profitability game. So once the adjustments are taken care of, I think there will be a good adjusted ROA to work on. But he needs to build a trust organization going forward.
You have in the past spoken about what we've seen at IndusInd Bank. The consequence of that is that trust has become a collateral damage. So just to get back to the point, Abhizir, about balancing growth and bringing in trust, the governance, the controls, do you think he will be able to deliver growth in the next 12 to 18 months as he does begin the process of repair and recovery? What is your own view?
I think it's an imperative. That he will generate growth. First good part is that we've got somebody who has delivered growth in the past and somebody who's delivered growth with the right balance of governance. So in that sense, yes, I think he has the track record to do it, and I think he should do it. The risk, of course, always remains that you err or focus too much on the side of governance and kind of compromise growth. I don't think that is a desired approach, and I think knowing Rajiv from the past, I don't think he will do that. So I think we should see reasonable growth in the next 12 months.
Yeah, Abhizir, I completely take your point. And I think with, what Mr. Anand brings to the table and what he's known for, scaling up the retail operations at Axis as well, I don't think growth is at all going to be, something that the market will have a question on. But with respect to the ongoing probes, because we don't have till now from the bank any comprehensive statement on what happened to the forensic audit, what is happening with RBI, Our colleague Timsy from Delhi was reporting that the MCA is looking at its own investigation as well. So would this still be an overhang? You know, what would you expect over the coming few weeks and quarters?
This is part of any turnaround story. There is legacy attached. You deal with the legacy. Just that the people dealing with the legacy will be far more credible, and hence the agencies or anybody else investigating would keep the issues behind, I guess, deal with the problems. Of course, I mean, we had Yes Bank also, where people had to deal with legacy problems. So you deal with the legacy problems, but at the end of the day, the credibility of the trust organization will make sure that these are dealt with better than what the legacy organization could have dealt with.
And Abhisar, so then coming back to the point on growth, in terms of just strategy, putting the problems behind, in terms of strategy and pivots and focus areas, would you expect any immediate pivots? Not immediate, but near-term pivots, say on a particular segment, not corporate, but retail or not wholesale, pull back from microfinance. Would you expect that in year one at all?
So, yeah, I think that the retail story sometimes has been overplayed and is too crowded a market. I think the mid-corporate and the medium to mid-corporate story is where India needs to find a niche, and we need actually a bank which focuses on that secured lending in the medium to medium, I would not say small, the medium to large segment. And that's where I think if the focus is the ability to grow India would be phenomenal. And then, of course, there are other segments like project finance. I think it's something which the banking sector has not delivered up to. And if there is an ability to get to some of those large ticket things, I think there will be a marked change. The bank has to identify what their niche is going to be and then play to that.
Do you expect a lot of churn taking place at the leadership level? Some more exits following him from Axis or even from the other banks? And how will that impact?
The good part is that, some of the churn in IndusInd has already happened. So there are good vacant positions. So I think the leeway and the flexibility for him to do something in terms of getting the right kind of people is clearly there. So yeah, we hope that he will get the good team in place.
Okay. All right, Abhisar, appreciate you joining in and giving us your take on IndusInd and how do you see things pan out. Wishing you a good day ahead. So Abhisar mentioned about Yes Bank, IndusInd Bank now is out of the way. I think the other big stock that we'll be looking at in August itself is RBL Bank. Whether or not there is some of that news with regard to fund infusion, someone coming and taking a stake. The stock has been showing signs, it's been holding in that vicinity of around 260, 270. I'll keep an eye out on that stock. Even in yesterday's trading session, it was one of the stronger stocks. So let's see whether or not there is some news in the offing in the month of August.
Nigel, just wanted to point out one thing, which people, will of course remember, that IndusInd Bank right now, I think is up 2% or so in pre-open. But from the lows, when the crisis hit, the stock had fallen to about 650 odd. From there, it's rallied 25% to 820, anticipating a turnaround and cleanup. So now I guess from here onwards, it'll have to be some more inputs that we get on these ongoing investigations, on some, some clarity on the strategy perhaps. That could take things higher. But for now, I think 15, 16 rupees at the start.
Well, that's right. Well, let's get straight to Sudarshan. Then he's joining to give us his 9-10 call. So, Sudarshan?
Yeah, it's DLF. Buy DLF with a stop under 780.
Okay, DLF, that's the one that Sudarshan is backing. Mitesh, what about you?
Yeah, I'll go with a buy on Grasim for targets of 28.62.
Thanks a lot for that, Mitesh. So Grasim and DLF are the two stocks that Mitesh and Sudarshan have for us. But let's hop across to Nimesh. He's here with the standout brokerage report of the day. Morning, Nimesh.
Morning, Nigel. So today's standout is on power OEMs. A big report from UBS. They've initiated coverage on 4 names, which is BHEL, Waaree, Premier, and Suzlon. And they've also raised the target price on Thermax now to 5,100. So these are the 5 stocks in focus. I'll talk about the 4 ICs, which is first one is BHEL. So UBS has initiated a buy with a target price of 340. They believe that rising thermal demand would mean that the net profit for BHEL can go up by 8 times by FY28 estimate. So that's the first stock, which is BHEL. The second name is on Premier Energy. Again, an initiating buy. There they have a target price of 1340. Now for Premier, they believe that the company has been ahead of the peers in terms of integrated expansion. So companies backward, a 10 gigawatt of backward integration would mean nearly 34-35% revenue and EBITDA CAGR over the 3 years between FY25 to FY28. So that's on Premier. The third stock is Waaree Engineering. Again, initiating buy. There they have a target price of 4,400. And for Waaree, UBS believes that the company can have a healthy 620 basis points of EBITDA margin expansion over the next 3 years between FY25 to FY28. So that's a big number on Waaree as well. And the last one is on Suzlon, again initiating buy, target price of 78. And on Suzlon, they believe that the sector tailwind as well as the competitive edge would mean a big earnings expansion. Even for Suzlon, UBS is expecting almost 40 to 45% of revenue and EBITDA CAGR over the next 4 years. So big initiating report on 4 names and a big target upgrade on Thermax as well.
Thank you very much for that. Vamakshi is also joining in for Siemens Energy. Vamakshi.
Well, Rima, good set coming in from this company. Remember that it was demerged from Siemens and houses the energy business. The revenue saw an uptick of almost 20%. The EBITDA margins have also expanded substantially by 470 odd basis points, and the net profit is up almost 80%. So good operational performance coming in along with very strong revenue growth. And largely this revenue growth is being driven by the power transmission segment. It's seen an uptick of almost 35%. The power generation segment though has grown, but at a much slower pace at almost 6% year on year. Largely, the expansion that we're seeing in the margins is also being driven by the power transmission segment itself. It's up almost 855 basis points for the power transmission segment. Now, the ordering activity, as far as that is concerned, new orders came in at around 3,300 odd crores. This is a massive uptick. The order inflows have nearly doubled on a year-on-year basis, and this is being driven by several large orders. Now, in addition to all of this, the company has announced a capex plan of around 280 crores. This will be in a phased manner, and they will be expanding capacity of high voltage switchgear products at their Aurangabad plant. So overall, it seems like a good set of numbers. Capex plans also bode well for the company. We also have a note coming in from Jefferies. They have a buy call, target price of 3,500. They say that Q3 for the company was very strong. Q3 because Siemens Energy follows a September year ended calendar. They're expecting the company to see 50% EPS CAGR from over the next couple of years, and this will be driven by robust power capex pipeline as well as operating leverage linked market margin accretion. So positive commentary from brokerages as well.
Okay, and the stock's holding up really well in the pre-open session, Vamakshi. Thank you for that. 4% higher. The other one that's doing well in this session is Godfrey Phillips. Mangalam, remember, just told us smoking hot. Indeed, both ITC and Godfrey, I mean, they've done really well in terms of cigarette volumes, but both companies have faced pressure on margins because of cigarette or tobacco leaf inflation, rather. So that's what we've got. Godfrey is up about 5% as we speak. Markets, I mean, entirely flat. It hasn't picked up on the positive cues either from Wall Street or from Asia. So the start is muted, but let's see if there can be some sense of momentum built up as the day progresses. Right now, we don't have too much of an indication. Watch for the banks, because like yesterday, ICICI Bank and HDFC Bank both are slightly nervous ahead of the RBI policy announcement. Bank Nifty is also a little subdued. IndusInd Bank, of course, is charting its own path with a gain of 2%. It's not that 10% pop that we had in the pre-open. Now it has settled to about a 2% gain. So the question is, can the bulls prevail once again? Can they continue to build on yesterday's pullback? Well, looks like it's going to be a quiet start, and then we'll have to take it as it comes. Counting down to the open, and here we go. So the Nifty about 22 points lower, 30 lower, 39 lower, 40 lower. So it's a lower start, you'd have to say. Mid-cap index is doing better. It's absolutely flat. Bank Nifty also actually doing better for what it's worth. Bank Nifty actually flashed a little bit of green just now. Apart from IndusInd, SBI is the other big one. While the private sector large banking names have been struggling yesterday and this morning, SBI is trying to offer a counterweight. The market's still down about 20 odd points. Seems to be some selling in large cap IT and Reliance as well. We'll see how it goes, but it's a very quiet start to begin with, guys.
Well, IndusInd Bank is your top gainer. It's not a blockbuster move. It's a sedate 1% gain. But that's the top mover right now on the back of Rajiv Anand's appointment as the CEO. 1.5% up on IndusInd Bank. The other notable mover is Bharti Airtel. Remember, it reports numbers later today. Numbers come out post-market hours. Airtel Africa, which is about a quarter of the company's overall valuation and numbers, came out with a very good set of numbers led by tariff hikes in Nigeria. Bharti Airtel's India mobile business performance will be tracked very closely. Coal India, Jio Financial, Ultratech Cement, Eternal, NTPC, these are some of the stocks on the gainers list. On the way down, you've got some large cap IT names struggling a bit. So Infosys, Wipro, TCS down between 0.5% to 1%. M&M is down nearly 1%. You've got HUL, which is correcting after the big up moves, and lots of brokerages came through. Stock did well, but now it's seeing a bit of a profit booking. Axis Bank is weak in trade, and you've got Reliance Industries struggling. All in all, it's very weak. It's a sluggish start, very lackluster. You've got a little bit of a red coming through on the Nifty and the Sensex. Banks are underperforming a bit.
Well, I think a bit of a pause for breath after the kind of run that we saw yesterday is par for the course. We need to take out higher levels, and then in fact you'll feel a little bit more confident. But let's focus on a few stocks that are buzzing around. Oswald Pumps, I think they came out with a set of numbers. The street likes it. That stock is reacting positively. AB Capital and Ather Energy, both of them, they had a good run yesterday. They're seeing some kind of follow-through buying today. So both of them initially, volumes are pretty okay. And both those two stocks were up. Oswald Pumps, yeah, that's reacting to its numbers. The other couple of stocks that are doing well is Sanofi. Pull up that stock, that's buzzing away. And Godfrey Phillips as well, as Mangalam told us, is smoking hot. I recall when Philip Morris came out with its set of numbers as well, we said the read-through could be that Godfrey Phillips could have yet again outperformed what the market did. And that seems to be the case. So that's opened up, gap up 6% higher. PSP Projects, yesterday we had highlighted the stock was down close to around 18% in pre-open, and there could possibly be a large trade in the offing. Well, in the second half of trade yesterday, we did see that the Adani Group went ahead and picked up that chunk in the stock. For the time being, the stock opens up with a gain of close to around 5% now that that last trade is out of the way. What's not doing well? Triveni Turbines reacting negatively to its numbers, so that stock is lower. TBO Tech, that's the other one that's reacting negatively to its numbers. And Bosch as well is down close to around 2.5%. Keep in mind, Bosch in the last 3 months has seen a very, very big run. It's coming for some profit taking in today's trading session. And because of this tariff worries and the talk surrounding it, we have a stock like Gokuldas Exports that continues to reel under pressure. I think Gokuldas Exports, Welspun Living, because of the kind of exposure that they have to the United States. India's talking tough, and rightly so. But it seems that these guys who have high amount of their exports out there, these stocks are a little under the weather today. But IndusInd Bank now is building on the gains, holding with a gain of around 2.5%.
Looking good. We should pull up Gokuldas. That's the stock that Nigel was just talking about. Some of these textile makers, exporter stocks, they're under pressure because of the kind of rhetoric that we've seen overnight as well. And by the way, on the gaining side, look at New India Assurance, 4% gain coming through on that one. Teamly is about 3%. So it's a little here and there. But otherwise, the market is largely flat to begin
Rainy is
with.
also one more stock you should watch. Down straight away 7% lower, very large volumes. Again, here it's an earnings miss. Revenues were down about 20%.
Absolutely. So a lot of individual counters in focus on the back of either news or earnings. Overall, market remains range-bound this Tuesday morning. Let's welcome in our next guest on the show. We have Samir Arora of Helios joining in. Samir, great to have you on. Long time, haven't spoken to you. I like the frames, new frames, I think. So wonderful.
I've been roaming around India and the world, so yeah.
Oh, okay. A new perspective, with looking at things with a new set of eyes, as they say, right? But I don't know. Are you finding anything new? I mean, we'll talk about Trump and tariffs and all that rhetoric in a bit. But let's talk earnings first, because I've been looking at a lot of notes in the last 24 hours. And the general sense when you read these sell-side notes is, itna bhi kharab nahi hai, Q1. But you tell us, what's your assessment?
Actually, the thing is that if you keep looking at the old companies, then kafi kharab hai. But there are so many interesting companies, and the ones we own, all of them had massive results, like massive growth at least. And in an environment where growth is very limited otherwise, you need at least 10-15% of your portfolio, maybe even 20% in 5-6 stocks, which are, you are looking forward every day to what they will do in 2 years and 3 years, instead of saying that, some company has guided for 1 to 3%. Now it is making it 2 to 3%. That kind of boring things you can handle only up to a point. So actually, if you look at the entire menu of choices, there were many companies that have done well, but in aggregate, it is nothing great. But it's not bad. It's like 9-10% type of aggregate earnings growth, which is okay for now, if it is as long as it's for 1 or 2 quarters only.
So where does that leave the market then? I mean, again, I'm just leaving aside the whole tariff issue, but with these kind of earnings and the cuts so far for full year are just about 1%. Most brokerages have cut by 1.2, not more than that. So where does that leave us in terms of market valuation? Any upsides or no?
So the upside isn't that you'll get 10%. If you see the big pools of earnings, so IT is growing maybe 3-5%. Large consumer is excited if they grow 5%. And the large banks are growing 8-10%, and after 1 or 2 quarters, they may grow 12-14%. So as of now, the aggregate earnings growth is 9-10%. Therefore, it would be reasonable to think that over the next 2-3 quarters, or at least till the end of the year, you're only supposed to make another 5-6%, which is 1% per month kind of return will be great. I mean, it won't come every month. What I mean is, you can't say today that we are in an environment of 20% growth, market appreciation. But hopefully next year, by the time interest rates come through and there is some government action on something to do with consumer a little bit more, and in any case, because of monsoon or because of interest rates feeding through, the consumer sector also does better. Otherwise, we are looking for our consumer stocks which grow very high, but the aggregate numbers, of course, for India are quite limited.
Samir, hi, Rima here. So you're in India right now?
No, I was. Now
you were in India. Okay. So I'm guessing you must have spent a lot of time on ground. You must have met companies, investors. I mean, what were your big takeaways, and what is the shift in the sentiment or tone compared to your last India visit?
By the way, I come every month, so that is not a big deal for me in that sense.
Right.
But then
the first part of the question.
The way I present it to people and to client distributors and even internationally is that you will make very below average return, like 10-12% or 10%, but it has to be compared with alternative, which is the interest rate. So if the government bond is giving only 6 point some percent, which say 9-10 years ago was giving 9%, so you are supposed to make a spread of 5-6% kind of range. So don't look at it in absolute that, oh my God, previously the market used to grow, earnings used to grow 14-15%, but now only 10-12%. Also for now, because the inflation is low, the nominal growth is low. And to the foreign investor, we say that you were broadly making at the market level, we used to outperform, but and still do hopefully. But at the market level, you are making 14% type and losing 3-4% on currency. Now you may make 11-12% and hopefully not lose much on currency. So in the end, everybody's happy and they move on by focusing also on the alternative and not just looking at the nominal number, which is lower than we have seen in the past.
Hi, Samir. Good morning. Good to see you. When I thought Surbhi will ask you about Trump, because he's been making a lot of noise. You'll just completely ignore it. Yesterday, I think what was trending since the cricket game as well as Trump were trending, people are talking about whether or not he made a couple of calls to the bowlers and said, I got it done. Thank you so much for your attention, But that was on a lighter note. But what do you make of Trump's commentary?
So the first thing is that, in some macro sense, somewhere there is some angle. It might be geopolitics angle, which might lead to some problem or something that who's your friend, who's your enemy, are you in this camp, that camp. But from an economy point of view, because the exports to US are so low, and particularly from the stock market, other than these two textile companies or one which, we also own Gokuldas and all. Okay, these guys will follow what to do. But broadly, we won't even know exactly which stock to feel negative on from this angle. Look at the positive that today one of our other companies, Paytm, has sold some 4,000 crores of stock led by two American banks, Goldman and Citi, which I assume broadly means that the investors will also largely be foreign and maybe American. So today, if we find, I hope we do, that the number of investors or a large thing was bought by US investors, that would be like a positive thing to say that even practically nobody is overly reacting to that. Either assuming that this is limited because of our economy and the weight of exports or share of exports, or that this is not going to stay for long.
Samir, this morning in your typical style, you have tweeted on IndusInd Bank, Bajaj Finance and PNB Housing Finance. Now, where Mr. Anup Saha joins PNB Housing or not, that time will tell. But do you think the
stock?
Yeah, that's what I want to ask you. Do you think the stock has overreacted to Mr. Girish Kaushki moving on? Is it providing a good entry opportunity because it's lost 20%, in a matter of 3 sessions, I think?
Well, people say we are not supposed to talk about stocks, but broadly we know that no CEO is worth that much. But, if it turns out that he's joining the private equity guys who sold the stock, that would be hugely negative, and I would also be very agree with those private equity guys. But if it turns out he's left for another job, now what can you do? But if in all these cases where you find that the management is good, but on their leaving, if the stocks fall 20%, then you have to take a new view that the management is not good, that they did not hand over that company fairly and squarely to the management. They did not deal with succession planning, or they made it more volatile by leaving, because your responsibility does not end on the day you just leave suddenly, particularly if you leave suddenly. So, but anyway, as of now, 20% looks a bit too much. I agree.
But, forget about the stock for a second, Samir. I have to thank you. I thank you online as well. Thank you for the humor. I just could not stop laughing after reading that tweet. No one puts it like you do.
Which one?
The same tweet, the same post we're talking about, yeah.
So many tweets, I know.
That's also true. That's also true. No, but we're talking about the one that's on our screen, talking about these big-ticket management changes at large financial organizations. Let's see. So we have the answer on IndusInd now. We have to wait by and see the answer on PNB Housing. But on IndusInd, and larger question on banks, Samir, one, we have the policy coming up. So, you tell us on financials if you're changing anything, retaining your stance. And specifically, do you think that this is going to be a case of buying a turnaround story? People love to buy turnaround stories in this market. Problem is, half the time those stories don't work out. So what do you think?
We also buy many turnaround stories, from Paytm to Zomato to delivery to whatever, to PD fintech also. But this one I am not buying right now, because, we have seen when there are these legal cases, one is just a results and growth, and one day they're becoming earnings and all that. But here there are, you've seen how cases come up 1 year later and 6 months later. And this is a bit more complicated. Plus in financials and in banks, we already have our exposure. Plus these things don't grow that highly, that at that higher rate that you think that you are fascinated by the fact that something in the economy, or not economy, but in habits of people is changing. So this is like a regular this thing. So I am not buying right.
So you're circumspect, and I completely understand where that comes from. This is exactly what we were discussing with Abhizir Divanji just a while back, that from this forensic audit to MCA to RBI to SEBI, there are too many pending inquiries.
And they drag for years, or 1 year, 6 months, whatever. Plus in this, we have enough exposure in this sector, so we don't need to try.
Got that point. Just to go back to the Trump issue that Nigel highlighted, I want to get your overall sense on this. Till now, when we were talking about why FPI flows are not coming. So first, they were not coming because the US market was doing too well. Then they were not coming because India earnings are maybe pedestrian, some will argue. Then they were going to South Korea. Is this going to become another reason? If there is this, cold tonality between India and US, will it make foreign investors more nervous?
By the way, foreign flows are coming from Feb 1. If you see in aggregate from February 1, the flows are positive. This month, they were negative for two reasons, I think. One was the Trump tweets or whatever. And second was the results did disappoint a few people if you looked at them individually. But otherwise, because of the big picture thesis of the entire world, and also mine, that the world is diversifying away from US in terms of their equity exposure. Currently, the MSCI world, the US weight is very high, maybe some 68, 70%. And everybody seems to be feeling that although US as market is doing well, but for different reasons, maybe because of currency, because of otherwise, the world is looking at non-US also. One reason may be that for the first time in many years, the MSCI world ex-US is beating the US market in pure performance. You can see that in the nervousness about dollar and the appreciation of gold, and these books like Ray Dalio's book on how countries go broke, that there is some nervousness, maybe there is anger, maybe there is frustration towards US. So there is some X%, small bit, large bit, some move away from US, which for the rest of the world then becomes proportionately very high. Means if 3-4% leave US out of 70 or whatever, that for the 30% weight is a 10% increase. So in that, India has a story. You can be 1 day behind, 1 month behind. If China gets more than 1 day, you will get, because you are part of that emerging market. But even otherwise, if you call primary plus secondary together, India is getting flows since Feb. The real selling happened in September 24 and in Jan 25, which was together in 2 months, something like 22 billion. But after that, it's not been in your face selling.
Got that. So Samir, one sector in India which you think is overhyped, and one sector where you think perhaps consensus may be getting it wrong and it could be a little under-owned, undervalued.
So overhyped, I've always said these new businesses are normally overhyped. I have read many books on this, particularly the solar theme. They might be great for India. We need it for climate, but for investment, these things never work. And even IT is still overhyped. Even today, people say that the valuations have reached long-term average. If you have reached long-term average, that means there were periods when it was below average. And what were those periods and why today should be a period which should be below average considering the uncertainty in US, the fact that companies are themselves admitting there is firing, that companies are not in aggregate hiring people while in the same city, some GCCs are hiring in massive numbers. There is a disruption going on. But because we have in the past seen great returns, nobody's willing to give up so easily. So that hope has to be, I think, brought down a little. In terms of another one, I think overhyped is the stock market related stocks, which is the exchanges, the depositories, the brokers, because we know that the government intent is to bring it down. We know that people have lost money. So beyond a point, we see that in the participation in the accounts of all these guys who come up every day and disclose how many active accounts, everything is falling. And we know broadly that if people lose money, then sometime or the other, they will drop out of this. And this has happened in Korea in the past where there was some frantic this thing in the olden days and then suddenly it disappeared one by one. And in a few years, you became a normal this thing. It's also a macroeconomic issue. I saw the interview of, what's his name, Ashish Gupta of Axis with Lata saying that it is more than a stock market issue. It's a macroeconomic issue. I believe he was saying that it is 5-6% of India's savings that the F&O traders are losing every year, which is a big number. And most of it is going abroad. So that makes it even worse. By the way, it neutralizes the entire tax cut that was given by in the budget, which was, say, 1 lakh crore. And broadly, the public has lost 1 lakh crore. And not only they have lost, if they had given it to some other Indian or to me, I would have spent it in India. They have given it to guys who have taken it out of the country story over. So now they want another tax cut or a GST cut so that they can give it to Dream 11 or give it to F&O. What is it is not a stock market issue. It's a macroeconomic issue. And it, one way or the other, has to be brought down.
Okay, and just one more, the other part of the question. Any sector which, according to you, is grossly undervalued in India?
I don't know about grossly undervalued.
Little undervalued.
But the thing is, people are more cynical about the new age companies not realizing what change is happening. So the change is that these are the only few stocks, because they're not sectors, where we are not relying on end growth of consumer or end growth of insurance or end growth of logistics, but the shift in your either, if it's a retail thing, in your personal preference in buying from route one or the other, in buying online instead of from agent or buying through quick commerce instead of going to your store or whatever. And these things can go on forever because these things are early in the game. The end with the businesses where you have to rely that India's growth will go from 6.5% to 7.5%. Those things will take time and you need many more things to fall in place. But the cynicism is, and that's why, I don't even own a lot if you see the portfolios. But just to irritate the system is so much fun via Twitter that I enjoy both the returns and the irritation I provide.
Oh gosh, and in these new age businesses, at least the Paytm bet, like you said, I mean, things seem to be improving, at least the numbers seem to be improving.
Everybody is improving. All of them
Paytm, and even Eternal for that matter.
Old age. You see, we are young people, so we relate to these new businesses.
Absolutely.
With Paytm, Samir is also enjoying Prince chart with, that was the other one he put out on Twitter.
Absolutely. But okay, to sum it up, Samir, before we let you go, so what you're saying is expect 5-6% return for the rest of this year, which is 1% return per month. which is too less by Indian investors, expectations. We're used to bull markets.
Tell them sorry.
Tell them sorry. What about if the RBI comes in and obliges with another, 25, 50 basis points this year? Do you see the bulls charging again, or is it just 1% per month?
No, this year, okay, but not now, because if they do, then my bank's earnings will fall a little bit more for now, because as they cut, it makes it, you need another 3-6 months to get everything in place. By the way, I have one more quick suggestion that what India should do. I thought about it in the morning, that we have to follow the Mark Zuckerberg policy. So what is our strategy? His strategy is, I will hire these individual guys from different companies in AI and make my own company. I think India should target 10 US companies and target them in the sense, bring them to India, bring Tesla to India, bring Disney to India, bring Harvard University to India, give them 200 million, 500 million.
Tesla is already in India, and Disney.
No, not that. For opening one BKC, that is not India. Tell them open, we give you 500 million, give Disney 500 million open. Basically make the American companies invest in India while the Americans...
bring them to India like that.
While the Americans want Indians to invest in America or the world to invest, you call Harvard University and say, we give you 250 million. Open a campus. You call Universal Studio. You call New York Public Library. Give them 200 million. Come and open 6. I mean, do something big with only $4-5 billion, but focused on deliberately US.
You think they can stand up to Mr. Trump? Maybe that's a debate for another time. They'll get a call saying, "What are you doing, Mark?"
No, if they don't want,
like he called him Mr. Tim Cook.
Then you can call Oxford University. First, you try US. I mean, what I mean is, you have to change that discussion.
Yeah.
And it won't be a lot. Maybe $500 million on 10 companies, $5 billion. What's the big deal? And obviously, you won't give it outright. It'll be based on you spend 80%, we'll give you 20%. But basically, somehow make a list. Just like Zuckerberg made a list of employees who has to target. And he targeted them, and then some of them agreed. You also target X number of companies.
Think big. Yeah. Absolutely. Think big always.
And focus.
Okay. All right, Sameer, good to have you on the show as always. And congratulations to you, Alok, Dinshaw, as well as the team on the outperformance with regard to the Flexi Cap Fund. And look forward to having a drink with all of you all towards the end of the year. Hopefully it ends on a high.
In the meantime, you can invest SIP.
For 1% per month. Got that.
Got that, Sameer. Look forward to meeting you and chatting up with you. Thanks a lot for joining in. Well, let's focus on a corporate then. Shree Cement, the numbers look quite disappointing. The volume degrowth is something the street didn't like. We have Neeraj Akhoury, the managing director at Shree Cement, who joins in on the show. Hi, Mr. Akhoury. Thanks a lot for joining in and speaking to us here at CNBC-TV18. Tell us about this volume degrowth. The last time around you joined it, you told us the focus is on profitability rather than on chasing volumes. And that's the way it's played out even this time around. But now the degrowth for the first quarter is 7%. Earlier, you were talking about a mild 3% volume growth for the year. Does that hold?
Good morning, Nigel. I think you have to see it from both ways, Nigel. One is that in terms of prices, we have grown by about 9% YOY, or even in terms of EBITDA per ton, we have grown by roughly about 45%. It has been a very conscious strategy that we have been following, which we call value over volumes. A part of that strategy is now playing out. We are seeing that at this new price positioning, also our volumes are stabilizing. So I would strongly argue that the strategy which we have adopted is the right one to take the company in the future.
Right. That's the strategy that you have adopted, and maybe it could bear fruit as well. Yeah. But what is the guidance from here on? Earlier, you were guiding for ballpark close to 3% volume growth for the year and 6% realization growth, which meant that the revenue growth would be close to around 9%. Maybe you stick to the 9% revenue growth. You can clarify on that, but maybe you change both these two, variables.
No, we will stick to the same numbers, Nigel. In fact, on volumes, we would see now, in our view, we should be growing about 4 to 5% on the annual basis, around those numbers. And other numbers, what we have said is what we will be planning to achieve in the year.
So 4 to 5% volume growth still you're guiding for after seeing a 7% decline in the first quarter. So then you have to make up, big time. What does it do in terms of your profitability?
That we have taken this study for last 6 months.
Yeah.
And now it is playing out. Now our acceptability at the new price positioning is gaining ground. We are seeing the volumes in the key counters returning back. So with all that in having around, we believe that a 4 to 5% volume growth is the right number to look at.
So 4 to 5% volume growth, your revenue growth will be ballpark closer to around 9%.
Yeah.
And you believe that volumes will make up from here on. What about your EBITDA per ton? That's something that you held on to. You said you'll be in that vicinity of around 1,400 rupees per ton.
Absolutely.
Even though you degrew, you still managed that number, which is commendable because you didn't have operating leverage that's playing out.
Yeah.
For the year, 1,350 to 1,400 rupees per ton, you can hold on to?
Absolutely. So I think 1,350 to 1,400 is the right number for the full year that we should be able to deliver.
And you think this, you would have clearly lost market share in the first quarter because of the strategy that you've adopted. Lower volumes, the industry grew in, mid to low single digits while you degrew. So there would be some market share lost. According to you, what is your current market share? And will you recoup the market share you had in the past?
So let us see how the future plays out, Nigel. But we were at about 8%, and I think that we should be able to retain that. We are coming up with some new capacities. We have already commissioned some, and about 6 odd million tons of new capacity in India, and about 3 million ton in UAE is still coming up now. So market share in India, we should be able to maintain for the full year.
Got it. Are you interested in Deccan Cement, Mr. Kuri? One part of the street says that Mr. Bangur and team, they go and see a lot of assets, but they're not being very aggressive. They're just participating. They're not pushing hard. Deccan Cement, that's the last one that we have heard that it could potentially be on the block. Have you looked at that asset? Is there any interest? And even JP Cement, the last time around you said you will focus more on organic growth. These two assets, do they fit the bill? Will you look at that?
As I have always said, we will rather grow through organic routes. And if you look at last 2 years, 3 years, our growth is organically is about at 35%, much higher than the industry growth numbers in the same period. Acquisition, we are interested, but we have to get the right value and the right strategic fit. Otherwise, we will continue to focus on our organic growth route.
Okay, Mr. Parth Jindal as well yesterday at the press conference said he rather do it organically, but he said, I'm not going to tell you all how much I'm adding capacity at because then our competitors will know, how low the capex spend is for them. So that aside, we'll have to see how that pans out. Now, the UAE operations, that's always been a drag, but this time around, it's turned around very, very well. Impressive showing. What changed so much with them? And now you're getting confidence, you're going ahead and adding capacity. Has there been change in sentiment? Is there some kind of reason that these numbers are looking so good?
So we had done a huge amount of changes in UAE, be it in our operating methods, in our management, in our approach to market. All that has worked out very well, Nigel, for the last 1.5 years, 2 years now. And that is why we are seeing the results. UAE performance now is exemplary in our mind. It's extremely good, and we are seeing that with the kind of products that we are offering, the market demand is there, and therefore a capacity growth plan has been initiated.
So these numbers are sustainable, you think?
I think so. I believe so, and I'm convinced about it.
Okay, all right. What about the cash in your books? The last time around, you all were thinking about how to reward your shareholders. I think a few years ago, you all were getting peak multiples. The street was very, very happy. Now they believe that maybe the aggression is not there. Though you all have focused a lot on pricing, and that's paying rich dividends. Is there a buyback in the offing? Is there a one-time special dividend? Because your cash balance would be what? Close to 6,000 crores or thereabouts?
About 7,000 crores, yeah.
7,000 crores, so something for the shareholders, maybe a small buyback?
So, I really can't comment on this. This is a board decision. We will take it at the appropriate time. At this moment, as I said, we are fully focused on how do we reach our 80 billion ton capacity additions, capacity in the next 2 years. We are already exploring many more sites where we will start work this year. So for the time, I think we are more convinced about investing that money to grow the company to 80 million tons.
Okay, all right. So, both these two assets you're confirming you're not interested in, right? JP as well as Deccan Cement.
I would not say I'm not interested. I have never made that comment. I would continue to say, Nigel, that Shri will like to evaluate every opportunity.
And where will you be most keen, sir? Where will you be most keen? Because there will be probably a large conglomerate going by what we saw with Holcim. Probably Heidelberg at some point of time comes to the market because of what the global parent has decided. And that could be strategic in nature in central India.
Very speculative, Nigel. So I would not like to comment on that. Heidelberg is a strong player and they are doing well in India. I am not aware of any such strategy that they have taken of exiting India. I'm not aware of it. But for now, I would fully focus our entire efforts on how to grow organically. And as and when opportunities come, of course, we're going to evaluate them.
Okay, all right. Going by what the parents' commentary is with regard to emission, and where they want to head, probably the cement assets, in India will be something that we'll have to look forward to. But let's see how that goes. For the time being, we'll take your commentary on the organic growth plan. The growth of close to around 4 to 5% in terms of volumes, holding on to your market share of around 8% and a EBITDA per ton in that vicinity of around 1,350 to around 1,400 rupees. Thanks a lot, Mr. Ukuri, for joining in and giving us all of those details. Wishing you a good quarter ahead and we look forward to chatting up with you. For the time being, we'll slip into a short break. On the other side, we'll have the international trade expert, Abhijit Das, and the former finance secretary, Subhash Chandra Garg, who will be joining in to talk about Trump's tariff threat on India.
Welcome back. Now decisively lower. It's 24,600 in the Nifty. We opened flat, but now we've lost close to about a half odd percent. DLF is the top Nifty loser. The bookings numbers were good. 44% jump in Q1, but the stock is slipping. BEL, Adani Enterprises, IT stocks taking it on the chin. Infosys losses more than about 1%, and Reliance Industries too is quite weak in trade. But the big story is US President Donald Trump took to Truth Social last evening and he said, "We will substantially raise tariffs on India over its purchases of Russian oil." Following the US president's tariff threat, India has issued a strong response, a very strong response. Parikshit is now joining in with more on this. Parikshit.
The Indian government has tried to set the record straight with the US. They've gone on to say that the actions being taken by the US administration and the European Union against India for purchase of Russian oil are absolutely unjustified and unreasonable. And India will continue to take all measures necessary to safeguard national interest and also economic security. India has tried to remind the Trump administration that we started buying Russian oil after the war began because traditional supplies were being diverted to Europe. Secondly, the Biden administration at that time had encouraged India to go ahead and buy oil at the price cap because it was necessary for strengthening global stability in crude prices. Remember, there were no sanctions on India at that time for the purchase of Russian oil at the price cap that had been decided by US and European countries. Indian imports are necessity compelled by global market situation. That's the word coming in from the Ministry of External Affairs. The government has also said that it's very revealing that the very countries who are criticizing India right now and taking action against India for buying Russian oil and energy are themselves indulging in trade with Russia. For example, European Union imports of energy in 2024 had reached a record 16.5 million tons. US continues to import uranium, hexafluoride, palladium, fertilizers, and chemicals from Russia as well. So India is trying to set the record straight before a domestic audience, but it's also extending an olive branch to the US by saying that we are buying more oil and gas from the US. In fact, crude oil imports from the US are likely to go up by 150% year on year in FY26 itself. The trade negotiators will be talking later this month, but the word coming in from industry bodies and experts is that there is a need to dial down the rhetoric. It is important to have some clever diplomacy on the table and look for ways to save and protect this long-term strategic partnership, which is very critical for India.
Thank you very much for that. We're now joined by former Finance Secretary Subhash Chandra Garg. We also have with us Abhijit Das, international trade expert and former head of Center for WTO Studies. Gentlemen, thank you very much for joining in. Mr. Das, let me begin with you and the latest heat that we're feeling from Donald Trump. In the past, you've said that, this is Trump being Trump. His aggressive rhetoric should not be taken seriously in a way. But now it's just increasingly getting more and more provocative. What are your latest thoughts?
Thank you for having me on your show. Trump being Trump, as I said earlier, he will try to use the big stick in terms of tariff threats to extract as much of concessions as possible. He has already struck almost one-sided, hopelessly skewed deals in his favor with European Union, with Indonesia, with Japan, and a few other countries. He's trying the same trick with India, and it is to the credit of the government that so far we have stood very firm. Showing any weakness in front of the threats being shown by Trump could have consequences not only in the agriculture sector, but could have implications for access to affordable medicine, could have implications for our digital future, could have adverse consequences for even for sectors such as MSMEs through meeting demands of the US on government procurement. In a nutshell, Trump is using the tariff threat for extracting one-sided concessions, for trying to make sure that the policies in various countries, including India, are aligned, are changed to do just one thing: promote the economic and commercial interests of the United States. So that's where we are.
Mr. Das, Mr. Garg, good to have you on. Let me bring in Mr. Garg into the conversation as well. And sir, I just kept reading and rereading the lines yesterday, the NEA statement. It was quite telling, Till now, and it's been, 3-4 months. We've just maintained stoic silence, or not really engaged with any of the rhetoric. But yesterday was a very clear and very specific call out in terms of what the EU is buying from Russia, what the US itself is buying from Russia. So where does this leave the hope for some sort of a trade breakthrough? This looks like a bit of a logjam. Your interpretation, sir.
So you issue a statement bringing out the fallacy or the that United States, EU, all are doing business with Russia, and they're asking us not to do it. Now, that contradiction, etc., is aimed at what? It's aimed at telling the United States that don't try to fool us. Let us be clear about you are doing business. Let's also do business. Is that the intent, or is that the intent is that all right, now we have seen seen through your game, and we'll also not be any longer looking at the kind of deal which we have been trying for the last 3-4 months. So I don't know what exactly is the message being sent, but in my judgment, Trump, everybody now knows, is not only transactional, but he negotiates on the moment. That in this particular moment, what does he want? A couple of months back, he was against Ukraine in favor of Russia. Today, he has turned completely against Russia and is in favor of Ukraine. So that is something. It's very difficult. So to do a deal with a mercurial person like him, he has his objective, and unfortunately for the world, he has succeeded in wielding this tariff bludgeon in such a way that he has got what he wanted to get. Most of the world has given in to his ask. So whether it's EU, Japan, Indonesia, Vietnam, etc. So I think he sees today that tariff is a very, very good weapon in his hand. And he can make the recalcitrants like India also to fall in line by saying that 25% is one, but I'll put you under much more of a penalty kind of thing. So I think you can't have a negotiation under such a situation. It's like a storm. When some storm hits you, you don't do a deal with the storm. You try to weather it out. You try to see that it passes through, and your damage are limited. So in my judgment, what is today needed is that we should sort of call this bluff out of this tariff threat.
Yeah.
Let us look at our interests. We have $85 billion kind of export to them. 40 is exempt in any case, the electronics and other things which have a different trajectory. It's about $40 billion of the trade which is at risk of the tariff. In my judgment, if you don't offer any concession to United States on this, even if there is a 10, 15, 20% kind of loss, I think we'll be able to call this bluff out of the tariffs. That is the way to go rather than trying to find a deal with.
Mr. Garg, the point is taken. Don't chase a deal with the US given the unpredictability and the mercurial nature. But while India's overall share might be low in US trade, there are certain sectors where the cost of inaction will hurt them greatly. So it may be $40 billion overall, but it's restricted to certain sectors like textiles, for instance, gems and jewelries. So isn't that going to greatly hurt these sectors if we don't do anything and strike a deal? They may get impacted severely.
See, if you do a deal, let us say you accept 25% tariffs on textiles, it wipes out all your profits, all your margins. Then what are you gaining out of that export? So if you are, let us say, making 15% and you reduce your prices by 25%, what is that export worth? If that reality is recognized, and so this will tell you very clearly that in this situation, that if you're faced with 25% tariff, it doesn't make sense to export to textile to America. So what do? Suppose you have some surplus left and Americans don't accept. Then you either use that for our factories to use that in the domestic market, or take it elsewhere where there is no this 25% kind of thing.
No, absolutely. But sir, the counter to that would be coming in obviously from the specific segments that get impacted. And I think the textile folks have already reached out saying that they want some help with duty drawbacks, etc. And then there's a question of penalty. So 25% plus we don't know what penalty he's thinking of. Let me quickly go back to Mr. Das for the final word on this. Mr. Das, the issue seems to be that we're stuck at multiple fronts. I mean, this is not just about tariff, line-by-line tariff negotiations at all, right? I mean, there's market access issue. They want to bring in GM crops. Then there is the Russian oil issue. So do you see any scope of a middle ground?
Honestly, a middle ground does not exist because Trump does not believe in a middle ground. Trump believes only in his own ground and he doesn't want to concede anything to the other party. So in all likelihood, any deal which we might end up striking with Trump could be hopelessly tilted against our interests. And let's not forget that these tariffs, which are illegal from the WTO perspective, are also being challenged in the US courts. So should we be conceding huge ground, giving concessions just out of fear that Trump will block our exports through these illegal tariffs when at a subsequent date, let's say a few months down the line, these tariffs have to be withdrawn by Trump because they are illegal? I think at this juncture, prudence suggests that we hold on. We should not be making unilateral concessions. We should not be. We should not get cowed down by the tariff threat. We may have to endure a bit of pain, but in the long term, enduring that pain works better in national interest than giving concessions which Trump is demanding of us.
Yeah, absolutely. That's a point well made and well taken as well. So perhaps India, one of the few countries that actually hasn't, quote-unquote, bent the knee, as the EU is being called out for, and plenty of local opposition there for the deal that they've done. Thank you very much for the perspective that you've shared with us this morning. Appreciate you joining in. Well, with that, let's quickly get back to the market. The market, which could not really sustain with the opening gains at all. I mean, we are practically giving back, I think, 70% of yesterday's rally. 110 points lower on the Nifty now. Mitesh is back with us, and Mitesh has been cautious about yesterday's rebound as well. Mitesh, what now? What's the call? Index and stocks?
I've been talking about the Bank Nifty. Now, the Bank Nifty is just around yesterday's low, 55,437. And today we are at 55,470. So about 30 odd points away from yesterday's low. I think in that bridge, you could see some pressure on the Bank Nifty. Disclaimer, we have some put spreads over here. So there is already a negative position which I've taken. But I do expect, once 55,400 goes, there could be about 500, 600 point kind of decline on the Bank Nifty. And with that, I have a sell on HDFC Bank. That's a key component of Bank Nifty, and it's turning slightly weak, after making new highs and showing first signs of profit booking. So sell here with a stop just above levels of 1995 and look for a target in the range of about 1945, 1950 to begin with, and maybe even lower. And the second stock which I have, that's on the buy side. AB Capital yesterday had a big breakout bar. Today is giving a mild pullback. So if you get it around 274, 273, take long positions with a stop below 268 and look for a target of 285.
Thank you very much for that. Let's get to some stocks which are on the move. Godfrey Phillips is zooming on the back of a very strong Q1 performance. More than a 30% top-line growth. Manglam joins in with the fine print.
Well, it's a 37% top-line growth that Godfrey Phillips has showcased in the first quarter. And for perspective, ITC on a much larger base obviously showed cigarette revenue growth coming in at 7%. For the last 13 or 14 quarters, if I remember correctly, Godfrey has been outpacing ITC, and prior to that as well, barring 3-4 quarters, it has actually steadily continued to gain market share. Now, ITC obviously saw a margin decline as well, and Godfrey wasn't any different. So EBITDA for them grew at 25% at a time when the revenue grew by around 38%, and as a result of which margins came down from 25 to 22.7%. The street doesn't worry about that because a 38% revenue growth and them gaining market share definitely has the street excited, and the net profit, despite margins compressing, actually grew over 25% as well. 285 crore turned into 356 crores. The additional kicker that came in was the company announced a bonus of 2:1. So that's another thing that is leading the stock higher as we speak. Good numbers, bonus, and also them gaining market share.
Well, that's right, Mangla. And when Philip Morris came out with their set of numbers, actually it was very disappointing from Philip Morris's perspective. But their commentary on India was quite good, which hinted that maybe, in fact, these numbers could be a little bit better. And as we speak, the stock is racing away till around a 10% gain. I recall on Bazaar morning call itself, we had made this point that Godfrey Phillips, the read-through from Philip Morris actually was positive. The stock is reacting in a positive manner. IndusInd Bank, that's the top Nifty gainer. Let's revisit the news of the appointment of Rajiv Anand as the MD. Gaurav joins us to tell us more. Gaurav?
Well, yes, Rajiv Anand will be taking over a position of MD and CEO in IndusInd Bank from August of 25. Now, RBI has given an approval for the appointment of Mr. Rajiv Anand as MD and CEO. And remember, CNBC TV18 was the first one to break in this story that Rajiv Anand can be a front-running candidate for IndusInd Bank CEO and MD. When we look at the track performance for Mr. Rajiv Anand, it has been strong. He has been in the industry for over 35 years, and before joining IndusInd Bank, he was Deputy Managing Director for Axis Bank. He was also handling wholesale business banking there, and he was also one of the key person who was responsible for the digital banking there. In fact, he was also one of the founding MDs for Axis Asset Management in 2009 for 4 years. So definitely a strong track record is where he is coming from. And given the fact that he has a strong track record and experience of handling a bank which is bigger than IndusInd Bank, it is actually cheering up the market. In fact, this all started on 29th of April when Mr. Sumant Katpalia, who was MD and CEO, resigned from IndusInd Bank, and from there, in the 3 months itself, we are seeing this turnaround happening in the MD and CEO position. When we look at the overall uncertainties, now they still remain, but one part of the uncertainties is actually going away because of the appointment of MD and CEO, and this is what the brokerages are also penciling in. Now, Jeffries is saying is that the reorganization of the top management is one of the key things, which is key initial steps, but from here on, they will be watching out from any other joiners from Axis Bank or any other bank. In fact, Citi is also saying that from here on, there will be key things to watch out for, which includes strategic roadmap, execution capabilities, and ability to turn around the operating profit. Now, remember, ROA has been below 1% for IndusInd Bank, which is one of the cause of worry for investors, and that is the reason why we will be watching out on how the ROAs will turn around from here on. But definitely, as of now, good news is that Rajiv Anand is joining in, and as a result, we are also seeing stock is also cheering in day to day.
Thank you very much for that. We had a new listing today. Aditya Infotech, its market cap post the surge is about 7,900 crore, and it's had a fantastic debut, 50% up right now. It had raised about 1,300 crore rupees. Subscription was 106 times. Look at that, 51%. It's a company which manufactures surveillance products and services and systems, so your at-home IoT, CCTVs, etc. Good debut. Get into a break. On the other side, Manisha will join in to talk about commodities.
Welcome back. Let's talk about the commodity markets now. We have Manisha joining in with the latest. Manisha, what's on your radar?
Well, I'm looking at gold after very many days, Surbhi, and that is because with all these geopolitical concerns and tariff issues, inflation, we've seen gold prices actually come stronger yet again. Overnight was above $3,400 an ounce. We've seen 1.5% of gains come in for the gold prices. Silver as well gained up by more than 1% overnight. Gold actually with that 1.5% has been the biggest one-day decline in 2 months that we've seen gold prices to perform here. Remember, for the months of April, May, June, even July for that matter, gold has been holding above $3,300 an ounce. Every dip is getting bought into. For the Indian markets, I mean, look at that. We're trading at a 1 lakh rupees, 10 grams yet again. We did see prices decline down to 96,000 as well. But yesterday was an all-time high in the New York session for the Indian markets. And we seem to be holding that magical number of 1 lakh rupees for the Indian markets, even at this point in time. Well, it has to do with the weak US jobs data. That has weighed onto the dollar index. The jobs data came in less than what the street was anticipating, less than what we saw in the previous couple of months as well. And the last 2 months also revised down is something that has seen that money flowing back in case of gold there. Also, with those numbers, the markets are now pricing in an 80% chance of a rate cut for the month of September. Well, the probability mills also tell you that 60 basis points of a rate cut is what, by this end of this year, is what markets seem to be pricing in. Markets as well as gold for that matter, and is the reason you're looking at that support coming in for the markets there. The US also had unveiled tariffs between 10 to 41%. That takes effect from 7th of August. Ahead of that, there's a lot of conversation coming in from banks and brokerages, revising their gold forecast on the higher side for this year and the next as well. Also seems to be really supporting the markets. The global banks also have expressed concerns over near-term US growth, inflation outlook. Some of them have been talking about recession fears as well. Again, supportive there. And then it has to do with the Fed statements as well. San Francisco Fed president says that time for rate cut is approaching. Markets took cues from that. And then you also have Governor Adriana Kugler's resignation, where the markets believe that it gives President Trump chance to nominate replacement of his choice, are some of the things that the markets really seem to be reading. Citi was the only one, as we've been telling you, which have come in with bearish sentiment in case of gold prices. But they have revised it on the higher side now. In the next 3 months, Citi believes that prices can go to 3,500, 3,600, 3,800 is also what they're anticipating. In focus now, for you to watch out going forward, is going to be the June trade data, ISM PMI report numbers from US, and that is where the US dollar and gold will take cues from.
Okay, all right, got it, Manisha. Thank you very much. Well, on that note, we do have to take a very quick break, but when we come back, Lata is going to be in conversation with Goldman Sachs economist Santanu Sengupta and B. Prasanna of ICICI Bank on what the RBI could do in the policy tomorrow.
Welcome to It's the Economy. We are 24 hours away from the monetary policy, and the growth picture has gotten a tad more disturbing, with the US president reiterating even higher tariffs on India. Now, with inflation already undershooting, does this growth scare give the Reserve Bank another reason to cut, and perhaps cut tomorrow itself? That's the question we'll be asking. The market will also want to watch out for other indications other than rates, like, for instance, liquidity. I have with me B. Prasanna, head of global markets at ICICI Bank, and economist Shantanu Sengupta from Goldman Sachs. Gentlemen, good morning, and thank you very much for your time. Shantanu, I noticed that you have cut the GDP forecast because of this 25% tariffs, but it's by very, very marginal, 10 basis points for the current year. Would that really prey on the Reserve Bank's mind? I mean, 10 basis points, 6.4% GDP growth, not a bad number.
Yeah, so the 10 basis points is because there's only 5 months left in the calendar year. On our fiscal year basis, we are at 6.1 compared to the RBI around 6.5. Now, I think what is important is what the forward looking is on the tariffs. Our view is that this will likely not be the final word on tariffs, and as you can see, that there's been much progress overnight also. So we'll have to see where it finally settles at. I think the RBI will be looking at the mix of data. High frequency data has been mixed. Rural economy doing well, urban. There's some signs of tepid data. Investment data on the private capex front, especially, has been tepid. And our sense is that the RBI might just want to wait out and see how things pan out over the next couple of months before moving further if they have to.
6.1, you said. My own poll had indicated 6.3, with everyone saying there is a downside bias because they had not yet factored in the tariffs. But just tell me, what do you expect the Reserve Bank to say in terms of inflation forecast? They are at 3.7. What will they say, and what will they say about growth, you think?
Our sense is that they'll have to likely bring down both the growth and the inflation numbers. I mean, inflation purely from a tracking basis, with a huge downside that you've seen in vegetables inflation, but more broadly, food inflation has been relatively contained. Our number is around 3% for the fiscal year and the calendar year. It could be a tad lower depending on where finally vegetables inflation settle at. I think they will also point out that core inflation has been inching up. The governor also alluded to it in the interview with you, and the forward-looking inflation is important from their standpoint. On growth, again, we think that they'll have to bring down numbers a tad bit. There's a huge uncertainty around growth given where this final rate of tariffs, and then there are like elasticity assumptions that you make on different products. Not everything will sort of get impacted in a similar manner. So I think with the uncertainty around growth, they'll have to bring growth down a little bit, but inflation clearly down towards 3% is what we would think.
Yeah, I think so. The poll, my poll indicated 2.9. So, coming closer to 3 is a must. Prasanna, therefore, a double question to you. If they don't cut rates, but bring down, inflation and growth forecasts, inflation substantially, how will the market react? If they cut rates, how will the market react?
So I think, Lata, either way, we do feel that there are things for the bond markets as well as yields and the market to look forward to. If they don't cut, I think they can't afford to speak hawkish in any case, because like you said, and like Shantanu pointed out, there is a downside risk to growth which has opened up. We have also kind of revised it a tad bit lower. Plus, there is a twist in the tail in the US Fed as well, now with almost certainty that there will be a 25 basis cut in September, and followed by a reasonably larger rate cut cycle, maybe extending for 125 basis points till next year. And the fact that inflation is going to surprise RBI earlier estimate by nearly 100 basis points in Q2, and the average inflation for the year going to be at around 2.9%. They need to bring it down by 80 basis. So if you look at all of this, plus the fact that the high frequency indicators have slowed down, the possibility of a rate cut has opened up. We would say that a rate cut between the August policy, which is tomorrow, and the next policy is almost 100%. Now, it is a toss-up on what the RBI really wants to do. Do they want to front load? I mean, this dispensation has been clear that they want to front load and give a fillip to growth as soon as they sight the space opening up. So do they do that? Or do they wait for a whole lot of other data like the GDP data, actual GDP data, then the Fed action and all that, and delay it further for next 2 months? But to answer your question more directly, I think either which way bond yields are headed lower marginally. But I have to say that as far as duration is concerned, there is not a significant large move that we expect though.
Okay. When Prasanna says duration, he means the 10-year bond is not, the yields are not falling much. Whatever changes you see, I guess you are expecting more in the T-bill and the 10-year and the 1-year level, right, Prasanna? That's what you meant.
Yeah, maybe up to 3, 4 or 5 years.
You may see yields fall.
Yeah.
Okay. Okay. Now, am I right that both of you are expecting the Reserve Bank to cut forecasts but not cut rates? Shantanu, is that your position tomorrow?
Yes, we don't think there's a rate cut tomorrow. We think it is likely later in the year, possibly in the October meeting, maybe the December meeting, depending, again, on how things pan out. But on forecasts, we think that, yes, they will likely cut both growth and inflation numbers.
And that's also your expectation, Prasanna, right? No cut, but
no,
cut in
Lata,
forecast.
No, I'm not as strong in my views that there is no rate cut tomorrow like Shantanu. I think between tomorrow and the next policy, there will be a rate cut. You cannot discount the possibility of a rate cut tomorrow. The governor.
Intermeeting. You mean intermeeting rate cut?
No, I'm talking about RBI.
Yeah, I know. You're expecting RBI may cut between August and
between the policy.
Okay, either this or that.
And the next policy. So it's either the August or the October.
Okay, I might tell you that our own MPC voted just 3:2 in favor of a pause, like Shantanu. So very narrow vote. And likewise, Ritu's poll, which we will shortly present, is also indicating the market is very narrowly placed between this or that. But what else will you watch out for, Prasanna? We know that it's a small change, whether the governor cuts and right away or sounds dovish so as to cut on September 30th is a small change. But what will you watch out in terms of other impulses from him?
I think if he doesn't cut rates, then what I'll watch out for is a language that he's using to, justify a neutral stance. I think earlier, the neutral stance clearly came across as a hawkish stance where the rate cuts are not likely to happen. And that's the reason why the market felt that there is nothing forward-looking to look forward to from a policy perspective. But I think tomorrow the language that the governor will use will be very important. And the second thing is, of course, a whole lot of questions on liquidity. While RBI has been doing a very good job on managing surplus liquidity, and when liquidity gets taken away, also announce, short-term 1 and 2 day VRRs to give liquidity back. They've done a commendable job. But I think maybe clarity on what the liquidity policy framework is going to be in terms of usage of instruments and in terms of what are they targeting as a size of the liquidity surplus, and whether weighted average call rate versus SORR, which is the rate that they would likely to use for monetary policy targeting.
Okay, I don't know if they will say that all. They may give away the liquidity report, and maybe that will indicate. But yes, the market really wants to know whether are you watching TREPS or are you watching call rate? The charts will come up. Shantanu, guide us? What should we watch out for in the governor's language? Which sentences, which paragraphs?
In our view, the language is much more important for tomorrow. Look, I mean, if you think about the June meeting, they cut 50. Ultimately, financial conditions tightened through rates, both long rates and short rates being higher. That is because they moved from accommodative to neutral. So if you look at financial conditions in India from the previous meeting up to end of July, there's actually been a net easing only from the FX channel, right? Because, your FX depreciated, or the trade-weighted INR depreciated. That is the only thing that really eased financial conditions for you. Everything else tightened, including equities. I understand for the last couple of days, given the rhetoric on tariffs, again, the market is pricing in a little bit of easing. But therefore, our point is that the communication tomorrow is much more important than whether they deliver the 25 basis points of rate cut or not. So let's say, and Prasanna hopefully will agree with this, that if they cut tomorrow and the market gets the signals that this is the end of the cycle, I would imagine that the curve will steepen and you'll not get a lot of transmission apart from what you would be getting in any case from the EBLR channels. And therefore, the market needs to believe that there is hope for something more to come, but not yet fully delivered. And that communication is important for transmission to go through in our view.
Actually, I was fishing for that answer from both of you, that tomorrow actually a cut will not be as dovish talk and no cut, because that keeps expectations alive. Just a final question, Prasanna, currency, it's went all the way to 87. I mean, our low is 87.97. What do you, will that prey on the Reserve Bank's mind? And in any case, what is your forecast, say, over the next quarter?
No, I think the currency spot depreciation is not likely to prey on RBI's mind. It's not done from a policy perspective so far. So I would like to believe that they will continue with that stance, that the currency rate will be a reflection of the macros and flows. As far as the what we think on INR itself is concerned, I think it's been unfortunate that even as the dollar weakens and even as the dollar weakens against most of the other developed market currencies, current account deficit countries and India in particular have not been able to enjoy that tailwind, primarily on account of the significant outflows or the lack of inflows in both FDI as well as in FPI. And hence, and also you have a huge short position in the forward dollar market, which the market knows that the RBI will be looking to recoup and close out at some point of time when inflows come. So RBI has turned out to be a buyer when the dollar flows come in. And also, unfortunately, because of this rhetoric on tariff actually increasing over the last 1 month or so, this actually means that the rupee needs to depreciate in order to regain the competitiveness from the exporter side. So I think a little bit of depreciation is in the order, and most of the negative things seems to be coming. The only saving grace is oil is still very low and heading towards 60 due to OPEC considerations. But on the other hand, if the Russian-related oil spike happens, then there could be an uptick in oil. So the forward-looking view on oil also is a little bit not very clear. So from that perspective, I think there is a little bit of a depreciating pressure on the INR.
Oh, that's an important takeaway, depreciation of the rupee on the cards. Thank you very much, gentlemen, for laying all the cards on the table. We would know, of course, in 24 hours what the RBI thinks. Wrap up on Bazaar, Chartbusters coming up.
IndusInd Bank at one point was up 5%. Now the weakness of the market has come down, but still among the top Nifty gainers, up around 2%. As the RBI has approved the appointment of Rajiv Anand as the MD and CEO for the company, brokerages remain mixed. The stock off its morning highs, but still up 2%.
Tobacco products maker Godfrey Phillips delivers a smoking hot revenue growth of 35% and profit growth of 25% in the first quarter. The stock is up 9.5%.
Triveni Turbine slips on a disappointing first quarter performance. Revenue and EBITDA fall over 20% as geopolitical tensions hurt the business. Stock down 7%.
Angel One's client acquisition remains strong and market share rises in July. The stock, however, sees a sharp fall from the highs this morning.
Butterfly Gandhimathi reports strong margin expansion, revenue growth despite a challenging environment in the first quarter. The stock up nearly 9%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. We're still celebrating yesterday India's win against England, though the markets, well, we've given back most of what we put on in yesterday's trading session. Hey, Mangalam.
Hi, Nigel. You know, yesterday's game puts a spring in everyone's step. Yeah. Let's see what happens from here on. But just like, Test cricket, life is not any different. It gives you a lot of opportunities. Stick the ground and stick around. And obviously, even if it's a well-fought series, 2-2 is as good as a win.
Well, that's right. And we were in minority, right? If we thought that we're going to end the series 2-2. So it was good to see that the fight back. And particularly in this game, the way the English batsmen came out batting, best ball, it didn't really play out for them because they were playing a T20 at the start of it. They put us on the back foot, but our boys stood up and they got counted.
Baseball, unfortunately, has never worked against India in the last few years. Ever since, the baseball came by,
yeah.
India is the only team where they haven't defeated. But what we'll do is we'll talk about all of this off the air. Right now, we do have a bunch of earnings to contend with. AkzoNobel reported a weak June quarter. That's exactly what all the paint companies did as well. Both revenue and profit facing pressure along with margin contraction. But more lies ahead for the company as the big deal that we were talking about has happened. The CMD Rajiv Rajgopal joins in. The stock down about 3.5% on the back of the first quarter performance, but important to track what lies ahead. Rajiv, always a pleasure speaking with you. And instead of now asking you, what's happening, who's buying the company, now that we know all of that, the question is how far along the integration process is right now. I mean, by when is this entire deal likely to complete? And what have been the levers that have been put in place so far, ever since the announcement that has been made?
Good morning, Mangalam. Good to see you and Nigel, and good morning to all the viewers. So first and foremost, as far as the entire process is commenced, as you know, you were there when the announcement got made. The CCI application had got filed around the 17th of July. It takes, I understand, about 3 to 4 months, and then it will be followed by the open offer. At this point of time, I think that we are constrained to what we can discuss, and it's largely around the organization, etc., which the discussions started. Obviously, some of that will pick momentum because we've been also busy, given that fact that we had our board meeting and AGM, etc. So it will start picking up, and obviously factory visits, etc., will commence. But suffice to say, I think delighted to be part of a conglomerate, which is one of the most dynamic groups in the country. And hopefully, me and my entire team will sort of move lock, stock and barrel towards the end of the year. I expect the deal to conclude by the end of Q4 or early January, but that's the timeline we currently have, Mangalam.
But a lot of the work will be done before that as well, right? You want to hit the ground running. So while... Yes. My question was, while process takes its course and the integration formally happens by the fourth quarter, I'm sure you guys are now looking at where and what, all of that before you all actually formally integrate. So
there are a bit of constraints because of the CCI process. There are do's and don'ts of what we can and what we cannot discuss, and we are complying to each and every part between both the organizations. And it's important from our perspective, from a governance point of view. So hence, I think that entire, discussion would really start a couple of months or closer to when the CCI approval is in place. That's when really the momentum will pick up. But yes, I think at a very high level, we are understanding in our way, what we could do. I think the larger part is in terms of what the company name would be, etc. And I think it's more for Mr. Park Jindal to enumerate that. I think it's not fair on my part to really talk about it. So I leave it for him to sort of give you an update of what's happening.
You know, Rajiv, it's always good speaking to you. Me and Mangalam, we should think about how we're going to go about bowling this over. 6 balls, and then we had to bowl in the googly with regard to who's going to take over. Now, at least that query is out of the way. So let's focus on business. What's the split between retail and B2B segment? And in the first quarter, how did both these two segments perform?
So actually, this is one quarter, Nigel, where in the month of June, we actually had a very difficult month. Actually, April and May we were doing well, but I think because of the uncertainty exactly in terms of what's going to happen on the warranties that are given on the products, retailers in terms of what's going to happen to the stock lying with us. While we did anticipate some of it, and we did talk to about 700 dealers when we had a meeting with them in Kolkata around the mid of June, obviously it wasn't enough because it was coming across. So this was across both, I would say, on the decorative side, both on retail and projects, we had a tepid month. But you know what? The good news is July has bounced back. So pretty much if I now look at July, and July ended up with a growth, which may be a little contrary to the way the industry would have seen it. So if I take an average of July and June, I think we would have been there. I think now the trade, our customers and consumers have got a little more certainty of what's going to happen. And they know that the gear is going to change and we are going to get far more aggressive. So I think that's good. I think that's the good part. On our B2B business, on our coatings business, again, we had similar challenges, actually. And we also had end of order because marine and protective, for example, there's a clear order book for 6 months. We had a massive sort of an uptick last year in the same period where some of the naval ships were getting sort of quoted. Obviously, that came to an end. But again, if I look at the order book for the next 3 to 6 months, I'm not worried. I think this was a blip, and that blip will be taken care of. I think our journey, our quest of continuing to gain market share, giving both customers and consumers confidence in the fact that we are very much there. We continue to stand for best-in-class quality. And with the dynamic and the speed and aggression that JSW integration will bring in, I think we're really poised to really partake in the larger market.
Possible for you to quantify the impact around the channels on account of the takeover announcement? You said that June was difficult for you. I mean, I suppose part of that could also be on account of unseasonal rains, but a large part was because of this uncertainty. Could you give us a sense how much of that was lost and now how much of that has come back? What is it that you had to say to them?
So Mangalam, typically, see, look, I didn't talk about unseasonal rains or the early rains because that's got covered by many of my peers who already come on your channel. But really, I think we typically dealers in our case stocks approximately between 3 weeks to 4 weeks of stock. There was an impact of about a week because people started down stocking a bit, not sure in terms of what's going to happen next. We've had to send out letters to our customers and to our B2B customers, giving them an assurance that all the warranties and everything will stand good. AkzoNobel will stand guaranteed till the time AkzoNobel is there. And fortunately, JSW has also agreed, and obviously we want a seamless integration happening between the two business. Once that got done and people got the confidence, by the end of first week of July, things have started pulling back. So it's just a matter of time now that we believe that we will start sort of getting back.
What about the growth outlook for the year? So, if you could tell us what kind of ambitions would you have? Obviously, Parth will get involved at some point of time. I had a chat with him yesterday. He's sounding very optimistic about cement. So I'm sure he'll be quite optimistic on, paints as well. But what growth aspirations do you have? And Rajiv, do you have, is there going to be any price increases or do you think that's already in?
So Nigel, to answer that part, look, I don't think any price increases are going to happen at this point of time, because look, the market is discounting at a much higher level, and which is baked in. And fortunately, we've been able to, from a decorative side, at least keep our margins relatively intact. Our margin dilution happened in the coatings because of the mix. We sold more of the low margin business in the last quarter than the high margin, which is our vehicle refinish business, which will come back. To answer your question in terms of outlook, I believe that, look, we would end up with now a high single digit, not a double digit growth on volume, and value will slightly, maybe about 1 or 2 points lower than volume because of the fact that the growth is largely coming in the economy, waterproof, mass, those segments and construction chemicals. We are yet to launch our construction chemicals portfolio. We've just started testing it with a few projects, decorative B2B customers. And as we get confidence and as the stability, etc., is checked for, we'll then start bringing it into the B2C market. So we are fairly confident. I think we've got an aggressive plan. We will also come with a new campaign closer to Diwali. And with that, I'm fairly confident that we will start getting back. Again, my first ambition is to get back to being the top 2 in terms of growth, something that we lost last quarter after being there for almost 12 quarters. And then obviously then start really getting back for high single digit and then double digit growth. That's the progression.
So this year, high single digit and thereafter double digit.
Yes, absolutely. We stand committed. Yeah, you're right. I think Parth has had a conversation with us in terms of his ambition and outlook. It is very aggressive, and I'm looking forward to it.
All right, we take that point. Rajiv, thank you so much for that. What proportion of those conversations were around margins, or was it largely top line itself?
Both. I think, look, from our perspective, obviously it was largely top line, but there would be a margin conversation because erosion of margins is not really something that we would like to. It's about saying how we can reinvest in our business.
Right. Take that point entirely. Thank you so much, Rajiv, for joining in. Look forward to having this conversation with you closer to you getting the CCI approval and thereafter the strategies that you would be making as well. That's AkzoNobel, stock lower on the back of a weak first performance, but the company is guiding for better times ahead. With that, we'll take a short break. On the other side, we have the management of Aditya Infotech, CP+, which listed on the NSE with gains of over 50%. The IPO, remember, subscribed over 100 times.
Welcome back. You're tuned into Chartbusters. So let's get our next management on the show. We have security and surveillance products maker Aditya Infotech, which has made a strong debut on the street, listing with gains of over 50% to its issue price. To discuss the prospects of business going ahead, we're now joined by the Managing Director, Aditya Khemka, and Anup Nair, the President of Strategy and Business at the company. Hi, gentlemen. Good morning. Thanks a lot for joining in. Congratulations to all of you all. It's a big day for you, for your team, your families as well. So wishing you all the best. But, the very fact that the stock has opened up higher, the street will want to know some kind of guidance from you all. So give us a few details. What kind of utilization levels are you functioning at currently? I believe your market share is ballpark 20%. Where do you see that number headed? And if that's the case, what kind of growth are you looking at? Do fill us in with this.
Yeah, so thank you for having us, and I think we are highly grateful for the response we've got from the market on the listing. It's something we've been dreaming and cherishing for years. Thank you so much. So Aditya Infotech and CP Plus is one of the leading CCTV and surveillance company in India. We've been literally playing the role like an evangelist of this industry for last over 2 decades now. And we have, the largest dealer distribution network across 550 towns. The manufacturing is 3rd largest in the world in Kadapa, Andhra Pradesh. This is like the largest plant outside of China for CCTV and surveillance products manufacturing. And a lot of backward integration to take the company to Atmanirbharta, as the Prime Minister says, to become Atmanirbhar. We are working towards that direction. And, being the only brand, the only Indian brand at that space we are in right now, and the only brand known at the customer level with our, tagline, Upar Wala Sab Dekh Raha Hai, which really helped us resonate well with this technology and giving a name to this category. I think we are at a sweet spot and a perfect position to deliver value to our shareholders moving forward.
What are the numbers though? Let's get to some numbers. Utilization levels and
in terms of market share. So the market share for the company is at about 25% plus, and the market share that you were mentioning is for the own brand CP Plus. So that was at about 20% plus, and the current utilization levels is at about 75%.
All right. One of the questions that the street has is that a large part of your inputs are imported from China. Is there a country risk there, and what are you doing to integrate yourself fully from India? And even the products that you make from India, what are your imports for the components out there?
Yeah, so I think, Government of India has also come out with this new certification called STQC, which has several clauses regarding cyber security and trusted supply chain. So the company has, over the last several quarters, diversified the whole supply chain for all the critical components outside of China. So our dependence on the critical components or the semiconductors is no longer on China. So it's largely on American companies, Taiwan companies, and using Taiwan fabs. Once the fabs in India come up, which we are hoping, we could also localize the semicon, which is the major chunk of the BOM component. And apart from that, a lot of localization has already happened in things which, we can do in India, be it all kinds of power electronics or cable connectors, housings, and stuff like that. All that is already done in India, and a lot more is in the process. And as we see the electronic component manufacturing scheme showing some colors in the coming future, the passive electronics can also be localized. So I think it's a journey. We started as an import model, moving into manufacturing, into R&D, and now into localization. And also, we are working with companies like L&T Semiconductor to design IP camera chips from India. So the SoC design work is also going on. So a lot of work like that is happening. Even we just started lens manufacturing in our plant. I think one of the only companies to try that out. And those are things we are already initiating.
All right. 2,200 crores was the revenue in FY23. That moved to 2,800 crore and thereafter 3,100 crore in the last financial year. What is the potential growth rate that we should be looking at for the revenue for your company? What pace is the industry growing at?
Yeah, so the industry over the, let's say, last 5 years in India has been growing around 17%. And we have been trying to beat the industry growth over the last 5 years also, and we've been fairly successful. We hope to continue the same growth in the future, beating the industry and expand our market share. And hopefully with the new changes in the dynamics of this industry, with the STQC certification and the pushback to the neighboring country brands, which the Government of India has already regulated, I feel Indian brands like ours tend to hopefully gain better market share, and we will strive for that.
And what about margins? Will hold around 8%?
So margins are around 8.5% EBITDA, and Like Anup mentioned, 20% is of our own brand, and the balance is we continue to distribute another brand from China. But with this new regulation and tailwinds, a large chunk of our business will move to our own brands where we have a better margin. So we hope to increase that. And now even the manufacturing is 100% subsidiary. So earlier we used to consolidate half of the margin. We will have full margins consolidation. So overall, we hope the EBITDA level should be.
So 20% from your own brand goes to what number?
I'll take that. So what he meant is that the own brand share within the revenues is at about 75%, and the 25% is a distributed brand. So the blended margin is what you're seeing at 8.5%. And the own brand margins would be almost 3x the distributed margins. And with the tailwinds, it's the own brand that will grow aggressively. And so
from 75-25, what will the ratio look like?
So I think we believe it might go to a 90-10 because the neighboring country brands cannot qualify for selling IP cameras any further with the new regulation. So their play will only remain in the analog camera technology, which is more like a flat market.
So say 3 years from now, possible for you to get to almost 6,000 crores of revenue along with double-digit margins, given your past run rate and the triggers ahead?
So I don't know if I can comment on that with the futuristic numbers, but we would love to be there.
All right, take that point. Thank you so much, Aditya and Anup, for joining in. The street has placed a big responsibility on you all. The stock is up 60%. The issue was subscribed 100 times. So obviously, it's on you to go ahead and, repose return the sort of faith that everyone has shown on your business. With that, we'll take a short break, come back on the other side. We're getting more of the markets and stock-specific action. It's a 100-point downtick on the Nifty, which continues closer to 24,600. Let's see whether 24,550 to 24,600, the range that has been the support for the market, continues in today's trading session so far or not itself. And we've suddenly seen a switch between the number of stocks which are advancing versus the number of stocks which are declining. 1,600 in the red for about 1,000 in the green. We'll leave it to the team of Trading Hour and the others that follow to take you through all the rest of the trading. With that, we wrap up on this edition of Chartbusters.
Good morning. Welcome to Trading Hour. We are coming to you live from CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar, and with me is Hormuz Fatakia. It's 11 o'clock. Markets are down close to about 0.5%. So after yesterday's bounce, things have weakened in our own markets. We started flat, but now we've lost about 100 points. The Nifty is at the 24,600. So we couldn't manage to hold on or build on yesterday's gains, and that's a bit disappointing. Sectors which are under pressure: capital market plays. The Nifty Capital Market Index is down close to about 1.5%. Realty, FMCG, IT, and pharma. All these four sectors are down anywhere between 0.6 to 0.8%. Banks are also struggling in trade, particularly the large cap bank. The Nifty Bank too is down close to about 200 points. And what doesn't help is Donald Trump, the U.S. President, just escalating the pressure on India when it comes to tariffs. So all that's weighing. The mid-cap index too is down close to about 0.6%. But for that, keep in context that yesterday we were up nearly 1.5% on the broader markets. But Hormuz has now moved over to the big wall. Actually, he started the show at the big wall. Hi.
Hi, Reema. It's a sudden and sharp fall that you noticed in the capital markets index, particularly when you're counting down to a major listing tomorrow, that of NSDL. Keep an eye out on that. There has been significant interest for that name when it comes to the IPO. Well, to move on to the movers then within the broader markets, there are a few earnings reactions. We are counting down to a lot of earnings as well. And Triveni Turbine is among the top losers today within the broader market space, 7.5% lower. But it's not like the stock has fallen only today. It's been an underperformer for the last couple of weeks now and has gained only twice in the last 12 trading sessions. And over 25 lakh shares have already been traded in today's session within the first couple of hours of trade, compared to a 20-day average of just 2.5 lakh. PSP Projects was a big drag in yesterday's session. Today, the stock has clawed back some of those losses, but is off the highs. Promoters offloaded some of the stake. Adani Infra was the buyer in that block deal. Almost 1 crore shares were traded yesterday, and 6.5 lakh shares have already been traded today. The 20-day average comes up to just around 1.5 lakh. So for now, 3.5% higher on PSP Projects as well. Now, Newgen Software is the other one. Was a big underperformer over the last couple of weeks. In the last two sessions, the stock has gained well over 10%. Now it's almost 10% higher in today's session itself, and on the back of very strong volumes as well. Now, in comparison to a 20-day average of just over 2 lakh, we have seen already 12 lakh shares being traded on the stock. And a result reaction today is Godfrey Phillips. Mangalam spoke about the factors that aided the quarter gone by. The company has also announced a bonus issue, 9.5% higher on that stock. It's at a 52-week high, and 6 lakh shares, almost 7 lakh shares now already traded on the counter, compared to a 20-day average of just 1 lakh. And an interesting bit here is the fact that barring the month of January, the stock has gained every single month in 2025, taking its year-to-date advance to around 90% now. So the stock has almost doubled on a year-to-date basis within the first 8 months of the year. Positive earnings reaction on Godfrey Phillips, but some pressure within the broader markets.
Thank you very much for that. I think we're getting some news on Anil Ambani. He's reached the Enforcement Directorate office in Delhi. You can see the visuals up for you on your screen. He was summoned questioning as a part of the ongoing probe into an alleged 17,000 crore loan fraud case. So that's the ED probe, which is ongoing, 17,000 crore. And that's Anil Ambani at the Enforcement Directorate headquarters in Delhi. Live visuals coming through. But let's get to more stock-specific action back home in India. Vivek is now joining in with the standout brokerage report of the day that Nimesh highlighted earlier in the morning. Vivek?
Well, that's right. So our colleague Nimesh highlighted earlier in the morning a standout brokerage coming in from US, a deep dive that they've done as far as the power OEM sector of India is concerned. So what is it that they like? Number one, they have an anti-consensus positive stance as far as number one, both thermal ordering as well as solar module manufacturing is concerned. Remember, overall street is quite muted in terms of the prospect, saying that thermal is likely to fade away. However, UBS on the other hand actually says that there is an upcycle ahead in terms of ordering, and they believe that the advantage actually goes to incumbent leaders. So where are they positive on? Number one, they've initiated buys, and they have buy ratings on BHEL, Wari, Premier Energy, as well as Suzlon. Thermax, they've maintained the buy rating and have actually increased the target price to 5,100 rupees a share. What is it that they like in terms of for BHEL? Number one, they like the rising thermal orders that the company is set to bag. And remember, it's almost a moat, especially when it comes to BL as far as construction of thermal power plants in India is concerned. They believe net profit is likely to rise 8x by FY28. When it comes to Premier Energy, in terms of integrated manufacturing capacity in the solar cell module space, they like that. They also like the company's 10 gigawatt backward integration capacity could drive 34% top-line growth, 36% EBITDA CAGR from FY25 to FY28. Waaree Energy, again, very similar, capacity-led earnings acceleration underway. They expect almost a healthy 620 basis points EBITDA margin expansion. And lastly, when it comes to Suzlon, they believe that the sector tailwinds as well as competitive edge may actually lead to earnings growth as far as this wind turbine generator OEM is concerned. They also like that the company's annual deliveries right now at 1.5 gigawatt. They expect it to go ahead and see a significant uptick to 4.2 gigawatt. Overall positive on power OEM as well as the solar space.
Interesting list there. Vivek, thank you for that. And in this list, Waaree is the one that UBS sees the highest upside potential of 40%. And the rest too is anywhere between 20 to 40. So very bullish note coming in on all of these names. But, well, it's not reflecting on the price today. Waaree is at the lowest point of the day now. Suzlon is the other one, is where they see a 20% upside as well, does UBS. And that too has given up most of its gains now, trading around the flat line is Suzlon. But shifting back to the stocks on the move, I highlighted Godfrey Phillips in just a bit from just a few moments earlier as to why the stock is moving higher. But Mangalam is here to break down the numbers as to what actually contributed to this 9% up move. Mangalam.
Well, if you're growing to, I'll just say that again, because if you're growing at around 4 or 5 times the industry leader, then you are bound to see the kind of stock price move that we're seeing on Godfrey Phillips as well. 38% revenue growth is what the company has reported, closer to 1,500 crores on the top line. This compares with 1,079 crores that the company did earlier itself. And we did see margin compression for ITC as well, but that's come by for Godfrey Phillips too because of high leaf tobacco prices. But when you're growing 38%, a 25% EBITDA growth looks a lot better than growing at 7% and then the EBIT growing at around 3 to 4% itself. And as a result of which, the net profit has grown 25%. And it's been the last 13 or 14 quarters, if I remember correctly, where Godfrey has been outpacing the industry, not just ITC, but VST Industries as well. And that continues, which explains why the stock is higher by almost 100% this year itself. And prior to that as well, we've seen a big move. Add to all of this, the company has gone ahead and announced a 2:1 bonus. So that's a positive for shareholders. And they've also stated their intent to go ahead and get rid of their retail business. They did that about 3 quarters ago. So all the strategies in place for them to continue to gain market share and grow faster than the industry.
Thank you very much for that. Get into a break. On the other side, we put the focus on the crypto market. Manisha Gupta joins in.
section.
Welcome back. Still continuing to hold on to that 25,600 mark on the index as of now. Still 100 points lower is where we stand. But shifting focus now to commodities, and Manisha is here to put the spotlight on crude oil prices after yet another increase in production approved by OPEC Plus. Manisha.
Well, yes, and markets weren't expecting a huge number, but what we have seen from April, May and June, and then of course extended to July and August and now September as well, we'll see 547,000 barrels per day of further hike in output coming in from the OPEC. Well, the 8 members clearly are eyeing the market share. What with all these geopolitical tensions and the US talking about not just primary but secondary sanctions as well coming in on Russia, we have seen pressure come in for the crude oil prices. The markets as of now do not believe that you could be looking at those kind of sanctions on Russia, because if that happens, then we are looking at a very big chunk of Russian oil getting out from the market. That could lead to a spike in prices. And most global banks and brokerages believe that even if that happens, would be for a very short period of time, because one, you will have OPEC supplies coming into the market. US has been increasing production, and at these higher prices, whoever is holding in sense of production spare capacity will start to come into the markets. Well, actually, most banks and brokerages are talking about lower prices going forward. If all goes fine and we do see this conversation settle down after sometime in the month of August, the fourth quarter could actually be looking at lower crude oil prices. Goldman Sachs has talked about $64 a barrel for Brent, and the first quarter could actually see 56. We were talking to Mizzou yesterday, and they've talked about sub-$60 barrel prices by the last quarter of this year. So not too many banks and brokerages are very bullish on crude oil prices from here. They believe that whatever is happening is going to be very short-lived, a near-term phenomena. By the end of this year, you could be looking at 50s and 60s in case of crude prices.
Thank you very much for that. So today the IPO of Knowledge Realty Trust opens. Now this is a REIT. It would be the third REIT in India which is in the commercial office space. The fourth one is the Nexus, which is largely catering to the retail side of the segment. Now Knowledge Realty Trust will be the largest REIT in India based on the gross asset value, which is close to about 60,000 crore. It will be the second largest office REIT in Asia, and their portfolio currently comprises of close to about 46 million square feet of a total area. Their occupancy has also gone up from about 85% in 2023 to about 91% as of the last fiscal year. And some of the tenants that they have in their company include Amazon, Cisco, Franklin Templeton Asset Management, HDFC Bank, amongst others. So it's a healthy mix of GCCs as well as a lot of multinational companies. Yesterday, we got the announcement that the company's raised about 1,620 crore via its anchor book. Shirish Godbole, the CEO of the company, and Kaisar Parvez, CEO of Knowledge Realty Trust REIT, are now with us on the company. And this is a company which is backed by Blackstone, sponsored by Blackstone and the Satwa Group. Thank you very much for joining in, gentlemen.
Thank you for having us.
Thank you. So, Shirish, let me start with you. I remember from an earlier interview of ours where you spoke about targeting a mid-teens kind of a revenue growth. That's what shareholders should expect. See, that's ultimately what matters, right? So take us through the math behind that number. And how is your REIT different from what's available in the market right now?
Sure. So mid-teens total return is what we had discussed. And current return, or dividend yield of 7.2% stabilized, going up to 7.7 and 8.7. So a mixture of fixed return plus upside through NAV appreciation over a period of time. That's the mid-teen return. That's what we discussed, and that's what we're looking forward to provide to our investors. And how we differ is in a number of ways, honestly. First of all, I think we've got a very solid portfolio of assets. They are very well located, diversified, primarily in the best office markets, Mumbai, Bangalore, Hyderabad. We also have a very small SEZ component. In today's markets, leasing SEZ space has not been easy thanks to the rollback of the tax concessions from the government. Third, we have a very good internal growth story. We have significant CAGR, as I've called it before, compounded annual growth rate per year of our NOI growth, which is 13%. And our mark-to-markets, the rents are way below where market rents are. So we have a 20% upside sort of potential to increase those rents over a period of time. So that's very positive for internal growth.
So for what percentage of your portfolio can we see a 20% escalation?
So it's $1.5 million per year sort of maturing. And so $1.5 million square feet per year will roll over, and that will see the appreciation
of 20%.
Of 20%, right? But going back, the fourth thing we have is a very good external growth story. So we have a mindset to acquire assets. We have a brand neutral platform in Knowledge Realty Trust, and we want to use that brand neutrality to attract more sellers into our portfolio. So we'll be growing and with an active mindset to acquire, which has not been the case, with other competitors going past. But the most compelling reason, I think, is when you add that together and offer it at our yield. We're offering 7.2, as I said, stabilized, where someone like an Embassy is trading below 7%, and then someone like a Mindspace is trading below 6%. And frankly, we think we have all the attributes, if not more. So that's what makes it a compelling buy.
Gentlemen, Kaiser, to you then, the utilization of your proceeds. You mentioned, Sirish, that you want to acquire assets as well.
Yeah.
Will the proceeds, some of it at least, be used to acquire some of those assets that you raised from the IPO, or would it be used to pare down the debt at an SPV level? What are your utilization plans of your proceeds?
Yeah. So
yeah.
So the complete raise of 6,200 crore is a primary raise. All of that will be used to pay down the debt. In fact, that money is essentially used to sort of improve our balance sheet and strengthen the portfolio. And post the money, really, our LTV becomes 19%, which is the lowest LTV in the listed space.
And so post which you will be debt-free at an...
Maybe 19%.
19%.
Yeah.
Got that. So currently, the portfolio is about 46.5 million square feet. You spoke about how you're actively going to be in the market to aggressively expand and acquire. So what have you set your eyes on?
So, for acquisitions, we're really being opportunistic, right? I think the key as a company going forward is we're going to make sure we have accretive acquisitions. These are going to benefit our DPU and distributions to our shareholders. And so it'll depend on the opportunity.
But is there something which is in the pipeline? Sorry to interrupt.
Well, we have multiple, sort of assets that we're going after. But I think they're too early. I think right now we want to get the IPO done, get our act together in terms of operations, and then sort of pursue the acquisitions immediately after. But we'll be in the major cities that we have already got a presence in. Pune is another example where we might expand into. Calcutta, maybe one more. And then over time, tier twos are getting attractive as well. So we'll keep our eyes open, but initially it's the major cities in India.
You're present in Gurugram, but is Delhi NCR not part of your expansion
Of course,
plans?
No, it will be. So I think we have one asset, but we're clearly looking out and will look to expand. It's a very strong market, and besides the three strongest markets that we have, Hyderabad, Bangalore, Mumbai, NCR is obviously the next one. So we'll look out for acquisitions as we go forward.
Kaiser, just to come back to the point about the dividend yield, right? It's 7.2%, it goes up to 8.2%. But now real estate is also a cyclical business. There are ups, there are downs. So, in a down year, where do you think the dividend yield can come down to? I mean, set the expectations right, for shareholders. Yeah. And especially as you are planning to expand even into tier 2 cities, where you may not be able to command the kind of rent escalation that you do in marquee properties in BKC, for instance.
Yeah. So I think that's a very relevant question. And I think we always say that real estate is cyclical and upturns and downturns. We take pride in the fact that our portfolio is very well positioned for the down cycles as well. And why we say that is because of a couple of levers of growth. So first, obviously a 13% NOI CAGR, which essentially comes from two big facts. One is obviously, sort of leasing up of the vacant spaces, but an even more is the mark-to-market potential of 23%, which is unlike any other listed peer. And what really sort of happens is that every time a lease expires, it gives us a natural reason for an uplift in our rents. And that's a big growth. The other big growth comes in from our contractual escalations, and those escalations, all our leases are contractually escalating at a 5% annually or a 12 to 15% every 3 years. So if you add all of these together, you're getting a yield of 7.2 on an average.
I get it, but this is the projection from FY25 to FY29, which is one real estate cycle that we're currently in, where your NOI projection is NOI is net operating income, projection is 13%. I meant, give us a sense, like say the last 10 years, last 15 years, where we've seen a cycle. What has been the average, operating income growth or the dividend? I mean, we didn't have a dividend yield, but say the NOI growth.
Yes, and exactly to that point, because our rents are much lower than the market, we have enough cushion and buffer.
Even beyond FY29.
Even beyond FY29, because we have 23%, our current rents are 23% lower than the market. So in some ways, it insulates through a down cycle as well, right?
And also, I would add that, to Kaiser's point, we've got assets which are very well located, good quality. So what happens, Rima, is in an up market, they benefit. But even in a down market, they're able to weather the storm the best. And I think that's the beauty of the assets we have.
If you could give us a sectoral breakup as well of your assets, which sectors do you have the maximum exposure to? Because there has been a lot of chatter or a lot of news flow surrounding the IT sector and the layoffs that are happening there, so on and so forth. Do you see any impact because of that? Is this just a sectoral exposure?
I think that's a very relevant question. In fact, you're right. The IT services is going through a recalibration. Fortunately for us, the IT exposure, the traditional IT exposure is in low single digits. Most of our tech-linked exposure is through GCCs, and most of these GCCs operate very differently compared to like a project-based IT services firm. In fact, we take a pride in a massive, strong tenant diversity. 45% of our rents come from GCCs. And a big part of the other section comes from BFSI, pharma, engineering firms.
I think you also said last time, 7 out of the 10 large top 10 clients are also GCC.
Yeah, absolutely.
Just out of time, thank you very much, both Kaiser and Shirish, for coming down and speaking to us. Wish you all the very best.
Thank you.
Thank you.
Thank you very much for having us.
Glad to be here.
All right, on that note, we need to slip into a very short break. Don't go anywhere. On the other side, we'll discuss the market technicals. Videsh Thakkar joins in.
Some recovery from the lows of the day for the benchmark indices. We are back at the 24,650 mark as of now. But of course, that does not take away from the fact that there are a lot of movers in the broader markets. Godfrey Phillips is now up 10%. as we speak. There are other movers like the New India Assurance, that is up 8.5%. Yash just spoke about New India Assurance last week after its results and some strong management commentary. So another 8.5% on that stock. And Tata Investment announced results yesterday, announced a stock split yesterday. They will be splitting their shares into 10, and that too is up 6% in today's session, slightly off the highs of the day, but still trading with gains of around 6%. Some other earnings reactions that have come by: Inox India down 5%, TBO Tech is down 4 as well, and some of these capital market names too trading lower, be it the likes of BSE or MCX. Run up as well quite a bit has MCX, so seeing some bit of a cool off from the higher levels. But what is the current trend within the futures and options space, considering we've seen a fairly choppy first couple of hours? Mangalam is here to decode just that for us. Mangalam.
It is indeed fairly choppy, and every time we move towards that 24,750, 24,800 mark, we see some supply. At the lower levels, there is some support coming between 24,550 to 24,600, and we are, seeing moves around this range itself. And right now, as we speak, we're on the lower end of that range. So Nifty down almost 81 points. We have the mid-cap index down 0.25%, though it's off lows, still fairly off highs. And then I looked at a couple of data points. August 1st low of 24,535, an important level to watch out for. And August 4th high of 24,736, which was yesterday's high, is the range in which the Nifty is likely to meander as we move forward. And that's what option writers are indicating as well, because the 24,700 call, which has a premium for almost 75 to 80 rupees, fairly well traded in today's trading session, telling you as you move towards 24,750 to 24,800, there could be some sort of resistance. But at the lower level, the 24,600 put writers are equally active for a premium of 75 rupees. That tells you that around 24,500, we could see some support that comes in for the market. For those who are writing the straddle of 24,650, they are playing for a broader range between 24,450 to 24,850 on the Nifty. A lot of stocks on our radar, long positions particularly added on a couple of these auto components. So we have Uno Minda and Sona BLW, both of them fairly well bid in today's trading session. But the capital market plays, all of them are seeing some short additions. So we have BSE, MCX, Angel One, all of them in the red on the back of some short positions being added.
Thank you very much for that. Mitesh is now back with us for a quick technical check on the markets. Mitesh, hi, welcome back. Your thoughts on the kind of little bit of a sell-off that we've seen in the last 1 hour, and what would your calls be?
Yeah, I think, good morning again. I think it's just that the market is not directional, and that's why you're getting this choppy kind of 1 day or 1 day. My sense is that keep a watch on the bank Nifty. If it starts trading below 55,400 and closes below that, we might actually see the bank Nifty correct by about 500-600 points, which could in turn have an effect on the Nifty as well. And both the indices could then slightly be trading lower. So watch the index closely. In fact, I had a sell on HDFC Bank earlier. So right now, even ICICI Bank is turning negative. So sell here with a stop at 1460 for targets of 1420. And both HDFC and ICICI, I think, command a fair amount of weightage in the bank Nifty. So that way, in that sense, it looks likely on the negative side. And on the buying side is Jindal Steel and Power, which I would recommend buying the stop at about 974, targets of 1020.
Mitesh, thank you for joining in with your views on the index and on specific stocks as well. And the index currently still 85 points lower as we speak. And the other one that we were talking about is Mahanagar Gas, MGL2, is down around 3% in today's session. A couple of Nifty names reporting results today include the likes of Adani Ports. That comes out with numbers later in the day, and of course awaiting numbers from Bharti Airtel as well. That too is currently trading with gains of around 1%. Adani Ports has now almost moved into the green after recovering from the lows, and Bharti Airtel continues to remain at the highest point of the day. I take a short break, and just as we do that, some more market opinion. We spoke to Samir Arora, the founder and fund manager at Helios Capital, and listening to excerpts from that conversation.
You see the big pools of earnings. So IT is growing maybe 3-5%. Large consumer is excited if they grow 5%. And the large banks are growing 8-10%. And after 1 or 2 quarters, they may grow 12-14%. So as of now, the aggregate earnings growth is 9-10%. Therefore, it would be reasonable to think that over the next 2-3 quarters, or at least till the end of the year, you're only supposed to make another 5-6%, which is 1% per month kind of return will be great. This one I am not buying right now because, we have seen when there are these legal cases, one is just a results and growth and one day they're becoming earnings and all that. But here there are, you've seen how cases come up 1 year later and 6 months later. And so this is a bit more complicated. Plus in financials and in banks, we already have our exposure. Keep going on and they drag for years or 1 year, 6 months, whatever. Plus in this, we have enough exposure in this sector, so we don't need to try it. The foreign flows are coming from Feb 1. If you see in aggregate from February 1, the flows are positive. This month, they were negative for 2 reasons, I think. One was the Trump tweets or whatever. And second was the results did disappoint a few people if you looked at them individually. So overhyped, I've always said these new businesses are normally overhyped. I have read many books on this, particularly this solar theme. They might be great for India. We need it for climate, but for investment, these things never work. And even IT is still overhyped.
Welcome back. The big news break of the morning was the fact that the new CEO appointment of IndusInd Bank, and that was approved by the Reserve Bank of India. Rajiv Anand is now at the helm of affairs at IndusInd Bank for a period of 3 years. Let us now revisit the news. Gaurav is joining in to give us a sense of what brokerages are making of this development as well. Gaurav.
Well, yes, definitely a positive move for IndusInd Bank, and the reason being that now Mr. Rajiv Anand has been appointed as MD and CEO. He will be taking over as a post of MD from 25th of August for the next 3 years. Now, remember, RBI has approved the appointment, and we were the first one to break in that he could be a front runner in the series of IndusInd Bank's MD and CEO's search. Now, if we look at the track record, he has shown a very strong track record so far, more than 35 years of experience in the banking industry, and before joining IndusInd, he was also a part of Axis Bank as the as a Deputy Managing Director. He was also one of the founding MD and CEOs for Axis Asset Management from 2009 to 2013. And he also has an experience in Axis wholesale banking business. And also he was responsible to drive the digital banking for Axis Bank. So definitely he has an experience for handling a bank which is bigger than IndusInd Bank, and that is the reason why market is taking this move in a positive way. Let's not forget that on 29th of April, Mr. Sumant Katpalia resigned from the post of MD and CEO, and within the 3 months itself, we are seeing this turnaround happening. And at the same time, let's also not forget that concerns around the fundamental problems of IndusInd Bank, they still remain. But given that there is a new phase to management, now market is taking it in a positive way because there will be some clarity on how the bank is going to go towards that 1% ROA and even further going on. Other than that, now brokerages, when we look at them, they are also being a little bullish. Jeffries said that the reorganization of the top management is one of the key steps, but from here on, they will be watching out on if any other member from Axis Bank or any other bank is joining the bank. Citi is also a little bullish about the bank. What they're saying is that from here on, the key monitorable includes strategic roadmap, execution capabilities, and also its ability to turn around its operating profit. So definitely they are being optimistic, but a little cautious. And as a result, when we look at stock performance also, it is up in trade today.
Thank you very much for that. It's up 1% now, so it's come off. At one point of time, the stock was up nearly 4-5%. But let's talk about Triveni Turbine. Stock is tanking post the disappointing Q1 numbers. I think it's a top-down miss. Vamakshi joins in with the details.
Well, absolutely, Reema. Weak set of numbers for Triveni Turbines. Keep in mind that this time around the performance was impacted by the geopolitical uncertainties. The revenue saw a dip of almost 20%, and this dip is largely being led by the domestic markets, which fell by almost 24%. Exports were down to almost 15% on a year-on-year basis. The gross margins, though, more or less saw a slight bit of an improvement by around 32 basis points. But given the kind of rise that we've seen in the employee expenses, which were up almost 14%, the EBITDA margins contracted for the company by almost 81 basis points, and the net profit saw a decline of almost 20%. So overall, a weak set of numbers. This time around, what the company has said is that the performance was extremely disappointing. It came in below their own expectations, and this is because there were deferment of dispatches as well as the orders to the subsequent quarters. This happened because of the geopolitical uncertainties, which is why some of the international customers could not complete their inspection on time, which has resulted into this dent on the results. As far as ordering activity is concerned, it was weak. The total order inflows declined by almost 16% on a year-on-year basis, and the exports is the main reason why this decline is being witnessed, because the exports have declined by almost 40%. Now, keep in mind that Q1 FY25 did have a large base for the exports, so therefore there was some decline on account of that. But apart from that as well, the management has alluded to lower export demand across products as well as the aftermarkets. Now, we also had some commentary coming in from the management. They say that the quarter's performance fell short of their expectations, but they, however, are taking efforts and they are trying to realign their operations, and they are confident that the company can manage its growth trajectory going forward. So for now, it's a disappointing set for Triveni Turbine. Resultantly, the stock is down and out in trade today.
Down and out indeed. 7.5% lower on that stock is the Triveni Turbine. Vamakshi, thank you for that update. Anirudh Garg from Invasset PMS is now joining in on the show. Anirudh, good morning. Thank you for joining in. Would you call this quarter a fairly resilient one considering the expectations that we had, or would you still fall into that category that the earnings recovery that was anticipated is still a couple of quarters away?
I think. Firstly, a very good morning. I think that is the way the markets are. Markets are always future discounting, and that is what is happening in the markets right now. We are setting up a base for a better year to come. Though I believe that there will be some sectors which will continue to face these pressures going forward as well. But I think whenever there has been this uncertainty as is going on now, whenever there is confusion, whenever there is fears, especially the markets, not the companies, but the markets, they make better bottoms and provide a better opportunity of growth. We are very confident that in the next 3 to 4 months, we should see all-time highs on the Nifty.
All-time highs in the next few months. Can you quickly, Anirudh, take us through your top bets? I mean, the way your portfolio is constructed. I know, a couple of months back, you had said how pharma was your big bet. 20 to 25% of your portfolio was concentrated in the pharma healthcare bracket. How has it changed?
Okay, so now I think with the uncertainty coming over, though pharma is still CDMO, CMO was our bet, I still believe there is steam left there. But overall, we had shifted from pharma. Why? Because this uncertainty that that Trump is, changing his stance every day, not behaving like the biggest economy in the world. So what we have done is we've made a portfolio Trump-proof. There are a lot of opportunities, domestic opportunities available. For example, the capital market infrastructure sector, defense and railways, and a lot of consumer names which are gaining traction. I think commodities are back in flavor. So we are just sitting on the side, and then if the things we get any early shoots of things settling down with the US, we'll enter those spaces again.
Anirudh, what about the capital market plays? There has been a lot of uncertainty regarding more regulatory action coming in for a lot of these players, but considering the fact that if the markets are bound to move higher, say over the next 5, 10, 15 years, do you see this as just another speed bump in what promises to be a longer term growth trajectory going forward for all of these players, be it the broking firms, be it the asset managers, and be it the depository participants as well, especially considering we have one listing tomorrow?
Yeah, so I think you're absolutely right here when we say that in the long run, see, the fundamental relative change is that the psychology of it is very, very difficult to change the psychology of the investor. We all come from the background where our parents and our grandfathers used to invest merely in FDs, and today FDs are no longer considered an investment by majority of the people because of those efforts of SEBI, AMFI, the mutual fund Sahi Hai campaign. People have shifted to the equity culture in the past 4 years. There's been tremendous change, and it is very difficult to get. It is I won't say a decadal change, but a generational change. And this relative change is much, much more stronger than smaller regulatory approvals. What regulatory approvals are happening, I think they will aid rather than stopping. They will aid the confidence of the people. They will strengthen it. So all these regulatory approvals where a few firms are making so much profit and the general public is losing, it is somewhere the duty of the exchanges and especially the regulator to check that such I would go to an extent of saying loot should not happen in the Indian markets. That is how the sanity and the trust in the market would be preserved. I'm totally with SEBI in it that options, I believe, are weapons of mass destruction unless used properly. And if they are doing it, delaying it to 15 days or maybe going forward into 30 days, I think it's a good move. The capital market infrastructure has seen a decadal generational change, and this change should continue.
NSDL, since we brought that topic on, I mean, did you all participate? Were you all subscribers in any firm at the anchor book or even otherwise? It's a very good subscription for a large issue. I think total was 41 times. And now once it lists, is there still any juice left?
I think there's still juice left, Rima, because these are the two monopolies out there. Yeah, it's a duopoly set up with one of the greatest, Indian markets. I believe Indian markets and your markets, they are the only two economies in the world where you will find democracy and demography both, which are very, very essential for stock markets to flourish. For these markets, there are only two depositories out there, CDSL and SDL. So I'm very, very bullish for them in the long term, though we have not subscribed to it because as per policy, we do not go in for IPOs.
Anirudh, a lot of these chatter around the tariff-related bit has had a lot of impact on all of these textile names, be it Gokaldas, be it KPR Mills, be it Wellspun, and the peers and so on. But do you believe that this higher tariff rate is detrimental to their prospects? And if you do have exposure to them, what do you recommend doing now, especially considering that there is an overhang here and there is, even if there is a deal that happens, this uncertainty is likely to continue to persist for at least till the current US president's term goes on. So what do you do with these textile stocks, particularly those that have a significantly large exposure to the US?
Okay, so we were primarily bullish on these companies because we believe that somewhere sanity will prevail and the better ones, the ones which are professionally managed, will rise from the ashes. But from what the US president is doing temporarily, I think it's okay to hold on. We don't have much exposure, not more than 3% of the total portfolio towards the US export-oriented sectors, but and definitely not more than 5 if we indirectly count the other companies as well. Going forward, I think US doesn't have an option. It is just trying to negotiate. I think offense is the best defense is what US is doing in a race which it lost to China just because it did not take toll in time. Now it is doing it, and the only way to do it is what US. I think one of the ways to do is what Donald Trump is doing. So ultimately, they're all politicians. Sense will prevail, business will prevail. Profits, and money making is permanent. Somewhere, I think things will get back to normal, and all the better ones will, of course, make as quality makes a higher high every time. The better ones will prevail and become even bigger from here.
Thank you, Anirudh, for joining in. That's Inva Asset PMS. They expect new highs for the market in the next few months, and they've made their portfolio Trump-proof as of now. So there's a big tilt in capital markets, domestic plays, whether it's in consumer, railways, defense, etc. Get into a break. On the other side, we'll tell you what the street expects from the RBI MPC tomorrow. Welcome back. All eyes will be on the RBI MPC decision tomorrow. What's the expectation? Ritu is now joining in with that. Ritu.
Well, the RBI's August policy meeting is shaping up to be anything but predictable. A CNBC-TV18 poll of top economists shows a clear split, half expecting a 25 basis point cut, while the other half say the MPC will hold rates steady. But zoom out and look at the broader macro picture, and inflation has dropped to a 77-month low. CPI is expected to average below 3% through the year, and some like SBI, for instance, are warning that not cutting now could be a costly type 2 error, essentially waiting too long and hurting growth when inflation is already under control. But most economists see the terminal policy rate settling at 5.25%, and that means one more 25 basis point cut will wrap up this easing cycle. When asked about when that last cut will come, the poll is split again. 30% say August, 30% October, with December still leading, signaling we're near the bottom either way. On the stance, there's no ambiguity. All expect RBI to stick to the neutral stance, though the tone could lean towards dovish because inflation is softening and growth signals are turning mixed. Speaking of growth, 70% believe RBI will leave its forecast unchanged, but it may flag some signs of slowing momentum. On inflation, 90% are expecting a downward revision, to possibly around 3 to 3.3% because of the easing food prices and favorable base effects. As for the tone, 60% expect it to be neutral, while 40% are leaning towards dovish, which aligns with the improving credit transmission and continued liquidity surplus. But the wild card is tariffs and trade tensions, where half the economists say no policy impact because of this specifically, but 40% do say these external headwinds could push RBI to ease further, but most agree it's still a wait-and-watch game. Finally, do keep an eye out for revised liquidity management frameworks coming out, any commentary on the growth narrative, and a possible extension of the external benchmark-linked lending rates to NBFCs as well.
Ritu, thank you for that update. Take a short break. Put the spotlight on the two major earnings later in the day, Bharti Airtel and Britannia on the other side. Stay tuned.
Welcome back. Bharti Airtel will be the big number to watch post-market hours. Now, remember, Bharti Airtel is a sum of parts. So, on a consolidated basis, the poll is for a 2.5% revenue growth. What we know already is Airtel Africa and Indus. Airtel Africa was a strong set of numbers, a revenue growth of about 7.5%, EBITDA growth of 9%. Basically, Airtel Africa was a good set of numbers because in their key market, Nigeria, there was a tariff hike. But Indus Stars on the other side, which is now being consolidated in Airtel, was a bit of a disappointment. Now, what will the street watch? The India wireless performance. And here, it's going to be a fairly lackluster quarter because there are no tariff hikes. The last tariff hikes took place in July, so that flow-through has completely happened. The only thing that helps on a quarter-on-quarter basis is there is one extra day. So ARPUs could inch up and come to levels of about 250 to 251 rupees. On the subscriber front, things have been slowing down for Bharti versus a Jio. Now, at least as per the TRAI data, Bharti has added only 1.2 million subscribers in Q1, while Jio has added close to about 7 million subscribers plus. So we're going to watch what the company has to say about that, and are they losing market share or losing sleep over the loss of market share. Now, recently, UBS also downgraded Bharti from a neutral to sell. One, they're saying the probability of a tariff hike cannot be ruled out because tariffs in India may be lower than that of the developed markets, but they're in line with global emerging markets. So there will be a tariff hike. but the quantum, and it could be even delayed. So they're expecting a ARPU CAGR of about 10%, lower than what market is. Also, the street was betting that, now that the capex intensity is behind companies like Bharti Airtel, they've done their rollout for 5G, etc., the free cash flow will improve and therefore the companies will start giving more dividend. Now, they gave dividend last year, but that disappointed the street. And according to UBS, even the dividend yield will expand, but not as rapidly as the street was hoping for. And the final point that UBS made is that the valuations are in line with some of the regional peers. The stock also, by the way, is down about 5.5% from its recent highs. But all in all, for the India mobile wireless business, expect a fairly lackluster quarter.
Expecting a fairly lackluster quarter, all eyes will be on whether they do give out any dividend or not this time around. So keep an eye out on Bharti Airtel, still closing in on the highest point of the day at 1930. The other one, of course, is Britannia. Mangalam is here to tell us what the street is expecting from there, Mangalam.
Well, the stock has done well. It's up around 25% from the start of this year, down little today, but ahead of numbers. The street is expecting gradual recovery in urban and this resilience in rural to continue. The monsoons have been good as well. Raw material prices are volatile. That may impact gross margins, but remember the company has a very strong cost program and that may support EBITDA margins as well. So revenue growth of 7.5% is what the street is working with. You're looking at a number just shy of that 4,600 crores on the top line. The EBITDA grows at around 8%. You're looking at 814 crores on the EBITDA. This compares with close to around 753 crores. And the margin stays steady at around 17.8% too. Net profit on the back of an 8% EBITDA growth comes in at 12%. You're looking at a domestic volume growth between 4.5% as well. And the overall revenue growth would be led by 3 to 4% price hikes too. Management commentary on demand, raw material environment, but more importantly, what they do with their newer ancillary products is something that I'll be watching out for closely.
Thank you very much for that. And that brings us to a close in this edition of Trading Hour. From the entire team, thank you for watching. Don't go anywhere. Halftime report is up next.
Rising tension on trade between US and India hurts sentiment. Energy and realty are the big drags while metals stay resilient.
RBI clears the appointment of former Axis Bank Deputy MD Rajiv Anand as MD and CEO of IndusInd Bank for 3 years. CNBC-TV18 first reported the story back much earlier that he was the front runner. The stock cheers the move as the focus now shifts to key management changes and the road ahead.
Anfin has floated the sale of its remaining 5.84% stake in Paytm, becoming the last early backer to make an exit after SoftBank, Alibaba and Berkshire Hathaway. The sale will lift an overhang for the stock.
US President Donald Trump has said he will substantially raise tariffs on India given its buying of Russian oil. India calls the move unjustified and unreasonable, pointing to purchases by EU and US from Russia.
Hello and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. As always, with me is Mangalam Malu as well as Ekta Batra. Good afternoon, guys. But a bit of a correction from yesterday's highs, what we're seeing coming in for the markets as of now. Nifty, Sensex both down almost 0.5%. We're seeing most of the indices are trading in the red. Mid-cap also trading in the red. Nifty Bank not doing anything exciting as well.
Hi, guys. Yes, absolutely. I think, there's a little bit of sentiment which has been dampened because of all of the overnight cues with regards to tariffs, what could happen in terms of oil prices going forward. So I think that is obviously the big key worry for our markets. But separately, we do have a lot of earnings to reckon with today. So we do have the likes of Bharti Airtel. We have Britannia, which is going to be coming out with numbers. We have the likes of Lupin, Alembic, Torrent Power, Adani Ports. So all of these stocks will be in focus on account of numbers. I think that would probably be one of the key focuses in today's trading session. And obviously, ironing out of any kind of tariff uncertainty would probably be top of mind.
Yep. The interesting thing is that the market has been meandering in this range, give or take all the news pieces. We've been finding support around the 24,550 to 24,600 sort of zone. And as we move towards 24,800, 24,850, we see that supply come by. So we're just moving around. Yesterday, the up move was led by external facing counters. We had the IT stocks do well. We had the metals do well. Now those guys are coming lower. But the autos, they're picking pace once again. So pull up the intraday chart of Maruti Suzuki. That's the one that has moved higher. Some of these auto ancillaries are fairly well bid in today's session as well. So Uno Minda for one is higher. Sona BLW is another one which is up around 2%. And a lot of the stocks actually from the old economy are doing a lot better as well. So pull up something like a CG Power, pull up India Cements and something like an NHPC as well. All these stocks doing fairly well, though there are still more stocks which are declining than the number of stocks which are advancing. Vinny, we have management.
Absolutely, we have a management, and that is Nucleus Software. They reported their numbers last week. This time when you talk about the Q1 numbers, a muted performance that's coming from the company. Growth is seen, actually we're seeing a decline in terms of revenue, 4.9%. This is on a quarter-on-quarter basis. EBITDA margins come in at 15.6%. Now, what is the outlook for the company? Where are we heading now going forward? What should we be watching out for in terms of numbers, order book? What's the pipeline? Given, we've seen TCS given those layoff numbers as well. What does it and where does the company stand? We do have Parag Bhise, who's the CEO of Nucleus Software, joining us on the show. Parag, good afternoon and thank you so much for giving us your time. Let's start by talking about the revenue. Firstly, how is that shaping up in Q2? Given that Q1 has been a bit muted performance, what are we watching out for in Q2, FY26? And in terms of order book, where is that standing as well?
So, firstly, thank you so much for inviting me on your show. So glad to be here. You would know we don't give any forward forecast. So about Q2, I won't be able to talk about numbers. But I can talk about... No, we don't give any guidance. You would know that has been the company policy. So we don't venture into that area. I can talk about what we are doing at our end, if that can give you any indications. But we continue to work on our fundamentals. The order book you mentioned, again, numbers won't be possible, but order book is looking strong. We are getting traction from market, both from India and from other regions where we work in. we continue to work on our fundamentals that we've been talking about. We embarked upon a lean transformation journey. Lean is a concept from manufacturing, primarily coming from Toyota, and that is it's though our first year, second year just started, but it is giving us indications of huge productivity enhancement. So I can talk about those things and what we are doing on the floor for sure.
Okay, but there was a bit of an elongated cycle, right? Deal cycle, where you were seeing deal conversions were not happening faster. Has that at least improved, and does that, pencil in for the rest of FY26?
So I would repeat that the traction and order pipeline is strong. The conversion, I can't say whether it is, it is taking time. There's no significant improvement. I'll repeat what I had said in some other forum earlier, that for sure we are seeing that the delays are because every such proposal is going up to the board level, even for smaller companies, larger companies, any investment proposal. There is a lot of due diligence that is required, I think even mandated by the regulators. So those are the factors, I think, which is making it longer to convert orders as compared to anything else that I can attribute to.
Sure. Just wanted to narrow down upon the geographical mix, Mr. Bhise, because we understand that 58% of your revenue is from India at this point in time. Are you looking to change this mix given the kind of uncertainty that we're talking about when it comes to, say, AI, trade tariffs at this point?
So absolutely. And this India focus, I said that earlier, it is not by design. It is, after COVID, I think India was among the first economies that started recovering. That coincided with our new product launches that were happening. So we got first traction from there. We have got about 60 odd customers on India on our new products. We are not because of geographical and geopolitical uncertainties. Even otherwise, the focus is to move outside. In any case, we have a huge customer base in Middle East, in Southeast Asia, few customers in Australia, Japan, and South America. And these customers, many of them are on our older platforms. Now that we have a product on our new technology platform, and it has shown success in Indian market, there's definitely a focus to move to other geographies with our product suite. So for sure.
So do you have an aspirational target as to what proportion of your revenue should move, or rather come from other geographies? Currently, it's sub 60%, which comes in from India. And if you could also throw some light on the cost environment, because you've been, earlier indicating that you would like to go to margins closer to that 20% mark, which you've historically enjoyed. How far along are we on that journey?
Can't give, again, no specific timelines or targets, but for sure we would like to go to those margins that we have seen in the past. Our business model, which is more license-based and less dependent on revenue from revenue per person, gives us that leeway that we can, as we do more and more licenses, the chances of not only our top line but our margins also improving are significantly there. We have much better chance there.
Okay. Parag, what about Finaxia? That platform, obviously, you all have collaborated recently also with the HNB Bank in Sri Lanka as well. A lot is that happening over there. So what is the traction there? Anything in terms of client addition over there? You could give us any indication.
Yeah, so Finaxia, while the HNB was in news recently, but I think a quarter back we had also issued a press release with Federal Bank. Federal Bank in India has also adopted Finaxia. That is another very strong offering we have. The traction from India, Southeast Asia is there. But let me clarify that Finaxia is a product line which is which is not a mass market product like our other product, which is the FinOne lending, more on the retail lending. The number of customers, small banks, finance companies, everyone does lending. So from a numbers point of view, for the number of deals point of view, these two are not comparable. Typically, Finexia is taken by large banks who work with large corporates. So it is like more on the corporate banking side. But yes, from a traction point, we are seeing traction on Finexia as well.
Okay, all right. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Nucleus Software talking about the quarter gone by. Well, for the markets, down around 0.3%. So just about trading with that negative bias at this point. We need to take a short break, but we'll be chatting with the management of Marico on their Q1 performance. Stay tuned for that.
Welcome back. You're watching us here on Halftime Report. The Nifty is now curtailed its losses from about 100 points to just about 60 points. So we'll keep an eye out on that, the recovery that we're seeing from the lows. The auto stocks, which we were talking about, M&M for one, has moved higher. And Trent is the other one I'm looking at. From its lows, it's seen a big recovery over the last few trading sessions. And remember, the company reports its numbers tomorrow. Was a big cut that we saw as they reported their first quarter update, where the revenues grew just by about 20%. So it's not that the street does not know the revenue growth. The important thing to track now will be the management's outlook on what the performance of the company is likely to be, given the sort of store expansion plans that they have. Some important news at the bottom of your screen. SEBI may end weekly options expiry, introduce bi-monthly and monthly expiry. It may bring out a consultation paper on discouraging options speculation. We'll probably get Yash to talk a little more about that, but the fact that there could be curtailment of weekly options expiry does not bode well for some of these capital market names. So we have BSE for one, which is lower right now. But let's get in. Marico reported a largely in-line set of numbers, good numbers coming in, 9% volume growth, which is the highest in the industry. I caught up with the MD CEO, Saugata Gupta, and spoke about the important aspect of the raw material inflation and margins. Let's hear him out.
The worst is over. In the last 2 weeks, it has come out from around 11 to 12% from the peak. Also, you must realize that we have to balance profitability along with supply chain assurance so that we ensure that we have, during these high inflations, we have enough supplies at the right time, at the right place. Because as you know that we compete with a lot of smaller brands as well as unbranded, where they do have supply chain constraints, and this is an opportunity also to grab market share. So I think things have stabilizing, and therefore we will be able to give a far better view of this in the second half of the year. Having said that, I think we are an extremely resilient brand. If you look at even in the last two inflationary cycles where we have taken significant price increases, we managed to hold on to Parachute volumes. I think it's one of the most inelastic in terms of brand, in terms of price inelastic brands. It has a strong equity. And as I said that while during inflationary times, traditionally in terms of supply chain and other, we have significant competitive advantage. So I don't see it as a major concern as such. Yes, there are short-term dips in profitability, but as I said, that if you look at history, 1 year of inflation, it always is followed by a deflation, and therefore we make up as far as profitability is concerned over a 2-year CAGR. And the other thing which is interesting is that if I look at the Marico portfolio now, whether it's in India and international, the dependence on Parachute has significantly reduced in terms of delivering to the profit numbers. We now have a significant diversified portfolio, value-added hair oils, the part which has done very well, is a high margin portfolio. So I think things are, the dependency also has significantly reduced compared to even say 5 or 10 years ago.
So is it fair to say, you will get clarity on how much better the margins can be, say, in the next quarter or so, but for now, the margins that you reported in this quarter are likely to not be breached on the lower side. Is that fair to say?
Absolutely. I think, as I said, 1 or 2 quarters, I don't think is a problem. I think things will definitely improve in the second half. And number 2, as I alluded to, that as you get into a 2-year CAGR, next year, obviously, there will be a significant catch-up because this will be followed by a deflation. Because what happens is that whenever there is such high, as you know, that coconut has different sets of demands. And whenever these demand streams ration, whenever there is such high inflation.
All right, so let's talk about the good part of your business. It is the revenue growth. You did extremely well. A large part of that obviously was price-led as well, but volume growth of 9% also is the highest in the industry. How much of this is sustainable? You've targeted double-digit revenue growth. Could you be a little more specific about, what range are we looking at and what proportion of that would be volume-led?
If you look at our trend in the last 4 quarters, we have been, sequentially moving up 6, 7, 8, 9. Yeah. And I think in this year, hitting a number, double digit is very much possible. We will attempt to do at least in 1 or 2 quarters. Given the inflation and whatever outlook we have, I think we believe that, and the fact that we are extremely confident of continuing to deliver double-digit constant currency growth. And so far, things are stable also on the currency front. As far as the international markets is concerned, there is reason to believe that we should be in the ballpark-ish 25% revenue growth this year.
25% revenue growth this year with a couple of quarters of double-digit volume growth. The street would really like that. Value added, that's the one. After very long quarters of weakness, it's come back this quarter. Do you think this is sustainable? What is it that you changed for it to improve? How much of that can be attributed to consumer sentiment? And from here on, what's the prognosis on value-added hair oils?
2 things. If you look at the last couple of years, I think we went into a trap of not investing behind the category as a market leader. It is perhaps our responsibility to invest behind the category and not bother about maintaining share of voice. I think competitive intensity was far more at the bottom of pyramid, and there was a significant movement from ATL to BTL, and we also went into that, which I believe doesn't lead to necessarily category growth and offtake growth. And therefore, what we did was we said that we are okay to sacrifice some volumes at the bottom of pyramid. We are not going to get into the trade game, but convert that resources and transfer that resources into investing behind ATL for brands which are, what I call mid and the premium segment, Secondly, I think what has also helped value-added hair oils and is going to continue to help is our Project Setu. As you know, Project Setu aims to increase our overall direct reach by 500,000 outlets over the next 3 years. And especially in rural or semi-urban, I think what happens is that only core brands are throughputed through wholesale. In our case, it will be Parachute and Shanti Amla. So obviously the 2nd, 3rd and the 4th brand in VAHO, whenever you do direct distribution, there's far more range selling and it gives an opportunity to be sold and made available, and therefore, and when you invest, obviously there's brand preference and switch. So I think that that is going to sustain, and therefore we are extremely confident with this strategy of maintaining this double-digit value growth for value-added hair oils. And what is interesting is X of Shanti, which is the bottom of pyramid. I think the volume growth also was in double digits for the other brands, and therefore this is the right step. I believe this is a far more sustainable growth, and also the growth is coming in the high-margin component of value-added hair oils.
That's great insight, Saugata. Things are all looking up right now. Are there any risks that you see to growth and any sort of thing that can topple the apple cart? There is a lot of global uncertainty around as well.
See, we are a domestic consumption company and most of the international markets are stable. Obviously, there could be black swans, but I think one of the things we are mindful of is ensuring that we will take every step to maintain parachute volume growths in the next 1 or 2 quarters when the inflation is high. And that is, we are doing every possible step to do that. I think we firmly believe that we have entered a kind of a virtuous cycle of growth because of all the initiatives we have taken and taking right calls. The diversification strategy is also going well. I think we have to keep on executing well. I think execution is extremely important and stay disciplined in the resource allocation. As you know, one of the things we believe in is that we always believe that we have to drive volume-led top-line growth. Yes, inflation is good for us in some way. The second thing is that we will never manage margins by doing cost management, especially cutting A&P. This is something we have been following steadfastly over the last couple of years, and we'll continue to do that. And I think we have to continue this high level of execution and focus strategy.
Okay, so that's the management of Marico talking about their Q1 numbers. Just want to point out that Aurobindo was the other one that released its numbers last evening. And if you just look at the stock, it's now down around 2% What they did say in the conference call probably deterred a little bit because they have indicated that the reason why they reported weak numbers was Revlimid generic and the weakness that came through from the US business on account of that. But they've maintained their guidance of low, mid-single digit or 8 to 9% FY26 growth. So that's positive going forward. But nonetheless, let's move on. Sources tell CNBC-TV18 that the Finance Ministry is in talks with SEBI to take steps to reduce options market speculation. Yash is here with all of the details that he's picking up on this story. Yash, go ahead.
Well, CNBC-TV18 had reported it earlier that market regulator SEBI was looking at different ways to do two things. One was to reduce options trading volumes and the speculation there. And the second one was to increase cash market volumes. Now, what we've been given to understand as fresh piece of information is that Finance Ministry has also been in discussion with market regulator SEBI to consider options to reduce options market speculations and the volumes there, and of course increase the cash market volumes. The letter has been sent from the end of Finance Ministry to market regulator SEBI to consider steps in order to do this exact same thing. That is, as I said, to look at reducing options market volumes as well as the speculation there. Now, according to our sources, SEBI has also been considering various steps to be able to achieve this objective. The first one is that market regulator SEBI could consider doing away or removing the weekly options expiry and replacing that with either bi-monthly, which is fortnightly, or a monthly expiry. That could be a big move which SEBI could consider. The second option which SEBI is considering is reducing cash market margin requirement. Currently, of course, the margin requirement towards cash market transactions is higher as compared to options trading, and that is one step which SEBI could consider, which is to incentivize cash market transactions by reducing the margin requirements there. The third option which market regulator SEBI could consider is to reduce, and rather to suggest government to reduce STT or securities transaction tax when it comes to cash market transactions as compared to options market transactions. These are some of the important steps which market regulator SEBI could consider and propose and suggest to the government to take steps towards that. But of course, the government at this point of time thinks that weekly expiry is largely being used for speculation and not for effective hedging, and that's something which it wants to change, and hence discussing steps with market regulator SEBI to be able to do that.
Okay, Yash, thank you so much for that. But on that note, we're going to slip into a very short break. We'll get you more stock-specific action after the break, so stay tuned in. Welcome back to our halftime report on CNBC-TV18. Nifty, as of now, is still down 62 points in trade, though off the day's highest point. But, let's talk about some of these individual stocks that are buzzing and moving in trade today. Vivek is joining in with us to give us that list. Vivek?
Well, thank you so much for that. Well, a very volatile trading session, as was expected. Quite a lot of stocks that are buzzing, mainly on the back of earnings, as well as some important news developments that have happened. First on the list has to be IndusInd Bank. Weeks of uncertainty, and the CNBC-TV18 News Break has been confirmed. Rajiv Anand has joined as the MD and CEO of the company stock. One of the top gainers, almost 2% higher, especially as far as the F&O space is concerned. Siemens Energy, remember this is the demerged entity of Siemens Limited. Very strong set of results. Stock high by almost 4%. All-round beat with order book too quite strong. Godfrey Phillips, continues to outperform its peers, especially in terms of top-line growth. That stock saw the company reported earnings growth as well as top-line growth of over 35%. Stock up almost 10% in the session today. And BHEL, after a while, this particular capital goods major is moving quite strongly. This after UBS has an anti-consensus buy call. They estimate that profits could grow 8x from the current levels by FY28. On the other hand, quite a few laggards as well. Manappuram Finance among the key laggards. Remember, the company's subsidiary Asirvad Microfinance has gone ahead and declared its results. It's a muted set. That stock low by almost 3% today. Triveni Turbine, amongst the capital goods stocks, one of the weakest results that this particular company has seen, almost 6.5% lower. And OneSource, this particular pharma space, that particular stock too, among the top laggards in the session today.
Right, Vivek, thanks a lot for that. OneSource, we'll shortly get speaking to management as well to try and figure out what the outlook for them is. But meanwhile, let's go across to Nigel, who's standing by at the F&O desk to tell us a little more. Nigel, we're lower, but it's volatile within a range.
Well, I'll tell you what, Mangalam, going by the evidence that we have, if the markets go to around 24,550 or there is that temptation, in that vicinity of around 24,500, 24,550 odd, that punt is actually working out because from the lows of the day, yet again, we've recovered. Look at the high and the low of the day, the difference is close to around 150 points or thereabouts. The PCR, the Nifty PCR, that had moved to around 0.95, that's cooled off closer to around 0.83. Because the call writers, they come back into play. I'll tell you what, this is not such a bad thing. Because the call writers, they are writing, the strikes very, very aggressively. So you look at the 24,700 call, it's added close to around a crore shares out there. The premium out there has come down to around 80 rupees from around 133 rupees or thereabouts. So there is writing being seen at that level. You go to the 24,600 call as well. The premium at the start of today was close to around 200 rupees. That's come down to around 130 rupees or thereabouts. But the reason I'm saying that the bulls believe that they can defend lower levels is the markets are down, right? Close to around 80, 90 points or thereabouts. But the 24,600 put, the premium is more or less constant. It started the day at around 68 rupees. Currently, it's at around 70 rupees. So it appears there is more writing at this particular level, which tells you that that 24,525 odd level, in the near term, that's one of the crucial support zones that you're expecting to hold out. And that's going to be important. So levels, well, we are in a broad range on the upside, 24,850 mark. That's the important mark. On the downside, that vicinity of around 24,500, 24,550. Stocks that are unfocused today. AB Capital had a big run yesterday. This morning it came in for some profit taking. But after the profit taking, just take a look at the way the stock has recovered and there's a massive spike in open interest. So there's fresh long addition on that particular counter. Nuvama, not a very active stock in the F&O market, but there is fresh buying as well out there. And if you're looking at a short covering bounce, well, CG Power, our technical analysts as well earlier this morning, they're given a call that structurally the stock has seen a bit of a correction. And now it's looking at a bit of a bounce back. And there is a short covering bounce that's playing out on that particular name. And Shree Cement, after coming off the highs of the day yesterday, today as well, it's down close to around 1%. And that's more on account, not cash market-based selling, but it appears there is unwinding of long positions on that particular counter. So for the time being, we're in the range. We should protect the low of the day if the bulls need to fight back. Yesterday, we had a green close, but that came on low volumes. Back to you.
Okay, all right, Nigel. Thanks very much for that. So that's the update coming in on the F&O space. We need to take a short break, but before that, just watch out for one stock, Sanofi Consumer. So they're the ones that, have Allegra as well as Combiflam in their portfolio. That one is reacting to its numbers. It's up around 9% at this point in time, doing very well in terms of trade and reacting to what was a good quarter gone by for the company. That's the reason you're seeing that spike up around 9%. We'll take a short break, but on the other side, Manisha Gupta will join in. She has with her Dinesh Somani, who's the founder of Pro IntelliRaid Services. Stay tuned for that.
Welcome back, and joining us on the show now is Dinesh Somani. He's founder, Pro IntelliTrade Services. Mr. Somani, hi, thank you so much for joining in. And I want to talk about the gold prices first, because this is where we've seen an all-time high yet again for the Indian markets, even as the international markets are still $50 to $80 away from that 3,500 mark. But the kind of gains that we are seeing in gold, what is it that you see on charts? Are we back on recovery? Do you see newer highs?
Definitely, it's already at a new high. The previous high was close to 1,01,000. Now it has made a new high of 1,01,344. Probably the recent gain is mostly attributed to the depreciation in the Indian rupee. Since July till date, it already depreciated 5%, and in a month it depreciated more than 3%. So it overall I see the major gain coming out of the dollar appreciation, and probably the COMEX market, if you observe, it is still $140 short of the all-time high. So we expect a dip of around 400, 500 rupees from here, probably 1,500, 1,550 around, and a fresh renewed buying would emerge out of it. We expect gold to test 1,05,000 by Diwali or the year end.
1,05,000 by Diwali or year end. Mr. Somani, also, how would you look at the silver prices? Because we've seen, pardon me, support come in for this as well. It hasn't broken below 36. 39 continues to be a resistance. For this, what's your sense for the global markets, and how do you see Indian markets performing, let's say, by this year end?
Like, as you said, 36,000 is a very crucial support. We don't expect it to go beyond below this level. On the higher side, 39.40, 39.50 is a resistance. Probably the 40 level mark is acting as a major resistance, and above it, we may test $43, $44 very soon. Overall, in the Indian market, if you see 1,08,600 is a very crucial support. A previous breakout and any level around this level is a good buying opportunity. Upside potential by Diwali or year end, we may expect 1,25,000 to 1,33,000. Silver looks comparatively more bullish compared to gold as of now.
Mr. Somani, also, how are you looking at crude oil prices? Because today is the fourth straight day of decline, and the markets really are looking at a lot of factors, fundamentals. What with all those statements that we are hearing from US in sense of sanctions on Russia, and then OPEC has continued to increase production. India finds itself in middle of all of this. One, how are you looking at prices? And with the kind of supply numbers that we are working with markets anticipating that by the end of this year, there could be supply excess, how are you looking at those numbers?
Yes, definitely. Whatever you said is perfect. The production is going to increase because the OPEC countries, they want to have the market share as far as crude oil is concerned. And that's why the reason they are increasing the production. The demand is not in line with the supply. I mean, the supply's excess, demand is limited. Overall, we see the prices are going to be in the range of downside max to max 55.50, upside max even 6,100. This 600 price range is there for next 3 to 4 months. Overall, I mean, if I look at the chart structure, prices rally from 47.50 to 6,600, then suddenly collapse to 55.50. So whenever there is a huge rally and a vertical fall, the next 3 to 4 months goes into consolidation. And that is what is observed in crude as of now. In a very narrow range, I could say 5,700 to 1,500 is the range that is to be there in the next 1.5 months.
Mr. Somani, you also follow natural gas quite closely, and we have seen continuous, constant profit taking into this one as well. Do you see it now trading near its supports levels, or is there a chance of a further decline from here?
Yes, 255 is definitely a short-term support. We've seen a fall from almost 358, 360 levels. 100 rupees fall is on the chart right now, and a pullback rally might be there definitely. But since it's a lean period, the demands are lesser, and stocks are ample. If we compare both the months, June and July, the stocks are increasing and they're almost at the highest level. So overall, the structure, even on the chart, looks weak. A pullback rally towards 285 to 90 would again attract selling. Downside, it's minimum 235 on charts, and 312 should be the stop.
Since we have you with us, Mr. Somani, I also want to talk about copper now. That very sharp decline or sell-off that we saw in the previous week, almost by 25, 28, 30% in some of those contracts there. Is that sell-off done? Are we more balanced when you look at the other international markets, which is LME and Shanghai as well? And from here on, for the very near term, how are you looking at copper prices?
Like the COMEX rallied mostly on the tariff concerns. It was about to raise the tariffs, and it rallied almost abnormally. And it fell also abnormally. It's fall almost 27% from the recent high. While LME was intact, it is still trading around 66, 96, 9700. So we don't expect a much greater fall in COMEX as of now. Downside, if I say a broader range to 867, 870, that is a major support, a crucial support. we don't expect prices to close below this level. Upside 905, 910 is a major resistance. Overall, if I see any fall towards 880, 878 level could be a good buying opportunity. Stop loss on closing basis should be 860. Upside we expect by Diwali till 937 levels. That should be definitely there.
All right, Dinesh, thank you so much for joining in. Manisha, thank you so much for taking us through that conversation. Before we slip into a short break, a couple of Tata Group companies, they're doing extremely well. Titan reports its numbers in the later part of this week. Trent does it tomorrow. Both these stocks have moved higher to the high point of trade. So that's something we'll watch out for as we move forward. In fact, let's take a short break. That's Trent. We have the quarterly updates for both Triton and Trent. The street did not like, in particular, the revenue growth rate for both these companies. Let's see what the companies have in store for their operational performance. 3,400 on Titan. Trent up to 5,334. Take a short break, more on the markets and individual stocks.
Welcome back. Well, let's talk about one particular company. OneSource Specialty is the next management that we're speaking to. The company has reported what was a weak set of earnings, especially on a Q-on-Q basis, with the revenue declining 23% sequentially. The margins also declined this time round, but the operating expense has also come down Q-on-Q. To talk more about this, we have the managing director of the company, Neeraj Sharma. Mr. Sharma, thanks very much for taking the time out. If you could just take our viewers through why there was a sequential dip, and quite a sharp dip you'd have to say, in terms of the numbers this time.
Yeah, thank you, Vinny. Thank you for having me over. As we have said last time, also when I came in here, that FY26 for us is a transition year. You see, FY25, our principal business of drug device combinations was primarily based, the revenues were primarily based on the service fee which we get. And from FY27 onwards, this business will be giving revenues primarily from commercial sales. So this is the year FY26, which is a year in transition where we'll be actually moving from the service, the pre-approval service fee to a commercial in the second half. And that's how we had said that our first half will be heavy, where we'll be doing executing our MSAs, and the second half is the one where the commercial revenue will start flowing, and that will be heavy. So, keeping that in mind, our first quarter performance has been as per our expectations. If you see how we have grown quite significantly versus last year. So the year-on-year growth, whether in revenue or in EBITDA, has been very significant. And as you progress in the next few quarters, you will see that with the commercial launches happening in H2, we'll have a significant H2.
Okay. When you say a significant second half, it is going to be based on your drug delivery devices, what you are going to be supplying for GLP-1s. Just quantify how much can we probably expect towards the end of this fiscal in terms of what the commercial orders could be for OneSource.
Yeah, so I think we have again mentioned that we are very fortunate to be working with some of the largest companies in the generic field, the global players, the regional leaders, country leaders. So we have a very strong customer base here, and these are all looking at launching in the markets which are coming off patent, whether it's Canada or Brazil, at the time of market formation. So what today we are sitting on actually is purchase orders from them. In fact, what has also happened, Vinny, that over the last couple of months, all our customers who are actually going to be entering the market at the time of patent expiry have actually been increasing their forecasts for launch. In fact, based upon the fact that we have all these customers on take or pay contracts, we have actually taken the leap, and actually we are advancing our capex program actually, whereby significant increase in our capacity, which was actually earlier supposed to happen in FY28. We are bringing it a year ahead, FY27. So keeping all this in mind, we see that our customers will be launching on time, assuming they get approvals, and B, we are reiterating also our midterm growth aspiration, which we have set to be a 400 million revenue company basis organic growth with a 40% plus EBITDA margins. And a significant part of it will be
Mr. Sharma, actually, you preempted the question around 400 million and 40% EBITDA margins. You spoke about medium term. What we want to understand is, how do you define that medium term? Do we see that number coming by, say, FY29, FY30? And if FY26 is, a transition year, then what's the glide path to that? Do we see a big jump in FY27 over FY26?
Yeah, so the aspiration which we mentioned, the guidance which we have clearly said is actually FY28 numbers on an organic basis. So it's a fairly, fairly next to 2 to 3 years is a time horizon which we are saying. FY28, that's the guidance. And FY27 is the year where the commercial revenues full year will be there. So it's going to be a jump, definitely. But as you see, moving from roughly about 170, 172 million, which we did FY25, to about 400 million organically in FY28. That's how the transition is going to be. FY27 full year commercial, and then FY28 again ramping up further.
Right. Mr. Sharma, two-part question coming in for semaglutide. One is the Delhi High Court has restrained Dr. Reddy's as well as OneSource from selling semaglutide in the domestic market. What's the update on that front? Also, we had comments that came in from Sandoz this morning as well, saying that, in Canada, they would launch semaglutide at 60-70% at a discount, or, price cuts versus what it's sold at. Do you think, now semaglutide may not be as lucrative, both these parts?
So I think on the first part, unfortunately, as you know, it's a matter which is sub judice. I won't be able to say much other than the fact that we are very much allowed to manufacture the product as we speak and sell in the markets where the patent is not there. To what you highlighted, what the CEO of Sandoz has said, I think that's a question better posed to our customers, because today we are manufacturing based upon our customers' forecasts, and I can tell you, basis the increased forecast which we have from all our customers are very bullish. Our customers are very bullish, to launch in these markets, whether it's Canada or other markets which are opening up, and that bullishness has been continuing. And as I mentioned earlier, that thanks to that bullishness, we are actually even advancing our capex program just to ensure that we fulfill the demand which our customers are putting on us.
But you're not just supplying semaglutide, you are also supplying for other GLP-1 drugs.
Absolutely. So we have actually our strength is in drug device combinations.
So would that include Eli Lilly as well?
As of now, as I said, we are a very, very strong player in the generic space in GLP-1s, which are already in the market. And going forward, as we speak, we are engaged with the companies who are actually going to come up with the next wave of GLP-1s, innovators who are going to come in next wave. So as you know, there are multiple candidates in this space. This is such a attractive and revolutionary space that there are many, many candidates, and we are engaged right now with some of the innovators who will be coming in the next wave.
Okay, all right. More on that soon, Mr. Sharma, once we get more clarity in terms of a couple of these contracts. Thanks very much for joining in and speaking with us and giving us your perspective on OneSource specialty. So the next leg of growth will probably come from GLP-1. FY26 is expected to be lumpy, but FY28, they're sticking with their guidance of $400 million with 40% margins, and that would be based on the supply of a lot of these devices which are used to give GLP-1 drugs to patients. Well, we need to take a short break on that note, but we'll get you a lot more on stocks once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. As of now, the Nifty continues to be around the 24,600 levels. As of now, down almost more than 80 points and trade 0.3% of decline that we're seeing, recovered from the day's lowest point, but still some bit of a pressure there. Broader end of the markets are also not doing anything exciting. Mid and small cap both down almost 0.4% in today's trading session. Bank also seeing a decline of almost 0.3%. But that's all the time we have on this edition of Halftime Report on CNBC TV18. Thank you so much for tuning in. Up next, Business Lunch.
Rising trade tensions between the US and India hurt sentiments on the street. Energy and realty are the big drags, while metal stocks remain resilient.
RBI clears the appointment of former Axis Bank Deputy MD Rajiv Anand as MD and CEO of IndusInd Bank for 3 years. CNBC TV18 first reported that he was the front runner. The stock cheers as the move, as focus now shifts to key management changes and the road ahead.
CNBC TV18 learns that the Finance Ministry and SEBI are in talks to curb excessive stock options trading, a shift away from the weekly to fortnightly expiries, lower margins for cash trades, and a cut in STTs may be considered to reduce speculations in options and increase cash trades.
US President Donald Trump has said he will substantially raise tariffs on India given its buying of Russian oil. India calls the move unjustified and unreasonable, pointing to purchases by EU and US from Russia.
The RBI's Monetary Policy Committee will announce its interest rate decision tomorrow. The CNBC-TV18 poll shows that the market is divided between a cut and a pause. ICICI's Global Markets head B. Prasanna tells CNBC-TV18 that the market may be happier if the RBI does not cut rates, but indicates dovishness by cutting inflation forecasts. Good afternoon, you're with us here on Business Lunch. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Fatakia. With me as always is Vamakshi Thoria. Vamakshi, good afternoon. Welcome back after a day's break for you. Well, but the markets are also taking a bit of a break after the rally that they saw yesterday. And it's quiet, if you could call it that, because a 90-point fall could be just another day, despite the headwinds that the country currently faces.
Exactly, Hormas, bang on. And in fact, with the kind of developments that took place with the US threatening to increase the tariff rates on India, we could have expected a bigger fall. But at least for now, it's not such a great fall as you were pointing out. It's in fact a 45-point recovery from the day's lowest points. So for that matter, the markets are in the red, but the fall could have been much greater. The mid-cap end of the market is, however, taking a knock. It is underperforming the benchmark indices. The mid-cap index is down almost 0.6%. This is reflected in the advanced decline ratio, which is leaning a little more towards the declines for now. It's almost 1 to 1.5. But apart from that, we have lots of stocks in focus. Take a look at Gokaldas Exports. Last I checked, the stock had taken a knock in today's trading session. It was down almost 8%. Given the kind of developments that have taken place between India and US, Gokaldas Exports is the stock that I'm talking about. There you go, 8% lower for this counter. The other counter that is not doing too well is Wellspun Living. Again, this company does have some exposure to the US markets and does have some sort of supply to some of these big retailers there. So therefore, Wellspun Living is also taking a knock in today's trading session. Of course, we have a whole host of numbers that are a whole host of stocks that are reacting to numbers. Take a look at Triveni Turbine. That stock is down and out in trade today, almost 7% lower. On the flip side, Godfrey Phillips is is trading with a gain of almost 10%. Almost.
52-week high for Godfrey Phillips after its results. Very strong performance at that. And Tanla Platforms has moved to the highest point of the day, 9% higher on that stock as well. And some of the other earnings reactions, Sanofi Consumer at one point was up 15%, and that stock has cooled off a little from the highs of the day, but still holding on to gains of around 9%. So good going for Sanofi Consumer as well. On the flip side, though, as Vamakshi was highlighting Gokaldas, there are a lot of other names like Thomas Cook is down almost 6% at the lowest point of the day. And most of these apparel names with a significant exposure to the US are struggling in today's session as well, be it SP Apparels down 4.5%, Wellspun Living, as Vamakshi just mentioned, and a lot of the other names, be it the likes of KPR Mill or Arvind Fashions, all of them not doing very well for themselves in today's trading session. So that is the state of the market currently, still around 90, almost 100 points lower on the index, but continues to meander in a very narrow range. But the big news break from last evening that was confirmed was the CNBC-TV18 news break, of course, and that was the Reserve Bank of India approving the appointment of Rajiv Anand as the MD and CEO of IndusInd Bank for a 3-year period. Ritu is here with the big takeaways from that announcement. Ritu.
Well, big development for IndusInd Bank with the Reserve Bank of India approving Rajiv Anand's name for the MD and CEO position for a 3-year term effective the 24th of August. We were the first to report that Rajiv Anand was shortlisted by the board and was a front runner for the position on the 27th of June, and now it is official. A chartered accountant and commerce graduate, Rajiv Anand is a financial services veteran with over 35 years of experience, known specially for his expertise in capital markets. He began his career as a trader at HSBC and joined Axis Group in 2009 and became the founding CEO of Axis AMC. Since 2013, he's been on the board of Axis Bank, where he headed both retail and wholesale banking and rose to become its deputy MD in 2021, retiring just a few days back. And now he steps into a bank which is at a crossroads. IndusInd Bank is recovering from a massive loss in the fourth quarter, its worst ever, driven by accounting lapses. It bounced back in the first quarter with a profit, but the damage triggered a string of senior-level exits. The bank's chairman, Sunil Mehta, though, has assured investors that legacy issues are behind and the impact of all these irregularities has already been absorbed. He also outlined a 5-point focus for the bank, including a profitability-first approach, cost discipline, and a focus on recoveries. So when Rajiv Anand takes charge, his task will be cut out, and it is a tall order. First and foremost, of course, to stabilize the ship, rebuild the bank's reputation and restore stakeholders' confidence, fix the internal control systems and ensure a sustainable return to profitability while cleaning up the books as well. Equally important will be to rebuild the core team. The bank has been without a CEO and deputy CEO since late April and is currently being run by an executive committee. He must also execute the 30,000 crore rupee capital raise to make sure that the balance sheet is strengthened while also managing the ongoing fallout from the accounting lapses, the MCA probe being the latest.
Well, thank you so much for that, Ritu. Thank you for putting all of that into perspective. But moving on then, let's put the spotlight on Tata Motors because the company has announced the appointment of PB Balaji, its current CFO, as the next CEO of Jaguar Land Rover with effect from November 2025. He comes with 32 years of experience in the automotive and consumer goods industry. Balaji will succeed Adrian Mardell, who is set to retire upon completion of its contractual term.
That is the developments at Tata Motors. You can see numbers of Alembic Pharma flashing at the bottom of your screen, a 15% jump in its net profit, a 10% revenue growth as well coming in. So numbers have started to trickle in as we speak. The stock looking to recover from the lows of the day. The EBITDA is up 19% as well compared to last year. We'll get to the margin picture as well. And it's 130 bips expansion, 16.5% compared to 15.2% last year. So overall looks like a steady quarter for Alembic Pharma. Revenue growth, margin expansion as well. We get more granular details on that with regards to its US sales and some of the other aspects as well. But the stock that has been doing well, we spoke about Godfrey Phillips at a 52-week high today, strong revenue growth in the quarter, and Mangalam is joining in with the fine print of how the numbers are. Mangalam.
Well, incredible numbers, no two ways about it. You know, if you told me that this quarter there would be a company that did revenue growth of 38%, with a 25% profit growth, the street would take that with both hands, and that's exactly what we're doing with Godfrey Phillips as well. And this at a time when we had a peek into what the industry is likely to do with the leader ITC reporting their cigarette volumes coming in upwards of 6%, which was also a multi-quarter high. But Godfrey has gone ahead and, as it has done over the last 10 to 12 quarters, one step ahead and continued to gain market share. What's important is that, when you're growing revenue at 38%, even the leaf tobacco inflation is not impacting their margins so much. Yes, the EBITDA grew 25%, a lot slower than their overall revenue growth, but 25% itself is a lot higher than what a lot of the other companies have reported so far as well. So despite the margin compression from 25% to sub 23%, Street likes it. And this cycle, as ITC pointed out, the prices have come down as well. So going forward, if they maintain their volume momentum, EBITDA margin expansion is also just a matter of time. The important part, however, is that about a few quarters ago, the company had set its sight on looking to sell its retail business. So they're looking to strategize growth of their tobacco business over the others, and that's what's playing out. It's not just today. Over the last 1 year or so, the stock has been a big mover. In fact, in 2025 itself, it's up almost 90%.
Well, thanks so much for that, Mangalam. Big moves on Godfrey Phillips, but then shifting focus to new debutants on the bourses today. Aditya Infotech saw a stellar listing at almost 50% premium. In fact, we also spoke to the management earlier today on the margin outlook. Let's listen in to what they had to say.
So margins are around 8.5% EBITDA, and like Anup mentioned, 20% is of our own brand, and the balance is we continue to distribute another brand from China. But with this new regulation and tailwinds, a large chunk of our business will move to our own brands where we have a better margin. So I think we believe it might go to a 90-10 because the neighboring country brands cannot qualify for selling IP cameras any further with the new regulation. So their play will only remain in the analog camera technology, which is more like a flat market.
The new listing, Aditya Infotech, 60% higher now in comparison to its IPO price. Now, sources are telling CNBC-TV18 that Finance Ministry is in talks with SEBI to take steps to reduce the options market speculation. Yash is here with more details on this. Yash.
Well, CNBC-TV18 had reported it earlier that market regulator SEBI was looking at different ways to do two things. One was to reduce options trading volumes and the speculation there. And the second one was to increase cash market volumes. Now, what we've been given to understand as fresh piece of information is that Finance Ministry has also been in discussion with market regulator SEBI to consider options to reduce options market speculations and the volumes there, and of course increase the cash market volumes. The letter has been sent from the end of Finance Ministry to market regulator SEBI to consider steps in order to do this exact same thing. That is, as I said, to look at reducing options market volumes as well as the speculation there. Now, according to our sources, SEBI has also been considering various steps to be able to achieve this objective. The first one is that market regulator SEBI could consider doing away or removing the weekly options expiry and replacing that with either bi-monthly, which is fortnightly, or a monthly expiry. That could be a big move which SEBI could consider. The second option which SEBI is considering is reducing cash market margin requirement. Currently, of course, the margin requirement towards cash market transactions is higher as compared to options trading, and that is one step which SEBI could consider, which is to incentivize cash market transactions by reducing the margin requirements there. The third option which market regulator SEBI could consider is to reduce, and rather to suggest government to reduce STT or securities transaction tax when it comes to cash market transactions as compared to options market transactions. These are some of the important steps which market regulator SEBI could consider and propose and suggest to the government to take steps towards that. But of course, the government at this point of time thinks that weekly expiry is largely being used for speculation and not for effective hedging, and that's something which it wants to change, and hence discussing steps with market regulator SEBI to be able to do that.
But absolutely, Yash, an important development out there. We'll keep tracking this as and when it unfolds. But for now, we have a lot of these capital market names that are taking a hit. BSE, for example, is down almost 4%. So we'll see how that unfolds. But let's slip it to a very short break. Up next, we get you updates from US President Donald Trump's tariff threat to India. Stay tuned for more. Welcome back. US President Donald Trump took to Truth Social last evening and said he will substantially raise tariffs on India over its purchases of Russian oil. He wrote, and I quote, "India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchase, selling it on the open market for big profits. They don't care how many people in Ukraine are being killed by the Russian war machine. Because of this, I will be substantially raising the tariff paid by India to the USA," end of quote. He, however, did not elaborate on what the tariff would be. Remember, last week, Trump had said that he would impose a 25% tariff on goods imported from India and added that India would also face an unspecified penalty, but gave no details.
Now, following the US president's tariff threat, India has issued a strong response. Parikshit is joining in with more details on this. Parikshit.
The Indian government has tried to set the record straight with the US. They've gone on to say that the actions being taken by the US administration and the European Union against India for purchase of Russian oil are absolutely unjustified and unreasonable. And India will continue to take all measures necessary to safeguard national interest and also economic security. India has tried to remind the Trump administration that we started buying Russian oil after the war began because traditional supplies were being diverted to Europe. Secondly, the Biden administration at that time had encouraged India to go ahead and buy oil at the price cap because it was necessary for strengthening global stability in crude prices. Remember, there were no sanctions on India at that time for the purchase of Russian oil at the price cap that had been decided by US and European countries. Indian imports are necessity compared by global market situation. That's the word coming in from the Ministry of External Affairs. The government has also said that it's very revealing that the very countries who are criticizing India right now and taking action against India for buying Russian oil and energy are themselves indulging in trade with Russia. For example, European Union imports of energy in 2024 had reached a record 16.5 million tons. US continues to import uranium, hexafluoride, palladium, fertilizers, and chemicals from Russia as well. So India is trying to set the record straight before a domestic audience, but it's also extending an olive branch to the US by saying that we are buying more oil and gas from the US. In fact, crude oil imports from the US are likely to go up by 150% year on year in FY26 itself. The trade negotiators will be talking later this month, but the word coming in from industry bodies and experts is that there is a need to dial down the rhetoric. It is important to have some clever diplomacy on the table and look for ways to save and protect this long-term strategic partnership, which is very critical for India.
Well, thanks so much for that update, Parikshit. But let's move to a very short break. More news and updates on the other side.
Welcome back. The Reserve Bank of India's Monetary Policy Committee will announce its interest rate decision tomorrow. CNBC-TV18's poll shows that the market is divided between a rate cut and a status quo. Ritu is here to tell us what to expect from the policy.
The RBI's August policy meeting is shaping up to be anything but predictable. A CNBC-TV18 poll of top economists shows a clear split. Half expect a 25 basis point cut, while the other half say the MPC will hold rates steady. But zoom out and look at the broader macro picture and you'll see inflation has dropped to a 77-month low. CPI is likely to average below 3% through the year. And so some like SBI, for instance, warn that not cutting rates now could be a costly type 2 error, essentially waiting too long and hurting growth when inflation is already under control. But most economists, that is 70%, see the terminal policy rate settling at 5.25%, which means one more 25 basis point rate cut is going to wrap up this easing cycle. On the timing of the rate cut, the poll is split. 30% say August, another 30% October. December leads at 40%, but signaling we're near the bottom either way. On the stance, though, there is no ambiguity. All expect RBI to stick to a neutral stance. But speaking of growth, here 70% believe RBI could leave the forecast unchanged at 6.5%, though the street does expect RBI to flag signs of slowing momentum. On inflation, 90% expect a downward revision to RBI's 3.7% forecast, possibly to around 3 to 3.3% because of the easing food prices and the favorable base effect. As for the tone, 60% expected to stay neutral, but 40% are leaning towards dovish. But the wild card in all of this is tariffs and trade tensions, where half of the economists see no policy impact, while 40% do say external headwinds can push RBI to ease further, but they do agree mostly it's still a wait-and-watch game. Finally, do keep an eye out for the revised liquidity management framework, any commentary on the growth narrative, and the possible extension of the EBLR, which is the external benchmark-linked lending rates, to NBFCs as well.
Well, thanks so much for that, Ritu. But moving on to the latest update from West Asia, amid mounting domestic and international pressure for the release of hostages, Benjamin Netanyahu will convene a meeting of his security cabinet this week to decide the Israeli military's next step in Gaza. Take a look at this report.
Benjamin Netanyahu said on Monday he will convene his security cabinet this week to decide on Israel's next steps in Gaza. The announcement follows the collapse of indirect ceasefire talks with Hamas. One senior Israeli source suggested more force could be an option. On a visit to Israel, U.S. Middle East envoy Steve Witkoff had said he was working with the Israeli government on a plan that would effectively end the war in Gaza. Talks in Doha had aimed to secure a short-term ceasefire that would see an influx of desperately needed aid to more than 2 million civilians, many of whom are gripped with acute malnutrition. Health authorities in Gaza said at least 40 Palestinians were killed by Israeli gunfire and airstrikes on Monday, including 10 seeking aid, adding another 5 had died of starvation. Video obtained by Reuters showed Palestinians running from gunfire near a Gaza Humanitarian Foundation aid distribution site in central Gaza on Saturday. Israeli officials have floated ideas including expanding their military offensive and annexing parts of the war-shattered enclave. Israel's Channel 12 on Monday, citing an official from the Prime Minister's office, said Netanyahu was inclining towards expanding the offensive and seizing the entire Palestinian enclave. Israeli Army Radio reported on Monday that the country's military chief has become increasingly frustrated with what he describes as a lack of strategic clarity by the political leadership. A spokesperson for the Israel Defense Forces declined to comment on the report, but said that the military has plans in store. Hamas has repeatedly said it won't lay down arms, but it has told mediators it was willing to quit governance in Gaza for a nonpartisan ruling body, according to 3 Hamas officials. It insists that the post-war Gaza arrangement must be agreed upon among the Palestinians themselves and not dictated by foreign powers.
Well, with that, we call time on this edition of Business Lunch. From Amakshimi and the team that put this show together, thank you so much for watching. Numbers of Excite at the bottom of your screen. The market too nearing the lows of the day. Mid-cap radar takes the action forward on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Well, we're starting the show at the day's low for the Nifty. We have come off 170 points from the day's high. Earnings which are trickling in, but most importantly, whatever is happening globally is something which is impacting markets.
Good afternoon, Sonal. You're absolutely right. So much uncertainty in terms of tariff, earnings not as well or as good as what the street was anticipating. All of this clearly taking a toll as far as the markets are concerned. But we have a lot lined up on the show, an important corporate conversation as well. So let's start off with the top headlines. Rising tension on trade between US and India hurts sentiment. Oil and gas, pharma and realty are the big drags, while auto and consumer durables are in the green. Mid-caps drag.
Angel One is in focus post-July business update. Company's client acquisition remains strong and market share rises. Client base up nearly 2% compared to June.
Butterfly Gandhimathi reports a strong margin expansion and revenue growth despite a challenging environment in the first quarter. The stock rises 7%.
Siemens Energy gains after reporting numbers for the quarter ended June 2025. The company reports strong revenue growth driven by power transmission segment, while EBITDA margin improves to 19.1%. Okay, all right. Those are the top headlines for the Nifty. The headline is that it is at the day's low currently. So is the Sensex right now. So we have come around 140 points off the day's high, below the 24,600 mark, and a lot of components which are contributing to that. In fact, for now, it's only Nifty Auto which is in the green right now. But apart from that, if you look at something like a pharma index, realty index, FMCG, IT, all of them in the red, and those are the major reasons for that drag on the Nifty as well. Yesterday, banking index kept Nifty in check. Today as well, it's down 0.6%, but bigger cut coming in from mid-caps, and that's exactly what we'll talk about.
That's right. So Hormuz is standing by the wall. A lot of earnings, Hormuz. Lot of stocks in the broad end of the market that are making all the moves. So which are the stocks on your radar? This is a special segment, Midcap Buzzers.
It keeps you going, doesn't it? The midcap index at the lowest point of the day as well. We start off with some of the top gainers, if you can call it that. We're starting off on a little contrarian note on the broader markets today. We start off with stocks that are gaining in today's trading session. And there are the stocks of the likes of MGL and the kinds that are doing well in today's session, bucking the trend. But of course, the focus is on the earnings reactions. We saw numbers from Exide just a few minutes ago. We saw numbers from Triveni Turbine, because of which the stock trades at the lowest point of the day as well. Numbers from Eris Life Sciences came just a few minutes earlier. So a lot of these earnings reactions, mid-cap pharma names are starting to report numbers as well. Take a look at Anup Engineering as well. That stock was down almost 3% after its results, seeing a bit of recovery from the lows of the day. Now, some of the other movers in today's session include the likes of the other stocks that are doing well, or the stocks that are doing well on the volumes front. The textile stocks, though, they are not doing well. Gokaldas Exports is one of them, 8% lower on that stock. Look at Wellspun Living and SP Apparel, that too not having a very good day at the office. So not good going for textile names. On the volumes front, though, there are stocks that are doing well. Look at Prakash Industries. Butterfly Gandhimathi is something that you guys just highlighted, and Jai Bharat Maruti is a result reaction as well, 3% higher on that stock. And even today, there are some names that are at a 52-week high, maybe off the highs of the day, but take a look at JK Cement, take a look at CSB Bank and Datamatics. Those are some of the stocks that are at a 52-week high. Back to you guys.
Okay, all right. Thank you so much, Hormuz, for joining in with those names. Let's welcome Shrikant Chauhan now from Kotak Securities for a technical check on the markets. Shrikant, good afternoon. The question, of course, is what's the next important level to watch out for on the Nifty? Will we see lower lows from these levels?
Good afternoon, Sonal. Good afternoon, Vivek. As far as Nifty is concerned, the next level to watch out for would be 25,450. And above this level, the market has spent a lot of time, close to 3 months. And now we are seeing gradual decline towards those levels. At these levels, if we see the market breadth, then it is very poor. And also, if we consider the today's formation, based on option statistics, then supports have shifted again back to 24,500 450 levels. So broadly, I am of the view that the market is going to remain in a range. At the same time, at 24,500 450 levels, the market is having excellent support. From there, again, we can expect a recovery because the fall is quite gradual. Means it has taken a lot of time to reach these levels. So in case if we see the market is dropping below these levels, then also I'm not seeing the market to sustain below these levels so easily. So rebound is definite, But yes, because of the news flow, because of the overall uncertainties in the world markets, in terms of news flow, I think the market is finding difficulties to sustain at higher levels. So till the market is not crossing 24,800, we are going to see range bound sort of activity in this market. That's my view.
Okay, Shrikant, and within this very volatile trading session, any picks for our viewers?
Yeah, Vivek, see, there are a number of stocks which are doing really well. They are managing, they are holding above their important support levels and crossing important resistance level. Specifically, if we consider Radico Khaitan, then it is consistently holding the series of higher top, higher bottom. Currently, it is around 2875. It was around some 1,000 levels few months back. From there, all the way, it is at 3,000, but the overall momentum is still intact. And it is clearly indicating us that in case if there is any correction, let's say close to 2750 or 2800 levels, there we should look for adding this stock more. But even at this level, it looks quite attractive. I'm expecting this stock to move towards 3500 levels, which will take some time. But in the near term, at least we can see the levels of 3150. That's my view. The other stock on which we are bullish is from the diagnostic space, and that is Lalpath Lab. Here also, if we consider the technical pattern of the stock, then it is into strong pullback mode. It is on the verge of crossing its previous high of 3550. Currently, it is around 3200. But in the near future, I am of the view that the way there is a buying interest for the stock, it is going to cross this level. So at this level also, it's a buy around 3200. We can expect at least 3350 in the near term. But in the medium term, the stock may even cross the level of 3500.
All right, take that point. Thank you, Shrikant. Dr. Lalpath Labs is at the day's high as we speak. With that, we'll slip into a short break. When we come back, management of Mindspace REIT will join in to discuss their Q1 numbers and the outlook. Welcome back. You're still tuned into Midcap Radar. Mindspace REIT, that's the stock on our radar, reported their Q1 numbers, saw revenue surge by 18% on a YY basis. EBITDA was up 22% as well. Gross leasing, which is an important metric to track, was up 55% in the same period. Ramesh Nair, who's the MD and CEO at Mindspace REIT, is joining us now to discuss more and, most importantly, the outlook going forward. Ramesh, good afternoon. Thank you so much for joining in. Well, leasing this time around at 1.7 million square feet has been strong, a 55% uptick that you saw. What's the target for FY26? You saw good growth in FY25 as well. Will you surpass that, do better than that?
Thanks, Sonal and Vivek. Our gross leasing last quarter was 1.7 million square feet. Our revenues went up around 21%. Our occupancy today stands at 93.7%. We hope to take this to 95% by the end of this financial year. Our NOI is up 24% year on year last quarter, and distributions are up 18%. Now, why is all this happening? The market has been outstanding, phenomenal market conditions. Every quarter, we are seeing market breaking new records despite the global uncertainties. During that 3-4 weeks, when there was those big tariff wars and the India-Pakistan issue, those 3-4 weeks, we had seen a little bit of a slowdown in decision making. But in spite of that, this quarter, the overall market posted very, very good record numbers. Net absorption for H1 calendar year, again, it's an all-time high. Net absorption up 28%. Gross absorption, again, up 18%. Vacancy levels, we're talking of around 14.5%, down from around 17%. So all market conditions kind of looking at a good market for people like us.
And what's the outlook for leasing in FY26? You did 7.6 million square feet in FY25. Same number in FY26?
See, the leasing numbers were big for last year, mainly because we also had a lot of stock coming up. We had the data center pre-leasing, which we did, which is close to 1.1 million square feet. We had the R2 building in Pune, which was 1 million square feet, which is pre-leased to a global capability center. We had the B1 building in Hyderabad, which is 1.5 million square feet, which was again pre-leased to a big global banking GCC. So we need to have that stock to keep going up that way in terms of gross and net leasing.
Understood. So you mentioned, Ramesh, that stock needs to keep going up. So currently, what is the kind of occupancies that you're seeing across the portfolio? Any significant trends that you're seeing either geographically or sector-wise? And end of FY26, where do you expect that number to be?
So in terms of under construction, we have our B8 building in Hyderabad, which is around 1.7 million square feet. A lot of interest in that. Hyderabad market has gone through the roof. Rentals, which 1.5 years back were in the early 70s, has gone to mid to late 90s already. So that's an opportunity. We will start construction in Airoli for our B15 and B17 buildings very soon. We also have a B18 building in Hyderabad, which we are hoping to start construction soon. So as an experience center, again, 150,000 square feet. This is a big club facility, which we're doing in Hyderabad, which is expected to be completed in the next 2 months. So multiple things happening on the under construction CapEx side.
Okay. You're talking about under construction CapEx. What about the SEZ portfolio? How much of the portfolio has been denotified, I'm sorry. And what kind of occupancies are you seeing in that particular portfolio?
So SEZ, we've converted around 2.3 million square feet. In that 2.3 million square feet, we've already leased around 1.6 million square feet. That's played in our favor. In a park like our Airoli West Mindspace Park, which we call Gigaplex, vacancies pre the demarcation rules used to be 72%. That's now become 92%. Overall, our Airoli parks, which used to have an occupancy of around 75%, has now become 85%. So we've been big beneficiaries of that demarcation laws. Today, government has been highly supportive. The paperwork is easy. You can get your space demarcated in as much as 45 days these days.
So when it comes to new capacity addition, Ramesh, are you waiting for this entire process to go through, or are you already have a strong capex plan underway? Which are the geographies that you're targeted? And in terms of the portfolio, end of FY26 and FY27, where do you expect to be?
So in terms of capex plan over the next 3-4 years, the spend is going to be close to 4,200 crores. This year, of that 4,200, we would be spending around 1,200 crores on capex and around 200 crores on upgrades. Growth is going to happen both organically and inorganically. Like I mentioned, redevelopment, which we are already doing, B1, B8 in Hyderabad, that's happening. Data centers, we are putting up close to 1 million square feet again in Navi Mumbai. With that, our data center portfolio would be 5 data centers, so 3 under construction and 2 already operational. From a growth perspective, on an organic point of view, there's close to 7 million square feet, which is either under construction or development pipeline. We have close to 2 million square feet vacant area, which is spread out across the country, which we need to lease. We also get mark-to-market rental growth and contractual escalations, which happen. Inorganically, our sponsor has close to 18 million square feet, a lot of which we have ROFOs on. So acquisitions from the sponsor group would be a big growth driver for us. We're constantly looking for third-party acquisitions. We just did one, 800,000 square feet in Hyderabad Financial District. And we also look at consolidation within our parks, wherein smaller spaces available, which landlords want to sell, we end up acquiring it. So many strategies at play for both growing organically and inorganically.
Got it. Got it. Thank you so much, Ramesh, for joining in. Always a pleasure speaking with you. Thank you for telling us about Mindspace plans going forward and a lot more. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Midcap Radar. Well, earlier today, our colleague Nimesh had highlighted a particular report. This was on the power OEM, the power space, the wind energy as well as solar energy space. This particular report was from UBS and it was a standard brokerage report of the day. So what exactly is UBS saying as far as the power as well as the power OEM space is concerned? Number one, they have an anti-consensus positive view on the entire space. They believe that there's an upcycle ahead and the advantage most likely will be with the incumbent leaders. So which are the names that they've initiated coverage on? Number one is BHEL, the second one is Wari, Premier Energy as well as Suzlon. Thermax, they've retained their buy stance and they've raised the target price to 5,100 rupees a share. On UBS, what is it that they believe? They believe that the rising thermal addition is something that bodes quite well for BHEL. Remember, BHEL almost has a moat when it comes to building thermal power plants in India. So they anticipate that net profits could rise up to 8x by FY28. On Premier Energy, remember, solar cell module manufacturing company ahead of peers as far as backward integration and integrated expansion is concerned. They believe that the company's 10 gigawatt backward integrated capacity could drive 34 to 36% top line as well as EBITDA CAGR between FY25 to FY28. Wari Energies, the thesis is quite similar. Both of them, remember, are in a similar space. They believe that they expect close to 620 basis points of EBITDA margin expansion between FY25 to FY28. On the other hand, when it comes to Suzlon, they believe that this wind turbine generator manufacturer is something that continues to have sector tailwinds as well as a competitive edge that they believe will lead to significant earnings growth. They expect annual deliveries for Suzlon to rise from 1.5 gigawatt in FY25 to close to 4.2 gigawatt by FY28, translating to a 46% EBITDA CAGR from FY25 to FY28. Overall, an anti-consensus positive view is what UBS has on the entire power space. But moving on, some more movers. Remember, Triveni Turbine 2 is from this particular space, but that stock is seeing a muted or negative reaction in trade following its Q1 earnings. Vamakshi joins in with more details.
Well, Vivek, Triveni Turbine is absolutely slammed in trade today after the company reported a weak set of numbers in this first quarter of FY26. The revenue saw a decline of almost 20%, and this decline is largely being led by the domestic sales, which are down almost 24%. Exports were down too, but down only 15% on a year-on-year basis. We've also seen that their gross margins have expanded only marginally by 32 basis points to 52.17%, but their EBITDA margins have taken a knock of almost 81 basis points, given the kind of growth we've seen in their employee benefit expenses, which rose by almost 14% on a year-on-year basis. The EBITDA is down 23%, and the net profit too is seeing a cut of almost 20%. But what's leading to this sort of muted performance or weak performance from the company is the way the geopolitical uncertainties played out in the first quarter. The dispatches as well as the orders were delayed and pushed into subsequent quarters because some of the customers, the international customers, did not travel for the inspections. Apart from that, the ordering activity this time around was also very weak. Order inflows stood at 536 odd crores. This is a downtick of almost 16%, and most of this, the growth is being led by the exports business. Remember that Q1 FY25 was, there was a high base as far as exports are concerned. And this time around as well, despite that, they have highlighted that there was lower demand across products as well as aftermarkets. Now, the domestic business too, on the other hand, saw an uptick of almost 32% in the order inflow. There was some commentary that came in from the management as well, and they say that the quarter's performance fell short of their own expectations. However, they are taking efforts to realign operations, and they believe that the company can maintain its growth trajectory going forward. But nevertheless, weak set of numbers, order inflow weak, and therefore the stock is down and out in trade today.
Thank you so much, Vamakshi. Muted execution, muted order inflow, ensuring that this particular stock remains under pressure today. Well, a couple of other stocks on the radar. Have a look at Naukri or Info Edge. That particular stock has seen quite a bit of a fall from the day's highest point. That stock trading near the day's lowest points. A couple of auto ancillary companies have recovered quite smartly. Have a look at Uno Minda, that particular auto ancillary company, trading near the day's highest point. Sona Comstar 2, that particular stock, has recovered quite sharply. But with that, it's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra and with me is Vinny Motiwala. And as always, we'll talk about how to do your mutual fund investments to achieve goals in life. And today, the final goal is quite fun. It's going to be about travel, but about education as well.
Absolutely, travel and education. Travel is for me. Education, maybe you can pick it up, given that
I'm very well educated. I'm just joking.
But yes, we can do that. Inflation is increasing everywhere, and we need to know how to, up that inflation, make more returns as well. So today, firstly, we're going to start discussing about your vacation budget. How can mutual funds actually help you, plan your holidays? What should you be investing in? Near-term, long-term goals on your vacation holiday. How should you be budgeting this? To talk to us about that, we have Varun Fatehpuria, who's the founder and CEO at Daulat Finvest, as well as Prableen Bajpai, founder at FinFix Research and Analytics, joining in with us to talk to us about that. Varun, as well as Prableen, good afternoon, and thank you so much for joining us on the show. Let's start with the vacation, right? Everyone wants to align their investments with vacations, the budget that comes in over there, and everyone wants a holiday every year at least. One holiday is what you want. How should, you use mutual funds and different categories, different types of mutual funds to actually budget this vacation? Prableen, first, if you could start with that.
Good afternoon, Vinny. Mutual funds definitely give us a great variety of products and categories which are available to investors to align their vacation goals, of course, and other different goals, because we have specific categories which are well suited for a different time period. So while planning your vacation, the key is first that the investor or the person who's traveling or planning their travel has to decide on the investment horizon, that how far is the vacation. And that's the first step. Because let's say if the vacation is going to happen in 1 to 3 years, then the focus has to be on capital preservation. There has to be liquidity, and we are not looking at any volatility there. We want something which is going to stay more stable. So let's say debt funds, arbitrage funds, there's this new category, which is the income plus arbitrage. These become the preferred options. And of course, within these, which category or which particular scheme would suit the investor will also depend on their own tax liability and the exact horizon which they have. But of course, the focus remains on capital preservation, and thus we are not really looking at high risk and any sort of high returns here. But we are just setting aside that amount to be able to cater to that holiday which is going to be there in the next 1 to 3 years. But Vinny, let's say if this travel is 3 to 5 years away, then probably there is some scope of growth as well as undertaking a little amount of risk, and that is where hybrids come in. And I think within the hybrids, balanced advantage funds, multi-asset funds can be good categories to go for. And there are a lot of schemes which even during the previous fall, which happened from September till April of 2025, were able to contain the losses at 1/3 of how much Nifty fell. But of course, again, investors will need to see that they're looking at a slightly conservative sort of a hybrid fund here and not picking the risky one, because the highest fall was even up to 24%. But hybrids, I feel, can be the go-to category for this 3 to 5 year period. And if the vacation is, if you're really planning for the long term, and if you're planning a vacation after 5-7 years, then I think, of course, you can have the regular equity exposure, but more towards the large caps, so that you have a certain amount of growth, which is able to also negate the inflation, which is going to happen in that time period.
Take that point. Varun, let me come to you. What are some of the mutual fund categories, according to you, which can be looked at when it comes to funding your vacation? And adding to that, because we are factoring in inflation, there are travel costs which are fluctuating, how can one plan their corpus, especially when we are talking about volatile economic periods?
Yeah. Hi, Sonal. Firstly, thank you for having me back on the show. I would just allude to a lot of what Prableen had mentioned with respect to having a very clear understanding of what your time frame for investing in. And then because mutual fund gives you such a lot of varieties with respect to the schemes that you could choose for, that you could pretty much customize any sort of a travel goal that you have for yourself, depending on when you want to take it, right? So obviously for shorter term time periods, anywhere between 1 to 2 years, where your goal is capital preservation, always stick to debt funds. And in debt funds, you could look at categories like liquid, ultra short, even perhaps money market funds, right? Where the goal is to provide you with capital protection and hopefully over a period of time, give you a certain percentage of points over and above the inflation. So those are the categories that you could look at in the debt category. If you're, let's say, planning for a vacation 2 to 3 years down the line, then you could start potentially looking at some allocation to hybrid strategies. And even within hybrid funds, which predominantly have a bias towards fixed income. So something like an equity savings fund or a balanced advantage fund, or even in some cases, conservative hybrid funds, or even in some cases, very specific multi-asset allocation funds, which provide you sort of like a fixed income like experience, but with a favorable equity taxation. So these are the strategies that I would consider for, let's say, goals maturing in the next 1 to 3 years. And second thing which investors need to definitely keep in mind is take into account inflation, right? Inflation, the headline inflation could look anywhere between, let's say today the print is at about 2 to 3%. But I would definitely recommend take that with a pinch of salt, maybe even 4 to 5%, because once we go out to travel, we see that definitely prices have significantly jacked up from when we were there maybe a year or two back. So domestically, if you're traveling, take that into account. And if you're traveling internationally, then add some currency depreciation as well against the INR.
Prableen, on the inflation point also, is there a possibility, right, when you see inflation, the number increasing, then maybe you should start stepping up that SIP? Is that a possibility? And when you're reaching closer to that vacation date, how do you start transferring? Is there a transition of your investments from those high risk to safer bets or safer instruments that one could look at? How should you go about that as well?
So ideally, Vinny, this strategy can be implemented if you have a vacation goal which is around 5 years away and plus. Because if the goal is, let's say, 3 years away, so today a cost of 3 lakhs for your travel, even after 3 years would come out to be about 3.67 if you're looking at 7 to 8% inflation. If you're planning to go abroad, the same 3 lakh would almost become 4 lakhs considering higher inflation, because last year, like we saw, there have been so many reports where actually international travel expenses really moved up since January of 2024 to now. Rupee has depreciated almost by 5%. So all of these need to be factored in. But sadly, if the time horizon is very short, like for a 3-year period, unless and until you're doing a lump sum, and there also you'll have to take some risk with a hybrid fund, you can't actually gain the kind of returns you would want to beat this inflation. So the amount of investment will need to be higher. But having said that, yes, still you need to set aside a decent amount of money so that you don't indulge in taking last minute loans or other avenues which are in fact going to be a cost in the future for you. So definitely setting aside that corpus and stepping up is a great idea if the horizon is slightly away, and moving from your equity. Let's say if you do have an equity portfolio which you've created and the goal is coming, it's close by. So as a standard rule, definitely, Vinny, we do recommend that, there has to be, we have to ensure safety of capital, and, you're looking to sort of lock in your gains which you've earned in equities. So gradually moving into something safer makes sense. So STP can really reduce the timing risk, so that you're not sitting with your equity allocation to the last minute and then waiting to move out. So STP becomes a good option. And also, Vinny, one more thing, that sometimes during your cleanup or during the portfolio reviews, there are certain schemes sitting in your portfolio which probably you didn't even allocate for your vacation. But let's say that you feel that needs to go out and that churn is required. That can also be used for a specific goal such as vacation. And your additional corpus which you're planning to invest can actually be diverted towards something that is which you feel can add more merit to the overall portfolio.
Got it. So Varun, your take on this one is systematic transfer plan as we approach vacation, the right way to go about it. And when we talk about funding vacations, what are the advantages of funding vacations, say through mutual funds versus taking a personal loan or other ways as well? And how does discipline of SIB contribute to making travel dreams more affordable? We don't want any stress here as well, right?
No, definitely. I think coincidentally, just today, a report came out that about a third of the Indians actually take out personal loans to fund their vacation or fund their personal lifestyle, which in all honesty is something that you could try to avoid to the extent maximum possible, right? Because there are a couple of reasons for that. I think when you're taking out a personal loan to fund these kind of expenditure, number one, the cost itself is really high from an interest rate perspective, right? So let's say if we do simple numbers, if you're borrowing, let's say 2 to 3 lakh rupees, on an absolute basis, perhaps you would not be able to see it as such a significant amount from an interest component. But if we actually get down to doing the numbers, Sonal, the interest could as high be as 12, 15, even 20% in some cases. So definitely these are unsecured loans which the banks and NBFCs are lending you to. And so accordingly, the charge is passed on to the borrower. So to the extent possible, try to avoid taking on a personal loan, because it also creates that EMI burden every month once you have taken that vacation. On the opposite hand, if you look at mutual funds, I think once you have a certain amount of goal that you want to achieve from a target corpus point of view, I think then it is very simple to keep that money aside every month, whether that goes into a debt fund or a hybrid fund, depending on what your overall goal is. But at least it creates a sense of discipline and forces you into a good enforcing behavior rather than taking on loans to fund your personal lifestyle.
Absolutely, this does help you in planning your goals as well, long-term goals, and even better. That's on vacation, how you can fund your vacations through mutual fund, and obviously 3 to 5 years, then you would be better planned right now as well. But on that note, we're going to actually sip into a very short break. On the other side, we're going to be focusing on how to strategize your investments amid the rising education inflation. How should we be going about that? So don't go anywhere. Welcome back to MF Corner on CNBC-TV18. We still have with us Varun Fatehpuria of Daulat Finvest, as well as Prableen Bajpai of Finfix Research and Analytics. Now, what we're going to be discussing is going to be education and education inflation that's coming in as well. 8 to 10% is the education inflation. Is it possible to actually beat this with mutual funds, or how should you plan your mutual funds to help you, educate your kids for higher education that you may look for as well? Varun, let me start with you this time. This 8 to 10% per year is your education inflation that we look at. Overseas, then you obviously have that forex cost, additional costs that come in as well. Firstly, how should an investor actually start or accurately estimate that future cost that will come in terms of the corpus that is required, whether it's in India or you want to go and study abroad? How should you go about this?
No, absolutely, Vinny, right? I think as you correctly pointed out, the education inflation today in our country, and we often speak to a lot of our parents, clients who are planning for their child's education 15 years, 20 years down the line. This is a tingling point for a lot of them, given that the education inflation numbers for not just our country, but if they want to send their children abroad, accounting for depreciation could run as high as 9 to 10%, maybe a couple of percentage points, even more, taking into account currency depreciation, right? So we ran actually some simple numbers to see how do you actually accurately forecast a number from a goal perspective that you would like to reach in X number of years, and what could be a potential amount that you could look at contributing either through an SIP or lump sum top-ups over that period, right? So let's just take, for example, today a 4-year undergraduate course in a private US university costs anywhere between 2.5 to 3 crores. And it is important to note here that we're not just taking into account the cost of tuition, but also the cost of accommodation, lodging, living expenses, and the travel to and fro back from your home country. So that number ranges anywhere between 2.5 to 3 crores. Assuming that if I add inflation numbers of 6 to 7% to that, and a further INR currency depreciation of 4%, we are looking at a total annual adjusted inflation number of 10% over there, right? So over a 15-year period, that 2.5 crores actually rises to as high as 9 to 10 crores. So if I were to get to that amount in 15 to 18 years, I would need to set aside roughly 1.5 to 2 lakh rupees every month starting today, assuming my investments grow at about 12 to 13%, right? So we can really see that how inflation and currency depreciation significantly adds to the overall cost, which parents need to keep in mind. And the key is to just start early.
Oh my God, the exorbitant fees that we have right now for even playgroup or nursery. Let me not
Sonal is feeling the pain right now.
Let me not even get started on that. But Prableen, let me come to you, because when we are talking about preparing for it already, what mutual fund categories would be good for that? Which are the most effective in beating education inflation, say over 10 to 15 years? And how should allocation shift as the goal is nearing and you're reaching that high education goal for you?
So I think one is lucky, Sonal, if you start 10, 15 years, you're aware and you've started, because you do have that long time period where your money can compound. And even with a small contribution, you can create a decent corpus for your child's education. And also, Sonal, this is really, really crucial to have a separate education corpus for your child, because by the time your kids are growing up and they go to college, your retirement is also closer. So if you haven't catered to this separately, then, you somewhere can jeopardize your own, take out money from your retirement corpus. So that can be really bad for your retirement life. So it's really important to create a separate education, planning has to be there. So if we just go down and, we take an example of India with, let's say, 15 years tenure and 25 lakh cost today, this would become roughly 1.04 crores in the next 15 years. And for this, Sonal, an SIP of about, if we are just simply taking 12% returns, an SIP of about 22,000 will be required. And let's say if you can't do this 22,000 in one go, then probably 12,500 with a step up of 10% is what can get you there. And let's say if you're taking a fixed income product, Sonal, because, a lot of us, we feel that PPF and Sukanya Samriddhi, of course, they're absolutely amazing products because they are totally tax-free. So if a 7% product is taken, then you actually require a 33,500 contribution to create the same corpus. So I think each one of us has limited resources. So that extra 10, 12,000, which is going to go every month, I think if that can be saved through equity investing, that can really help, and that can probably be allocated towards the retirement goal. Also, even if you are adding some part of fixed income, through these schemes because they do have restrictions of how much can be invested. And I think the education corpus usually, which is the target corpus, becomes really big. So using them is not solely is not a viable option. But I'll give you an example that if we are looking at large, mid and small caps, the worst performers in their categories over the last 15 years have given 14.5% returns. And the best performers from the large, mid and small, even if they're just taken in the 1/3 combination, has given us 18%. So overall, Sonal, definitely equities remains the preferred choice with, I think, allocations to all large, mid and small with a multi-cap kind of an allocation, and international investing, if the limits permit, definitely should be added.
Okay. Varun, your thoughts coming in on, what kind of funds that an investor can look to invest for a child's education. Which are those funds that one could look at? And also, how can one actually mitigate that risk that is there? Because when I want to maybe withdraw, maybe 5-10 years later, and there's a market downturn, then how should I avoid that risk as well?
So Vinny will take that question independently, right? I think from a category selection perspective, there are two distinct categories one could look at. One is obviously the children's gift fund, which comes with a mandatory lock-in period of 5 years, or the child attains majority, whichever is earlier. The drawback to that is you are fixed to a particular investment strategy from a particular fund house. Right? So there is not a lot of leeway from an investor perspective with regards to the market cap selection or the factor selection or the style selection. The other strategy, which we always recommend, since you have that long of a runway ahead in front of you and the time horizon, go for creating a custom mutual fund portfolio, right? So if you have a 15-year long horizon, I think it's important that you start with a very aggressive allocation to equities, right? And within equities, perhaps you could look at a combination, what Praveen mentioned, of large, mid, and small, depending on what your risk appetite is. But once you start nearing your goal and what you talked about, making sure you have the money at the right time, it's important that we start actually, de-risking the portfolio so that we're not caught in like a March 2020 or an October 2024 situation where over a period of time, our corpus can really go down by 15-20%, right? What we have really saved over a 15-year period. So it's important that I think we start with an aggressive equity allocation. I think once the time has elapsed, maybe slowly start shifting that to a hybrid allocation to offer that balance between growth and capital protection. And then maybe 2 to 3 years, once you're approaching your goal, to make sure the corpus is intact, start doing a switch or an STP to debt funds to make sure the capital gets protected. So this is roughly how we would encourage parents to think about education planning if you have the time by your side.
Okay, all right. We take that point, Varun. And this is, of course, a motivation as well for all young parents to go ahead, start investing in mutual funds for education. I've done that, and I hope that everyone else does it as well. There are a lot more questions. Of course, this can go on, but this is very helpful. So I would like to thank Prableen and Varun for joining us today and telling us how to go about first educating yourself well and then going on a vacation after that. So, or do both of them simultaneously. But thanks a lot for joining in today. Okay, with that, we'll do one thing. We'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
KOSPI is the index that is gaining the most in today's trading session.
Banks will hold the key because yesterday they did not participate. So let's see what the Bank Nifty does today. It's a lower start, you'd have to say. Mid-cap index is doing better. It's absolutely flat.
In aggregate, it is nothing great, but it's not bad.
The actions being taken by the US administration and the European Union against India for purchase of Russian oil are absolutely unjustified and unreasonable.
It's very difficult to do a deal with a mercurial person like him.
What are they targeting as a size of the liquidity surplus, and whether weighted average call rate versus SORR, which is the rate that they would likely to use for monetary policy targeting?
Current utilization levels, it's at about 75%.
We started flat, but now we've lost about 100 points. The Nifty is at the 24,600.
As a market leader, it is perhaps our responsibility to invest behind the category and not bother about maintaining share of voice.
A chartered accountant and commerce graduate, Rajiv Anand is a financial services veteran with over 35 years of experience. A CNBC-TV18 poll of top economists shows a clear split. Half expect a 25 basis point cut, while the other half say the MPC will hold rates steady.
Well, we're starting the show at the day's low for the Nifty. We have come off 170 points from the day's high.
Well, it's an action-packed closing bell last hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Surbhi and Nigel. Guys, unfortunately, yesterday's relief rally didn't hold up. You know, markets have been down from the word go and still down close to about 0.5%. So the Trump tariff, the renewed Trump tariff threats have hurt sentiment because global markets have been holding up okay.
Well, indeed, and that's why, in fact, the market continues to trade in a bit of a band. And, ex of the Paytm trade, actually, today volumes are still lower. Okay. Yesterday as well, volumes are rather subdued. Yesterday, the volumes are the lowest in the last 1 month or so. So currently, it appears that very, very lackluster trade. These moves are coming on relatively lower volumes. As it is, the average volume for July was much lower than June. It was more than 15% lower. And in fact, the last two sessions, actually, it's been even lower. So I'm just looking at the volume chart right now. It's still relatively lower, given that you had a couple of large trades since morning.
And the rupee's weakness is not really helping sentiment, right? And that's another bugbear, which now markets have to deal with. Foreign investors who are looking at India have to deal with, because there's been persistent weakness that we've been looking at today itself. But the fact is, on the brighter side, at least we didn't break yesterday's low. Yes, the Nifty, for a brief bit, did slip below the 24,600 handle, but then it's trying to sort of claw its way back. So let's see how it goes. We'll figure it out. But there is disappointment in the broader market. There's no denying that. The advanced decline ratio is telling you that almost 2 stocks declining for every one that's advancing. So it's a weak session, and you're really trying to find out stories that are working. Not a very easy day of trade today. Let's tell you, we've got, of course, a packed next 1 hour lined up. So let's tell you what we have coming up for you on the show. We're, of course, putting a lot of the big movers in the spotlight today, and Godfrey Phillips is one of them, flying after the Q1 numbers coming in. So what's worked for the stock, what's the street commentary, we'll tell you in just a bit. Lots of other stocks in focus as well. Plus, the big story that Yash is picking up, the possibility of more curbs in the futures and options market. What lies ahead? Look at the damage it's doing to a stock like BSE. Yash will join in on a lot of the source-based inputs that he's picking up. We're watching out for, of course, big earnings today. There's FMCG major Britannia coming up. Bharti Airtel all set to report after the bell as well. So a quick sneak peek into what these biggies could deliver. And then, of course, a lot of other earnings. Like I said, today is a very stock-specific day when we're talking about earnings. Triveni is down. Siemens Energy has been up. The commentary from Siemens has been very positive as well. So we'll talk about these two, couple of others as well. So a packed 1 hour lined up ahead.
Well, I'm just looking at the global markets, so just Asia Nikkei, that's the Japanese markets, ending with a gain of about 0.6%. Taiwan was up 1.2%. Hang Seng opened flat but closed with a gain of about 0.7%. Shanghai opened with a gain of 0.5%, ended with a gain of nearly about 1%. So Asia was firmly in the green, and Europe too has started off on a positive note. So the CAC is up marginally, up about 0.1%, 0.2%, but the DAX is up close to about 0.4%. So today's weakness in India, the reversal from yesterday's gains, is very specific to India, and it could be on the back of Trump making those statements to substantially raise the tariffs on India and penalize it for imports of Russia. And it's across the board selling. Banks continue to remain weak, but capital market stocks have been under pressure. The capital market index is down over 1%. You've got oil and gas down 1.25%, pharma, realty, all these indices are reeling with cuts of over 0.5%. IT, bank, those two too, down nearly about 0.6%. Yeah.
Well, but a couple of stocks actually are seeing some kind of buying. Vishal Mega Mart, I'm looking at the intraday chart. That stock, in fact, has recovered some of its losses. Sona, BLW as well. I recall the stock was down 3%. That as well has seen a good recovery in trade. You have Orient Pro as well, that's moving on relatively higher volumes as well. So select names from the broader markets are actually moving up. You pull up, an Aditya Birla Capital as well. Yesterday it was up 10%. Today, it's not giving it away. It's still up in trade today. So numbers good, commentary good as well. Management, has given some confidence out there. The street is buying into that name.
There's BLS International, came out with numbers just a while back. Strong numbers. Revenues up 44%, margins expanding to 29%, bottom line has gone up nearly 50%, and that stock moved up 5%.
Indeed. Quite a few names actually. Rima Newgen as well, another name that's up more than 10% in today's trading session. And you have Aditya Infotech, which is the newly listed company. We spoke to the management earlier today. That's up a whopping 60%. Enough of stock spotting. Let's get to Mitesh. Mitesh, your call has been bang on. This market is looking a little bit punctured. The structure itself has got punctured, and that's why you've been talking about shorting on bounces. What levels are you looking at on the downside, and what would make you change the stance?
Good afternoon. So I think one, the Nifty hasn't broken below the lows which we tested on Friday. I think, the Nifty is still holding about that. And I highlighted this in the morning that the problem could possibly come from the Bank Nifty. Purely because of, the fact that when I was looking at the chart components of HDFC Bank and ICICI Bank, which enjoy significant weightage in the Bank Nifty, both were, looking negative on the hourly, 2-hourly and immediate setup. So I think that's what has happened today. The Bank Nifty is slightly, I would say, underperforming the Nifty, and, it's making a fresh slow. I think if the Bank Nifty, does not manage to capture and close above 55,500, and the reason I'm highlighting this is because we have an event coming up, but the RBI policy is coming up, then I think, it could be slightly negative for the Bank Nifty, and we could see a level maybe not really below 55,000, but close to about 54,700, 750 zone. So in that sense, the Bank Nifty is the index to keep a watch upon. The Nifty is still above this 24,500, 550 support area, so pretty okay with me. On the stock side, I have a buy on Pidilite with a stop at 29.80 for targets of 30.60, 30.65. While on the sell side is Policy Bazaar, which I would say is a sell with a stop at 17.70 for targets of 17.10.
Okay, Pidilite reports numbers. The street is expecting a pretty good quarter, 9% revenue growth, volume growth of about 8 to 10%. The company is targeting a double-digit volume growth every quarter, and the street will track, its entry into paints, etc., the developments on that front. 2% up. That's Mitesh's pick. MTAR tech numbers are up for you on your screen. The sky is rocketing. The profits have doubled, 14.8 crore. Look at the EBITDA jump, 72% increase in the company's EBITDA. The bottom line is up more than about 100%. Awaiting the revenue number, while there is significant margin expansion, there is a 72% increase in EBITDA, margins at 18% versus 13%. But let's get a handle on Godfrey Phillips. That's clearly been one of the stocks of the day. Manglam is the first to tell us that very strong revenue growth. Manglam, more details?
38% revenue growth. The street likes that. In fact, we were working with good revenue growth largely because we had a peek into what ITC did. ITC reported a 7% cigarette revenue growth along with 6% plus volume growth that was at a multi-quarter high. So the street believed that maybe all the other participants in the industry would do well as well. And Godfrey Phillips has been doing well over the last 13 or 14 quarters as compared to ITC. So they've been slowly gaining market share. And at a time when leaf tobacco inflation would erode margins for all the tobacco companies, the only thing that will save you on an absolute basis is revenue growth, and that's exactly what has come by. So, despite a margin compression of nearly 230 basis points, the company's EBITDA has grown 25% year on year, and that's on the back of a 37% revenue growth, and the net profit also has grown at 25%. And given the current consumer sentiment and environment, if someone told you that there was a consumption company, not commenting on the nature of that, but there is a company that grows at 38% revenue and 25% profitability, the street would take that with both hands, and that's exactly what is taking place on Godfrey Phillips, not just this quarter, the last few quarters as well, and which is why the stock is up nearly 90% this year, and before that as well, we've seen a big move. Add to this, the board has also gone ahead and announced a bonus 2:1 for all the shareholders, so that stock doing well in today's trading session, along with doing well all through this year.
Yeah, that's an important point, actually, the fact that the bonus also is chipping in with the good vibes, so to speak, when it comes to Godfrey's performance.
On Godfrey Phillips, on July 23rd on Bazaar itself, in our morning chat, we highlighted that there was a big amount of delivery-based buying, which was much higher than what it normally was at. And also the read-through from Philip Morris's international call that they had on the India business was particularly positive. Keep in mind, the global company was down 7%. But, the read-through was good, and that's why we highlighted about the delivery-based buying. It had crossed a couple of technical levels, and now you have the numbers that are quite good. So it's shaped up quite well, and as Manglam said, the stock has had a big run. But just want to alert our viewers at around 8 a.m. on 23rd of July, we had spotted the stock as well.
Yeah, absolutely. I mean, and that's Godfrey. Actually, it's been a string of not such bad news from consumer companies. Remember, we were discussing Marico at the same time yesterday with its 9% volume growth. And up next is now Britannia. So is the cookie going to be crispy, Manglam?
Likely to be crispy. Let's see whether it bakes well in the middle or not. By the middle, I mean the EBITDA margin. The reason why I say that is because, revenue growth is likely to be decent. 7.5% is what the street is working with. The street knows that, this time around the stock has gone into numbers with good, expectations. Notwithstanding today's down move for the year, it's up around over 20%, which is better than what the other consumer peers have done as well. Little under 4,600 crores on the top line. The EBITDA grows by around 8%. The gross margins are likely to be compressed, largely because of volatility that we're seeing in raw material prices. But the company has a very strong cost elimination plan as well. So that could keep their EBITDA margin stable at that around 17.7 to 17.8% mark. The net profit on the back of that grows by about 8 to 10% as well. Closer to 12% is what the street is working with this time around. More than the numbers, the commentary on how raw material prices are likely to pan out, how urban inflation is, or rather how urban environment is picking up, and at the same time what their plans are with the ancillary business is something that we'll be watching out for very, very closely for Britannia.
Okay, all right, got it. Thank you very much for that. Well, let's discuss some of these consumer names with our, first guest on the show, Dharmesh Kant from Chola Securities is joining in. Dharmesh, I was just trying to jog my memory, and I think barring Colgate, not too many other companies have disappointed. Most have sounded optimistic about improvement in growth in the second half, including Lever, for that matter. You like anything in FMCG, cigarettes, tobacco? Let me expand that, even in Alcobev?
Yeah, good afternoon, Sobi. Thanks for having me on the show. I mean, the numbers have been okay type of numbers as far as FMCGs are concerned, and it's more to do with the market situation in which we are. So a flight to safety kind of numbers is being always liked by the markets. My own sense is even Q2 would be a difficult quarter for most of these companies. I mean, the margin contraction will be seen, and the way we have seen in Q1. So there won't be any, elbow room out there as far as the margins are concerned. Volume would be around 5-7% kind of a growth. So commentary wise, they sounded, cautiously optimistic rather than very optimistic on the prospect. Given the fact that valuations are still very rich and they are trading at, higher end of the valuation multiples, higher price action would be very unlikely. As far as cigarette division is concerned, one aspect is very clear. The premium segment has been doing very well. Even ITC, the premium segment cigarette sales were much better than what they were. So I think here one can play a bet on ITC rather than Godfrey Phillips. The stock has done a phenomenal run-up. The numbers were excellent. But going forward, given the type of performance we have seen in ITC, it values more merit with the valuation multiples at around 19 times 1 year forward as compared to, say, Godfrey Phillips, which is 40 times 1 year forward. So with other businesses firing in by, say, Q3, Q4, I do expect ITC to give a price action of 15-20%. So that's a better bet in the entire FMCG space. Others, I think, is just more of a trading play for a day or two.
Okay, so betting on ITC, that's where you could have a return of about 15-20%. Budget pain numbers are up for your screen right now. We've got the profit number. Profits down 11% to 315 crore. Revenues have gone up 3.6% to 3,200 crore, but the bottom line has taken a hit. EBITDA is also up 1.2%. So we'll wait by to see. Part of the reason is there will be some margin compression because the EBITDA growth is less than the revenue growth, 50 basis points of margin compression. But we'll wait by to see if there is any other item impacting the bottom line. Stock is down over 1%. But let's get to the other big story. Sources tell CNBC-TV18 the Finance Ministry is in talks with SEBI to take steps to reduce options market speculation. This news that Yash has put out has taken the stocks lower. BSE is down 5%. Many other capital market players under pressure. Yash joins in with the details.
Well, Rima, we had reported this earlier that market regulator SEBI is working and looking out for ways in which it can reduce options market trading and the speculation there. And as against that, actually focus on increasing the volumes in the cash market. Now, what we've been given to understand from our sources is that the Finance Ministry has also sort of, been in discussion with market regulator SEBI with the same agenda that options volumes and the speculation there needs to be reduced. On the other hand, cash market volumes need to be increased. According to our sources, the Finance Ministry is of the view that options market volumes or the transactions there is not meaningfully adding to any productive side of the economy. In fact, it is not even being effectively used for hedging and only being used for speculation, whereas cash market volumes and the transactions there would actually add to the productive economy. It is with this rationale and indication that Finance Ministry is in discussion with market regulator SEBI to explore ways, asking SEBI to explore ways to look at how options volume can be reduced. Now, there are three important suggestions which market regulator SEBI is also considering to reduce options market volume. The first one is with respect to the expiry itself. We have weekly options expiry. Market regulator SEBI is likely to consider an option to make this weekly expiry and turn it into a fortnightly, which is every 15 days, or even a monthly expiry if needed, which will help them reduce the options market speculation and the volume. The second option is to sort of propose or ask the government to reduce securities transaction tax or STT on cash market volumes, essentially to incentivize cash market volumes, which will automatically bring down the options market volumes. The third one is to reduce the margin requirement on the cash market transaction side as compared to the options market. These three are important suggestions which market regulator SEBI is considering. It is likely that it could come out with a consultation paper with regards to the same proposals and its suggestions. And of course, once consultation paper is given out, after taking stakeholder views, the market regulator could take it to its board to approve the final regulations here.
Okay, Yash, got it. So basically, from what you're picking up, it seems that the regulator is not entirely done in terms of trying to cool the action and the excitement in the F&O market. Thank you. We'll take that forward with our guests. BSE is still down about 5% in today's trading action. Dharmesh, capital market stocks. Let's start with BSE and even some of the other wealth manager stocks like whether it's Angel, whether it's Nuvama. What's your sense? Because there is, that's true. There's immense regulatory overhang that continues, at least on the derivatives market. So do you feel that it could impact volumes lower? Volumes have just started recovering for most of these players.
In fact, Surabhi, volumes are very down. They are gradually shifting on the downward trajectory, and last 3-4 days was also very bad. And the volume-wise, the type of market we are in, even if the regulator doesn't do anything, the volumes are going to, they are drying up. What I understand is regulators want options to be a more of a hedging kind of a mechanism rather than a play on the market. And if that is the sense of direction in which they are moving into, then definitely more stringent regulations are likely to come forward, and that will further curb the volume activity in the derivative segment. So this is bad for brokers. People who are into direct equity broking and whether it is options trading, that is bad for that. But as far as wealth managers are concerned, wealth management companies or asset managers are concerned, I don't think there's a problems out there. So AMCs are likely to do well. Wealth management companies are likely to do well. At the same time, exchanges, the revenues will come down. And see, the exchange, BSE, MCX, the play is the visibility of the NSE listing comes through. So there would be a natural cool off on the prices of both MCX and BSE. To my mind, it should be around 35 to 40 times 1 year forward PE multiple. So that leaves a scope of around 15 to 20% more kind of a stock price correction for both these exchanges. So what we are advocating to our client is to go for AMCs like Nippon and SDFC. They are a better place in this market. They are a more stable place. So those options look far better off than direct plays on the broking companies like Motilal or Angel and the likes.
Okay, all right, got that, Dharmesh. Let's move on to all the other stocks that are buzzing on the back of their Q1 numbers. Sudarshan joins and he's collated a list. Sud?
So I'll start with Exide Industries, where earnings were largely in line with estimate. But what is the reason that stock is down? Because the commentary is looking mixed, especially companies saying that one concern that remains is the increasing raw material cost, and it believes that even going forward, raw material costs are expected to be higher. As far as earnings are concerned, profit was up 15%, revenue too has increased by 5%, EBITDA has jumped by 11%, and margin has expanded to 12.2% from the level of 11.5%. Next one is Siemens Energy. It has reported earnings for Q3, they call it Q3 SY25, and earnings were very strong, led by power transmission segment. This segment had seen revenue growth of 35%. Because of this, total revenue has increased by 20%, and margin has increased by almost 500 basis points to 19.1%. Even order inflows were strong and have almost doubled to 3290 crore from almost 1700 crore. Next one is Aurobindo Pharma. Earnings for Q1 were weak, and that's the reason stock is down. Even in the commentary, though, companies saying that it will be able to manage margin what they had seen in FY25. Even revenue growth is saying that it would be in high single digit, but earnings were weak. Triveni Turbine, very weak set of earnings, and it was impacted by geopolitical tensions. Revenue was down 20%, EBITDA has fallen 23%, and even margin has dropped by 100 basis points. One company that has reported earnings just a few minutes ago, that is MTAR Tech, and stock is sharply higher, where revenue has increased by almost 22%, EBITDA too has jumped by 72%, and margin has seen a huge expansion, and that's up by almost 500 basis points. That's the reason stock is sharply higher.
Dharmesh, any of these stocks that Sudarshan was talking about in your portfolio where you're recommending a buy or you're looking to add, you're seeing a trend?
None of the stocks are there, but yeah, the space is there. I mean, defense is what we have been liking for a long time, and this correction which happened a couple of weeks back, we have utilized that correction to add on to the defense stock. And there, I think HAL and BEL still merits a long by standing. If you are having a vision of, say, again, it has to be 3 to 5 years, not a quarterly earnings. So this quarter, MTAR has reported a good set of earnings, but again, one should not be looking into quarter to quarter kind of earnings as far as defense stocks are concerned. So defense is a space which we are focused on. I mean, pharma Oro came out with numbers, but that were not good set of numbers. And same has been the case with most of the pharma companies, barring, say, Torrent, Mankind, or Cipla, which was in line. But again, the valuations of, if you look at Torrent Pharma or Mankind Pharma, is far ahead of its earnings trajectory, which they have been, pursuing. So that's a mess. So I mean, defense is a space which we are more invested into.
All right, and you're saying from the defense pack, what you like is HAL and BDL?
It's HAL, BEL, Bharat Electronics.
BEL, got it, BEL. Very quickly, there's a lot of debate with regard to this solar module, solar cell makers. Y'all believe that there are brighter prospects for some of these names? The street is a little bit skittish about visibility in terms of earnings. Vari Energies is something that you like?
Yes, Nigel, we have come out with an initiating coverage on Vari Energies yesterday itself, and I will tell you the problem areas or gray areas. One is that oversupply of capacity has been talked about for India. So by 2030, 777 gigawatt of capacity should be there in India. And at that capacity, the per capita utilization will be around 1661 kilowatt hours for India, which is still 50% lower than the world average, which leaves you with all the permutation combination in place, 600 to 1100 gigawatt of more capacity to be installed. So that is concern number one, which people are debating about. We are on the side that it's not a concern. The second point is US related exposure of Waaree Energies. They already have 1.6 gigawatt of facility in US. They are adding up 1.6 more. So this places them in a far ahead of their competitors where they don't have an exposure in US itself. And the third is the type of per capita consumption is going to go up by be it EVs or data centers or AI modules. They all consume more energies into play. With the capacities in place, ALMM is one area, DCR is another area. So Waaree is best positioned to capture all the spaces because of their already they are sitting on 13.3 gigawatt of capacity by 2 years, and that would be 22.5 gigawatt in India. That is solar modules, almost 15.4 on solar cell, and 10 gigawatt in ingot and wafer. So I think positionally they are well placed. We are seeing an EPS of say 154 by FY27, almost doubling of the profits by then. And based on, even if you give a P multiple of 25, which is 40% discount to the current multiples, the immediate target price is 38.50. We will keep on re-rating or revising as the numbers roll by.
Okay, all right. We will leave it on that note. Tharmesh, thanks very much for joining in. Good to get your perspective on all of these stocks that we have discussed. We'll connect again soon. Well, we do have to take a break. And as we do that, here's a reminder for all our viewers. You can unlock a world of exclusivity, expertise, and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, as well as curated lifestyle benefits.
investing.
Welcome back. So, well, it's a bit lonely out there today because we are the only major market in red. Otherwise, the world has been a shade of green. But anyway, let's get to some more action. Hormuz is here. He'll always have something to excite us and, inspire us. Let's see what's on his buzzer's radar today. Hormuz.
Well, some interesting movers and mostly on the downside in today's session, of course. We'll start off with Gokaldas Exports, and for obvious reasons as well. The stock has been underperforming, and another 9% knocked off today and has declined in 4 out of the last 5 sessions. 11 lakh shares have already been traded here compared to a 20-day average of just 4 lakh. And this year already the stock is down almost 35%, most of it which has come in the last few days. But between 2020 and till date, the stock has already gone up 10x. So it's a big mover on the upside. From almost 70 rupees, the stock has gone up to almost 700 plus, giving up some of those gains this year. Prakash Industries is the other mover today. It's a result reaction on a day when most of the stocks in the red, that's up 12%. There's 1.8 crore shares have been traded compared to a 20-day average of 9 lakh. And historically, the month of August has been good for the stock. Every last 3 years, the month of August has yielded positive returns for Prakash Industries. Tanla Platforms is the other one on the positive side today. The stock has snapped a 4-day gaining streak. And take a look at the volumes here. 80 lakh shares on this 13% up move compared to a 20-day average of just 5 lakh. And as a result of this move, the stock has turned positive on a year-to-date basis after it declined almost 40% last year. In an era of living with Avenue Supermarts and D-Mart, Vishal Mega Mart has quietly made its move higher from its IPO price, another 3% higher today, almost 2.5 crore shares traded compared to a 20-day average of just over a crore. And from its IPO price of 78 rupees, the stock is already up 85% from those levels. And the last one on the list is Sanofi Consumer. It's another positive earnings reaction, and it is the biggest single day gain that the stock has seen since the end of June. But take a look at the volumes here. 2 lakh shares have been traded today, a 20-day average of just 3,000 shares. Very, very hectic activity in terms of trade on this stock. And as a result of this move today, the stock has also moved higher from its 200-day moving average. So there are some names that are bucking the trend, but the loneliness, as you mentioned, has keeping the Indian markets on the downside today.
Okay, all right, Hormuz, thanks very much. But like I said, always action on Hormuz's stocks board, no matter what the index is doing. Thank you for that. Well, let's bring in our next guest on the show then. Nikhil Ranka, CIO of Equity Alternatives at Nuvama Asset Management, is joining in. Nikhil, great to have you on. So the market in a bit of a funk, so to speak, kind of stuck. But, what's the sense you get? Looking at earnings, what is your assessment? Are we indeed poised for an earnings takeoff? Or should we just be happy if we don't get more downgrades, if we can do at least 9-10% this year?
So good afternoon, Surbi. If you remember the last time I was on the show, markets were closer to 25,600 on the index. And we said the best case is that markets either time consolidate here or we correct till 24,800 levels, because on an FY27 basis, the fair value of Nifty itself was coming closer to 26,000, 26,200. And we've seen markets correcting 1,000 points from those levels. Now, if you actually look at it, 2-3 things have happened. One, inflation has come down, because of which, if you look at it this year, most likely our nominal GDP growth will be in single digit. And our markets have tracked the nominal GDP fairly closely in terms of returns. And even if you look at some of the macroeconomic indicators, be it electricity demand, auto sales, cement volume growth, for most of these macroeconomic parameters, what we are seeing is a single-digit growth. And therefore, my sense is we will have a period where, markets will be dull and range-bound for a fairly decent period of time, say probably next 2 quarters. And then from Q3 onwards, probably as markets start factoring in FY28 numbers, we roll over to FY28. From there, we should see markets take off. My base case is that for the next 2 quarters, markets will probably consolidate in this 24,500 to 25,500 band. Probably Q3 of this year is somewhere where we expect that markets will start moving higher.
Nikhil, hi. Lots of question marks surrounding the business model of IT. Just because IT companies did well over the last 2 decades, can they continue to re-engineer themselves and come out on, come out trumps at this current transformation juncture that they're in. What is your view? Because people are questioning, the existential crisis in a way, or they're saying it could be in a structural funk. Growth could be in mid-single digits over the medium term.
So, good afternoon, Rima. My sense is, Rima, our IT companies have been fairly resilient in terms of engineering their businesses models and when the situation has demanded so. If you look at it, when we were at the peak of the tariff crisis, the prices that we are seeing on large cap IT names, probably TCS closer to 3,000, Infosys closer to 1,400 levels. We saw that prices when index was closer to 22,000 odd levels. And at that point of time, 2-3 things were not clear. One, whether FY26 will be a growth year for IT companies. And second, what sort of margin impact that these companies will have to take. As we have traversed through the 2 quarters, what we are seeing is, one, clearly things are not as bad as they initially seemed to be. For most of the IT names, FY26 will have dollar revenue growth, maybe in low single digits. And margins also have been fairly stable in that sense. And if you look at valuations, most large cap IT names are now down below 20 times. If you look at the consensus EPS for TCS closer to 153, 154, Infosys closer to 75, 76 rupees, all these names are now starting to trade below 20 times. And my sense is from these levels, the absolute downside in these names clearly looks very, very limited to me. 2-3% more. And I don't think beyond that you will see. And the point is, the bulk of the FI selling that we have been seeing in the last 15-20 days has been concentrated in IT names. And therefore, we are seeing that move on those stocks. My sense is once the selling ebbs, we should have some bounce back on IT names. They should head back 5 to 7% higher from these levels, with probably 2-3% more downside from these levels.
All right. Hi, Nikhil. Good afternoon. So IT is something that you like. Various arguments, right? You look at the dividend yield, you look at the free cash flow yield, and you'll say, okay, it's a bullish argument. Or you look at the premium that the IT index trades at in comparison to the Nifty. It was around 30%. At the peak, it's 50%. It's come down to around 14.5 to around 15%. So various arguments supporting it out there. But the other pillar of the market, you're saying the Nifty bank can still correct 5% from here. Tell us the rationale.
So, Nigel, if you look at the commentary from most of the banking names this quarter, 2-3 things have happened. If you look at the NIM decline that has happened this quarter, the commentary has been that the first rate cut of 25 bips has been completely passed through. The second rate cut of 50 bips, only a part of that has got passed. So Q2, again, for most of the large banking names, will see NIM decline to the extent of 10 to 15 basis points. And on the asset quality side, if you look at, whether be it Axis, Federal, everybody is starting to see some deterioration on the retail asset quality. So a combination of these 2 things would probably mean that banking names can at best have single-digit earnings growth in FY26 because your pre-provisioning profit growth itself will be in single-digit, and if you have some increase in credit cost on top of that, then double-digit earnings looks extremely difficult from current levels. And therefore, my sense is there could be 3-5% more downside from these levels in banking names. And post that, both IT and banking will be at multiples from where it will be very hard to build incremental downsides. And therefore, as I said, the base case still remains that 24,500 should hold for the markets. In an extreme case, we might go down to 24,200. But given the data points that we have now, doesn't look that we will go below 24,200.
Okay. All right. Just one more point with regard to cement. It's had a horrific last 1 year, but the stock prices didn't correct that much. However, there are green shoots now. Pricing, if I look at it, July to last July, it's up close to 8%. So there's some recovery on that front. If the economy is going to recover, the second half of the year will look good on volumes. Your view on the stocks are then, what do you like? JSW Cement, I was speaking to Parth Jindal yesterday, and he was sounding very optimistic. He would actually be lucky to come this year rather than last year, because last year, the industry itself, there was a lot of pessimism out there. But this year there is hope, and that could explain why he's coming at premium multiples. Let's see how the issue goes, but your view on cement.
So Nigel, I mean, the only sector where we have seen some sort of earnings upgrade or earnings beat this quarter has been cement. Now, the good part that has happened for cement is if you look at the overall industry of close to 650 million tons, almost 350 million tons is now consolidated in the hands of two players, Birla and Adani in that sense. And we saw this same thing happen with telecom also, that, you know, as the industry structure move towards more oligopoly, pricing is something that starts looking up. My sense is the same thing will start happening for cement also, and incrementally the flow through to EBITDA is extremely high even in case of cement, because the costs more or less are pretty fixed in nature in that sense. And coal obviously is not seeing any upside to that extent. So therefore, you know, as the industry consolidates and we have some price hikes towards the second half, because Q2 obviously is a monsoon quarter, so one cannot expect large price hikes that will come through in that quarter. Q3 onwards, my sense is the pricing will start moving higher, and for a lot of companies, then 1,000 rupees per ton will more or less become a base. And the industry will start looking to move towards 1,400 to 1,500 rupees of EBITDA per ton. We've clearly been hearing from con calls of most large cement companies that 1,500 rupees per ton is a number that they want to achieve over the next 18 to 24 months. And that should lead to some sort of excitement on the street for cement names. And therefore, we are positive on cement companies from these levels.
Nikhil, thank you very much for that. That's the view coming in. Let's get a handle on what's happening in the futures and options space and what the trends are. Mangalam joins in.
Well, the market's grinding lower, no two ways about that. We're looking at, you know, the frontline indices track lower levels, but the good part is, or the one, you know, area of support is that today's high and low on the Nifty are pretty much in line with what we've seen during the series. So we haven't, you know, broken out or broken down below that as well. Yes, the Nifty is down about 83 points. We have the Sensex, which is lower as well. But today's high, 24,733. And you look at the low today, 24,592. Compare that to the low that we've seen, you know, on day one of the series and the high that we saw yesterday, pretty much in line. Yesterday's high was 24,736 and August 1st low was 24,535. And this is the broader range that the street expects will play out, at least for the very near future, because that's where option writers are placing their bets as well. Look at the 24,700 call that comes up for you, 65 rupees in premium, telling you that over 24,750 or 24,765, you would see some sort of supply start to come in. And remember, the option price out there has come down as well. At the lower level, though, we have the 24,600 put writers equally active as well. And they believe that around 24,525 or 24,550, there could be some support which will come by. For those who are looking to pocket the premium that is available at the 24,650 straddle, which is a call and a put together, this morning that straddle was available for about 200 rupees. So the broader range that they were looking at was 200 points on either side of 24,650, which is basically 24,450 to 24,850. Now the premium on that has come down as well by about 30 points on the entire straddle. Just a couple of stocks which are deserving mention right now. You know, a bunch of them seeing a lot of long positions being added. Uno Minda, one of them since morning, has seen a lot of long positions being added. And Pidilite reports its numbers tomorrow. And it was just this afternoon where we saw a big spike on the stock and presumably some long positions being taken ahead of numbers on Pidilite. Though on the short side, BSE has been you know, well sold throughout today's trading session. LIC Housing Finance and very recently Info Edge comes up as well with a lot of open interest spike and positions added on the short side. So for the Nifty, while it is lower right now, it's a range that the street is hoping will continue to play out. Individual stocks, all of them in focus.
Okay, all right, Mangalam, thanks a lot for that. As you said, the markets are grinding lower, but you know, at lower levels, you're seeing some kind of buying. And as we speak now, the Nifty actually has cut its losses by half. So there is some hope. Maybe, in fact, the street senses that maybe Mr. Trump, just maybe, could soften his stance and we could have a deal in the next few days, which is better than what we have heard so far. Slip into a short break. On the other side, Nimish is waiting for us. He'll tell us what's going on in dealing rooms. We'll also get our technical expert back with us to give you a couple of trading ideas. Welcome back. The street is sensing something, it appears. The markets have actually cut its losses. And in the last few minutes, I think a couple of stocks have stood up. You have Shriram Finance has moved to the high point of the day. It's a good move out there. You have Bharti Airtel ahead of its numbers. That as well is moving like a thug. Well, good move out there. And you have Tata Motors that was trading in the red. That's moved into the green. So there are a few movers from the Nifty pack, now down only 50 points. But as promised, Nimish is standing by. He's going to tell us what he's picking up in D-Street Chatter. Nimish.
Hi, Nigel. So today's surprise could be a positive number from the large institutions. So that's the overall sense that I'm picking up. The volumes have picked up, but it's on the but they are better buyers. So that's from a flow perspective. But again, it's been extremely choppy for the last many days, and so is the case today as well. A bit of geopolitical risk, a bit of risk towards the US as well. That's putting some bit of pressure on the Indian markets for the last many days, and so is today. From a range point of view, I've been talking for the last few days that it's been that 600, 700 points range. The Nifty seems to be it has to break out on either side for a decisive move. That's not happening for the last many weeks now. So I think for today, the big takeaway is that maybe you'll see a positive number from the larger institutions. Technology, financials, and select large cap is where I sense there is a bit of buying interest back from larger institutions. So that's the space to watch out for. But broadly, while it's been pretty much range bound, seems like today's a day of a bit of better buying from large institutions.
Nimesh, this buying at the FI desk, is it linked to the Paytm block deal? Were they buyers in that, or is it even outside of that we're seeing a pickup?
I would say X of Paytm block, there is buying interest. And as I said, the buying interest is largely into technology stocks, financial names, and select large caps. So it's not like across the board, but there is buying X of Paytm as well. So that's from a flow perspective. From an individual stock perspective, the first stock on my list is AB Capital. That was a big mover yesterday after the earnings. Today a bit soft, but I understand there could be a large block deal in AB Capital very soon. There's an alternative fund which owns close to 3.5%, and they could be the potential sellers in AB Capital block. So that's the first name. The second stock is Nesco. While the stock has been consolidating of late, I understand there could be some strategic or a corporate development in Nesco very soon. So that's the second stock. The third stock is Axis Bank. The stock has been under pressure and has relatively underperformed the financial names. But my sense is that large part of the selling from a leading long-only fund seems to be largely over. And small buying has emerged from larger HNI desk is the sense on Axis Bank. So that's the third name. And the last name is AU Small Finance Bank. Again, the stock has seen a bit of volatile moves in the last many days. But from a flow perspective, there is buy flows from larger HNIs. And for AU Small Finance Bank, the next big trigger would be the approval of the universal banking license. So that's going to be a big trigger to watch out as far as AU Small Finance is concerned.
Thank you very much for that. Bharti's numbers are post-market hours. So on a consolidated basis, we already have the Airtel Africa numbers. Those were very strong because of the Nigeria tariff hike. So Airtel Africa was strong, but on the flip side, Indus Tower was a bit disappointing, particularly on the margin front. So the street is going to watch the India wireless performance. And over here, the company seems to be losing subscribers, not losing subscribers. The subscriber addition momentum is lower compared to Jio. So maybe they're losing some market share because as per the TRAI data, Bharti Airtel has added about 1.2 million subscribers in Q1. Jio was at more than 7 million. ARPU could continue to tick up bit by bit. So 250 is the poll versus last quarter's 245. So we'll watch for Bharti Airtel. But Mitesh is now with us for a few BTST calls. Mitesh, anything on Bharti Airtel? And generally, markets have seen a little bit of a lift from 24,600. We're now up to 24,660.
I think that's because of the fact that we have an event coming up, and it's not exactly a tariff-based one, but the monetary policy-based one. And I think the bank Nifty has also cut down its losses. Maybe going into the event, and that's my advice as well. Don't carry heavy positions. But on the stock side, Bharti I think has recovered well. It's managed to get past 1900, 1915 zone. I think as long as above that, good chance that we could see 1950 on the upside. And on the stock called Solar Industries, one of the stocks which I like, that's a VTST. Keep a stop below 14,780, look for a target of 15,300 types on the upside. And a VTST on TVS Motors, which is closing at a fresh high. So that's a VTST with a stop at about 29.70 for targets of 30.10.
Okay. All right, got that. Mitesh, thanks very much for all the trading advice today. We'll see you again with the market bright and early tomorrow morning. Bright and early tomorrow morning also we'll have a new listing, and it's an important institution, part of the market infrastructure setup of the country. And we're talking about NSDL finally making its way to the listed public markets. Vamakshi is here. with a lowdown on the company and what perhaps potential investors can expect. Vamakshi.
Well, absolutely. NSDL is set to make its D-Street debut tomorrow at the upper price band. NSDL will command a market cap of around 16,000 crores with listings slated exclusively on the BSE. In fact, the IPO overall was subscribed 41 times with a subscription of 104 times in QIB category, 8 times in the retail category. So let's actually decode NSDL. Now, it was set up in 1996. It is India's very first securities depository and remains the largest. It oversees the highest number of issuers, active instruments, and total asset value under custody. Think of it as a bank, but for securities. So your stocks, bonds, mutual funds, and more, all safely held in demat form. The business, however, goes beyond the depository. Now, NSDL runs 2 wholly owned subsidiaries, NSDL Database Management, which delivers e-governance and tech solutions from SEC Online Insurance Repository to digital onboarding. And the other one is NSDL Payment Bank, which offers digital banking, prepaid cards, merchant acquisition, and third-party product distribution. But NSDL doesn't operate in isolation. It's actually locked in a duopoly with CDSL. The differentiator? NSDL leans more on institutions and unlisted companies, while CDSL thrives on India's booming retail wave. And the numbers actually tell the story. Now, in FY25, NSDL reported a revenue of 1,240 crores, growing at an 18% CAGR since FY23. Yet the margins lagged 26.4%, with profits of around 343 crores and an ROE of 17.1%. CDSL, on the other hand, with a smaller revenue base of 1,082 crore, delivered 527 crore in net profits, a margin of 57.7%, much better than NSDL, and a stellar 29.9% ROE. Now, valuations are actually reflecting this trade-off. At 47 times FY25 earnings, NSDL comes in at a nearly 24% discount to CDSL 61 times. And, just to wrap it up, NSDL is a story of steady growth with leaner profitability that is being reflected in its current valuation discount to CDSL.
Thank you very much for that. Very well explained. Look at Gokuldas. Stock is down 9%. That overhang of tariffs on the entire textile remains. But at the bottom line in Q1, the company seems to have delivered okay, 52% growth seen. But the other big Q, and the big one, is going to be the RBI MPC, which will announce its interest rate decision tomorrow. The CNBC-TV18 poll shows the market is divided between a cut and a pause. Ritu is here to tell us more and what to expect.
The RBI's August policy meeting is shaping up to be anything but predictable. A CNBC-TV18 poll of top economists shows a clear split. Half expect a 25 basis point cut, while the other half say the MPC will hold rates steady. But zoom out and look at the broader macro picture and you'll see inflation has dropped to a 77-month low. CPI is likely to average below 3% through the year. And so some, like SBI, for instance, warned that not cutting rates now could be a costly type 2 error, essentially waiting too long and hurting growth when inflation is already under control. But most economists, that is 70%, see the terminal policy rate settling at 5.25%, which means one more 25 basis point rate cut is going to wrap up this easing cycle. On the timing of the rate cut, the poll is split. 30% say August, another 30% October. December leads at 40%, but signaling we're near the bottom either way. On the stance, though, there is no ambiguity. All expect RBI to stick to a neutral stance. But speaking of growth, here 70% believe RBI could leave the forecast unchanged at 6.5%, though the street does expect RBI to flag signs of slowing momentum. On inflation, 90% expect a downward revision to RBI's 3.7% forecast, possibly to around 3 to 3.3% because of the easing food prices and the favorable base effect. As for the tone, 60% expected to stay neutral, but 40% are leaning towards dovish. But the wild card in all of this is tariffs and trade tensions, where half of the economists see no policy impact, while 40% do say external headwinds can push RBI to ease further, but they do agree mostly it's still a wait-and-watch game. Finally, do keep an eye out for the revised liquidity management framework, any commentary on the growth narrative, and the possible extension of the EBLR, which is the external benchmark-linked lending rates, to NBFCs as well.
Okay, so that's the RBI policy, and we are awaiting all the action tomorrow. By the way, remember to tune in to the all-new CNBC TV18 Prime. We, of course, bring you insights from policymakers, business leaders, and economists shaping both world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Well, we have Jay Bal of Cash the Kiosk who joins in on the show. Hi, Jay. You've been quite positive on the Nifty, but the Nifty has seen a full correction of around 1,000 points. Where is the crucial support level, and would you be a buyer post this recent pullback?
Hi, Nigel. The support now been projecting 24,400, and that still remains the focus for the market. The markets require either one more lower low below 24,535. Or possibly two lower low. Depends on what the markets do in the very short term. The markets were to go to 24,750 first before breaking 24,535. The market will probably reach only 24,400. But if 24,535 were to break first before 24,750, we could see further low closer to 24,000 mark. So what the very short term becomes quite important. In the longer term, my view remains unchanged. Bullish for the long term, fresh all-time highs from 6 to 12 months perspective, somewhere close to 29,000.
Okay, all right. Any individual stock calls you have for us, Jay?
Yeah, I'm positive on the auto space. As you can see, TVS Motors is clocking fresh all-time highs. The signs are there in Hero Motors too. I'm bullish on it with a stop loss of 4,200, anticipating about 5,300. The Nifty Auto Index crosses 24,200. The whole sector will start to rise. And I have a logistics stock as a second pick. Western Carriers, it's a relatively new listing. Stop loss of about 101. I know it could go back to its post-listing highs of about 170, but we can keep it conservative and anticipate about 150 with a stop of 101.
Okay, Western Carriers, 150 is the target. Want to give us one more?
Yeah, you can look at something like a Bajaj Auto, but it's again will be preempting the move. Yeah, so look at things on the positive on the auto space and even on the metal space. But we need a breakout to happen. So we are looking at something. Yeah, look at auto space and metal space.
Got it. Okay. All right. Jay, stay with us. For the time being, I think we need to wrap down on the markets. Well, it was a day when the Nifty goes home in the red, but actually, X of the, some heavyweight names, the Nifty did pretty okay. The problem today was big names like Reliance Industries, Infosys, and ICICI Bank. All of them went home with cuts of around 1 to around 2%. And because of that, in fact, the Nifty continued to remain under pressure. But the breadth of the market wasn't too bad. You had one stock that was declining for close to 2 stocks that were advancing, for 3 stocks that were declining. And names that did well, Titan, IndusInd Bank, well, they were up and about. Maruti as well did buck the trend in today's trading session. From the broader markets, though, quite a few stocks did well. You had Sanofi that was up 12%. Newgen was higher in today's trading session. Godfrey Phillips, smoking hot, locked up close to around 10%. You have Aditya Infotech, the new listed stock, that as well went home with gains of close to around 60% in trade. On the losing end, though, there were a few losers in today's trading session that did pull back. That Gokuldas, in reaction to its numbers, was down. Triveni Turbine as well was lower. Keystone Realtors was down close to around 7%. Otherwise, a mixed bag in terms of trades as well. So not too bad. That range does continue, and the Nifty will be waiting for some kind of direction on the domestic or on the international front for further direction. We'll wrap up on this edition, though, of Closing Bell. Stay with us. Markets Forward comes up next.
The last trade ends in the red after Trump threatens to substantially raise tariffs over Russian oil imports. Nifty slips below 24,700, dragged lower by Reliance and banking heavyweights. Financials remain the biggest laggards.
RBI clears the appointment of former Axis Bank Deputy MD Rajiv Anand as MD and CEO of IndusInd Bank for 3 years. CNBC-TV18 first reported he was the front runner. The stock cheers the move as the focus now shifts to key management changes and the road ahead.
Antfin has floated the sale of its remaining 5.84% stake in Paytm, becoming the last early backer to make an exit. Triveni Turbine slipped on disappointing first quarter numbers. Revenue and EBITDA fall over 20%, while Aurobindo dips after reporting numbers below estimates.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points from trade today and, of course, and prepare you for the next trading day. I'm Surabhi Upadhyay and with me is Ekta Batra. Ekta, once again, the red color back on the screen today.
Hi, Surabhi. Yes, absolutely. You know, the tariff situation seems to be really dampening sentiment at this point in time. So, yes, we did have a weak session in today's trading session, not to mention that the advanced decline ratio was also on the declining side, around 1,900 stocks advancing to around 2,390 stocks declining by the end of it on the Bombay Stock Exchange. So yes, the Nifty slips below 24,700. The markets did see that profit booking take place, and the Bank Nifty, which underperformed. Net a session which you don't really want to discuss too much, considering that, you know, the uncertainty and the headlines change constantly now.
No, absolutely. And I mean, today, even the mid-caps could not really hold their own. And we had a negative advanced decline ratio, and the mid-cap index itself was under pressure. So not too much to cheer. And many of the sectors, in fact, most sectors in the market were under the weather today. So pretty widespread fall at that. But of course, there were individual movers and shakers and some bright sparks as well. And we'll talk about that as we go forward. So let's tell you what's lined up on the show today. We'll be tracking all the key news and the developments coming up, and the key movers and shakers include names like Gokuldas, Triveni Turbine, Keystone Realtors, big moves, some of them linked to tariffs, others linked to earnings. So we'll talk about that. Then we, of course, look at some more names, including IndusInd Bank, Aurobindo Pharma and Godfrey Phillips. Godfrey, of course, was one of the key stars reacting to good earnings today. And then, of course, we'll talk about the key cues to watch tomorrow as well. So lots coming up. But let's, as always, kick it off with the movers and shakers of the day. We have Hormuz joining in with the action. Hormuz.
Some interesting movers that came in today's session, be it earnings reactions, be it news flow. But the one pocket that was bleeding in today's session were the textile names, and for obvious reasons as well, because of this tariff situation on the course of deteriorating further. And that has resulted in stocks like Gokuldas Exports seeing a 9% knock in today's session. And not just Gokuldas, most of the others, but take a look at KPR Mill. That was the surprise package because it saw a sharp spike towards the close of the trade, and it ended in the green compared to most of the others that ended with losses. Earnings reactions continued plenty. Triveni Turbine, of course, was the big underperformer today, 10% lower. On the flip side, MTAR Tech reported results just a few minutes before closing. It ended 10% higher in today's session. We just spoke of Prakash Industries a few minutes earlier. Another earnings reaction, almost 12% higher on that stock. Sanofi was up 10% as well. So earnings reactions on the extremes. Keystone Realtors too, ending 5% lower after margins halved during the quarter. Newsmakers of the day, of course, PSP Projects was in the news yesterday because of a big block deal. It was the promoters that offloaded stake. That stock came off the highs at one point, was up almost 8-9%, whereas came off the highs to end 3% higher. BSE, of course, of the CNBC-TV18 news break. Tata Investment came out with results yesterday, approved a stock split, and it built on to those gains. And of course, Adani Ports after results, and Solar Industries, with most of the defense names seeing a bit of a move on the upside towards the close of the trading session. And lastly, in a market like this, there were stocks that ended at a 52-week high as well. Another high for Datamatics, another high for Godfrey Phillips as well, 10% higher after its results. And JK Cement doing well for itself at a 52-week high. Back to you guys.
Okay, all right, Hormuz. Thanks very much for that. Those were the top movers. And let's now go across to our guests. We have Jay Bala joining in to discuss the technicals of the market, and Sudeep Bandyopadhyay, who's with us to discuss the fundamentals. Gentlemen, evening. Well, Jay, let's start with you. It's been a weak close for the markets. The key levels that you would watch for going into tomorrow?
Hi, Ekta. The important support is at 24,400 and 23,950. And 24,400 is quite close to the recent low that we saw at 24,535. The fact that the markets are moving lower in a slow fashion with seeming struggle, that's the positive. And that's the indication that we've been, it's in line with our expectation that this is a correction from the July highs of 25,669. So, the markets are likely to find support between 24,400 and 23,950. And if the markets were to take out 24,950, then we can conclude the correction is over.
Okay, all right. Got that point. Jay, stay on. We'll have more questions for you in just a bit. Let's also get to one of the main stocks in focus today. And of course, we're talking about IndusInd Bank. The shares were up and about, gained almost 1.5% after the CNBC-TV18 News break finally got confirmed. The Reserve Bank of India has approved the appointment of Mr. Rajiv Anand as the MD and CEO of IndusInd Bank for a period of 3 years. Ritu is here with the details. Of course, she originally had broken the story a couple of weeks back. Ritu.
Well, big development for IndusInd Bank with the Reserve Bank of India approving Rajiv Anand's name for the MD and CEO position for a 3-year term effective the 24th of August. We were the first to report that Rajiv Anand was shortlisted by the board and was a front-runner for the position on the 27th of June, and now it is official. A chartered accountant and commerce graduate, Rajiv Anand is a financial services veteran with over 35 years of experience, known specially for his expertise in capital markets. He began his career as a trader at HSBC and joined Axis Group in 2009 and became the founding CEO of Axis AMC. Since 2013, he's been on the board of Axis Bank, where he headed both retail and wholesale banking and rose to become its deputy MD in 2021, retiring just a few days back. And now he steps into a bank which is at a crossroads. IndusInd Bank is recovering from a massive loss in the fourth quarter, its worst ever, driven by accounting lapses. It bounced back in the first quarter with a profit, but the damage triggered a string of senior-level exits. The bank's chairman, Sunil Mehta, though, has assured investors that legacy issues are behind and the impact of all these irregularities has already been absorbed. He also outlined a 5-point focus for the bank, including a profitability-first approach, cost discipline, and a focus on recoveries. So when Rajiv Anand takes charge, his task will be cut out, and it is a tall order. First and foremost, of course, to stabilize the ship, rebuild the bank's reputation and restore stakeholders' confidence, fix the internal control systems and ensure a sustainable return to profitability while cleaning up the books as well. Equally important will be to rebuild the core team. The bank has been without a CEO and deputy CEO since late April and is currently being run by an executive committee. He must also execute the 30,000 crore rupee capital raise to make sure that the balance sheet is strengthened while also managing the ongoing fallout from the accounting lapses, the MCA probe being the latest.
Okay, all right, Ritu. Thanks very much for that. Sudeep, what would your view be on this management change?
Well, I think this is the best possible outcome for the entire, IndusInd Bank. Rajiv is an experienced hand and he understands this business pretty well. His experience in the financial markets, in different parts of financial markets, will be invaluable. And he's the best man for the job. That's what we believe. He has a long journey ahead of him. And because a lot of things needs to be set right in IndusInd Bank, particularly internal systems, processes, and the controls. I'm sure he will focus on that. Of course, he has to also focus on profitability. And, instead of being inward looking, he has to ensure that the bank does the right thing and also is outward looking. So basically continues to expand business. So I think, IndusInd got a best possible deal under the circumstances. We'll keep waiting and watching. I won't rush to buy IndusInd. I think it's a journey. It's not a, one-day event. So we will keep watching the space.
Okay, all right. That's advice on IndusInd Bank coming in. Gentlemen, stay on. We have lots of other stocks to discuss as well. A lot of stocks today were in the news. There was Paytm because of the large trade that took place. Angel One that came out with the business update. There was Triveni Turbine, which fell very sharply on numbers. There's, of course, Godfrey Phillips, as we told you, which was one of the better stocks, up 10% today, reacting to Q1 performance. Vamakshi is here with the details. Vamakshi.
Well, Paytm was in focus today because Antfin sold its entire nearly 6% stake. It was actually 5.84% in Paytm for nearly 4,000 crores. So therefore, the stock was down and out in trade. Apart from that, Godfrey Phillips, on the other hand, reported a very good set of numbers. Revenue surged by 37% on a year-on-year basis. The margins, however, came under a tad bit of pressure, and that is because of leaf tobacco inflation. In addition to that, they've announced a 2:1 bonus issue, so that again pushed the stock higher in today's trading session. Triveni Turbine, on the other hand, saw its revenue dip by almost 20% on a year-on-year basis, and this is because the company's orders as well as dispatchments were sort of delayed or pushed out into the subsequent quarters. The order inflows too were very weak, down almost 16% on a year-on-year basis, and therefore we did see Triveni Turbines fall in trade today. And lastly, Angel One was in focus. Of course, we did have the monthly business update, which included the gross client acquisition, which saw an uptick of almost 17% on a month-on-month basis. The average daily turnover too saw healthy growth of 18.6% month-on-month. But what the market share also improved across the board. But what actually overshadowed this good business update is the fact that sources told CNBC-TV18 that SEBI is considering to curb weekly expiries as well as increase the margin requirement. So that sort of pulled all of the capital market stocks lower, and Angel One was one such casualty.
Okay, all right, Vamakshi. Thanks very much for that. So, a whole range of stocks which were in focus today. Jay, I'm going to toss it over to you. Do you have any view in terms of the technicals of, say, Paytm as well as Godfrey Phillips?
Yeah, Paytm is bullish, but the momentum is for the short term is quite strong. But the risk rewards from these current levels of 1,000 odds isn't that attractive. So if you're already holding, then you can trail that with a stop at about say 925. But otherwise, it's not a fresh entry. When it comes to Angel One, it does look bullish, but it's come to very important support. It cannot print 2553. If it does that, the possibility of an uptrend gets questionable. So it must start sprinting higher from tomorrow onwards. So yeah, that 2553 on Angel One is an extremely important support.
Let me ask Sudeep on this as well. Sudeep, very quickly, every time there's news about some fresh F&O regulation, we see that in capital market stocks, right? BSE included. What's your advice specifically on BSE?
BSE definitely, from a long-term perspective, continues to look good. But yes, of course, all these changes in the F&O regulations, whereby, fundamentally what SEBI is trying to do is to reduce the speculation, so reduce the volume of F&O. So that definitely does impact BSE in the short term. So we have to be cognizant of the fact that it is not a cheap stock. So there will be price damage in the short term.
Okay, all right. Well, I'm looking at Aurobindo in today's trading session. That stock was in focus on the back of its numbers, and its numbers were a little weak in today's trade simply because of the reaction that it saw post what was a disappointing quarter, especially for the US business. But a couple of important conference call takeaways from the company. They said that the weaker numbers were due to lower Revlimid generic sales sequentially. They've maintained their FY26 target of high single-digit % growth, excluding a transient product, and EBITDA margins should be similar to FY25. So to put it into perspective, this quarter, Revlimid generic sales were down by 150 crores on a year-on-year basis, and that's the reason why the US business was lower. However, Europe did well for them this time, and they expect 8 to 9% growth in Europe going forward, and the rest of the business growth to be around 10% as well. But overall, recovered from the day's low, but nonetheless a bit subdued in today's trade. Sudeep, any view on Aurobindo?
Well, I'm a little careful, Ekta, these entire pharma companies which sell quite a lot of their, business in US. There are too much of volatility. One doesn't know where things will settle down for them as far as their US business is concerned. So I will be a little cautious. If I have to look at pharma, I will look at companies having significantly large domestic business. Let's say a Mankind, which has got 90-95% of their sales coming from India, or some other companies which have got significant businesses in India. If I look at the overall healthcare space, I will definitely focus on the hospitals, which to my mind have a much longer and better runway compared to some other sectors as things stand today. I'm not saying pharma is not good, but as things stand today in the world, it is better to be careful.
Absolutely, take that point. Perhaps less confusion and more certainty, because hospitals have been reporting good numbers and rising patient volumes. Okay, let's now address that story I was just referring to. We were just discussing BSE with Sudeep. Now, here's the latest. The Finance Ministry, we learn, is in talks with the market regulator to curb options market speculation even further. According to sources, the Finance Ministry and SEBI have been discussing ways in which options market volumes can be trimmed and cash market volumes can be increased. Sources say that the government thinks weekly expiries are not being used for hedging, but only being used for speculation. And that is what caused the decline on BSE. Let me take this up with Jay as well. Jay, just looking at the chart structures for a lot of these stocks, BSE included, and several others. I mean, there have been high flyers in the past, right? Whether it's a Angel One or a Novama or 361. What are the charts telling you now?
The high of June, July may not be the final high for BSE Limited. I'm still bullish on it, but the short-term correction still has little room to run. So it's a medium-term pick than a short-term upsides to work with. But reasonably confident that the 3,000 odds levels that you saw earlier in June will get exceeded, possibly stomaching short-term headwinds. And Angel One, as I pointed out, it's very close and important support. But BSE Limited, MCX are slightly better than Angel One.
Okay, all right, Sudeep as well as Jay, we're going to leave it on that note. Pleasure speaking with you all this evening. Thanks very much for joining in and taking us through your thoughts. With that, it's time for a short break, but we'll get you all of the top corporate voices of today as well as the events to watch tomorrow. Welcome back to Markets Forward. Let's get to the corporate corner for today. First up, we have Shree Cement. The firm's management has indicated that the company is prioritizing a value over volume strategy. The management said that it would see a volume growth of 4 to 5% in FY26 and expects to maintain its revenue growth guidance of 9%. The management further added that its market share is expected to remain stable in FY26. It had guided for EBITDA per ton in the range of 1,350 to 1,400 rupees per ton.
Okay, and next up, we have Sarda Energy and Minerals. The management has planned a capex worth 750 to 1,000 crore rupees for FY26. With most capex planned on the mining side, the management is optimistic that it will bring down the net debt levels to below 500 crore rupees. And the company expects an EBITDA of 2,000 crore rupees in the current financial year.
Next up in the list is Knowledge Realty Trust. The company's 4,800 crore IPO, which opened for subscription today, has raised around 1620 crores from anchor investors. The management says it will use the cumulative 6,200 crores to pay debt and improve the balance sheet. Adds that the firm has a good internal growth story, which is a significant CAGR of 13%. Commenting on the rent segment, the management says month-to-month are below market rates, giving opportunity to increase prices, and that it expects 20% upside potential for increase in rent.
Next up is Marico. The management believes the worst of the raw material inflation is behind the company. The company adds that margins are expected to hold steady and not fall below the current level. Also, the company is projecting 1 to 2 quarters of double-digit volume growth in the current fiscal and adds that a full-year revenue growth of over 25% is a strong possibility.
We also spoke to the management of OneSource Specialty Pharma. The company is quite optimistic about the second half as it expects significant growth led by a series of commercial launches in the pipeline. The company confirms that it is preparing to launch semaglutide in Brazil and Canada or be one of the suppliers to the bigger companies. Once patent exclusivity lifts, that's not all. The company's management maintains its FY28 guidance, targets $400 million in terms of revenue with 40% margins, adds that the company is also engaging with firms to develop the next wave of anti-diabetic drugs.
Okay, and with that, let's move on. The RBI's Monetary Policy Committee will announce its interest rate decision tomorrow, according to a CNBC-TV18 poll. The market is divided between a cut and a pause. Ritu is here with the expectations.
The RBI's August policy meeting is shaping up to be anything but predictable. A CNBC-TV18 poll of top economists shows a clear split. Half expect a 25 basis point cut, while the other half say the MPC will hold rates steady. But zoom out and look at the broader macro picture and you'll see inflation has dropped to a 77-month low. CPI is likely to average below 3% through the year. And so some like SBI, for instance, warn that not cutting rates now could be a costly type 2 error, essentially waiting too long and hurting growth when inflation is already under control. But most economists, that is 70%, see the terminal policy rate settling at 5.25%, which means one more 25 basis point rate cut is going to wrap up this easing cycle. On the timing of the rate cut, the poll is split. 30% say August, another 30% October. December leads at 40%, but signaling we're near the bottom either way. On the stance, though, there is no ambiguity. All expect RBI to stick to a neutral stance. But speaking of growth, here 70% believe RBI could leave the forecast unchanged at 6.5%, though the street does expect RBI to flag signs of slowing momentum. On inflation, 90% expect a downward revision to RBI's 3.7% forecast, possibly to around 3 to 3.3% because of the easing food prices and the favorable base effect. As for the tone, 60% expected to stay neutral, but 40% are leaning towards dovish. But the wild card in all of this is tariffs and trade tensions, where half of the economists see no policy impact, while 40% do say external headwinds can push RBI to ease further, but they do agree mostly it's still a wait-and-watch game. Finally, do keep an eye out for the revised liquidity management framework, any commentary on the growth narrative, and the possible extension of the EBLR, which is the external benchmark-linked lending rates, to NBFCs as well.
Okay, all right, Ritu, thanks very much for that. And before we wrap up, we'll bring you some key market events to watch out for. Makshi is here for that.
Well, the most important event tomorrow will, of course, be RBI's MPC interest rate decision. But apart from that, we'll be keeping an eye out on a whole host of cues. Now, on the economic front, we'll be watching out for S&P Global Services PMI data for India as well as the United States of America. Apart from that, keep an eye out on global earnings because they continue in full force. Bayer, Siemens Energy, Walt Disney, Uber, Airbnb, as well as Lyft are some of the companies that are expected to report their numbers tomorrow. Back home, we'll be keeping an eye out on numbers from some auto stocks like Bajaj Auto, Hero MotoCorp. Apart from that, Pidilite as well as the Wislab, and from the capital goods space, we'll be watching out for BHEL. Rights issue, we do have Inox Wind in focus because 1,250 crore rupee rights issue is expected to open for this particular counter. As far as TCS is concerned, they will be meeting with the Karnataka Labour Department over their layoffs, so this will be another counter that we'll be watching out for. And lastly, we have 3 new listings tomorrow, one of them being NSDL, Sri Lotus Developers as well as M&B Engineering.
Wow, RBI policy, so many earnings, new listings. In short, it's a packed day that's coming up ahead. Makshi, thank you so much for that. And with that, I think it's a good time for us to take leave and get ready for this busy day tomorrow.
Yes, absolutely. And you never know with the headlines overnight from the US as well. But nonetheless, thanks very much for watching news and key headlines up next.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. India hits back after President Trump threatens to substantially raise tariffs over Russian oil imports, calls the targeting of India unjustified and unreasonable, and vows to take necessary measures to protect national interests. Trump's fresh tariff threat spooks sentiment, but the Lal Street closes with minor cuts and Nifty slips below 24,700. Banks remain the biggest drag. It's a divided house on the eve of the RBI monetary policy. A CNBC-TV18 poll shows economists and market participants are split right down the middle on a potential rate cut tomorrow. The Finance Ministry is currently in talks with SEBI to curb excessive speculation in the F&O markets. A shift away from weekly to fortnightly expiries, lower margins for cash trades and a cut in securities transaction tax may be considered to reduce speculation and increase cash trades. Axis Bank veteran Rajiv Anand appointed the new CEO of IndusInd Bank on a 3-year term. CNBC-TV18 was the first to report that Anand was the frontrunner. He takes over after IndusInd Bank admitted to a forex derivative accounting lapse leading to losses of nearly 2,000 crore rupees and a management change. British luxury car maker Jaguar Land Rover is all set to have an Indian in the driver's seat. PB Balaji, currently Tata Motors CFO, will succeed Adrian Mardell as the CEO in November. Enforcement Directorate questions Anil Ambani over an alleged 14,000 crore rupee loan fraud case. The summons comes after the ED searched nearly 40 premises linked to Anil Ambani. A cloudburst triggers massive flash floods in Uttarakhand's Uttarkashi district. Several houses swept away, mainly reportedly trapped under the debris. The Indian Army, the NDRF and the SDRF have been roped in for rescue operations. BJP President JP Nadda and Congress President Mallikarjun Kharge engage in a face-off in the Rajya Sabha. Kharge protests against the presence of CISF personnel in the well of the House. When members were protesting, the deputy chair says the personnel were from the Parliament Security Service. Nadda says the opposition should take tuitions from him on how they should behave. Health officials in Gaza claim 8 people have died in the last 48 hours due to starvation. Israel ramps up the military campaign with air and land attacks. The overall death toll in Gaza crosses 61,000 in nearly 2 years of the war. Well, let's go straight to the top story this evening. India has hit back at the United States for threatening higher tariffs and a penalty for trading with Russia, especially over energy imports. Now, in a social media post, President Trump said, and I quote, "India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchase, selling it in the open market for big profits. Because of this, I will be substantially raising the tariff paid by India to the US," end of quote. Now, responding to the US President, the Ministry of External Affairs in a statement has said that targeting of India is unjustified and unreasonable, and it's promised to take all necessary measures to safeguard national interests and economic security. India said it began importing from Russia because traditional supplies were diverted to Europe after the Ukraine war. In fact, India went on to say the US actively encouraged imports of Russian oil as it strengthened global energy security market stability. New Delhi has also called out the US and Europe for criticizing India's trade with Russia when both countries themselves are indulging in trade. The ministry said Europe's bilateral trade with Russia in 2024 was worth over 67 billion euros in terms of goods and services trade, worth over 17 billion euros in 2023. This, the Indian government says, is much more than India's total trade with Russia in the same period. India has also called out the US for importing uranium hexafluoride for its nuclear industry and palladium for its EV industry, along with fertilizers from Russia. Reacting to the developments, Mukesh Aghi of the US-India Strategic Partnership Forum said it is not in the interest of India or the US to get into a contest over trade with Russia. Take a look.
Just basically get away from getting into public media challenging Trump, because the moment you get into a contest, it's, he basically goes all the way down to ensure that he comes out as a winner. So my recommendation is don't react and stay focused on what's good for the country and move on.
Now, the United States has yet to sanction Russian oil or energy. And as the statement from the Ministry of External Affairs mentioned, the US was actively encouraging India to buy oil from Russia. This was because of a sharp spike in oil prices, with Brent crude hitting $137 per barrel
way back in March 2022 after Russia invaded Ukraine. In November of 2022, US Treasury Secretary Janet Yellen said, and I quote, "The United States is happy for India to continue buying as much Russian oil as it wants, including at prices above a G7-imposed price cap mechanism, if it steers clear of Western insurance, finance and maritime services bound by the cap." End of quote. In February of 2024, U.S. Assistant Secretary of State Jeffrey Piat acknowledged India's role in stabilizing global energy markets. He said, and I quote, "India has played a key role in efforts to stabilize global energy markets through its purchases of Russian crude." End of quote. Now, just a few months ago, in May of 2024, U.S. Ambassador to India, Eric Garcetti, admitted that India bought Russian oil because the U.S. wanted somebody to buy Russian oil, and the U.S. allowed the purchase to ensure oil prices do not go up globally. Here's Eric Garcetti, the former U.S. Ambassador to India.
And we take the smaller victories, like actually they bought Russian oil because we wanted somebody to buy Russian oil at a price cap. That was not a violation or anything. It was actually the design of the policy, because as a commodity, we didn't want oil prices going up, and they fulfilled that.
So that's Eric Garcetti, the former U.S. ambassador to India, saying the U.S. welcomed India's purchase of Russian oil. Now, President Trump is scheduled to speak exclusively to CNBC at 5:30 p.m. this evening. Stay tuned to CNBC-TV18 for the biggest interview of the day. We will hear more from President Trump. But let's move to the day's market action. The market closed with minor cuts after President Trump threatened to substantially raise tariffs over Russian oil imports. The Nifty slipping below 24,700, largely dragged lower by Reliance and banking heavyweights. Surbhi is standing by to wrap up the market action for us. Surbhi.
Well, it was a weak day of trade, and India was a little isolated, felt a little lonely in the fall because most of the markets had a flourishing close. The Asian markets, including mainland China, Hong Kong, etc., Japan as well. And while we were trading, Europe was also tracking gains. Now, two things are happening. In India, this whole nervousness and unease with respect to the trade relations with the US, they are definitely weighing on sentiment. And on the other hand, global markets are rallying, anticipating a Fed rate cut in September. So let's talk about the trading action here. At one point in time, the Nifty was threatening to give up even 24,600. But then there was a recovery towards the last 20 minutes of trade, which means that we've given up less than half of Monday's gain. But the losses were pretty much across all sectors. If you take a look at it in terms of, the sectoral bias, pharma and the capital markets part of the market was actually weakest. Pharma, of course, for obvious reasons, uncertainty around what's happening next in terms of those US tariffs. So if you see a lot of these stocks, Cipla, Dr. Reddy, Sun Pharma, Aurobindo, all of them were weak. On the tariff wars, we had a lot of the textile and apparel exporter stocks. They got hit quite hard. Gokuldas exports, for instance, was almost down 8-9%. There was Well-Spun Living losing about 4% as well. Let's talk about the wider fall on the Nifty. The losers beyond pharma names included the likes of Adani Ports, Adani Enterprises. A lot of the heavyweights were under pressure today. Reliance Industries, ITC, Infosys, all these stocks were nursing cuts and losses today. Banks, diverging moves coming in. The larger private sector names like HDFC Bank and ICICI Bank, second day running, both of them were weak and slightly nervous, it seemed, ahead of the policy. But then SBI was trying to cut the losses. There was some buying on Kotak Mahindra Bank as well. And speaking of banks, of course, have to mention IndusInd. Positive market reaction, almost 2% higher. All hopes being now pinned on Mr. Rajiv Anand to orchestrate a turnaround in operations. Let's talk about mid-caps. I remember I told you the capital market side of the market was quite weak. Well, that showed up in stocks like BSE, in stocks like MK Global and Angel One. Our colleague Yash put out the story that perhaps the regulator is considering several additional measures to curb activity in the F&O market even further, and that weighed down on sentiment. Other market movers, the ones on the upside today included Godfrey Phillips, positive reaction to earnings, almost 10% higher. Siemens, Solar Industries, Force Motors and New India Assurance also managed to find a couple of gains. It's going to be all about earnings tomorrow, so we'll be looking at the numbers from Britannia and Bharti Airtel post the bell. And of course, tomorrow is a big day for autos. Bajaj Auto, Hero Moto, these are some of the biggies that will report.
Yes, we'll be watching those very closely. Surbhi, many thanks. What we're also going to be watching closely is RBI's Monetary Policy Committee. It will announce its rate decision tomorrow. Now, President Trump's India tariffs threaten growth and inflation. Undershooting RBI's forecast will remain key focus cues for the MPC. A CNBC-TV18 poll of top economists shows a clear split. Half expect a 25 basis point cut, while the other half say the Monetary Policy Committee will hold rates steady. Our special coverage on the RBI's policy decision starts at 9:45 a.m. tomorrow morning. Reliance Group Chairman Anil Ambani appeared before the Enforcement Directorate in Delhi. This pertains to the alleged 17,000 crore rupee loan fraud case. The ED issued a look-out notice against Anil Ambani on the 1st of August, stopping him from leaving the country. Authorities had also conducted raids at more than 35 locations across Mumbai and Delhi related to the Reliance Group and its entities. India's Services Purchasing Manager Index climbed to an 11-month high of 60.5 in July against 60.4 in June. This as per the HSBC India PMI data. The services sector has now recorded expansion for 4 consecutive years. This was largely led by new client onboarding, solid demand and an improvement in export orders. Similarly, the composite PMI has also inched higher to 61.1 in July. Shares of Paytm's parent 197 Communications down sharply in trade today. This after investment firm Antfin exited the company by selling nearly 6% stake via multiple block deals. The sale may have fetched Antfin over $450 million. The exit from Paytm has come at a steep loss of nearly $2 billion. Warren Buffett's Berkshire Hathaway sold its entire stake in Paytm in November of 2023. Luxury car maker Jaguar Land Rover was all set to get an Indian in the driver's seat. Tata Motors Chief Financial Officer PB Balaji has now been appointed as the CEO of Jaguar Land Rover, effective from November of 2025. He will take over from Adrian Mardell, who's retiring after a 3-year stint at the helm. Balaji has been serving as Tata Motors CFO since 2017, as has over 3 decades of experience in the auto and consumer sectors. So a change of guard there at JLR. Speaking of change of guard, CNBC-TV18's Newsbreak has been confirmed. IndusInd Bank has appointed Rajiv Anand, the new MD and CEO, for a 3-year tenure. The bank's shares surging in trade post the announcement. This post has been vacant since Sumant Katpalia's exit in April this year following the accounting discrepancy. We were the first to report in June that the former Axis Bank Deputy MD, Rajiv Anand, was the front-runner for the post. Ritu's here with more. Ritu, congratulations first on that news break. What does Rajiv Anand's appointment mean for IndusInd Bank, and what will be the challenges that he's going to have to cope with?
Well, big development for IndusInd Bank, with the Reserve Bank of India approving Rajiv Anand's name for the MD and CEO position for a 3-year term effective the 24th of August. We were the first to report that Rajiv Anand was shortlisted by the board and was a front-runner for the position on the 27th of June, and now it is official. A chartered accountant and commerce graduate, Rajiv Anand is a financial services veteran with over 35 years of experience, known specially for his expertise in capital markets. He began his career as a trader at HSBC and joined Axis Group in 2009 and became the founding CEO of Axis AMC. Since 2013, he's been on the board of Axis Bank, where he headed both retail and wholesale banking and rose to become its deputy MD in 2021, retiring just a few days back. And now he steps into a bank which is at a crossroads. IndusInd Bank is recovering from a massive loss in the 4th quarter, its worst ever, driven by accounting lapses. It bounced back in the 1st quarter with a profit, but the damage triggered a string of senior-level exits. The bank's chairman, Sunil Mehta, though, has assured investors that legacy issues are behind and the impact of all these irregularities has already been absorbed. He also outlined a 5-point focus for the bank, including a profitability-first approach, cost discipline and a focus on recoveries. So when Rajiv Anand takes charge, his task will be cut out, and it is a tall order. First and foremost, of course, to stabilize the ship, rebuild the bank's reputation and restore stakeholders' confidence, fix the internal control systems and ensure a sustainable return to profitability while cleaning up the books as well. Equally important will be to rebuild the core team. The bank has been without a CEO and deputy CEO since late April and is currently being run by an executive committee. He must also execute the 30,000 crore rupee capital raise to make sure that the balance sheet is strengthened, while also managing the ongoing fallout from the accounting lapses, the MCA probe being the latest.
All right, Ritu, many thanks. Now, Adani Ports has reported a stable set of numbers in the 1st quarter. Net profit up 6%, revenue jumped 21% on an annual basis. However, margins contracted in the quarter. The company's also said that Gautam Adani will be redesignated as the non-executive chairman of the company. Adani will also cease to be a key managerial personnel of the company. No explanation given as to why this change has been ordered. In global earnings, BP reported a stable set of numbers in the 2nd quarter with profit beating street estimates. The energy giant reported an underlying profit of $2.35 billion and has increased its quarterly dividends to 8.32 cents. The company will also maintain the pace of its share buyback program at $750 million for the second quarter. Saudi Aramco, meanwhile, reporting a decline in net profit for the 10th straight quarter. This after lower crude oil and refined chemical product prices outweighed the impact of higher production. Net income attributable to shareholders fell by 19% to $22.8 billion in the second quarter, missing estimates. Revenue also fell to over $100 billion. Now, the Finance Ministry, we learn, is currently in talks with the market regulator SEBI to curb excessive speculation in the F&O market. Sources tell us that SEBI may consider a shift away from weekly to fortnightly expiry and cut securities transaction tax. Yash is standing by with more. Yash, what is the plan that both the government and SEBI are considering?
We had reported this earlier that market regulator SEBI is working and looking out for ways in which it can reduce options market trading and the speculation there, and as against that actually focus on increasing the volumes in the cash market. Now what we've been given to understand from our sources is that the Finance Ministry has also sort of been in discussion with market regulator SEBI with the same agenda that options volumes and the speculation there needs to be reduced. On the other hand, cash market volumes need to be increased. According to our sources, the Finance Ministry is of the view that options market volumes or the transactions there is not meaningfully adding to any productive side of the economy. In fact, it is not even being effectively used for hedging and only being used for speculation. Whereas cash market volumes and the transactions there would actually add to the productive economy. It is with this rationale and indication that Finance Ministry is in discussion with market regulator SEBI to explore ways, asking SEBI to explore ways to look at how options volume can be reduced. Now, there are three important suggestions which market regulator SEBI is also considering to reduce options market volume. The first one is with respect to the expiry itself. We have weekly options expiry. Market regulator SEBI is likely to consider an option to make this weekly expiry and turn it into a fortnightly, which is every 15 days, or even a monthly expiry if needed, which will help them reduce the options market speculation and the volume. The second option is to sort of propose or ask the government to reduce securities transaction tax or STT on cash market volumes, essentially to incentivize cash market volumes, which will automatically bring down the options market volumes. The third one is to reduce the margin requirement on the cash market transaction side as compared to the options market. These three are important suggestions which market regulator SEBI is considering. It is likely that it could come out with a consultation paper with regards to the same proposals and its suggestions. And of course, once consultation paper is given out, after taking stakeholder views, the market regulator could take it to its board to approve the final regulations here.
Yash, many thanks. Up next, a cloud burst triggers a massive flash flood in Uttarakhand's Uttarkashi district. That and more when we return. A massive cloudburst has triggered massive flash floods in Uttarakhand's Uttarkashi district. The floods caused landslides, wiping out homes and hotels in the region. Several people are feared dead or trapped under the debris. At least 50 hotels have been submerged or washed away as per initial reports. Visuals on social media show locals climbing to higher ground to escape the floodwaters. Disaster response force teams have been rushed to the spot. The Uttarakhand government has also roped in the Indian Army for the rescue operations. Parliament continued to witness multiple disruptions as opposition lawmakers held protests and demanded a discussion on the electoral roll revision in Bihar. BJP's President JP Nadda and Congress President Mallikarjun Kharge engaged in a face-off in the Rajya Sabha. Kharge protested against what he called the presence of CISF personnel in the well of the House when members were protesting. Deputy Chairman Harivansh said the personnel were from the Parliament Security Service. House Leader Nadda, hitting back at the opposition, said they should take tuitions from him on how an opposition should behave in Parliament.
पहले के जो अपोजिशन लीडर थे उन्होंने कहा था कि डिसरप्शन इज आल्सो पार्ट ऑफ डेमोक्रेसी। ये आपको मालूम। और दूसरी चीज साहब, सीआईएसएफ जो आपने लगाया है, फिर संशोधन कराओ, सीआईएसएफ नहीं है, माननीय लीडर हो गया, ये सिर्फ मार्शल ही आ सकते हैं। नहीं मार्शल ही आ सकते हैं। ये देखिए, मैं पूछता हूं आपको, क्या ये सदन आप चला रहे हैं, क्या होम मिनिस्टर अमित शाह चला रहे हैं? मैंने इन लोगों को कई बार कहा, 40 साल से ज्यादा ऑपोजिशन में रहा हूं, कुछ मेरे से ट्यूशन ले लो, मैं बता दूंगा ऑपोजिशन कैसे करना आता है। अभी नए नए हो, अभी तो 10 ही साल हुए हैं, अभी तो 10 ही साल हुए हैं, अभी 30-40 साल रहना है, मेरे से ट्यूशन ले लो।
In international news, Israeli forces continue to bombard Gaza, killing at least 74 Palestinians, including 36 aid seekers. The UN has said that 28 children have died from Israeli bombardment and lack of aid. Officials have said that Israel is allowing only 86 trucks of aid into Gaza a day, while a minimum of 600 trucks is actually needed to provide basic aid to starving Palestinians. The U.S. Embassy in India has issued a stern advisory to visa holders. The embassy has warned visa holders that there will be consequences if they overstay beyond the authorized period. Visa holders not adhering to these rules could face consequences including visa revocation, possible deportation and ineligibility for future visas. The U.S. State Department has announced that it will begin a one-year pilot program from the 20th of August. This will allow consular officers to require security bonds of $5,000, $10,000 or $15,000 from some applicants for business and tourist visas. This will be applicable for countries deemed high risk for visa overstays. India and the Philippines have announced strategic partnership. This comes after talks between the Prime Minister and visiting Philippine President Ferdinand Marcos. Prime Minister Modi said bilateral trade between the two countries has crossed $3 billion and strengthening it further is a key priority. This year marks the 75th anniversary of India-Philippines diplomatic relations. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, let's talk about diamonds now. And India's gem and jewelry market is bracing for impact after US President Donald Trump announced a 25% tariff on Indian imports with additional threat of secondary sanctions. The US is one of the biggest markets for Indian gems and jewelry. Exports to the US in the last fiscal year nearly touched a $10 billion mark. On the other hand, the country is seeing a surge in demand for diamond jewelry, with market size expected to double by 2030. De Beers projects a strong 12% annual growth rate, calling India one of the fastest growing diamond markets in the world. Joining us now to discuss this is Kirit Bhansali. He is Chairman, Gem and Jewelry Export Promotion Council. Mr. Bhansali, hi, thank you so much for joining in. First of all, it really is about tariffs. While the UK and India tariffs have been signed, and I did remember speaking to you at that time where you applauded it, the numbers do look good there. But when it comes to this whole logjam between India and US and the 25% plus penalty sanctions threat that we are dealing with right now, how is the sector reading into it?
It's the biggest worry of the industry today is US tariff. But the little hope came yesterday from the ministry that a large number of delegation from Washington is coming India on 19th of this month, and they are going to stay around 19th to 24th. So we are just crossing our fingers and hoping for the best.
Well, absolutely. Mr. Bhansali, I do understand that there have been a lot of presentations that you have made. You've been part of various convoys with the PM when it comes to many of these conversations. What is it that India is pushing forth with? 25% is something that I'm assuming the sector or the segment cannot work with. If there was a number, what is it that you have put forth?
Manisha, if I will describe you in two lines. So we have presented in front of Washington counterpart also, as well as American Diamond Manufacturing Association. Anup Mehta traveled with my AD 2 months back in New York, and we have given a nice presentation showing that Indian manufacturers making 4 to 5% profit in diamond business, while the retailers of America are making 60 to 100%. And they have about 70,000 small and big outlets. So it's not only the India will affect. The big impact will come on US retailers too. So we are talks are going on, and it is now the ball is in court of US, how to safeguard American retailers and how to safeguard Indian diamond industry.
And as you said, it's not too far away. 19th August is yet another date where you said the US convoy is coming to India, and there will be negotiations happening yet again onto this one. As of now, from where business stands, Mr. Bhansali, is it a standstill?
Absolutely.
Are the exports still happening?
Absolutely standstill as far as the US is concerned. With 10%, that window is open till 7th. So you can see exports in last 2-3 days. I don't have the right figure, but till 7th. After 7th, it will be totally dead. Nobody will export in 25%.
So clearly, there's going to be a bit of a difficult time there. So what is it that you're talking to the government and to ministries, Mr. Bhansali, in that context?
So Niti Aayog has a call urgent meeting on 7th. I and India traveling to Delhi on 7th. Ministry is also calling us. Let's discuss with them, and it's anything early to say about this.
Oh, well, absolutely.
They understand our sector very well, and they are also worried. So after talking with Niti Aayog and Commerce Minister, I can say something to you.
So, Mr. Bhansali, just for the sake of calculations, 10% is what we are working with right now. If it goes to 15%, does life change a lot for you? Also, in that sense, then, are you looking at various other markets? Because US being one of the largest markets for us, do you think the other markets can actually fill that gap? Or
yes, Manisha, this 10% is also difficult to digest. Forget about 25%. So yes, of course, you must be your answer to your other question. We are looking for other markets. GJPC is organizing first international show in Jeddah, Saudi Arabia between 11 to 14 September this month. And looking at the growth and huge demand in Saudi Arabia, definitely we are opening a door for new market.
Absolutely. Mr. Bhansali, you've just come back from a successful IIJS, and I attended it a couple of days as well. And it seemed bustling with a lot of energy, enthusiasm, new designs, people buying, especially ahead of the festival season. Is there, what kind of numbers, what kind of footfalls, how many exhibitors, and what is your feedback from IIJS?
IIJS 2025 is a reflection of the true story of India's growth. We have seen the record footfall, 50,000 plus visitors came, 2,500 from global markets, foreigners. I'm expecting business between 70,000 to 1 lakh crores. All-time high everything. That's the real growth story of India.
Mr. Bhansali, when we talk about Indian markets, and yes, all other segments and sectors also seem to be looking inward. Everybody is eyeing India because one, population is younger, stronger growth here as well, wealth creation, more spending opportunities, etc. When you look at the Indian markets, and we predominantly are 80 to 85% in sense of gold, perhaps 10-11% for diamond, a small 2% for gemstones is how Indian market is characterized.
Right.
Where do you see the maximum growth coming in?
So we have witnessed in last 3 years, domestic market is growing with 11 to 14%. In spite of 1 lakh rupees, 10 gram gold price. So
and do you see this sustainable, Mr. Bhansali?
Domestic market is going extremely good. I have no words.
Where do you see more growth coming in? Is it going to be gold, diamonds, gemstones?
Everything, but see, by seeing growth of 10 to 15%, we cannot fulfill that gap of exports. So we'll have to explore new market for export. If we lose two major markets, China and America, so GGBC will have to definitely work hard. It's a very tough road ahead.
Oh, well, absolutely. And perhaps all these bilaterals that we seem to be doing with various countries could be on the supportive side. What also seems to be happening with other countries, Mr. Bhansali, because there are conversations happening with Australia, Philippines is another country, Middle East, as you said, is a market which seems to be opening up, which you also are exploring right now.
Manisha, wherever we did FTA, if I start with UAE, we have seen in last 3 years, 33% growth in UAE export. In current year, we have seen 43% increase in plain gold jewelry. So now the next FTA happened with Britain. Currently, we are doing a $1 billion business with Britain. I'm expecting in the next couple of years, it will be triple.
Mr. Bhansali, is there a number that you would want to put in sense of how we've seen the first half of this year until now and how different can the second half really be? Because we do understand in the first half of 2025 calendar year, we've seen export numbers slightly on the weaker side because of the gold prices at all-time highs. The Indian domestic demand also suffered a bit. We are looking at lower caratages, lower weightages right now. Is the second half, which starts with the festivities in the month of August from this weekend itself until Diwali, which is in October this time, are you looking at better, stronger demand numbers to
Yes,
emerge?
Indian retailers and Indian young jewelry manufacturers are walking with the time. They are coming with 9-carat jewelry, 14-carat jewelry. Second, I am optimistic. Domestic will be 100% better. And for export, we'll have to wait and watch.
Oh, well, yes, those numbers absolutely depend on what we do see coming in from US because that really is the big chunk of numbers there. Mr. Bhansali, as always, thank you so much for joining in, talking about tariffs, IIJS, and of course the expectation of demand, especially in the Indian markets, which does seem very, very stronger there. But with that, it's time for a short break. Don't go anywhere, though. We shift focus to gold when we come back because that clearly is in focus. 80 to 85% of jewelry that India buys is solid gold. And there is a report recently which also suggests that 1%, the richest Indians, have parked their wealth. 60% of that wealth is in real estate and gold as well. What really are those metrics? There is something that we will discuss also after this break.
Welcome back. You're watching Commodity Champions, and the gold prices have hit an all-time highs of more than ₹1 lakh per 10 grams in India after seeing nearly 1.5% of a surge overnight. That's the biggest one-day gain that we've seen in gold prices in more than 2 months. There are several global factors that are supporting the prices, including the weak US jobs data that put pressure on the US dollar. The market is also pricing in an 80% chance of a Fed rate cut in the month of September. Another factor is President Trump's tariffs that have added to the global uncertainty. Physical demand for gold is also expected to pick up as the Indian festival season begins in the month of August with Raksha Bandhan. So where are the gold prices headed next, and what is the kind of demand that we're anticipating? To get answers to all of those questions, we are now joined by Shreyansh Kapoor. He's Vice President at Kashi Jewellers, and Sumit Anand of Punjabi Saraf Jewellers, Indore. Gentlemen, hi, thank you so much for joining in. It clearly is a time where there's a lot of uncertainty, but within that as well, the gold prices have just surged, trading above ₹1 lakh at 10 grams. Shreyansh, while the IRGS numbers clearly have been on the stronger side, as Mr. Bansali told us, but it really will boil down to the consumers coming in and buying at those levels. So what is it that you feel could conspire in the next 3 months, let's say? Because starting from now until Diwali, and then, of course, the Christmas demand globally will start picking up as well. So second half always is very important. But what are you reading into consumer trends? Will they buy at these higher levels?
Right. Hello, Manisha ji. So great to be part of the program, and thank you for including me. So as we were discussing the other time, the rate is up above 1 lakh. I'm just seeing a rate of 1,02,000 is hovering around that price. And, I have noticed in the last 2 months, the price, people are not digesting the price of 1 lakh plus. This is the one thing which we are seeing with the Indian consumer. I was sharing my opinion last time that what has happened is we're seeing a lot of customers coming and selling their old jewelry, whether for profit taking or for other reasons. But the demand as such has not picked up. Having said that, our next quarter is crucial, and I would literally use the word critical for the success of jewelry retailers in India. For the simple reason being that we enter as soon as Raksha Bandhan happens, which is happening this weekend, we're going to have a surge in festivals. And with that, traditionally, the buying also increases. So we are really, really hoping that they will start digesting the 1 lakh plus rate. And because of that, they would also start increasing the diamond jewelry. Another point to add, we are very happy to see that the BIS hallmarking has added the 9 carat as a jewelry category. And I feel in the next few months, this category should also come in, and this would also, we'll have more jewelry coming in this, albeit maybe not just gold, but with diamond and gold in it. And then so is the 14 carat, which is there. So I would say that would be better price points for consumers to buy.
Mr. Kapoor, 9 carat has just been introduced and it perhaps is used in very fewer geographies. And the overall gold buying, 9 carat is still a very, very small piece of that segment there. What kind of numbers, if you had to look at all categories of, let's say, 24 and 22 and 18 and 14, and now we have 9 carat jewelry coming out as well, how would you put percentage and sense of market share for all of these caratages?
Right. So there's a market for all. I was in IIJS. I just came back last evening, and I was surprised that when I went to the World Gold Council booth, they were showing me jewelry in 24 carat, which was very surprising. So on one spectrum, we having jewelry which is going to come in 24 carat pure. And on the other side, we have a 37.8% purity, which is 9 carat. So to answer your question, I would say the ballpark figure, India's love for 22 carat will still remain. I don't see that changing, but the ratios will change. I'm seeing a lot more people already picking up a lot of gold jewelry in 18 carat, a lot of people buying diamond jewelry in 14 carat. And I feel some of the people who buying 14 carat diamond jewelry will move to the 9 carat, especially to the gifting category, because this is the one category in which people still want to buy precious gold and precious diamond and still want to extend their budget too much. So I feel it's a great thing for their wallet. And the share will only increase with due time as the rate. And now the rates of 1,10,000. If that's the story which it continues, then I see a great future for the 9 carat and the 14 carat market ahead.
So, well, higher prices and lower caratages is perhaps what we're looking at in this season there. Sumit, let me get you in the conversation. And what is your initial reaction to the higher prices? And as Shreyansh was telling us, the last quarter or the last 6 months perhaps has seen more sellers, more exchange for old, for new jewelry. New buyers clearly have been on the lower side.
So I totally agree with Shreyanshji, and yes, this is going to happen. And but what I see is that slowly and gradually, peoples are still, okay with these rates also. Because earlier there was a reluctance, but now I see that those who wants to buy, they buy. And definitely, as the season come closer, they will be more easy and they will be more comfortable because they see a good future in gold also, and they don't want to lose this opportunity at this rate also. So I see a very good future and a very good festival season coming in.
Sumit, since you are on the bullish side is there a number that you're working with? Because the last quarter has seen a very sharp decline in volumes. Of course, the value-wise numbers do seem better. But for these next 3 months, which Shreyansh calls crucial and critical as well, what is the kind of volume and value numbers are you working with?
So what I understand, retail is a very tricky and a very tough for every segment now, especially jewelry. So we all have to work hard on marketing, on being seen everywhere. Uh, People have a dream and they want to buy, but yes, we have to be categorically there where they want to see us. The marketing will play a bigger role. And I'm very happy the way World Gold Council have came forward with a lovely, initiative to bring in 24 carats. And yes, if it is seen more, people will be more comfortable. What I see in numbers, our last quarter went well. Yes, we didn't find any growth, but we were at par almost. But I see this coming quarter should be around 20-25% growth.
That is in value terms or volume terms?
Value terms.
Right. Well, the whole question really is volume, isn't it? Because that is what
I know,
Yeah.
but the diamond proportion is also growing.
Okay.
What I see, the lab grown time, that confusions, which was peoples were reluctant in buying diamonds, but they are coming back and buying diamonds and polki in a big way now, and especially weddings, they are more concentrated on diamond and polki. So if the value is also same, and if we sell more diamond and polki, we are at par, I think.
So it really is going to be about the studded sector game that can really, keep the numbers on the higher side. Sumit, since you mentioned lab growns right now, how do people come asking for it? How bigger of a piece of a pie is that seem to be getting, especially in the Indian markets?
No, rarely. Rarely. There is a market, I'm okay, but I don't see anything big around that. At least there is no competition with the real diamond world.
Shreyansh, what is your sense? Because, now the consumer is spoiled for choice. You have gold categories, a lot to play with. You have naturals and lab-grown diamonds there. There is gemstones, which seems to be making a strong entry within the Indian markets now. What is it? Polki is something that Sumit also mentioned.
This is what I always maintain for any retailer to survive. You cannot survive on the margins what we get in gold jewelry. You have to look at other category, and studded is one great category to look at. Having said that, polki definitely is a very high profit margin product, but then polki is very determined to only the wedding season, which we are very early. Right now, we're entering the festival season. I do see a lot of demand coming up in the diamond category. And to answer the other question that how the ratio of lab grown and natural is, I'm very happy to share that in the last 6 months, the demand of natural diamonds is slowly coming back to its older levels. I'm getting a lot of solitaires demands. I'm getting more people asking for more diamond necklaces in price points. And the great part is the diamond price, because they have not increased, it offsets the high gold price. So it's a great alternative what we can offer to our consumers, where they have a certain amount. Let's say they want to spend ₹1,00,000 and they hardly get anything in that ₹1,00,000 in a gold jewelry, especially if it comes to a category like necklaces. But in diamond jewelry, with the 14-carat diamond jewelry, they can definitely get a decent size necklace with earrings and sometimes even a ring also in that budget. So this is a category which I feel can really grow. Also to share, DBS has just joined hand with the GJEPC, and they just launched the Indira campaign. I was part of that campaign, which they had just this last Friday in Bombay and in Mumbai. And it was amazing because, we seeing all the retailers coming together, and to again try to push the natural diamond category. And I feel that's a really right way forward.
Oh, well, yes, this was long overdue, wasn't it, Shreyans? Because for some years, we did not see the industry come together. But clearly, the last 6 or 12 months has seen a lot of these kind of coming together of various industries and brands and associations and trying to put forth jewelry as a whole and absolutely natural diamonds there. Sumit, this one is to you. So while gold and diamonds is one part of it, we also have seen silver jewelry pick up. Platinum did come back into conversation as well.
Yes, platinum, especially males, they are opting for it, and it's a different niche market. Platinum, especially what I see is men's having chains, especially their nice chains and then bands. These two categories doing well for us at least, and yes, it's growing. It's growing. I don't do silver much, so I cannot comment on silver. But yes, platinum is doing well for us.
Sumit, everybody has a view on gold. What's your sense on where could we see the prices by the end of this year?
So, yes, I see it growing. What I see is 1.5 to 1.6.
Shreyans, you want to stick your neck out and also come out with a price there? 1,05,000. Sumit, you said 1,05,000, 1,50,000. Sumit, did you say 1,50,000?
150 this year, yeah.
150 this year?
Yeah.
That's a very, very bullish call. Shreyans, what's your sense?
I think, rupee-wise, it should definitely cross the 1,05,000 very, very soon. And then we're going to see the next break at about 110. I don't see crossing 115 to 120. I mean, 120 is also, I think, stretching it till December. That's my personal view.
So the markets really seem to be factoring
the coming year.
Yeah. In the coming year, yes.
Yes.
The next 12 months does sound like
Yes.
that. And while, of course, I think the interest rate cuts and the dollar index declining could be a couple of supporting factors in the gold prices there. Let me come to both of you now for a final set of questions there. Going forward now with hopes high, all readiness in place, especially with the festival season coming in, what are the challenges, Shreyans, that you see in this industry going forward?
Like Sumitji is rightly saying, it's all about now pitching us in the right way to the consumers. And with the new Indira campaign coming up with De Beers and GJPC, if we can really push the natural diamond story, that will really make a difference. This is how it used to be in the old days when we really used to market natural diamonds. And that's where you would be surprised in the early 2000s to about 2006, the diamond ratio changed as high as 35% of a retailer. And then it went down to a low figure of 15%. So, we still have scope to get that margin back, to get the natural diamonds pushed out. And I feel it's the right marketing and the right consumer storytelling, which we can, and especially the emotional part of the marketing, if we can really, hit in that direction.
That point is well taken. So very bullish on gold prices, bullish also when it comes to value and volume going forward into this quarter. As said, it's an important one. It starts with Raksha Bandhan is this weekend and then continues until Diwali. And then there's a wedding season and then Christmas and New Year and then the wedding season yet again. So, well, absolutely next 6 months, very, very important for this segment. And within that, we'll also have to watch out for on what kind of tariff agreements do take place. That will impact the industry quite a bit as well. But as always, Sumit, Shreyans, thank you so much for joining in and making sense of a sector which really seems to be quite on the edge at this point in time. But with that, that's all the time that we have on this edition of Commodity Champions. Thank you for watching.
Hello, welcome to News Center. With me, Parikshit Luthra. The Indian government is calling out the United States and European Union for its trade with Russia. This after US President Trump threatened higher tariffs on India, blaming it on India's energy imports from Russia. Shireen Isban is here with the tariff tussle and India's response.
Well, let's address President Trump's latest tariff threat to hit India with a substantially higher tariff rate. Why? Because he says we buy Russian crude, but we also sell Russian crude for a profit, in his words. Now, India has hit back at the US for threatening those higher tariffs and a penalty which still there is no clarity on. In a social media post, President Trump said, and I quote, "India is not only buying massive amounts of Russian oil, they are then, for much of the oil purchase, selling it in the open market for big profits. Because of this, I will be substantially raising the tariffs paid by India to the United States of America." That is the Truth Social post from President Trump. Now, responding to President Trump, the Ministry of External Affairs has said the targeting of India is unjustified and unreasonable, and the government has promised to take all necessary measures to safeguard national interests and economic security. But here's what we need to focus on. What do the facts say? India began importing crude from Russia because traditional supplies were diverted to Europe. Remember, this was when the Ukraine war started. In fact, India at that point in time and went on to say that the US actively encouraged imports of Russian oil by India as it strengthened global energy market stability. Why was this the case? Because remember, back then there was a sharp spike in oil prices, and oil prices, Brent crude specifically, hit $137 per barrel. This was in March 2022. This was after Russia invaded Ukraine. Now, cut to November of 2022. US Treasury Secretary Janet Yellen said, and I quote, "The United States is happy for India to continue buying as much Russian oil as it wants, including at prices above a G7 imposed price cap mechanism, if it steers clear of Western insurance, finance and maritime services bound by the cap." Now, this was Janet Yellen in November of 2022, saying that the US supported India's decision to buy Russian crude, in fact, encouraged it. Let's go a step further. In February of 2024, US Assistant Secretary of State Jeffrey Pyatt acknowledged India's role in stabilizing global energy markets. He said, and I quote again, "India has played a key role in efforts to stabilize global energy markets through its purchase of Russian crude." Now, this is again the position of the US administration, not the Trump administration, but the US administration nevertheless. Now, just a few months ago, in May of 2024, US Ambassador to India, Eric Garcetti, admitted that India bought Russian oil because the US wanted somebody to buy Russian oil, and the US allowed the purchase to ensure oil prices do not go up globally. New Delhi also called out the US and Europe for criticizing India's trade with Russia when both the EU and the US themselves are indulging in trade with Russia. The ministry said Europe's bilateral trade with Russia in 2024 was worth over 67 billion euros in terms of both goods and services trade, worth over 17 billion euros in 2022. So you can see that there's been a significant increase. This, the Indian government says, is much more than India's total trade with Russia in the same period. Now, India is also calling out the US for importing uranium hexafluoride for its nuclear industry and palladium for its EV industry, along with fertilizers from Russia. That's not all. India has meanwhile been increasing its energy imports from the US. So remember, Trump's call to action saying that India must buy more from the US. Well, India has been doing just that. In fact, just in the first quarter of this financial year, US energy imports are up 114%. The share of US crude in India's import basket has risen from 3% to 8% in the month of July alone. Now, India is estimating a 150% rise in energy imports from the US this year. So that is where things currently stand as far as India importing energy from the US is concerned. The important question to ask also is that why has the US not sanctioned Russian oil? Remember, there is no sanction on Russian oil. There are sanctions on oil coming in, for instance, from Venezuela, from Iran. There is no sanction on Russian oil. So India's position is that it has been dealing with Russia as per the global norms and as per the price cap mechanism that has been put in place at this point in time. That is the position for now.
And here's former U.S. Ambassador to India, Eric Garcetti, admitting that India bought Russian oil because the U.S. wanted someone to buy Russian oil and not disrupt the global energy prices.
And we take the smaller victories, like actually they bought Russian oil because we wanted somebody to buy Russian oil at a price cap. That was not a violation or anything. It was actually the design of the policy, because as a commodity, we didn't want oil prices going up, and they fulfilled that.
To take this forward, I'm now joined by Christian D. Guzman, Senior Vice President with the Sovereign and Sub-Sovereign Risk Group at Moody's Ratings. Thank you very much for joining us on the program, Christian. Let me begin by asking you, on Monday, you had shared an outlook. Moody's had shared an outlook saying that India, with 25% tariff that has been slapped by the United States, will now be at a disadvantage compared to other APAC economies, which have tariffs in the range of 15 to 20%. At that time, you had also mentioned a potential risk of penalty. Now, Donald Trump has announced substantially high tariffs as a penalty for India's Russian oil imports. How would you revise your outlook on the Indian economy and the trade impact on India?
Well, I think let's take a deep breath here. I think when we're talking about announcements, there hasn't been anything other than a tweet. And tweet, I think, as we all know, isn't exactly policy, because under this administration, actual policy, when it comes down to the outcomes of negotiations, can actually be very different from a tweet. And tweets do appear to be somewhat of a negotiating tactic when you see all the sort of bluster that precedes actual agreements or outcomes. And it doesn't have to deal with trade. It can be other things. But this is just how the Trump administration conducts itself. Having said that, this is a pretty serious. I think the prospects of that penalty tariff has gone up just because it has been announced specifically for India. But let's also take a step back in the sense that previously, about a week beforehand, Trump had also announced that there could be penalty tariffs of up to 100% for all other countries that are importing Russian oil. So India perhaps is not quite targeted in that sense, but India was top of mind clearly when Trump wrote this message.
Right. And how do you see a risk to India, especially if it had to cut off supplies of Russian oil, buy more US energy, increase more supplies from West Africa, Middle East for that matter? How do you see India's crude import bill increasing?
Well, indeed, it would be an increase in the crude import bill. So, but let me just take a step back. It is our understanding that that the purchases of India's purchases of Russian oil did come at somewhat of a discount, at least previously. So, by actually purchasing oil at global market prices from, it doesn't matter where, either from the US or from the Middle East or from Africa, this will indeed increase the crude oil import bill. And that will help to widen the current account deficit. Now, for us, we don't think that's necessarily a problem. We don't think external vulnerability is as much of an issue for India as it used to be, let's say in 2013. During the taper tantrum, the financing is readily available for India to fill in any sort of current account deficit widening. But indeed, this could perhaps apply pressure to things like the rupee. But we don't necessarily see that this is going to be a significantly disadvantageous development if there is no disruption to the supply of crude oil imports. Here again, it doesn't matter where it's coming from, just that the supply of crude continues to flow into India and continues to fuel, literally, economic activity.
Right. Christian, if I were to ask you about risks to India as a result of a 25% penalty, a 25% tariff, plus an additional penalty that could be imposed in the days to come, what will be the pain points from India for India going forward?
Okay, so indeed, this is going to be perhaps more disadvantageous, and especially over the medium to long term, as India's ambitions to be more of an export powerhouse to compete with a lot of its Asian neighbors. That's going to be sort of cast in doubt. if there are additional tariffs on top of the 25% already. I think, as you mentioned, we had highlighted that this was already above what was being assessed for its peers in Southeast Asia in particular. So this would severely curtail perhaps the sort of growth outlook for the export sector and in India's ambitions in that. However, I think what we can also take comfort with is that this is still the world's largest economy by population. This is a very large domestic market. And India, because of that size of that domestic market, we see as being much more resilient to external shocks than perhaps its peers, which are much more export oriented.
Right. Which are some of the sectors which you feel will be impacted the most in India as a result of the 25% tariff, which is the highest among APAC economies, plus an additional penalty? You mentioned electronic products in your initial outlook on Monday.
Right. It is indeed those products where it is seeking to compete or to gain market share in the sort of the global production of certain goods. When you're talking about electronics, mobile phones were already there. I think it's quite well known that India produces more mobile phones than anybody else. So, but it is the other higher value-added electronics which could be put at a disadvantage. There are also other higher value-added types of manufactured goods when we're talking about when the things that you're competing on with regards to the China +1 type of flows, that trade and investment diversion away from China. Now, we're highlighting this because there was this expectation that India, given its large labor pool, given the low cost of labor, given some of the other advantages, including the government's focus on promoting such investments, was in a good position to actually attract those investments. But now, perhaps that outlook is unclear.
Right. Christian, how critical do you think is it for India to come to a trade deal? You know, there is a worry. Tariffs bring in additional revenues, even if it's a few $100 billion. Now, the worry is that if tariffs are imposed and there is no deal, then these tariffs will remain at this level, even with the next administration. But if these tariffs were to stay, at least for this year, what will be the impact on India's growth?
Once again, I would sort of harken back to the structure of the economy. This economy is a lot more domestically focused, domestically oriented. Yes, it is a large exporter of goods for certain products, pharmaceuticals, mobile phones, and things like that. But at the end of the day, we see that the domestic momentum is still fairly resilient. There is going to be downside risks, as we have highlighted, and those downside risks are getting a lot higher. But having said that, we don't expect growth to be, a recessionary, if you will. There will be some domestic offset to those external shocks.
Right. My final question to you would be, why do you think Trump is targeting India so much on a daily basis, threatening India so much for buying Russian oil, but not targeting China, which also purchases Russian goods and Russian energy?
Well, I think your guess is as good as mine, but I think we do know that this president, this U.S. president, does speak off the cuff, and whatever is on the top of his mind ends up in a tweet. So perhaps there are certain things that were going on in the White House that morning, that evening, that prompted these tweets, and they may not have been China-related, but perhaps India-related. But I think, like I mentioned, your guess is as good as mine.
All right. Christian Guzman, thank you so much for joining us here on News Center, giving us your view and telling us that there is no recessionary impact that you expect as a result of these Trump tariffs, but you feel there are downside risks for the Indian economy. Time for a short break, but coming up, Niti Aayog has recommended a stringent plan for production and purchase of EVs across the country. A special discussion with Sudhendu Jyoti Sinha, Program Director of Electric Mobility at Niti Aayog, when we are back. Welcome back. You're watching News Center. Union government think tank Niti Aayog has recommended a stringent plan for production and purchase of EVs across the country. In its report, Niti Aayog has pushed for subsidies, lower taxes and electricity rates for boosting EV demand. That's not all. The think tank has also suggested disincentives for internal combustion vehicles by mandating higher prices. On top of this, Niti Aayog has said that effective implementation of mandates will be necessary if India needs to reach 30% EV adoption in the next 5 years. Joining us right now is Mr. Sudhendu Jyoti Sinha, Program Director of Electric Mobility at Niti Aayog. Thank you very much for joining us, sir. One of the points that your report starts off with is India's EV adoption right now is at 7.6%. We are targeting 30% by 2030. Are we moving fast enough to reach there?
So thank you, Parikshit, for asking me to be with you. I would put it this way, that yesterday when we launched this particular report, and this was after a lot of deliberations. In the month of, say, February and March, we had almost 7 convenings where we connected ourselves to 167 stakeholders, and we attempted to understand that what are the kind of areas where we are probably missing out, and therefore that needs to be raised up. And that gave us some fundamental understanding that helped us to have some new approaches, and that also helped us to kind of work out on the action plans that has to be there. Yes, so it is a set of host of interventions that may be required. One could be that how to strategizing and strategically scaling up the charging infrastructure, how to enhance the EV awareness, scaling up R&D ecosystem is there, how to attempt so that the capital cost gradually gets transported, it gets shifted to the operating cost, the services which are delivered, that it becomes a focus rather than the assets which are procured, and yes, ease of financing. So basically the idea is that how the entire ecosystem can be taken care of. There was a discussion that we need to be working in a more resolute way so that we are able to achieve the targets. Correct? Yes.
Right. I would also like to ask you, sir, you've said that we need to work at a more resolute pace, and that was the feedback that you got after stakeholder consultations. But when it comes to the need for imposing mandates, why do you think mandates are necessary for the industry, including disincentives on ICE?
So I would put it this way, that you see, yesterday also our members so clearly said that mandates means that practically, while we have got from the demand side, there are specific incentives are there, then from the supply side also some action has to be taken. So yes, there could be one method of incentivizing supply side also, and there could be another method of creating some small little nudges, some small little disincentives. So but members so clearly laid out that those mandates, those disincentives, they have to be very kind of gentle nudges. They have to be very, very soft ones, not something that is going to create a massive pain point in this transition. And so far we have been able to do well. So maybe that in whole it appears that it is 7.6%, but if you see the specific vehicle segments, then our performance is something that is being, this is globally something of an acclaim. Our bus transition, for example, our three-wheelers, for example, they are something that is really a big achievement. So I would put it this way, that we will definitely be working out that if it is required, what we could be doing so that the polluting vehicles, they could be, their pace of their growth can be arrested, and in that space, the electric mobility, the clean vehicles can be pushed forward. Correct.
Right. Now the PM e-drive scheme, sir, it will end in March next year. What would be your recommendation, or what is the Niti Aayog's thinking when it comes to incentives post-March 2026?
So PME drive is definitely, as you know, on earlier occasion I have been able to explain that this is one of the very, very aspirational program. So rather I would say that it has built upon FAME 1 and FAME 2 and the multiple set of other interventions that have so far been taken. So PME drive has got very strong focus on public transport, it has focus on charging infrastructure, that is how it is going forward. And in majority of these areas, what we are watching is that it is able to achieve its target. Now, what next? Definitely, by the time we would be getting into the last quarter, we will be also taking stock and then we'll work that how exactly, what exactly we should be pushing ourselves as a next step to. But my sense is that yes, charging infrastructure that still should be incentivized and maybe that public transport should be one of the focus areas. But what should be the format of those incentives? How exactly we are going to achieve it? That only in future can unfold. But yes, we'll get going on this task of this assignment of working through and thinking through. Correct.
Right. Also, when it comes to having some sort of regulatory support for battery leasing, do you think this is one of the major missing links to bring down the battery cost for the consumer, support battery leasing, battery rentals, battery as a service?
Very correct. So battery as a service is definitely, that is going to be a master stroke because as we know that the battery is almost 35 to 55% of the cost of the vehicle. And as of now, the cost of the EV is definitely little on the higher side. So as we are moving on gradually, the cost is also coming down. The parameters are increasing, cycle life, the range, all those things are increasing. At the same time, multiple finance models are coming into position. So one of them is definitely battery as a service. So battery as a service, correct, I will say that if that can be positioned properly, that will definitely lead to a major lever in this transition. And as you see that some of these OEMs, they have taken to battery as a service model, and that is how they are doing so well, correct?
Right. Now, when it comes to charging infrastructure, do you feel that we are still lagging behind? And if we want to reach that 30% electrification goal by 2030, sir, we won't reach there with this current level of charging infrastructure?
Charging infrastructure, the pace of its growth, that has to be ramped up. Not that action has not been initiated from the central government. A lot of action has been initiated. You are well aware that almost 27,000 charging stations, that is the responsibility that we have given to the oil marketing companies to set up at their own petrol bunks or in the adjacent area. So that is one thing which is going on. In addition to that, the charge point operators, they are also being encouraged through multiple methods so that they are able to take it forward. And we are almost on a constant conversation and kind of coordination with the state discoms so that they take on the responsibility to expedite these charging infrastructure whenever they are requiring such approvals or when they are looking for such assistance. So that is when, the state distribution companies, they have to be very, very forthcoming in these areas. That is, just to recollect that yesterday we also, there was another report that was also unveiled, which was on electric mobility index. So what we are attempting to do is that we are creating a kind of ranking of the states, and in that rank, charging infrastructure is also one of the points that has got a higher weight. Therefore, our target is that the states must be taking this thing forward. Charging infrastructure must grow up as an independent business, as a new business opportunity, and we should be moving fast so that we are able to achieve our targeted goal. Correct.
All right, sir. And very briefly, sir, about financing, that's an important part. But do you think the financing should now focus more when it comes to public transport, also trucks?
Yes, financing is definitely one of the key areas. And let me put it this way, that now you would see that in last, as compared to last 3 years or 4 years, as we are moving along, then the finance institutions, the banks or the NBFCs, they are having more and more faith, more and more confidence in giving loans to the users, to the operators, to the manufacturers, to the charge point operators, to the entire ecosystem. Now they are willing to give it loan. And let me put it this way, that the government department is also functioning very, very properly in this. There are very much clear-cut guidelines which are being issued, that kind of, these banks, they should be, I would say that they should be forthcoming, they should be forward-looking in giving loans at rather, I would say, at a reduced rate of interest if possible. Correct.
All right. Thank you very much, Mr. Sudhendu Jyoti Sinha, giving us your blueprint of how India can achieve 30% electrification by 2030, areas where we need to ramp up our energy. With that, it's a wrap on this edition of News Center. Thank you for watching. Goodbye. Hello and welcome to News Center. I'm Parikshit Luthra. The top story this evening: the Trump administration has ramped up its criticism of India's purchase of Russian oil in what is Washington's strongest criticism so far. The White House's Deputy Chief of Staff Stephen Miller accused India of effectively financing Russia's war in Ukraine. The senior Trump aide said that US President felt that New Delhi's actions were unacceptable. In fact, US President Donald Trump has continued to threaten to impose secondary sanctions on buyers of Russian oil. A decision on the matter is expected on Friday. If US does impose sanctions, India's oil import bill could rise by $9 to $11 billion per year. Remember, Russian crude oil accounted for 35% of India's total imports in the first half of 2025. However, India's crude oil imports from US are set to rise by over 150% in FY26. Sources telling CNBC-TV18 that imports in the first quarter of the fiscal already rose by 114%, with share of US crude in India's import basket rising from 3 to 8% in July alone. Furthermore, government sources maintain that India's purchase of Russian oil is critical to maintaining price stability, sources adding that India followed all international protocols while buying from Russia. Brent spiked on fears of Russian oil going off the market in 2022. Sources have said that India's increased oil imports from Russia stabilize prices. Let me go across to our guests at this point. We're now joined by Gaurav Moda, partner and head of the energy sector vertical at EY, and Prashant Vishisht, who is Senior Vice President of ICRA. Prashant, what would be your estimate on the spike in India's crude oil bill if we had to increase imports from the United States and reduce our reliance on Russian crude?
Parikshit, if we were to buy market price crude in place of the discounted Russian crude, our estimate is that the import bill would rise by less than 2%, because as it is now, the discounts are quite low, in just about $2.5 to $3 per barrel.
And Gaurav, your own estimate?
Parikshit, I think there are three aspects to take into account here before we come to a number. Aspect one is that India's crude imports are fairly diversified now. We import from South America, the US itself, as well as other geographies all over the world. So that diversified sources helps us balance our averages. Second, most important aspect also is that the crude prices last year were averaging $75 a barrel. They went down to $60. Now they're $65, $66. So it's not like the crude pricing has gone completely out of whack in the market. Third aspect also is that India has been preparing for these kind of situations, not just now, but over the past several years, where we've increased our domestic inventories of crude. All PSUs are doing that. And we have strategic reserves and caverns where we store. So the question is not necessarily how much will be the direct impact on India's buying pricing, but more in terms of how we can stabilize and manage the market.
Right. Now, let me ask you, what would be India's options, Prashant, if we had to stop import of Russian crude oil in case the United States imposes sanctions on Russia and imposes secondary sanctions on countries like India and China if they were to purchase Russian oil?
Right. So, see, the first thing that we need to remember is that prior to 2022, our imports the Russian crude were in any case quite low, at less than 2%. We are also quite close to the Middle East or Gulf region, which is one of the biggest exporters of crude. So we are well served by that, by the crude that we can source from the Middle East. Besides that, there are several other options, US being one. Then there are a host of African countries, Algeria, Nigeria, and so on. So our crude basket has been fairly diversified, and we can obviously go back to some of these sources for replacing the Russian crude.
Right. And Gaurav, when it comes to getting a comparable oil bargain, currently the reason why we're buying from Russia, and this is right now, the Russian crude is the biggest in India's crude import basket. Would it be possible for us to get comparable prices anywhere in the world, be it Africa, be it West Africa or the Middle East?
Rishit, I would like to believe in the diktat that customer is always right. And India is the customer here. So this, in fact, is an opportunity for the selling countries to vie for more share of the Indian market if there is a replacement that's coming up. So I would anticipate that there could be further negotiations and bargain on the table for multiple countries to look at the Indian market. And as I said, we've been doing business with many of them. There are enough options on the table.
Right. Prashant, when it comes to India's options, if there were sanctions, for example, Donald Trump is saying that there could be 500% tariffs on countries which buy Russian energy, countries like India and China. If that were to happen, would India have to stop imports from Russia altogether, or it can bring it down to, say, something like 10 to 15% or 20% and increase imports from countries like United States, Middle East, West Africa?
Yeah, so see, if there is a very definitive big sanction tariff, then possibly India could reduce the proportion of the Russian crude. But what is also pertinent to note is that in case the Russian crude is, entirely priced out of the market because of sanctions or whatever reason, that accounts for about 7% of the global crude and petroleum products consumption. So where will the prices go? So that is the other factor. But yeah, in case we decide as a country to cut down the crude, there are several other options as well.
There are other options as well. If I can get you in, Gaurav, once again. Now, India has been diversifying its crude import basket. Overall, what kind of pressure would India be in terms of Russian crude oil being wiped out from the market, India not being allowed to buy Russian oil altogether?
If you look at the last 10 years or 15 years or 20 years average, we bought enough crude from so many countries. The percentage of crude sometimes has gone much higher from West Asia, sometimes from South America, even Africa. So it's not that, we've not been in these kind of situations. Even if one portion of the crude supplies get completely wiped out, if at all, there are enough options in the market for us to keep feeding in the crude requirements. Having said that, Parikshit, what I would like to bring to the table is that India still imports more than 80%. At some point, it even got to 85, 86% of the crude requirements. In doing that, we are still hitting a very large import bill. Having said that, the current government, Honorable Prime Minister, and even the MOPNG Minister are opening up the Indian markets for much more exploration and development activities for extracting oil from India's own oceans, whether it's the Bay of Bengal side or the Arabian Sea side. So I, in fact, see an opportunity which could be a win-win, where a number of the Indian Bay of Bengal areas have been opened up from no-go zones to open ENP zones, where there is opportunity for US and India to, in fact, collaborate to search and extract that oil, which may be beneficial for both markets. So this could actually be an opportune time to do both, not just thinking short term, that how do we diversify and take care of our immediate needs, but also to really extend hands with each other and do much more together.
Right. Prashant, if I were to ask you, now we've been learning from sources that India's crude oil and energy imports from US have more than doubled in FY26, and Indian companies are likely to increase their crude oil imports from the United States by 150% year on year in FY26. If we speak about this full fiscal, what do you think would be the value of our imports from the United States? You know, at the start of this year, Foreign Secretary Vikram Misri had said in February that India is likely to purchase $25 billion worth of oil and gas from the US. Would there be any estimate that you may have as to how we may finish the entire year in terms of our purchases from the US?
So yeah, certainly to reduce the budget deficit, to reduce the trade imbalance or the surplus that we enjoy with US, possibly one of the levers is to increase the energy purchases from them, including LNG and crude. I would not be able to pull out a number, but currently we are at about 6 to 8%, and that number can significantly increase. Additionally, a lot of our oil and gas companies are also looking at long-term LNG. And as we speak, US, there are about 6 to 7 projects that are coming up in the US. And US LNG being Henry Hub priced is quite attractive vis-a-vis the Brent-priced LNG these days. So a lot of our companies are seriously looking at LNG deals with the US companies also.
Right. What happens to the long-term contracts with Russian entities? If I were to put that question to Gaurav, what happens to that in the wake of sanctions? This month, we have seen a drop in imports from Russia, but it's still quite high in the range of 35 to 36%. Going forward, what will happen to the long-term contracts if by Friday Donald Trump does announce those secondary sanctions?
Actually, it's difficult to comment on long-term contracts which are one-on-one, government to government, or company to company on current basis. We'll have to get into details on evaluating what are the inbuilt penalties for such long-term contracts, or what are the flexibilities in providing volumes on such long-term contracts, immediate versus near future. So it may be a question of playing the balancing act on long-term contracts wherever applicable, but difficult to comment directly at the moment. Having said that, Parishit, what I would add is that this mutual win-win, which even Prashant spoke about, is generally possible in the energy sector for US and India. I spoke about the ENP aspect already. Prashant spoke about the gas, the LNG aspect. There is also the third aspect around renewables, electric vehicles, exchange of technology, and market access to all of that. And there is a fourth angle as well, where India is growing in terms of its need for data centers and data available within our national sovereignty. Number of US technology majors are buying that market into India. So I think there are multiple options on the table if we look at it as an energy win-win versus just oil in particular. There is enough to play around with.
Right. Thank you very much, Gaurav, Moda and Prashant, for joining us. So clearly an uncertain situation, but the answer would be diversification of crude imports, which India would be doing over the next few months. So we will have more long-term contracts with the US, but that doesn't mean the US can be the only supplier. We will have to ramp up significantly with the Middle East, from West Africa and other nations as well. We're taking a short break, but coming up, Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. A special conversation with Pham San Chao, CEO of VinFast Asia, on the company's India plan. Stay tuned. Welcome back. You are watching News Center. Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. The company's first overseas plant is expected to generate over 3,500 jobs in the next 5 years. It is part of a 16,000 crore rupee investment pact inked between VinFast and the Tamil Nadu government. I caught up with Pham San Chao, CEO of VinFast Asia, and began by asking him about the company's investment commitment in Tamil Nadu.
We have a long-term commitment to invest in Tamil Nadu. We made a commitment during the summit, investment summit in Tamil Nadu last year, and our commitment is 16,000 crore. For the first stage is 4,000 crore in Tamil Nadu, and we have spent nearly half of that on this factory in order to make it happen today. So this is the first stage of our plan with 50,000 capacity per annum, and we are going to scale it to 150,000 car eventually, depending on the response for the market. But we are very optimistic about that.
Right. Now you've got the VF7. Yeah, you've got the VF7 and VF6 coming up, and they will be manufactured at this facility. When does the commercial rollout begin? You've been inaugurating showrooms across the country. When does the sales officially begin?
Actually, I have opened a few showrooms in Surat, in Chennai, and eventually in other big cities like Cochin, Hyderabad, Bangalore, Kolkata, Delhi, Mumbai, Gurgaon, and we are going to launch the car eventually in few days, in which we are going to announce the features of the car and we announce the price. Then after that, we already opened online pre-booking. We have very impressive reservation, and after we announce the price, we start delivering the car to our dealers. Our customers, because next week we start delivering the car to our dealers already.
Right. So next week you start deliveries to dealers. When can the customers expect it by?
So basically, the customer can receive the car end of this month or beginning of next month. So this is very positive. Now we are working with the state. We have received already the CMVR homologation certificate from RI. We have RI representative coming to attend the event today, and he hand over the certificate for me. And now next step, we work with the state level in order to get another certificate at the state level. So we deliver the cars to customers.
Right. Could you also give us a sense of how many showrooms do you target in terms of launches in India? How many showrooms by the end of this year and end of next year?
So we have signed agreement with 13 group of showrooms, and we are going to open 35 showrooms in 27 cities. At the moment, more applications are coming in. Many potential dealers are calling us to express their interest. So in this month, we are going to open a few dozens more. And until the end of the year, we hope we have 35 showrooms in 27 cities. And after that, we will scale up more.
Okay. I would also like to ask you whether the company is looking to take advantage of the scheme for promotion of manufacturing electric cars in India. That portal has opened up. Are you looking to apply to avail of some concessions through the scheme?
It depends on the schemes. For the old schemes, which I don't remember the name of the scheme, but the scheme that we have been working for quite 1 year with the Ministry of Industry is no longer available to us. That scheme is going to apply only for any OEM which have not made any investment in India, which don't have the factory in India. We, VinFast, have already the factory in India. We start rolling out our first Indian-made car, and we start delivering the car already. So it's no longer available for us. But other scheme, we are ready to look into that and ready to apply for the incentive from the federal government.
Right. But how do you see the electric vehicle ecosystem in India, the regulatory ecosystem? What would be your ask of the government?
So basically, we asked the government that now over the past 1 year, the two sides have been in discussions, and now you came up with a scheme, but the scheme is no longer available for VinFast because we already opened our factory and we roll out already. So we also put a request to the government of the central government to allow us to import 2,000 cars for taxi, which is under the new reduced basic import duties as an incentive for us, because the car that we are going to import for our GSM operation is not the model that we are going to produce in Tuticorin yet. So that kind of scheme or incentive, we are requesting the government for the time being.
Okay, my final question to you would be, how do you see the competition in the India market from domestic EV players and also Tesla, which has now entered officially?
We believe that India is a very potential market. It's a growing market, emerging market. That's why it is a strategic market for us now. Therefore, we decided to move here very massively. That's why we have been able to build this factory within a span of 15 months. Within the 15 months. That's why we continue to do the same thing in the future.
All right, let's move on and get you some news from the telecom sector. Bharti Airtel's digital arm, Xtelify, has launched a new sovereign cloud service platform and an artificial intelligence-driven software suite for telecom players in the country. Ashmit Kumar caught up with the company's MD, Gopal Vittal, and began by asking him about Xtelify's new offering to customers.
So Xtelify is a 100% subsidiary, and it has all our 3,000 engineers work in Xtelify. All our digital applications are part of Xtelify. All our investments are now housed there, and we run one of the largest instances of our cloud, which has over 250 petabytes of data stored. Everything that we run runs off the cloud. We're extending the cloud because it's a telco-grade cloud. It's reliable. We also believe there's a need in the market for lowering the cost of ownership. We have heard that from many CIOs who have that as a pain point. And so we're now extending this cloud to them. In addition, we've been using a bunch of software platforms which we developed. They're homegrown software platforms for our own business needs, which deliver us improvement in business outcomes. We've also extended those software platforms to other companies in the world. We've already won 2 contracts, one with Singtel and the other with Globe. Of course, Airtel Africa, Indus Towers, the bank, our bank, all of them are already taking these platforms.
From a sectoral outlook, I know you're not sharing specific names of companies that you're in conversation with. From a sectoral outlook, which are the companies that you think can stand to benefit that you can partner with going forward on the cloud under Xtelify?
On the cloud, anyone who is looking to move to the cloud, or anyone who's looking to save some costs on the cloud, anyone who's looking to actually have a more sovereign cloud where the control plane resides in India, which is DPDPA compliant and is regulated, all of them would be target.
From your conversations, any particular sectors that you're focusing on? You mentioned banking.
At this point, we're talking to all. So the way we look at our business, we look at banking and financial services, we look at manufacturing and distribution, we look at technology companies, and then we've got the small and medium businesses. We're talking to everyone. Within this, there are about 50, 60 customers who've expressed great interest. So I can't announce it because they haven't given us a contract. So it won't be fair on them more than anything else.
Just one final question. This is clearly a commercial venture.
Yeah.
You're not sharing numbers right now, but from a slightly mid to longer term perspective, what is the kind of revenue split that you'll want to look at between the telecom business and the cloud business?
Yeah, I think that would be premature of me to answer. But I will say this. This is a large investment we made. This is a very credible and meaningful initiative for us, And if we don't make this work well, then obviously we'll be disappointed. So hopefully, a few years down the line, this should be a sizable revenue stream that we generate.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC-TV18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chenoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to, and hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest of the world is going to be beset with more disinflation. Think of a dam where the US puts on a tariff wall. It's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers, but the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think Lata, just to take it a little bit forward with the Sajid's argument, yes, the growth has been weak, and continuing the same vein what Sajid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number. But that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum, if you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better possibly in the first quarter, maybe a little more in the next 3 months, but the second half is actually going to be diametrically divergent. So in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half would be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth given the way things have been unfolding.
Okay, so even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Lata, I think the balance of risk, both to growth and inflation projections of the RBI are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the
the kind of summer decline in inflation has been much more than what was anticipated before. And the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9-12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad-based across cereals, as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, we'll probably reach somewhere around 4.5 inflation for the Jan-March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan-March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be, and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
Well, this is the thing. The point that Sajid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that, do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
Okay. Well, I'll want more opinions on that. Let me take a quick break. We are back with more questions, also questions on liquidity and where the Reserve Bank should keep the call rate. Back in a jiffy. Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy Committee. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much for your time and for your patience. Before going to break, I asked Dr. Sen about the timing. Let me get another opinion on that. Soumya, what's your sense? Would it be better to give it earlier because you will be in time for the festive season? Or would it be better to postpone because there will be more pressure on the governor in October? The Fed may have cut. The July number looks like, it will be 1% or something inflation. There'll be more pressure on him. So is it better to push it to October?
Yeah. Thank you, Lata. I think that's a very interesting point. In fact, our July inflation numbers are also closer to around 1.2 to 1.3%. It could be even lower. And the full year average is now tracking at 100 basis points lower than the RBI projection. Having said that, I think we need to understand that ultimately, given the inflation trajectory and given that the RBI is an inflation targeting central bank, it may have to adjust the rates in a downward direction if the forthcoming inflation numbers are an indication. But the question is that how do you time it, whether it is in August or in October? I think in my sense, a rate cut earlier than what would have happened in October could make some sense, because in every way, if you look into the data right now, all data seems to be front-loaded. If you look at the global growth numbers, they are front-loaded in terms of a better number, but they are not going to deteriorate going further. Indian growth numbers will be a story of two halves, good, better now, but it may not be better in the future. Even on the inflation numbers, I think if for the assumptions in the market, the concern in the market is that the inflation numbers over the point of time, maybe over the next year, could actually inch up a little bit. But there is also uncertainty over here, and the new base, which will be launched next year, could actually impart a downward bias, because if the food weightage comes down and the e-commerce gets included, there is every possibility that it could be a downward adjustment in the revised inflation numbers. And also the fact that, on a lighter note, the festival season is also being front-loaded this year. It's in October rather than in November, as it happens every year. And as we have seen in the past, in 2017 also, when the festive season was earlier, there was a significant bump up in the personal loans. So, and in sense that if you cut right now, there will be a scope for the banks to adjust the rates in the downward direction, and that could actually give ample time for transmission. So from every perspective, if all data seems to be front-loaded, either good or bad, and if the central bank may not take the decision to cut rates now, there is a larger probability of committing a type 2 error, which means that even if inflation continues to undershoot, you are not taking the action, because every policy we have seen that the inflation is undershooting this year, beginning from February. So if that continues, I think we may actually make a type 2 error if we are not cutting now, rather than wait for the later to cut when the numbers are out.
Okay, there is another fear which may be prying on the Reserve Bank's mind, because it's an institution with a lot of history. They've already given a lot of liquidity and a lot of cuts. So, Dr. Sen, can that worry prey on their head? That if I've given so much and it will work its way over the next year, then at a time when inflation will be at 4.5%, you're going to have all this liquidity act, and inflation actually turns out higher. Like you remember in 2010 to 2014, everything worked towards double-digit inflation, probably because you front-loaded too much. What's your sense? Can that be a fear?
There are two things. That can certainly be a fear. The point is, as we talked about, core inflation has been sticky for 2 years, or longer actually. That's not been changing. Right? So all the variations that you get are in those components of the CPI, which are inherently transient in nature. Now, the real question is that it's not just what the RBI feels may happen in a forward-looking sense a year from today. It's also important for the RBI to be seen to be doing something when the objective conditions of the world change. Now, my problem is that if we actually front load and then something goes off the cliff later, then we may not have any other arrows in the quiver.
Got it.
Right? The RBI will look toothless.
Okay.
And it's the image of the RBI which the RBI can and will, I think, try to protect.
Okay. Fine. Yeah, they should be seen to be doing something if things look very bad in September and they need that ammunition. Samiran, let me come to liquidity, the elephant in the room. Do you expect Reserve Bank to keep call rates at the lower bound? That is, if the rate is 5/4, suppose it's a pause, then will they keep it at 5/4? And if they do cut, will they keep call at 5%?
View, since RBI has now changed the stance from accommodative to neutral, it will be more consistent if in the neutral stance, the sanctity of the monetary policy operating procedure is maintained and the weighted average call rate is kept closer to the repo rate rather than closer to the SDF. Now, one way to get around this is to do the rate cut we have been talking about, that if you do the rate cut, then effectively the weighted average call rate falls down to 5/4 rather than staying at 5/2. So rather than doing this somewhat stealth method of keeping the rate 25 basis point lower than repo through liquidity operations, it's probably at this juncture in a neutral stance, better do an explicit rate cut and keep the overnight rate at 5/4 is what our view will be. Anyway, we'll all be looking forward to that new liquidity management framework suggestions to figure out whether there is any significant change to the current operating procedure that has been suggested.
Okay. Well, actually, on liquidity, some more opinion from you. Sajid, do you think continued higher liquidity will be needed to help credit offtake?
There'll be a temptation for that, Lata, because there's somehow this belief in the market that when you inject a lot of durable liquidity and banks are lending to the RBI, every day, whether it's the VRRR or in the STF, that somehow behaviorally that induces banks to boost credit growth, to lower deposit rates, cut lending rates, and boost credit growth. So
because it's a loss, that's a fair expectation.
Yes.
It's a loss when you put it to Reserve Bank. You might as well give it to an NBFC.
It's a fair expectation. The question is, does it stand the scrutiny of data? And so we looked at this, very exhaustively for the last 10 years. And what we find is that, theoretically, there should be two channels at which liquidity impacts credit growth. One is the interest rate channel. And Shamiran alluded to that when you inject a lot of liquidity, you push the call money rate down to the bottom of the corridor, and that will clearly have some impact on lending rates. And I agree with Shamiran, while that's tempting to say, let me do some stealth easing, in the wake of so much global uncertainty. If your stance is neutral and there has to be sanctity to that rate, you need to move that rate back to the policy rate. The question, therefore, is, well, what if I add more durable liquidity, keep call rates at the policy rate? Will the injection of more durable liquidity, increase credit growth? And what we find is there is no evidence for that. Okay. It's called the credit transmission channel. We find no evidence that beyond affecting the call rate, higher quantums of durable liquidity either boost deposit growth or boost lending growth. So I think the incremental efficacy of that is extremely limited.
Okay. Well, let's see. Even in the last cycle, the one I remember, 2004, it was only after the rates started rising that credit offtake went through the roof. But situations are very
lending
different.
Rates and credit growth.
Yeah. So, out of time, but very quickly, will the rupee be a worry at all? I mean, we've suddenly seen the impact of the trade issues on the rupee. Will Reserve Bank worry we can't cut too much, rupee under tension?
Should not be, Lata. I think obviously we need to wait for what this Russian penalty is and what that ultimately means. So that's something to monitor going forward. We have sufficient FX reserves to manage volatility. And importantly, inflation is below target. So any sort of imported inflationary pass-through will more than be offset by the disinflation we are seeing on food and core, such that overall inflation will still undershoot not just 4%, but the new projections and potentially actually undershoot 2%. So should not be a constraint in our view.
Oh, okay. Well, thanks a lot for many-sided discussion. Please take up your voting pads. The first question that you have to vote on, what will the MPC do to the repo rate on August 6th? Can I start with Samiran?
We are expecting a 25 basis point repo rate cut in the August meeting.
Okay, cut. Soumya?
We are expecting a 25 basis point cut.
Oh, that's two cuts. Sonal?
We think the MPC will hold rates this time, but a dovish hold.
Okay. Hold or a pause. Sajid, pause or cut?
It will be a pause.
Okay. Dr. Sen, your team is divided 2-2. Which way do you tilt?
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying. Finally, if you include an action on August 6th, how many rate cuts do you see in 2025? Samiran?
Only 25 basis point.
Okay. One cut only, that which you're expecting on August 6th. Soumya?
We are also looking at one more cut, 25.
To safeguard national interests and economic security. Let's listen in to Trump speaking to CNBC, accusing India of fueling the Russian war machine.
With India, what people don't like to say about India, they're the highest tariff nation. They have the highest tariff of anybody. We do very, very little business with India because their tariffs are so high. So India has not been a good trading partner because they do a lot of business with us, but we don't do business with them. So we settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine, and if they're going to do that, then I'm not going to be happy. But India went from the highest tariffs ever. They will give us 0 tariffs, and they're going to let us go in. But that's not good enough because of what they're doing with oil.
All right, we're now joined by Anup Vadhavan, former Commerce Secretary, and also Jayan Dasgupta, former Indian envoy to the WTO. Mr. Vadhavan, if I can come to you, what's your worry here with Donald Trump now saying that he's going to substantially increase tariffs on India in the next 24 hours?
Yeah, so it's a very, partial and unfair view. India is not the only country which has a economic relationship with Russia for very, very substantive reasons. European Union today is buying, even today, 20% of its gas is coming from EU. America itself is trading with Russia. They buy billions of dollars worth of fertilizer and other products. And, India also has a long-standing relationship with Russia. We are a developing country. There are various, well-understood economic stresses we face. So, buying Russian oil, which is economically prudent for us to do, is nothing so untoward or, exceptional. If you see even European Union, they brought down their purchases of gas from Russia, but still it is very high even today, and they'll reduce them at their own terms. So India will also, shape its economic ties on its own terms at a desired pace. So I think it's a very unfair assessment to make. And then, what about China?
Mr. Vadhavan, I would also like to ask you, there is a common perception that that we have in US policy circles, that Donald Trump also keeps saying that India is the highest tariff country, it is the tariff king. We are not the world's most protectionist economy. We have been opening up. If you had to set this record straight, where does India stand where it compares to other economies in the region and in the world who trade with the United States?
I think bulk of our tariffs are very moderate. They are between 3% and 10-15%. There are some products where the tariff protection is high for well-known reasons. Look at agriculture, for instance, dairy. We have a huge low-income population dependent on agriculture, dependent on, dairy. So we logically, like most developing countries, have a tariff protection there. And then you have to look at the other side of the picture. The US and the EU, their agricultural subsidies and dairy subsidies are to the tune of $1 billion a day each. And for many products, the American subsidies for their agriculture are more than the value of production of that crop. For instance, soybean, tobacco, highly subsidized. So you can't expect India to bring its tariffs down to 0 and compete against huge Western subsidies and expose a very vulnerable low-income population to all that pressure. So there are some, instances of high tariffs for well-known reasons. And, this whole thing of a trade deficit viewed very partially in terms of goods is again very illogical. There's a study recently you must have seen by GTRI, Global Trade Research Institute, where they've done a comprehensive assessment of our economic relations, which includes services, all these, companies like Google, Facebook, etc. And there, the finding is that there's a $30-40 billion US trade surplus with us, if you include services. If you include the billions of dollars Indian students are spending in the US, which is basically purchase of, educational services. And then the surplus goes up even higher. So even on that metric, it is not a fair assessment to, say we have a huge trade deficit with India, which is unfair. If you comprehensively view the economic relationship, then certainly there's a surplus in favor of Russia. And then what about, defense procurement and all our efforts to buy American, petroleum also, which might not be, in our economic interest in a real sense. It's at a distance and we have cheaper options. So I think it's a very, very partial and unfair assessment. And I was mentioning, case of China. If you see China's relationship with Russia, it is many-fold of the Indian economic relationship with Russia. If you're talking about BRICS being a sensitive issue, then, China is a major part of BRICS. So I don't understand there again the contradiction in, his response to China and his sort of, treatment of India on these issues. So it's beyond, any sense and understanding that I can sort of reach. And the only silver lining is that ultimately it's going to harm American interest. You see, by having a misplaced view about America being exploited, you will actually undo a huge success story. It's a huge success story which goes far beyond goods. He's obsessed with goods and trade deficit. The success story, American success story, goes far beyond that, and he'll undo that. We already have seen in the recent past the bond yields going up, and you will see there's talk of EU putting taxes on their services companies, Canada putting taxes on...
Mr. Madhavan, I'm going to come back to you. I'd just like to look at some key sectors such as electronics and technology, dairy and agriculture products, chemicals and pharmaceuticals, and how India treats the US compared to other countries in the region. Mr. Dasgupta, when it comes to electronics and technology, dairy and agriculture, chemicals and pharmaceuticals, how does India's tariffs compare with Vietnam, for that matter, China, Indonesia? You have Trump saying that India is a very high tariff jurisdiction. We do a lot of business with them. They don't do any business with us. Is this assessment too simple, too simplistic, and lacking facts, according to you?
Yes, absolutely. As far as pharma is concerned, we are also large importers of the active pharmaceutical ingredients, which we buy mainly from China. And for that, tariffs are very low. They are less than 10%. And a lot of it, which is meant for export production, of course, comes at even lower rates. As far as electronics is concerned, one has to look at the Information Technology Agreement signed in 1997, of which India, US, all are part of. And under that, the tariffs are at zero. So, if electronics is taken up as a whole, most of the items which are traded, not all, are already under ITA 1 agreement at zero duty for India. As far as chemicals are concerned, India is a large importer of chemicals, also of fertilizers, which is an allied industry. And you will see that the tariff rates for chemicals and fertilizers taken together is much below 10%. In fact, a recent survey has shown that if you take the average weighted mean of imports into India from the US, the tariff is only about 5.5%. And for Indian products going into the US, the average weighted mean is about 3.5%. So the difference isn't very wide. as far as the argument goes about a trade deficit, I can only name two countries which have a trade deficit vis-a-vis the US. One is the UK, which has been slapped with 10% tariffs. The other is Brazil, which also has been slapped with 50% tariffs. So I don't think really any logic is being followed by saying that, just because there is a trade deficit in terms of trade in goods only, that, India is going to get slapped with tariffs. As far as Russian oil is concerned, there are two other major buyers of Russian oil. One is, of course, China, against which no threat has been issued hitherto of extra penalties or tariffs. The other one is Turkey, and nothing is being heard about Turkey either. The third one, which also buys oil in much lesser quantities, of course, is Brazil. But Brazil already, 50% tariff, so I will not speak about that. The US itself buys low enriched uranium, palladium, fertilizers, still from Russia. Is it not really helping the war effort if we were to take the logic of the US administration in this matter? By trading with the...
when it comes to tariff rates in comparison with other developing countries, India's tariffs are in line, some with global peers, including Bangladesh, which is 14.1%, Argentina 13.4%, Turkey 16.2%, which are all countries with comparable or higher GDP per capita, maintaining similar or higher tariffs. Mr. Dasgupta, why do you think, considering the tariff situation in the region and how India's tariffs are not spectacularly higher or much higher compared to other countries in the region, why is Donald Trump going after India in this manner?
I think one of the major reasons is the large market that India has. Compared to the buying capacity of Bangladesh or its population or GDP, India has a much greater potential. So if, any effort can price open the Indian market, especially at zero tariffs or near zero tariffs, it would be a big thing. That is what the expectation is. But one of the caveats in that is the fact that in the 12,000 odd tariff lines at the 8-digit level, which are traded around the world in goods, the US doesn't have a significant presence in about 10,000 tariff lines. So even if India were to offer zero duty or near zero duty access on those 10,000 tariff lines, the US will not stand to gain very much. So I think the US administration needs to have a very rational approach. And of course, threatening India with additional tariffs within the next 24 hours, another dose of tariffs, is neither here nor there.
All right.
Yeah.
Okay, Ambassador Dasgupta, thank you so much for joining us. We'd like to thank Ambassador Mr. Anup Wadhawan as well to join us with that input on Donald Trump saying that he's going to impose substantially high tariffs in the next 24 hours. We're taking a short break, but don't go anywhere. News continues on the other side.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me, as always, Shruti Mishra. These are the top headlines from the startup world. Fibe's NBFC entity Early Salary has raised 225 crore rupees through non-convertible debentures issuance with a face value of 1 lakh rupees each. The funds raised will further accelerate the company's innovation-led growth and strengthen its lending operations.
Deep tech startup Eon Space Labs has raised $1.2 million in pre-Series A funding round from MGF Kavach and HHV Group. The funds will support the launch of Mira, a high-res space telescope, and 4 new Lumira EOIR imaging systems designed for dual-use surveillance and disaster response.
EdTech firm Lead Group has clocked an ARR of 415 crore rupees for FY25 to FY26, marking a 30% year-on-year growth. Lead also closed FY25 with 367 crore rupees in revenue and achieved operating EBITDA break-even.
SoftBank Group is building up stakes in NVIDIA and Taiwan semiconductor manufacturing. The Japanese technology investor raised its stake in NVIDIA to about $3 billion by the end of March, up from $1 billion in the prior quarter, according to regulatory filings.
Amazon is restructuring the Wondery podcast studio by shifting its award-winning narrative podcasts such as Business Wars to Audible and consolidating creator-led shows into a new unit. According to a memo seen by Reuters, about 110 employees will be laid off as part of the process, and many will transition to other parts of Amazon. Those were the headlines that we're tracking for you this evening. But on what's brewing today, Sun Mobility, the Bengaluru-based battery swapping pioneer, has just secured a major funding boost led by Helios Climate to roll out Africa's largest battery swapping network. Backed by investors like Indian Oil, Bosch and Vitol, the company is bringing its proven high-speed modular technology to emerging markets, starting with Africa, while continuing to scale at home. So what's next for Sun Mobility, and how will it use the funds that it's raised in the $135 million war chest? Joining me now to discuss this further is Chetan Maini, the co-founder and chairman at Sun Mobility. Chetan, thank you so much for taking time out and being here with us on Startup Street. You know, you've raised the $60 million, which totals $135 million that you've raised this year alone. How does Sun Mobility plan to allocate this capital, and what portion is earmarked specifically for its Africa expansion versus, domestic scaling?
So, India continues to be the largest micromobility market in the world. So clearly, India is our base. And through our joint venture with Indian Oil, Indofast, a lot of our investment is going to further strengthen our foothold in India, where we're looking at growing in the next year around 2.5 times to where we are right now. Coupled with that, the solution today is now ready for global markets. So a portion of these investments, are going to go into Africa and Southeast Asia. We're starting with Kenya and the Philippines as these initial markets on this front. And the third part is that we see the HEV business of trucks and buses also growing significantly. And we've been doing a lot of research and development in this space, and we're going to launch solutions next year from all the way from 3 tons to 55 tons. So the investments are to help build up our capacity for manufacturing, help expand into these markets domestically and globally, and into new products like buses and trucks that we need to build a strong portfolio across swapping systems for not just domestically, but also globally.
Sure. So, take us through, Sun Mobility's current presence. What are the countries that are doing well for you? How do you also plan to scale this presence further? And like you pointed out, a lot of this money will go to scale your battery swapping network across Africa, right? So what are the kind of partnerships that will be key to this execution out there?
So in India, we're today, in 23 cities, we have around 1,000 stations. Now in Africa, we're starting with Kenya. And like we have a partnership with Indian Oil, we are also partnering with large energy companies in Africa and in Southeast Asia. We feel that these energy companies have a lot of good forecourt, have a lot of presence in these markets, and enable us to scale much quicker with both having access to real estate as well as capital as we think through these markets. So in markets like Africa, the Bora Bora taxis, which are these bike taxis, constitute almost 80 to 90% of all motorcycles sold in these countries. and they do over 200 kilometers a day, and swapping is an obvious choice where consumers can actually reduce their cost by 20 to 30%, and also, reduce their emissions. So it's really, a really strong market for us with the core technology that we've developed.
Sure. And like you just pointed out, you already have about 1,000 plus stations across India. With over 1.4 million monthly swaps already happening out here, how critical is the Indian market as a testing ground and innovation hub for Sun Mobility's global expansion?
So all our, most of our R&D is based here. We have over 200 people in research and development. So we develop our own batteries, our stations, our BMSs. We manufacture our batteries and stations in-house. All the software platform, from onboarding customers to billing to managing an entire network, is done at Sun Mobility. So we're a very strong tech platform, which we are now tweaking for these global markets, right? Payment gateways are different, certain nuances are different, different markets, but the core platform, the core batteries, the core stations remain the same. And the products they go into, a lot of Indian OEMs today already operate in these markets. And so we're now able to take some of these OEMs to these newer markets that we're going into, which also enables us to get more products on the platform, specifically in Africa and Southeast Asia.
Sure. And, what about revenues? What are you currently clocking? Where do you hope to end this year? Also, how are you sort of monetizing your battery swapping infrastructure across Africa and Southeast Asia? And what revenue streams are expected to drive long-term growth?
So clearly, Sun Mobility, in a way, sells its batteries and stations to its joint venture in India, to Indofast, right? So there's a revenue stream from sale of batteries and stations. And the fact that we have a joint venture partner, which is 50-50 with IOCL. There's revenues from the swapping of batteries, which is either a pay-as-you-go model or a subscription model on this front. So these are sort of the main revenue streams. We replicate these in global geographies, but also with our local partners, there are other revenue streams like royalties for using the entire platform that come in on this front. And over a period of time, the fact that we have a lot of data, we're able to monetize the data through other areas of fleet operation, insurance, and other aspects. So this sort of is a, it's a very unique area where it's an energy business with a data structure on it that allows us to have newer forms of monetization in addition to what we think of the core energy as a service business.
So what do you think makes Sun Mobility's battery swapping model a better fit for emerging markets versus, traditional EV charging infrastructures? So,
if you look at it, the cost of when you remove the battery from the vehicle, the cost of the vehicle goes down by around 40%, right? So clearly the cost of vehicle is cheaper than internal combustion engine vehicle. And people have no more concerns about refueling time, range anxiety, what happens to your battery over a period of time, how does it deteriorate? It's battery as a service. So it removes all those fears where people almost have infinite range. They take the batteries and swap it in less than a minute, and they're off and going. So this has sort of been the driver. Also, as the number of volumes increase in a city, infrastructure becomes a challenge, right? Where do you charge your vehicles, especially after you increase, 20 to 30% of adoption in a particular city? And these stations are located very conveniently. In many cities, we have them within 1 or 2 kilometers of each other. And so it really allows consumers to adopt and go electric without having any of these concerns at a much lower cost structure.
Absolutely. All right, Chetan, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on this journey going forward.
Thank you so much.
Well, moving now to our hot seat segment. What if AI agents could actually learn on the job, just like humans? That's the big bet Soham Ganatra is making with his startup Composio, which recently raised $29 million in Series A funding, led by Lightspeed Venture Partners, backed by some of the biggest names in tech, from HubSpot's Dharmesh Shah to Vercel's Guillermo Rock. Composio claims it is building the infrastructure that allows AI agents to improve through experience, not just better prompts. Already powering over 200 companies, the platform enables shared learning across agents, turning static tools into adaptive AI systems. To break down how they are doing it, joining me now is Soham Ganatra, the co-founder and CEO of Composio. Soham, welcome to Startup Street. You've said AI agents aren't stuck because of enterprise resistance, but because they can't actually learn from experience, and Composio enables AI agents to build intuition. Now, that's a bold promise. First, Soham, if you could elaborate on the core limitation here and how is Composio solving it? Walk us through how your reinforcement learning layer works in practice.
So thanks a lot for having me. Appreciate you sort of inviting me here. So if you think about it today, AI agents are like an employee that joins on the first day and always remains on the first day, right? So if a new person joins our organization on the first day, they're like learning the ropes of how things work. But like by the 30th day, they've figured it out and they already know all the processes. They've like accumulated a bunch of knowledge around your how your organization works, and eventually sort of they're able to accomplish tasks. Today, AI agents don't learn anything over time. So they basically, the way they operate is that they are still making the same mistakes on the 30th day, on the 300th day, and maybe on the 3000th day, right? And we are trying to solve that by making them learn so that like they can actually improve and they can be more valuable as time passes on. Yeah.
Okay, so Soham, you're basically building what you call the missing infrastructure for AI. Now, beyond prompt tuning or workflow integration, you're enabling shared learning between agents. Now, what does that really mean and how does it work under the hood? Give us a real-world example of how a developer benefits from using Composio instead of starting from scratch.
So if you think about it today, like every time a developer tries creating an AI agent and like taking it to production, what they realize is that, oh, you know what? I'm dealing with like a bunch of authentication issues. I'm dealing with a bunch of sort of edge cases because Salesforce API doesn't really talk about the specific parameter that now I'm supposed to deal with it, right? Oh, maybe there's a rate limit issue here, and like I only could call this API like X amount of times. And so they all face the same problem. They all solve the same problem. And like as the sort of agent like goes more and more in real world use cases, as you see more and more sort of production use cases, you figure out more and more of these problems over time. What we do is we build a shared sort of learning layer that allows all the agents, like whatever problem they're facing, to sort of accumulate the knowledge at a single place and then allow developers to sort of tap into it. So when they are building any agent out there, they are able to just go live without worrying about all of these issues, right? And so one example of this would be like maybe GitHub has a different enterprise APIs that you don't really know about. And like now that like you are tapping into the shared learning layer, you don't really need to know about it. You just like get the advantage of it directly.
All right. You already have over 100,000 developers on the platform. Tell us what's driving this adoption. Who are your early believers? And give us a sense of your current business growth numbers. What kind of revenue traction are you seeing at this stage?
Yeah, I think like the promise that we made, which was like, hey, you all will be facing this issue, kind of resonated with a lot of folks out there. We grew like really rapidly into 100,000 plus developers. We have like a lot of folks from YC, like very small startups, were just starting up, starting to use us, to some of the largest customers out there that you could think of in Fortune 100 companies already using us for their production use cases. We essentially have more than 200 plus companies out there that are paying us millions of requests like being sort of managed on a day-to-day basis. And I would say we are in 7 figures revenue. Yeah.
Okay.
Currently.
7 figures revenue. Okay. Give us a sense of what developers and companies are building with Composio today and what use cases are gaining the most momentum.
Yeah, I think like you of course start with like a very base set of use cases like let's say support request automation, right? So you have requests coming in from Zendesk, Slack, Jira, and like what you want to do is you want to figure out like how do I sort of take this and like automate a bunch of these things using Composio. Maybe you the second sort of very popular set of use cases are developer tooling, right? I want to build a sort of pull request review bot. I want to build something around sort of my sort of deployments, right, and managing them. All of those things you could do through Composio. Then we have like a lot of sales automation going through us. Yeah.
Sure. Soham, tell us what's the bigger vision here? Is Composio laying the rails for a new class of self-improving AI software?
Yeah, I think we're trying to do that. right? The idea here is like instead of like static AI agents or static AI, the way you think about it, we essentially are trying to build like a sort of dynamically learning AI that keeps improving over time, that keeps understanding what are the mistakes it's making, and then basically adheres to whatever sort of the best process that you follow, the sort of the depending on like your liking, and like make sure that it gives you the best experience out there.
Okay.
Yeah.
Let's now talk about your Series A funding with this $29 million in the bag. What's the immediate roadmap? What are you prioritizing? Is it team, product, markets? And how do you plan to stay ahead of what's becoming an incredibly competitive space?
Yeah, I think like what we are focusing right now on first is improving sort of the infrastructure, because we are at the end of the day an infrastructure company and we need to scale up rapidly. So a lot of like focus as a team is going on that. The next focus is like building the skill coverage. Today, we already have 20,000 plus things that an AI agent that could do on top of Composer. We are rapidly expanding that and plan to get to like million skills out there. We're also working on reinforcement learning and essentially a lot of research around that, and like how do we sort of develop like sophisticated like learning sort of patterns and like understand them quickly. And like, of course, to do all of this, we are like hiring at a bunch of places across US and India, and a lot of like focus going towards that.
All right. And on that note, we'll have to wrap up our discussion. Many thanks, Soham, for joining us on Startup Street today, and wish you the very best for all your growth plans.
Thank you. Thanks a lot for having me.
With that, it's time for us to head into a short break. Coming up on the other side, Stan, the mobile-first social gaming platform, bags $8.5 million in fresh funding. We speak with Parth Chadda, the co-founder and CEO of Stan, on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Stan, the mobile-first social gaming platform, has bagged $8.5 million in fresh funding from a stellar lineup, including Google's AI Futures Fund, Nazara, and Japanese gaming giants like Bandai Namco and Square Enix. Built for Gen Z gamers and creators in mobile-first markets, Stan lets users build communities, monetize content, and turn gameplay into full-blown social experience. With over 25 million downloads and deep roots in Tier 2 and Tier 3 cities in India, Stan says it's only getting started and it's gunning to become the next billion-dollar social platform out of India. Joining me now to discuss this further is Parth Chadda, the co-founder and CEO of Stan. Also with me, my colleague Shruti. Parth, thank you so much for taking time out and being here with us on Startup Street. You know, what, according to you, makes Stan stand out in India's gaming and social media ecosystem? And how is it sort of different from, you know, global platforms like Discord or Twitch?
Thanks for having me here. I think that's a brilliant question. I get this question a lot, right? So, see, Stan is basically India's leading gaming platform, which is a lot social, right? So, gaming is all about interactions. People want to chat, they want to hang out. So, it's basically the ultimate hangout place for audience who love gaming, right? And it could be like casual games, it could be like competitive esports, it could be anything. And if you look at how the market in gaming has evolved in the last couple of years, we've seen a lot of PC wave, but mobile disruption has really, taken this 10x, right? If you look at Stan's growth as well, we've sought a lot for the mobile audience. I think the existing platforms which were there were really not making sense for the markets like India and other emerging markets. That's where we cracked, and there's something called as so Stan's biggest feature is the Stan Clubs. It's basically a chat room where these users hang out and they talk and they really build these true, connections. I always say that gaming is all about content, rewards, and companionship. Companionship is basically the fundamental stuff where it all begins. None of the existing platforms was really solving for the companionship. That's where we've really doubled down. And yeah, I think that's been the success driving force for us. And that has led to the organic growth.
Sure. Parth, this is Shruti quickly stepping in. You spoke about gaming really evolving in the last couple of years. So tell us, what does this $8.5 million fundraise signal about investor confidence in Stan? And how are you planning to deploy this capital? Will it be across product markets, partnerships?
Yeah, thanks, Shruti. So, I mean, this fundraise is definitely going to help us scale further. Like I said, we've just scratched the surface. India itself is about 550 million gamers. We've just reached like 25 million users. So with the fresh funding, and that's definitely like coming from some of the big names like Google and some of the top gaming corporates like Bandai Namco and others, we have now the next 18 months to us to scale this, expand our footprint in India, and also test the waters with other mobile-facing markets, which are showing similar trends around gaming, be it in creator economy space or just social stuff around gaming. So that's where we're going to be using our funds. And I think one important aspect is to build around product is we're leveraging a lot of AI. That's where Google AI Futures Fund is definitely, come in, and leveraging artificial intelligence to help creators produce content, make it safer space for people to hang out, get good suggestions around, building friendships. I think that's something which we are going to be doubling down in the next couple of months.
All right. And, with over 25 million downloads, right, how is Stan sort of capturing this Tier 2 and Tier 3 market in India? What kind of behaviors are emerging from these non-metro gaming communities?
That's a lovely question. I think I can tell you we were messing up in the first year. We were just building for the Tier 1 crowd, right? But if you look at gaming, it's all about masses. Like, people are making friendships around gaming. So it has to be supportive on low-end devices. It has to support even on 3G, 4G internet. Like, Stan works phenomenally well in a 4GB phone as well, right? So what kind of trends we saw was some of the big games, like, your shooter games, which are very popular, the social games, which are very popular in India, are loved by even the Tier 2, Tier 3, cities of India, right? Metro cities, definitely people have that mindset that there is a high ARPU, ARPU, which we see, but every Tier 2, Tier 3 city has a Tier 1 inside. But if you want to capture the masses, you got to make your product really accustomed to the audience, and that's what we've been building on. And it's very vernacular as well. Like we see a lot of people talking and chatting in different languages on the Stan platform. So I think these are some of the insights and trends which we've been noticing and just building around it.
Let's take us through the kind of revenues you're clocking currently and where do you hope to end this year with, and how is Stan really helping creators monetize their fan base? Tell us what kind of revenue streams are gaining traction on the platform.
Sure. So on the platform, we have two revenue streams today. One is like user spending for social economy. Like when you come on the platform, either you come through your friends or through your favorite creator. So if you want to play with them, hang out with them, socialize with them, you actually go through a currency called Stan Club Passes. You can relate it with those social cafes and arenas where you used to go in gaming world, and you can enter there for free. And then when you feel like playing, you recharge your card and then you go ahead and spend. Something similar happens on Stan in terms of users. They come and top up these in-app purchase, and then they spend across clubs. That's like the lion's share of our revenues today. The other interesting revenue source, which we have seen growing really aggressively, is a lot of game publishers and brands are spending money with us. I mean, we have about 25 million plus users, and we have 1 million plus influencers, creators building their world on Stan. Like you asked me, right? Like, how are these people able to monetize? So when a user comes in the app and the creator is making them hang out, they spend, and the creators make money out of it. And the game publishers and brands, they tend to spend to get distribution. So they get access to a large crowd. That's something which is like an interesting revenue source. And that's why you see a lot of these game publishers, like these Japanese publishers from US market, they're coming and partnering with us as well.
All right, Parth, thank you so much for taking us through those details, but we're completely out of time on this edition of Startup Street. So thank you so much for joining us on the show.
Thank you.
Well, with that, it's a wrap from Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story this evening: the Trump administration has ramped up its criticism of India's purchase of Russian oil in what is Washington's strongest criticism so far. The White House's Deputy Chief of Staff Stephen Miller accused India of effectively financing Russia's war in Ukraine. The senior Trump aide said that US President felt that New Delhi's actions were unacceptable. In fact, US President Donald Trump has continued to threaten to impose secondary sanctions on buyers of Russian oil. A decision on the matter is expected on Friday. If US does impose sanctions, India's oil import bill could rise by $9 to $11 billion per year. Remember, Russian crude oil accounted for 35% of India's total imports in the first half of 2025. However, India's crude oil imports from US are set to rise by over 150% in FY26. Sources telling CNBC-TV18 that imports in the first quarter of the fiscal already rose by 114%, with share of US crude in India's import basket rising from 3 to 8% in July alone. Furthermore, government sources maintain that India's purchase of Russian oil is critical to maintaining price stability, sources adding that India followed all international protocols while buying from Russia. Brent spiked on fears of Russian oil going off the market in 2022. Sources have said that India's increased oil imports from Russia stabilize prices. Let me go across to our guests at this point. We're now joined by Gaurav Moda, partner and head of the energy sector vertical at EY, and Prashant Vishisht, who is senior vice president of ICRA. Prashant, what would be your estimate on the spike in India's crude oil bill if we had to increase imports from the United States and reduce our reliance on Russian crude?
Parikshit, if we were to buy market price crude in place of the discounted Russian crude, our estimate is that the import bill would rise by less than 2%, because as it is now, the discounts are quite low, in just about $2.5 to $3 per barrel.
And Gaurav, your own estimate?
Parikshit, I think there are three aspects to take into account here before we come to a number. Aspect one is that India's crude imports are fairly diversified now. We import from South America, the US itself, as well as other geographies all over the world. So that diversified sources helps us balance our averages. Second, most important aspect also is that the crude prices last year were averaging $75 a barrel. They went down to $60. Now they're $65, $66. So it's not like the crude pricing has gone completely out of whack in the market. Third aspect also is that India has been preparing for these kind of situations, not just now, but over the past several years, where we've increased our domestic inventories of crude. All PSUs are doing that. And we have strategic reserves and caverns where we store. So the question is not necessarily how much will be the direct impact on India's buying pricing, but more in terms of how we can stabilize and manage the market.
Right. Now, let me ask you, what would be India's options, Prashant, if we had to stop import of Russian crude oil in case the United States imposes sanctions on Russia and imposes secondary sanctions on countries like India and China if they were to purchase Russian oil?
Right. So, see, the first thing that we need to remember is that prior to 2022, our imports the Russian crude were in any case quite low at less than 2%. We are also quite close to the Middle East or Gulf region, which is one of the biggest exporters of crude. So we are well served by that, by the crude that we can source from the Middle East. Besides that, there are several other options, US being one. Then there are a host of African countries, Algeria, Nigeria, and so on. So our crude basket has been fairly diversified, and we can obviously go back to some of these sources for replacing the Russian crude.
Right. And Gaurav, when it comes to getting a comparable oil bargain, currently the reason why we're buying from Russia, and this is right now, the Russian crude is the biggest in India's crude import basket. Would it be possible for us to get comparable prices anywhere in the world, be it Africa, be it West Africa or the Middle East?
Rishit, I would like to believe in the diktat that customer is always right. And India is the customer here. So this, in fact, is an opportunity for the selling countries to vie for more share of the Indian market if there is a replacement that's coming up. So I would anticipate that there could be further negotiations and bargain on the table for multiple countries to look at the Indian market. And as I said, we've been doing business with many of them. there are enough options on the table.
Right. Prashant, when it comes to India's options, if there were sanctions, for example, Donald Trump is saying that there could be 500% tariffs on countries which buy Russian energy, countries like India and China. If that were to happen, would India have to stop imports from Russia altogether, or it can bring it down to, say, something like 10 to 15% or 20% and increase imports from countries like United States, Middle East, West Africa?
Yeah, so see, if there is a very definitive big sanction tariff, then possibly India could reduce the proportion of the Russian crude. But what is also pertinent to note is that in case the Russian crude is, entirely priced out of the market because of sanctions or whatever reason, that accounts for about 7% of the global crude and petroleum products consumption. So where will the prices go? So that is the other factor. But yeah, in case we decide as a country to cut down the crude, there are several other options as well.
There are other options as well. If I can get you in, Gaurav, once again. Now, India has been diversifying its crude import basket. Overall, what kind of pressure would India be in terms of Russian crude oil being wiped out from the market, India not being allowed to buy Russian oil altogether?
If you look at the last 10 years or 15 years or 20 years average, we bought enough crude from so many countries. The percentage of crude sometimes has gone much higher from West Asia, sometimes from South America, even Africa. So it's not that we've not been in these kind of situations. Even if one portion of the crude supplies get completely wiped out, if at all, there are enough options in the market for us to keep feeding in the crude requirements. Having said that, Parikshit, what I would like to bring to the table is that India still imports more than 80%. At some point, it even got to 85, 86% of the crude requirements. In doing that, we are still hitting a very large import bill. Having said that, the current government, Honorable Prime Minister, and even the MOPNG Minister are opening up the Indian markets for much more exploration and development activities for extracting oil from India's own oceans, whether it's the Bay of Bengal side or the Arabian Sea side. So I, in fact, see an opportunity which could be a win-win, where a number of the Indian Bay of Bengal areas have been opened up from no-go zones to open ENP zones, where there is opportunity for US and India to, in fact, collaborate to search and extract that oil, which may be beneficial for both markets. So this could actually be an opportune time to do both, not just thinking short term, that how do we diversify and take care of our immediate needs, but also to really extend hands with each other and do much more together.
Right. Prashant, if I were to ask you, now we've been learning from sources that India's crude oil and energy imports from US have more than doubled in FY26, and Indian companies are likely to increase their crude oil imports from the United States by 150% year on year in FY26. If we speak about this full fiscal, what do you think would be the value of our imports from the United States? At the start of this year, Foreign Secretary Vikram Misri had said in February that India is likely to purchase $25 billion worth of oil and gas from the US. Would there be any estimate that you may have as to how we may finish the entire year in terms of our purchases from the US?
So yeah, certainly to reduce the budget deficit, to reduce the trade imbalance or the surplus that we enjoy with US, possibly one of the levers is to increase the energy purchases from them, including LNG and crude. I would not be able to pull out a number, but currently we are at about 6 to 8%, and that number can significantly increase. Additionally, a lot of our oil and gas companies are also looking at long-term LNG. And as we speak, US, there are about 6 to 7 projects that are coming up in the US. And US LNG being Henry Hub priced is quite attractive vis-a-vis the Brent priced LNG these days. So a lot of our companies are seriously looking at LNG deals with the US companies also.
Right. What happens to the long-term contracts with Russian entities? If I were to put that question to Gaurav, what happens to that in the wake of sanctions? This month, we have seen a drop in imports from Russia, but it's still quite high in the range of 35 to 36%. Going forward, what will happen to the long-term contracts if by Friday Donald Trump does announce those secondary sanctions?
Actually, it's difficult to comment on long-term contracts which are one-on-one, government to government, or company to company on current basis. We'll have to get into details on evaluating what are the inbuilt penalties for such long-term contracts, or what are the flexibilities in providing volumes on such long-term contracts, immediate versus near future. So it may be a question of playing the balancing act on long-term contracts wherever applicable, but difficult to comment directly at the moment. Having said that, Parikshit, what I would add is that this mutual win-win, which even Prashant spoke about, is generally possible in the energy sector for US and India. I spoke about the E&P aspect already. Prashant spoke about the gas, the LNG aspect. There is also the third aspect around renewables, electric vehicles, exchange of technology, and market access to all of that. And there is a fourth angle as well, where India is growing in terms of its need for data centers and data available within our national sovereignty. Number of US technology majors are buying that market into India. So I think there are multiple options on the table if we look at it as an energy win-win versus just oil in particular. There is enough to play around with.
Right. Thank you very much, Gaurav, Moda and Prashant, for joining us. So clearly an uncertain situation, but the answer would be diversification of crude imports, which India would be doing over the next few months. So we will have more long-term contracts with the US, but that doesn't mean the US can be the only supplier. We will have to ramp up significantly with the Middle East, from West Africa and other nations as well. We're taking a short break, but coming up, Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. A special conversation with Pham San Chao, CEO of VinFast Asia, on the company's India plan. Stay tuned. Welcome back. You are watching News Center. Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. The company's first overseas plant is expected to generate over 3,500 jobs in the next 5 years. It is part of a 16,000 crore rupee investment pact inked between VinFast and the Tamil Nadu government. I caught up with Pham San Chao, CEO of VinFast Asia, and began by asking him about the company's investment commitment in Tamil Nadu.
We have a long-term commitment to invest in Tamil Nadu. We made a commitment during the summit, investment summit in Tamil Nadu last year, and our commitment is 16,000 crore. For the first stage is 4,000 crore in Tamil Nadu, and we have spent nearly half of that on this factory in order to make it happen today. So this is the first stage of our plan with 50,000 capacity per annum, and we are going to scale it to 150,000 car eventually, depending on the response for the market. But we are very optimistic about that.
Right.
And
now you've got the VF7. Yeah, you've got the VF7 and VF6 coming up, and they will be manufactured at this facility. When does the commercial rollout begin? You've been inaugurating showrooms across the country. When does the sales officially begin?
Actually, I have opened a few showrooms in Surat, in Chennai, and eventually in other big cities like Cochin, Hyderabad, Bangalore, Kolkata, Delhi, Mumbai, Gurgaon, and we are going to launch the car eventually in few days, in which we are going to announce the features of the car and we announce the price. Then after that, we already opened online pre-booking. We have very impressive reservation, and after we announce the price, we start delivering the car to our dealers. Our customers, because next week we start delivering the car to our dealers already.
Right. So next week you start deliveries to dealers. When can the customers expect it by?
So basically, the customer can receive the car end of this month or beginning of next month. So this is very positive. Now we are working with the state. We have received already the CMVR homologation certificate from RI. We have RI representative coming to attend the event today, and he hand over the certificate for me. And now next step, we work with the state level in order to get another certificate at the state level. So we deliver the cars to customers.
Right. Could you also give us a sense of how many showrooms do you target in terms of launches in India? How many showrooms by the end of this year and end of next year?
So we have signed agreement with 13 group of showrooms, and we are going to open 35 showrooms in 27 cities. At the moment, more applications are coming in. Many potential dealers are calling us to express their interest. So in this one, we are going to open a few dozens more. And until the end of the year, we hope we have 35 showrooms in 27 cities. And after that, we will scale up more.
Okay. I would also like to ask you whether the company is looking to take advantage of the scheme for promotion of manufacturing electric cars in India. That portal has opened up. Are you looking to apply to avail of some concessions through the scheme?
It depends on the schemes. For the old schemes, which I don't remember the name of the scheme, but the scheme that we have been working for quite 1 year with the Ministry of Industry is no longer available to us. That scheme is going to apply only for any OEM which have not made any investment in India, which don't have the factory in India. We, VinFast, have already the factory in India. We start rolling out our first Indian-made car, and we start delivering the car already. So it's no longer available for us. But other scheme, we are ready to look into that and ready to apply for the incentive from the federal government.
Right. But how do you see the electric vehicle ecosystem in India, the regulatory ecosystem? What would be your ask of the government?
So basically, we asked the government that now over the past 1 year, the two sides have been in discussions, and now you came up with a scheme, but the scheme is no longer available for VinFast because we already opened our factory and we roll out already. So we also put a request to the government of the center government to allow us to import 2,000 cars for taxi, which is under the new reduced basic import duties as an incentive for us. Because the car that we are going to import for our GSM operation is not the model that we are going to produce into Tuticorin yet. So that kind of scheme or incentive, we are requesting the government for the time being.
Okay. My final question to you would be, how do you see the competition in the India market from domestic EV players and also Tesla, which has now entered officially?
We believe that India is a very potential market. It's a growing market, emerging market. That's why it is a strategic market for us now. Therefore, we decided to move here very massively. That's why we have been able to build this factory within a span of 15 months. Within the 15 months. That's why we continue to do the same thing in the future.
All right, let's move on and get you some news from the telecom sector. Bharti Airtel's digital arm, Xtelify, has launched a new sovereign cloud service platform and an artificial intelligence-driven software suite for telecom players in the country. Ashmit Kumar caught up with the company's MD, Gopal Vittal, and began by asking him about Xtelify's new offering to customers.
So Xtelify is a 100% subsidiary, and it has all our 3,000 engineers work in Xtelify. All our digital applications are part of Xtelify. All our investments are now housed there, and we run one of the largest instances of our cloud, which has over 250 petabytes of data stored. Everything that we run runs off the cloud. We're extending the cloud because it's a telco-grade cloud. It's reliable. We also believe there's a need in the market for lowering the cost of ownership. We have heard that from many CIOs who have that as a pain point. And so we're now extending this cloud to them. In addition, we've been using a bunch of software platforms which we developed. They're homegrown software platforms for our own business needs, which deliver us improvement in business outcomes. We've also extended those software platforms to other companies in the world. We've already won 2 contracts, one with Singtel and the other with Globe. Of course, Airtel Africa, Indus Towers, the bank, our bank, all of them are already taking these platforms.
From a sectoral outlook, I know you're not sharing specific names of companies that you're in conversation with. From a sectoral outlook, which are the companies that you think can stand to benefit, that you can partner with going forward on the cloud under Xtelify?
On the cloud, anyone who is looking to move to the cloud, or anyone who's looking to save some cost on the cloud, anyone who's looking to actually have a more sovereign cloud where the control plane resides in India, which is DPDPA compliant and is regulated, all of them would be target.
From your conversations, any particular sectors that you're focusing on? You mentioned banking.
At this point, we're talking to all. So the way we look at our business, we look at banking and financial services, we look at manufacturing and distribution, we look at technology companies, and then we've got the small and medium businesses. We're talking to everyone. Within this, there are about 50, 60 customers who've expressed great interest. So I can't announce it because they haven't given us a contract. So it won't be fair on them more than anything else.
Just one final question. This is clearly a commercial venture. You're not sharing numbers right now, but from a slightly mid to longer term perspective, what is the kind of revenue split that you'll want to look at between the telecom business and the cloud business?
Yeah, I think that would be premature of me to answer. But I will say this. This is a large investment we made. This is a very credible and meaningful initiative for us. And if we don't make this work well, then obviously we'll be disappointed. So hopefully, a few years down the line, this should be a sizable revenue stream that we generate.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC-TV18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chenoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to, and hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest